Luxury space, at least there may be a read across from a shared drop coming through from Coty, which is the fourth quarter results coming through, and an EPS miss. So we're watching the luxury space. JD Sports, interesting in terms of the subdued outlook. So they're cutting their profits outlook. Subdued demand for trainers, apparently, from JD Sports. On the upside, Novonesis coming through with a beat. The biosolutions company, so watching Novonesis on the back of that, that could see a bit of a move higher in that stock going.
I'm going to need a new pair soon, so maybe that'll move the dial. Okay, here we go. Let's talk about where we are with these markets. Let's talk about kind of what we're anticipating in terms of this open. Equity markets in some ways were left out of the move yesterday. Gold moved, the bond market moved, the dollar definitely moved yesterday. Big move in euro dollar. That was certainly one that stood out yesterday. This morning, bond markets a little calmer. Equity markets, though, remain calm. Maybe kind of caught in the headlights. Maybe that's the better way of looking at it. Let's take a look at what we've got then. Let me show you some numbers. We're not expecting much. FTSE's slightly negative. We're expecting other markets to be slightly sort of more positive, but either side of the flat line, no real clear sense of direction. We've just been drifting lower and lower over the last few sessions when it comes to European equities, and that kind of feels like maybe the trend is going to be hard to break today. CAC not yet open. The AEX will be interesting on the back of what we've seen in maybe out of some of the chip stocks in Korea. But if the chip stocks are spending money on buybacks, are they spending money on kit? I don't know. Tom seemed to think that maybe we would be seeing them be able to do both earlier. So the AEX is up by less than 1/10 of 1%. The IBEX is down by less than 1/10. I've got nothing. Tom, over to you.
It's a subdued session. We've got so far. We've got six sectors in positive territory right now. The best performance coming through, at least for the moment. Autos, interestingly, is up 0.7%. On the downside, the biggest losses coming through for travel and leisure, currently down 0.6%. Could be down to a continued grind high in oil prices, $92 a barrel right now on Brent, up 0.7%. Retail also under pressure, down 0.4%. So yes, on the upside, autos leading with gains of around 0.9%. Tech is also pushing through with a little bit of modest, very modest upside of 0.2%. And again, travel and leisure down by 0.7%. The biggest losses, at least for now, for that sector, Guy.
Let's quickly just have a moment on euro dollar, because I don't think this kind of feeds into the narrative that we're watching unfold at this point in time, whether or not it becomes a slight headwind. If the dollar does continue to move lower, how does that change the outlook in terms of what Europe is dealing with right now? In some ways, it deals with some of the imported inflation aspect that we're watching, but how does it translate into corporates? It's not a big move, but there was a decent leap yesterday. We're 116.85 this morning.
Yeah, I mean, it's feeding into the pound as well, and you're above that key 136 level there, 116 in euro dollar. It's definitely a bigger reaction in the FX market than what you're seeing in bonds. So gilts yields are down a little bit, but it's very much following the trend of Europe, where it's a subdued reaction to the 10 basis points decline that we had in 30 years on the US side.
Okay, let's try and get some sense as to what is happening here. Benny O'Connell, partner and portfolio manager over at Diamond Asia Capital, joining us around the table. Good morning.
Good morning. Good to be
here. Were you
here.
surprised to see stocks moving as little as they did yesterday on the back of the Besant move?
I was, really. I think that there was a lot of discussion in recent days that higher long end of rates was really depressing stocks, keeping a cap on things, and so then to see that reversal and not follow through in equities was a surprise. I think we saw anecdotal evidence that there was a considerable bit of pain and unwinding going on in hedge fund books, both on the discretionary and the quant side, so I don't know whether that was a factor yesterday.
In terms of where we go from here, does this stop the train being high yields, And where does that ultimately manifest the most in terms of its significance?
So I think I would concur with the consensual view, which is this is a short-term reprieve. Positioning it got quite extreme, but really doesn't change the dynamics in terms of longer-term deficit spending. Arguably, with midterm elections, there's a potential path whereby actually spending could increase even more as the Democrats look to negotiate with Republicans about getting more of what they want on things like Medicare. So I don't think it changes the long-term trajectory. It's just a short-term tactical, I think, reprieve.
And are there implications for other bond markets, or is it very much U.S. focused? Because we've had a more subdued reaction in Europe and the U.K.
I still think directionally for all the major global bond markets, direction of travel is going to be higher yields over the long term. The deficit spending issue we're seeing in the U.S. is not, as we know, unique to just them. Germany, for example, is going to continue to push down that path. France, very difficult to see how it kind of changes the direction of travel there. So no, I think it's a broader issue that's going to persist, and I don't think the sort of things we saw yesterday are necessarily long-term structural game changers.
Earlier this week, equities were under a bit more pressure as yields rose, potentially because term premium is rising without growth also rising. Are you worried about that kind of yield rise, or if it's deficit motivated, is that more concerning for equities?
I actually haven't been as worried as some in terms of the recent rise in long-end yields. I think it's been, as you said, a bit more term premium driven, a bit more about real yields moving higher. When I get concerned is really two things. One is because the market is signaling there's some concern of some imminent policy issue or inflation issue. And secondly is when rate volatility is just at a very high level. Rate volatility actually is at a very manageable level if you look at it right now, and actually came down after the moves yesterday. Inflation, although we've been talking about it for a while, doesn't, apart from Europe, where we can come and discuss that. I think there's a potential issue there on the energy side. I think generally, broadly in the US is a big concern of now.
Does this action drive the dollar lower? And if so, do US equities become less attractive on weaker dollar?
So dollar lower, definitely. I think this is reinforcement of a signal that trend can persist and continue. And I think if you see on the equal weighted dollar index a break, which we haven't had yet, then you'll see a lot of money jumping back onto that trade in terms of dollar weakness. How does that flow through in terms of the U.S. equities? I think for me, it's less of an issue because really the U.S. market is less about exports and the story is really more on the AI side where the dollar sensitivity is not as impactful.
And Guy touched on euro dollar. So for European corporates, where does that land?
I think it's more impactful for euro because I think before yesterday, consensus was moving very bearish on euro, for the coming months. And again, considering the energy and winter potential issues, I think this dynamic now gives a bit more balance to the debate. I don't think it suddenly is going to mean the euro goes on a massive tear. So I wouldn't be concerned, again, from an equity perspective, that it's something we have to really factor in and change dramatically in the models. But it definitely changes the direction of travel versus expectations.
Bernie, do you think the hedge funds have got a handle on what's going on right now? You talk to a lot of people. How confused is everybody out there? I come in on a daily basis and I try and figure out what is happening in the world. And it's really hard. I genuinely can't remember actually it being harder to understand what kind of the dynamics all mean and ultimately where they are going to show up, manifest themselves in a meaningful way further down the road. What are they doing? How are they thinking about the challenge in terms of what they face right now? They're getting pushed from one side of the boat to the other. Leverage is coming in and out. What are they telling you?
Look, I agree. It is a very difficult, challenging time. I would say generally, I think actually it's been quite impressive, the performance of hedge funds across the board. I think what you do see is, though, there's different behavior and performance in terms of the mix. So the ones who kind of thrive on this elevated, short-term volatility, have a broader diversification across what they do, they tend to do a bit better. I think having a focus whereby you're relying upon being able to predict with high conviction what's going to happen in the next 12 months, that's very difficult right now. There's so many moving forces. And generally markets, I think, struggle to focus on more than one or two key topics in their decision-making. Yeah. We have how many topics to think about right now? So, yeah, look, it is difficult. It is difficult.
You alluded to an inflation problem in Europe earlier. What does that look like?
So what I'm concerned about specifically as we head into the winter is two things. First is that gas storage levels are very low relative to history. So I think maybe 15-year lows, and about 15 or so points below where you'd normally be at this point in time. I think it's not necessarily alarm bells ringing quite yet because of the weather forecast and for the next couple of months. But we could get there if suddenly you go into a cold snap or period. So the gas situation, I think that's the first thing, and spot prices of gas are double where they were last year. And maybe just to also reiterate, like UK, Italian, retail, consumer, household, utility, energy bills will get affected by that if that manifests itself in the next few months. The second one is really refining, which I think has probably been talked about a little bit less, whereby refining margins are at record highs effectively. And the problem is that whilst this conflict persists, we're not getting the reversion that many of us expected, and that will continue to feed through in terms of prices at the pump, and actually also in time in other areas of inflation, because there are some pockets of the economy, if you think about, for example, in Southern Europe, where actually industrially they use diesel and some of that input for energy pricing.
Do you think the AI story continues to overshadow the energy story? And what is your preferred AI trade right now?
In Europe, it does overshadow for now, but as I said, I will be keeping an eye on this as we go into winter. My preferred trade is to think about how it evolves as we move into token cost deflation. It's already happened a lot, but it's going to continue to happen further. We're seeing not just the Chinese labs, drive that, but also the American labs move and cut pricing across the board. So what does that mean? I think that means thinking about people who can benefit from more than just pricing. So far it's been a lot of areas of the value chain whereby there's been tight supply demand, you benefit from very high pricing, high margins. I think going forward is about where does that sheer surge in volume benefit? And so that can mean companies, whether it's on the hyperscaler side, whether it's on the semi side, whether it's on the industrial side, whereby it's more about operating leverage and volume rather than price.
Just quickly, so you wouldn't buy Anthropic?
Can't comment on specific ones, but I would say, generally, the community is getting a bit more concerned about frontier labs.
Okay, that's quite a big statement. I can't let you go without telling me where to have dinner. Give me a restaurant recommendation.
I hope you've been to some of the recent ones that I mentioned before.
We have. But there's been a lot of kind of shortage. There was a lot of shortage for a while.
I'll give you a non-shortage.
Now you're moving.
Should we give some context to this?
So for long-time viewers, you know that this guy has what is it? Restaurant at Bernie's?
Yeah, so I write a newsletter on LinkedIn called Weekend at Bernie's.
Weekend at Bernie's.
And the end of the newsletter has a brief restaurant review. Yeah. Basically, I just love eating. I'm eating out in London all the time with my family and friends. So the one I'd be recommending very highly at the moment is Impala in Soho, so it's not shortage.
Yeah.
Pretty new. It's cooking over the fire. You have a lot of Egyptian, North African influences. Very buzzy atmosphere, great service, just all around, good place to go.
Weekend at Bernie's, there you go. Sorry, restaurant at Bernie's. How did I? Easy mistake to make, but big one.
Next time.
Well, no, we'll keep you coming back and get those restaurant recommendations. Bernie Kong, Diamond Asia Capital Partner and Portfolio Manager. Okay. Let's talk a bit about where we are with the market this morning. This is the story that we find ourselves with in terms of the Core 6. You are seeing ASML catching a little bit of a bid. You've seen a better bid coming through from some of the Asian chip makers overnight. Schneider's also up. But elsewhere, it's a pretty tepid performance. Defense stocks are down. Even Nestle is a little lower this morning. Novo's down. Big move yesterday, obviously, on the back of the RNA story. And we continue to watch that with great interest. But let's talk about some of the other market movers we are watching. Novonesis is first on Alex's list.
Well, Guy, it is. You can't do that to me. I've not had breakfast yet. All that talk of food, you've got me, my stomach rumbling. All right, but let's look to the movers then. Novonesis, up as much as 11% this morning. That's off the back of that raise in the full-year outlook, but also announcing that major share buyback. This, of course, is the biotech firm. It was dairy products and high-protein products really giving them a lift. Currently up around 8%, excuse me, 8% and in the green this morning. Let's turn to JD Sports. Very different picture there, down as much as 10% this morning. This was after they cut their profit, more than 10% now, after they cut their profit outlook. Weaker demand for trainers in the United States, seeing as really hitting the sports retailer. They are far from their 2021 peak when, off the back of COVID, athleisure wear really was a buzzword. You can see Sports Direct suffering from that. They're also suffered from some supply issues with some of their main suppliers like Nike. So down around 10% this morning. Let's turn over to Aegon. They are also down this morning. The insurers announced the departure of the CFO to be replaced by spring next year. Despite some of the good news the company had, analysts were saying that could create some near-term volatility. You're seeing Aegon down around 3% this morning. They're holding that shareholder meeting in October, talking about their move to the United States. And finally, let's finish with Trainline. The conversation yesterday about that 17% drop. They're still down today, but around 4%. That's off the back of an announcement from the watchdog in the UK. They're looking into the pricing practices known as drip pricing. So Trainline also in the red, but Novonesis really the one leading the pack at the front in the green, as much as 11% this morning.
Alex Morgan, thank you very much indeed on some of the stocks on the move this Thursday. Coming up, following the US Treasury's plan then to buy back longer maturity debt, we're going to discuss the outlook for markets with JST Advisors founder and CEO, John Turek. That conversation is coming up next. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Sorry. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
17 minutes into the Thursday opening trade. Let's check in on the markets then. Across the benchmark, you're flat. You're seeing losses in the UK. The FTSE 100 is currently down 0.2%. Basic resources, after gaining as a sector yesterday, currently amongst the biggest losers. The DAX is currently down 77 points. Over in France, the CAC current flat as well. And you're seeing across the benchmark again, largely unchanged after 6 days of losses, Guy.
Euro dollar 116 and change. In terms of what we're seeing in the bond market this morning, you are starting to see a little bit of a shift, actually. The US 10 years just turned positive in terms of the session. You're getting quite a big kind of U-shaped story this morning. It doesn't look quite so U-shaped on a longer-term chart, but you are back to seeing Treasury selling this morning, at least at a 10-year tenor. Let me just see if I can actually just change the drop down and get to the 30-year, just give you an idea of what's going on. It's a similar story. So, yeah, 519 is where we're trading on a US 30-year. So stabilization maybe is probably the best picture to describe what we're seeing. Big moves yesterday, though, obviously after Scott Bessent, the US Treasury Secretary, unveiled plans to buy back longer maturity debt. This came out of kind of left field. The move comes, of course, after we've seen global bond markets jolting higher in recent days, investors demanding greater compensation for the inflation risk and the deficit risk and the kind of the long-term trajectory risk of government debt in the United States. John Turek, CEO and co-founder of JST Advisors, joining us to discuss. John, what does this signal about how worried Scott Bessent is, the US Treasury Secretary, about these longer-term yields? This came out of left field from my perspective.
Yeah, no, I think you're totally right. I think what's interesting is that we had this announcement sort of 2 weeks before we had, after we had a refunding announcement from the U.S. Treasury. I also think it's noteworthy that sort of this announcement came in a context that it was really just a yield move that was pressuring markets. There was no dislocation within Treasury markets per se, either looking at swap spreads or sort of off the run, on the run bond spreads. So this was just kind of, I think, Treasury Secretary Bessent laying a marker down that he was uncomfortable with the move in long end yields, and it was much more from a level perspective than sort of a Treasury functioning market perspective.
What if this is a short-term band-aid, as we've been describing it maybe on the show this morning? What is the longer-term solution to the problem, to the question that the bond market is asking? Is it that the Fed reacts and we see the Fed kind of getting control of inflation? Is it that the US government decides that actually maybe we shouldn't be cutting taxes, we should be hiking them, and maybe we shouldn't be hiking spending, we should be cutting it? What is the longer term story here?
Yeah, I mean, I think the longer term story here is that the market is dealing with a pretty immense imbalance between savings and investment. And right now, there is a huge call on global savings that from a pretty price insensitive sector, and now we kind of compounded that, right, where we've had this 3 or 4 years of increased fiscal spend globally. And now we've kind of compounded that with sort of hyperscaler issuance and sort of the AI CapEx story. And both of these dynamics in the market are very big sources and have very, very big needs for global capital. And I think the question sort of, in light of, inflation above target globally as well, is sort of what's the risk premium that the bond market should demand for sort of funding, both of these pretty material, investments. So I think the question, even outside of the Fed, I think is sort of how do we sort of right size the imbalance that's sort of taken place now between investment and savings. And I think it's a much more longer term question. I don't think it's one that's going to be solved with tactical moves. But I do think that, given the context of this tactical move and the potential signaling effect of it, I do think it is quite significant.
I do wonder if the consensus is that you have pressure on bonds regardless and you just have a price path higher for yields. Is the U.S. Treasury defending 475 on the 10-year? Do you just get more and more buybacks? Presumably there's a limit on that.
Yeah, no, there's certainly. So, I think the interesting thing now is going to be the tactics around this move, because my feeling, and speaking to clients sort of following the move yesterday, is that you would assume that there's going to be follow through. Is this not just going to be a one-time thing, clean the shorts and then, next story? I mean, I do think that this, is going to be in the context of a battle now between, Treasury and the long end of the bond market, which is still in a structural trend weaker, higher in yield. And I think sort of the question is what is the next move? There's, a lot of different things that Treasury Secretary Bessent can come up with to sort of cushion the move. We saw the buybacks. I no one really had that on their bingo card for yesterday. So I think that's one. I think the question, as this kind of goes on and what the scope of this intervention ultimately is there is going to have to be this balancing mechanism between the front end of the curve and the long end of the curve, because to do these buybacks, they have to issue more bills. It is a little bit of an operation twist, if we remember from the QE days, because obviously the Treasury runs a big deficit. So, to spend more money, they have to raise more money somewhere else. So does that eventually leak into bills pressuring front end rates? Does the Fed have to respond to that? Does the Fed respond to that with, as we saw last year, with reserve management purchases? So I think that there could be a lot of tension on a go forward basis if this is sort of the beginning of something more material in terms of financial repression, long end repression, whatever nomenclature you prefer.
So, John, how do you think the Fed does respond to that? Because the markets are betting that there's less of a likelihood that they hike rates now, and part of that may be down to the minutes, but part of that down to this operation as well. They've pushed out those expectations. Is the Fed less able to address inflation risks if there is more issuance at the front end?
Yeah, it's a good question. I think that there's two ways to look at this, because the first way is that so much of the hold in July was conditioned on this idea that financial conditions were tightening from long end real yields going up. And Warsh, even in his press conference, sort of noted that this was, quote unquote, the market doing the work for them. From a intellectual perspective, it's easy to say that yesterday's move kind of undoes that in a way. But I don't think it's a clear read for what it means for the September meeting, because in the context of this result, we've also had data that's kind of leaned in the more dovish direction in terms of the inflation and non-farm payrolls we've gotten so far in August. So I don't think it's clear, what it means for the Fed. I don't think this is something that they'll address. But I think given that they've conditioned a little bit of, the reaction function we have in terms of, real yields doing some of the work for them, which was something that was pretty clear in the July presser, I think it's going to be something to watch, sort of how they interpret this. But I'm not sure it's a clean read on what this means for September in either direction.
Where do you think it shows up the most? Obviously, we've seen a big market reaction in the bond market. Equities less so, but a big market reaction in the dollar as well. Where does this kind of show up, do you think, next?
Yeah, I think the dollar is really the place to watch here, because what, functionally I think this does in a sort of textbook, financial repression way is you're moving one imbalance to a different asset price. And the way that this should leak is if that, long end real yields are not able to sort of equilibrate in the way that they quote unquote want to, that will have, a lot of positive influence on financial conditions, which should leak through predominantly the FX side. And I think that that's sort of the place to watch here. I don't know that it'll be sort of this like straight line. I think the market got very excited yesterday. This is sort of like some introduction of QE. I don't know if it's, to that extent yet. But I think you have to be cognizant now that the tail on the dollar has gotten bigger, because, if this policy does have a go forward basis, and it's one in the context of the Fed not hiking, I think it's the dollar is really the cleanest outlet for that.
Okay, John Churek, really appreciate your insights this morning, CEO and co-founder of JST Advisors. Switching focus, coming up, the UK tech startup which has raised $100 million in early financing in a bid to break the Nvidia monopoly. We're going to speak to the co-founder of Colossum. That is next. This is Bloomberg.
Wanted to say, Primer is back.
We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jelana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Happy Thursday. We are 30 minutes into today's session. Across the benchmark, you're seeing losses of 0.1%. If this continues, it will be a 7th straight day of losses for European equities, with the context, of course, that we are in the middle of August and volumes are pretty light. The DAX is currently down 109 points. The CAC current over in France is off by 0.1%. And the FTSE is just at 10,718, just down 0.2% so far. We're going to break some news for you on the central banking side. Sweden's Riksbank decision coming through. The central bank, keeping, as expected for our own economists, rates on hold at 1.75%. The estimates were for that hold, of course. You're looking at the currency largely unchanged on the back of that move. We are focused on guidance and expecting, our team of economists expecting some guidance around the inflation risks, of course, linking to the Middle East. Guy?
Yeah, probability of a rate increase later this year remains. That's the line that maybe ticks that box on the guidance front, Tom. Let's talk a little bit about where we are in terms of the market internals. 254 up, 333 down. I'm not sure there's a clear sense of direction for European equities this morning. Volume is light once again. We remain in mid-August. Let's talk about precision engineering. Sartorius raised this morning at UBS. Market reacting fairly positively to that. So we'll keep an eye on what is happening there. Michelin upgraded at JP Morgan. Market likes that as well. We're up by 4.4%, 1.9% on Sartorius and Michelin. Swatch is up this morning as well. A little bit of a pick, actually quite a decent pickup in terms of what we're seeing in terms of watch exports to the United States. We're up by nearly circa 10%. That is lifting the Swatch story quite nicely. Swatch up by 2.73%. There's some downside this morning. Apparently sneakers, trainers, call them what you will, under a little bit of pressure. JD Sports Fashion down by 12% on the back of that. We spoke to the Aegon CEO a little earlier. Market's not keen on the CFO exit. Remember, this is a business that is transitioning to the United States, and that plus a few other factors drowning that stock a little bit, down by 3.4%, 3.5%, and Orkla down by 6.54%. But we're reasonably balanced, upside, downside. That seems to be the narrative. Equity markets, once again, kind of going sideways. Up or down, we'll wait and see what the end of the session produces. We've been drifting lower over the last few sessions, Tom.
Okay, here's what else you need to know this morning. President Donald Trump has announced plans to inflict what he called an economic economic D-Day against Iran. Trump didn't specify what measures he would take, but his threat to target Iran's trading partners, none of which he cited by name, puts an immediate focus on China, which buys the bulk of Iran's oil. Total U.S. public debt has surpassed $40 trillion for the first time, with a surge of a third in less than 5 years. The news came hours after the Treasury Department announced it's ramping up a buyback program for longer-dated securities to rein in long-term borrowing costs for multi-year highs. Samsung and SK Hynix are preparing record shareholder returns after investors sent their stocks tumbling over concerns around the sustainability of AI hardware spending. According to reporting from Money Today, Samsung will soon announce a plan worth more than $72 billion, and SK Hynix already unveiled its plan to buy back $29 billion of stock, with JP Morgan saying the company may follow that up with additional returns worth at least $130 billion. Guy?
Let's pick up on that and talk to Neil Campling about what we are seeing here. Good morning. What's the signal? What are these companies telling us? The stock prices have obviously come down fairly sharply. We've bounced a little bit. Are they telling us they think their stock is undervalued? Are they trying to lift it further? What's the message?
There's a couple of things going on here. They are telling us that there's a lot of free cash flow they're generating now and expected in the future. We have to give some context to this, in that, don't forget, in June, Samsung were facing this labour strike, and there was a 90 trillion won package, basically, of buybacks expected to cover just the bonus payments for employees. So and Samsung have said basically on their earnings call recently that they will detail when it's right timing and regulations, etc., about what the best efficient use of the capital is. Both companies, though, are basically paying out about 50% of free cash flow. So, if you like, Samsung's saying whatever Hynix can do, we can do more.
That's the message.
That's the message, especially when you know these two companies are obviously significant rivals, and Samsung is the biggest of all out in Korea.
Alibaba is re-emerging as a favorite tech stock. It highlights the kind of U.S. versus China divide, and they report earnings later today. What do you expect?
The stock has risen 35% this quarter. As you mentioned, it's been very popular, been very positive. They've had 12 quarters in a row of single-digit revenue growth. So, are we going to get a double-digit growth number? We kind of need that. The Street's at about 8%. That needs to kind of come through. It's all going to be all about QuenWork. QuenWork being their AI, the AI which they have is almost at the frontier AI performance at a much lower cost. Is that going to translate into accelerating growth? That's what we need to see. If it comes through this quarter or it's too early, that remains to be seen. And we've seen the likes of Tencent and Baidu in terms of the price reaction to their stocks recently has been negative because they haven't seen the investments in AI paying off yet.
Okay, Neil Campling, thank you very much indeed, breaking down what we're seeing in terms of the buybacks and the proposed buybacks over in South Korea, and looking ahead to Alibaba. We'll stay on the AI story because UK startup Colossum has raised $100 million in early financing from backers, including the UK's sovereign AI fund. The company is attempting to break the AI monoculture with software that can match various AI workloads to the models and chips best suited to them. Colossum co-founder Daniel Akaraka joins us now. Dan, congratulations on the raise. Just expand on that then. What is the proposition? What is the problem that you and the team are trying to solve?
So, firstly, thank you. It's great to be here this morning. So taking a step back for a moment, obviously AI is exploding right now, and fundamentally the fuel, the engine behind the growth of AI are chips. And it's a very exciting time because there's an explosion of new chips that are coming to the market right now. Many countries are building their own chips, and these chips are very specialized for different use cases. They have pros and their cons. So some chips are very energy efficient, some are very fast, and it has led to a very interesting dynamic where end users and companies really just want to have the best AI that's faster and cheaper than it is today. And really that calls for a company like Colossum that is chip agnostic, that is global, that is able to take AI systems and to be able to optimize them for the right chip. And this is why we're so excited. We've shown that we can make AI systems faster, better, and stronger by utilizing these combinations of chips. And so we're super excited with our $100 million seed round in London to scale globally and to partner with many exciting new chip companies.
Is this also about breaking the grip that NVIDIA has right now?
So, kind of, as I mentioned, from our perspective, really, the best AI systems really for end users are ones that use combinations of different systems. Inherently, that means partnering with a large range of different players. NVIDIA have amazing systems. We collaborate very closely with NVIDIA right now and are super excited moving forward to do more. But we're also excited to announce our new announcements of our partnerships with Cerebras, for example, who are bringing incredibly fast inference chips to market, in addition to others like Rebellions in South Korea.
Does that mean we're going to be building data centers with multiple different types of chips in them? And then your system basically goes, I can use that for that, I can use that for that, and I can use that for that.
That's exactly right. So inherently, it doesn't necessarily have to be in one data center location. It could be over several different locations. But ultimately, what we found is that you can get efficiency by using those different chips. And that's purely for the simple reason that different chips have different benefits to them.
Characteristics.
Exactly. And so you can get efficiency by being able to scale the number of these chips. That's one way. The other is through what we call heterogeneity, by utilizing the different properties of those chips. And with our software, we can actually extract the benefits of those chips.
One of the big things that is being talked about in the industry at the moment is effectively the sort of securitization of chips. One of the things that comes with that is we need to understand the kind of the lifespan of chips. Does this mean that kind of older chips actually have a role to play? Because you can go, okay, that's not the most cutting edge, but we can keep it and we can use it because actually we can kind of downgrade it and use it for something else.
Totally, and we're already seeing that happening right now. So actually many of the older chips available on the market are doing incredibly well. And that's for a few reasons. One of them is that we're finding that there's actually many different models that can be used to run economically viable workloads. And some of them can be quite small, those models. And as a result, you can use these kind of older chips really well. That's actually part of what we're working on significantly, is how do you extract performance from older generation chips so that they can have longer lifespans, and how you can ultimately run them to be far cheaper and more energy efficient.
Chips are also something that governments have kind of protected within a country. Does that mean you have more sovereignty over how AI is used?
Yeah, exactly. So in the limit, this is a way in which you can build AI systems using a combination of different chips. What that does is really a kind of a great future for AI. Ultimately, it's democratizing the infrastructure in which we can build AI systems. We are very proud to announce, obviously, a funding round and the first investment from Sovereign AI in London, in the UK, and really kind of sovereigns and governments are finding that's incredibly important to them. If you can widen the access to your supply chains, that gives you increasing leverage, it gives you increasing options, and is one in which you're not kind of bottlenecked by any one single provider.
And it's about not being dependent on not just the chips, but also the models as well, right? So, and we're seeing this price pressure on tokens, so a price war. And we're seeing that, and China's been part of that, the open source, of course, the open weight models there. Where are we in that journey? Do we get commoditized? Where do you think the trajectory is for token pricing?
So I've just outlined kind of on the supply side, I guess, on the chip space, which is going increasingly heterogeneous. But you could also say the same on the demand side. So on the demand side, with the models, they're also becoming increasingly heterogeneous. What we're finding is that actually how AI is really used has changed. So people used to think that you would run everything, all of your tasks, through one big model. Right, and that was kind of the main vision that we'd had over the last few years. What we're really realizing now is that tasks actually are much more complicated than that. In reality, you can actually break tasks into subtasks, and as a result, you can actually use many smaller models to be able to do many of the most economically viable work. And yes, you can actually make that could be a lot cheaper to run, and also by optimizing those models to the correct chips, you can get even greater performance, and that is really amazing for token efficiency.
I do wonder, we're spending loads of money on AI infrastructure. If we become more efficient, is that just not needed?
I think there's two things here. One is obviously a huge infrastructure spend that's going into AI. Actually, there's two things here. One is that we do think that the market is going to grow significantly. So it's very hard to determine exactly the degree of this. So ultimately, there is a great amount of infrastructure spend that's been going on into this. It's not that it won't necessarily be needed. Actually, if you make the tokens much more efficient, it means you can actually do much more work. The classic Jevons paradox case. And so that's actually what we're seeing. We're making AI systems far cheaper. And as a result, for example, in case of cybersecurity, you can actually have much more cybersecurity that happens because it's cheaper to be able to run. So it's hard to guess kind of precisely. Time will tell. But we think actually moving towards a case where it's much more efficient actually means that you can make the most out of your infrastructure and potentially do better and more AI.
How long do you think chips are going to last for? It seems to come. If I'm going to securitize a chip, I want to know how long it's going to last. Is this something I amortize over 5 years, 7 years, 10 years?
So
what do you think?
It depends slightly on. Okay, so there's no really easy answer.
I'm sure there's no easy answer to this.
The first thing to say is that it depends on the nature of the chip itself. But what I'd guess to say is just looking at the trend, we've seen that actually they have a longer lifetime than I think previously we'd been expecting. And this is purely for the reasons we said earlier. We're extracting more, let's say, intelligence density out of the chips. There's more that you can do now, and there will be more that you can do in a year from now with that same chip. And as a result, the value will just kind of float with what you can do with it. So I'd be pretty bullish on what you can do with all the chips.
Dan, where's your revenue coming from? Who are your main customers? How much of that is stateside? And what is your level of commitment to remaining a UK business?
So there are two groups of customers that we work with, what I call people who consume intelligence. So they just want AI to be faster, better, stronger, and cheaper. And so we're working with amazing companies on that side. The other are people who are building up the capacity for intelligence. So the data center builders, the sovereigns, and so on and so forth. You asked me about in London. We are super excited to be here in London. We have an amazing world-class team.
You remain a UK business.
So we are a UK business. We are inherently global in terms of our outlook and scaling globally. But we are very, very proud to be based in London. Unbelievable talent here and recruiting the world best team.
Dan, great to see you. Thanks for stopping by to see us. Really interesting. Kind of filling in a lot of the blanks that we're trying to answer questions around at the moment. Dan Akaja, the Colossal co-founder. Thank you very much. Okay, coming up, what are the results of Walmart going to tell us about what is happening in the economy? You've got all the big box retailers coming through with numbers right now. Key test in terms of the state of the US consumer. We'll debate that story next. This is Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid? I don't think I was reading magazines until I was in them. You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca? Maybe somewhere in the middle.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
Welcome back to the opening trade. We are 48 minutes into today's session. European benchmark stock 600 is currently flat after 6 days of losses. Volumes, of course, are light. It's worth noting that. The DAX is currently down 0.3%. The CAC current is flat, as you can see. And here in the UK, the FTSE 100 is down just 21 points. Let's look ahead to what else we are watching throughout the day. Monty Paschi and their board members will set to review strategic alternatives to Intesa's takeover bid, so a focus on the Italian banking space. On the earnings front, Alibaba will be dropping their numbers at around 11 a.m. UK time, and when it comes to retail, Walmart is at 12 p.m. UK time. On the macro front, 1:30 p.m. UK time, you have US initial jobless claims, and later the ECB's governing member and Dutch central bank president will be speaking on central bank independence. Guy.
Okay, let's talk about what's happening with the retail story. Big box retailers in the United States, give pretty good clues as to what is happening with the US consumer. Walmart results, as Tom was just saying, investors are going to be watching for commentary on the health of the consumer, amongst other things. Ru Hellerman joins us around the table. We need to talk about the UK story as well this morning, but let's start over in the United States. What's Walmart going to tell us? What signal will we take away from the Walmart numbers later?
Yeah, so Walmart is really a bellwether retailer. I think it's going to be less about the headline beat, more about the composition of the beat. Same-store sales growth, obviously the key metric that the market's focusing on. If that's going to be driven by ticket and they can show evidence of market share gains and operating profit growing faster than revenue, then I think it's going to be a net positive. But if the composition of same-store sales growth is a bit more even between traffic and ticket, and we see a modest beat, conservative guidance, then I think the premium valuation that the shares trade on going to come under a lot of pressure.
We've had other retailers report overnight. We had Target, TJX, Lowe's. What was their performance?
Yeah, so it's been a real mixed bag, but I think, obviously the consumer in the US has been under a lot of pressure throughout the course of this year. Inflation's been elevated above target. Gas prices have been high for some time now. And what you're starting to see is the consumer still spending, but becoming much more selective about how and where they spend. And I think that favors, players with scale, and particularly some of the non-discretionary big box retailers, Costco's, Walmart's, etc., who can demonstrate value a bit more effectively than some of their peers.
How broadly should we look into the JD numbers? So JD Sports, the stock reaction is pretty brutal for that company. Is there a broader read across in terms of the health of the consumer here? What do you make of those numbers?
Yeah, very much so. So, retail stocks have rallied quite strongly. I think JD Sports is up about 40% from its May low. So there was a lot of, lot riding on this print. But I think what's jolted the market is commentary around the consumer. They said that their core consumer is showing signs of softness, and that's what partly drove the cut to full-year profit guidance. And I think that's why you're seeing such a nasty sell-off, because it seems like cracks are emerging in the consumer.
Are you seeing that elsewhere in the retail space? It's hard to get a read on the UK consumer at the moment because the data, the official data is really bad. So this is actually quite useful information. Is this being replicated elsewhere? Is this the first big tell on what is happening with the consumer, or is there information elsewhere saying the same thing?
Yeah, I think some of the macro data has been mixed. I know Adam's spoken about it. But, obviously with a single stock like JD Sports, you're really getting quite a direct read on discretionary demand. And there obviously are some more company-specific issues with JD Sports. They mentioned, the product cycle and some issues with their partners. But I think it's the commentary on the core consumer where they're seeing softness, which has spooked the market.
Yeah, understandably. Rahul, nice to see you. Thanks very much indeed. Rahul Ahmed joining us on what is happening with the retail space, the consumer space. Adam Linton, as we were just mentioning, sitting around the table as well from our Markets Live team. We're still kind of dealing with a little bit of the fallout from the kind of the macro story yesterday. This morning we're getting signs of stability maybe within the bond market, but equities are continuing to kind of drift sideways.
Yeah, I don't think really equities, equities is really the story of the week. I think it's very much what's going on in the bond market. I think what we saw yesterday was, showing the signs of stabilization to some extent. The actual actions weren't that important. It's very much the signaling mechanism. And in the US, this kind of 4.75% level is some sort of pain point at the moment. I think the thing is, though, is that does this really kind of stop the tracks, if US yields moving higher? Does it address the factors that we've been discussing throughout the week? Strong underlying US growth, rolling fiscal deficits, and some of the hyperscaler CapEx competition. And I think what we've seen, it's a very different asset class and different case, but absent a shift in fundamentals, it's hard to turn the tide for an asset. If you look at the Japanese yen, for example, yes, there was efforts to try and control it, but the market has said otherwise. And I think, when I look at the European bond markets, I don't think it's really that relevant. I think, yes, you see spillover buying from US paper into European paper. But as we saw last week, the US inflation data, that has a very limited runway. And, unless fundamental shift in favour for Europe, it's unlikely to have much of a durable effect. I mean, we saw hot PPI numbers for Germany this morning, and we've discussed about all the fiscal strains in Europe throughout the week. And I think from a supply perspective, keep an eye on the French auction today. Typically not a market mover, but definitely one to watch.
We've had softer U.S. data. That's fed into less hawkish pricing for the Fed, but nothing's really sustainably pushed Eurodollar above 116. We got that yesterday. Is the path higher from here?
I think it can keep grinding higher, but in terms of the bigger levels like the 120s, I still think we need a bit of better Euro story. I think if you look at the price action we've seen so far, it's very much just been dollar-led. We've seen that scaling back the Fed hike expectations. We've seen the Treasury buyback, which has brought in dollar credibility concerns. But if you look at the euro, month to date, it's relatively middle of the pack G10. It's not really doing anything that exceptional. And I think it needs a bit more of a geopolitical off-ramp. Yes, inflation is increasing, which warrants a monetary policy response, but really it does look like a kind of fairly priced for the ECB at the moment. And if this, does escalate more, there's also a terms of trade shock, which limits the extent to which the ECB can hike and support the euro. Then also from the dollar side of the equation, we're kind of on this glide path lower towards pricing out hikes, but I still think that's kind of not a given at this stage. The market's trading a reaction function. It still doesn't really know a lot about, and we saw there was a bit of a credibility hit from the FOMC in July. If Walsh looks to reassert that at the Jackson Hole Symposium next week, that could potentially reinvigorate a bit more of a hawkish skew around the Fed.
You mentioned geopolitical off-ramps. No signs of that right now when it comes to Iran and the Strait of Hormuz, and you're looking at Brent now above $93 a barrel, so up 1.5%, 1.6% in the session. WTI above $87 now. That continues to be a grind higher as well on oil prices.
Yeah, it does feel very much like risks are still tilted to the upside. I mean, we know there's no direct negotiations between the US and Iran. This Iran-Oman shipping agreement hasn't been achieved. Iran's, revitalizing its offensive and defensive capabilities. The Red Sea is still an active conflict zone. And I think in terms of the way the market was trading it back in kind of April, kind of May way, was that there is kind of an off-ramp, even if news flow is negative, that the US will take at some point. And the pathway is towards a resolution. But what we've kind of seen from the US administration is we've seen Trump say, not in a hurry. And then we've also now seen these kind of economic warfare, which also escalates things. It brings China into the mix. And as we've seen with Russia and Ukraine, the sanctions aren't a quick fix to a conflict resolution. And alongside this, Russia-Ukraine, that's still rumbling on. That's removing a buffer of support, which could drag oil prices lower. I just think after, getting burned with the collapse of the MOU back in July, I think the bar to reprice oil low is pretty high at the moment.
Okay, Adam Linton from our Markets Live team, thank you very much indeed. Let's check back in on the bond space right now. Largely unchanged when it comes to the gilt markets. Treasuries, you're seeing very, very modest selling. You're at 465 right now on the 10-year. Skylar, as we wrap up the 2 hours on opening trade today, what do you think is the key takeaway in terms of the action from Besant?
I mean, I think it's the dollar. It's the credibility issues.
Dollar.
Yeah, and I think it's the Fed as well. We need to see what their reaction is to this to see what the implication for the dollar is, right? If Warsh comes out and doesn't take this hawkishly, maybe that's even more pressure on the dollar.
Yeah, it's going to be interesting to watch. Yields are beginning to turn around. We're starting to actually see a little bit of selling coming back into the market. Talking of the Feds, Mary Daly's going to be on TV a little bit later on. We're going to be talking to her at 1:30 p.m. London time, San Francisco Fed President. That's going to be an interesting conversation. The Pulse is next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
Global bonds rally boosted by US plans to buy back more longer-term treasuries. This as US public debt surpasses $40 trillion for the first time. President Trump announces plans for economic warfare against Iran, threatening, quote, tremendous consequences for anyone doing trade with Tehran. Plus, Novonesis surges after announcing a €1 billion buyback program and boosting its full-year guidance. I'll speak with the CEO later this hour. Well, a very good morning. Here is the picture in markets. Treasuries steady now, but European bonds are gaining, fueled by US plans to buy back longer-dated debt. Yields especially down at the long end of the Japanese curve, and you're looking at the 40-year down 9 basis points at 4.1%. The long-end bond relief boosting sentiment in the equity market too. US futures are pointing higher. Nasdaq futures up 0.25% after the gains we already saw in the Asian session. And oil is higher again. We mentioned the geopolitics. Brent up 1.2% at $92.75 the barrel after President Trump said that there'd be unprecedented economic warfare against Iran. We'll dive into that, what that might entail. But Bitcoin also in focus, above 69K, getting towards 70K a token now after President Trump pressed Congress to pass a key crypto bill. Now let's check in on how stocks are faring across Europe. Let's get our map of the continent an hour into the open. Broadly, not doing very well. The Stock 600 is flat to the downside, and Spain and Italy managing to eke out some gains this session. But the DAX in Frankfurt, really the laggard today, despite autos being one of the leaders across sectors. That's what's happening in markets. Let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. We've seen global bond yields falling after the US Treasury said that it plans to buy back more longer-dated bonds. The intervention by Scott Bessent coming after borrowing costs hit multi-year highs. But former St. Louis Fed President Jim Bullard sounded a cautious note.
The market reaction suggests that this is an important tactical move from the Treasury, a little bit unexpected, so you're probably getting an outsized reaction right now. But I don't think it changes the fundamentals, big fiscal deficits and a Fed on the sidelines, which is what's driving longer-term yields higher.
Let's get a view on this with Ven Ram, cross-asset strategist at Bloomberg MLive. Ven, Jim said it was tactics. He didn't say it was strategy. Is this just a sticking plaster to keep yields in check?
Well, it definitely is a temporary get-out-of-jail card for treasuries, long-dated treasuries. I mean, short positions were ramping up on longer-dated treasuries. So the treasury buyback announcement will do them good in the short term because yields will stop rising. But I think it's the question, as Jim Bullard was talking about, it's about the longer-term trajectory. And there the picture isn't pretty rosy, Lizzie, because if you... basically, much of the increase in long-dated treasuries has come about from rising term premiums. Now, term premiums is the difference that investors want to hold longer-term securities rather than shorter-term securities, and it's extra compensation they get for doing that. But that extra compensation is what has driven the increase in yields in the short term. And if you, in an environment where inflation is not under control, and in an environment where deficits are not under control, those are the two principal components that move term premium. And if those components are not in good order, you're going to see those term premiums come back up beyond the short term. And that is the danger here of what is likely to happen.
OK, and we also got the Fed minutes overnight. Several officials backing a July hike, but we knew that from the June dot plot. Many also saying that tightening would be necessary if inflation didn't fall. How much did we actually learn from these minutes? How consequential are they for the markets?
Well, I think it is incrementally consequential for the markets, but as you said, we didn't learn a whole lot new. And I think that, look, I mean, given the recent soft patch of economic data, we've had very negative payrolls numbers for the past 2 months, and I think that that's going to dominate the Fed's thinking in the short term. So that means essentially that they're not going to raise rates in September and probably not in December. We don't know yet because we just need to simply wait for the data. But it's beyond the short term that matters as usual. And there, you know, you've got core PCE running at 3.3%. Last year, we were doing 2.7, 2.8. Now that's completely gone. We are talking about 3.4, 3.3 range. So I think that, you know, the risk is to the upside in terms of rates. And I think that, you know, if the economy manages to come out of this recent soft patch, I think that rates will head higher in the short term.
OK, Ven, thank you for your view. That's Bloomberg MLive strategist Ven Ram. And let's get another view now. We can speak to Banu Baweja, Chief Strategist at UBS Investment Bank. He joins me round the desk. Banu, nice to see you.
Good to see you, Lizzie.
I know you were listening there to what Ven had to say. So is this Treasury plan, going back to that, the early signs of fiscal dominance?
I'm afraid it is, right? Because, I mean, they've shown quite clearly that they care about long-end yields, and they should, because that's what matters for mortgages, and mortgages is what matters for the U.S. consumer. The U.S. consumer is what matters for the U.S. economy. So it really is a central variable for officials, both in the Treasury and also at the Fed, to keep a close eye on. The curve has steepened a little bit recently, and they've already said that they are, through this announcement, they've told us that they're quite worried about this. I think Jim Bullard is absolutely right. This is sticking plaster. The deficit is not changing. You're basically going to have to, how do you refinance? Well, you have to issue debt to refinance. You might be issuing short-term debt, but the overall debt, the national debt of the US, close to 40 trillion, is actually going to remain unchanged. You're not buying back debt and reducing or retiring debt. You're just going to issue shorter dated debt. The question, I think, and as Ven put it quite nicely, is this is going to mean, the large deficits are going to mean that investors require higher term premium. Now, higher term premium, the minute we think of higher term premium, most people think of steeper curves, and they think the long end is going to blow up. But if inflation can remain in check, that's a big if. If inflation can remain in check, it is likely, in my mind, probable that you get the term premium through a bull steepening. Right, which basically means the long end stays here because the short end comes down. So I think over time, the Fed is going to be incrementally more dovish to take short end rates lower so that the long end doesn't blow.
But then is it the dollar that pays the price? And maybe that's what President Trump would like.
This is what the gold price is telling us today, right? Other places where you have fiscal dominance, I mean, these are shades of fiscal dominance. This is early fiscal dominance, but you have quite clear fiscal dominance in places like Japan.
Yeah.
Look what the yen has done, right? So the currency does pay the price. And I think the dollar will pay the price, but I think it's going to be against selected currencies, you know, the ones which are safe havens. So we shouldn't think of this as dollar weakness of the same ilk as we saw in the mid-2000s, where all emerging market currencies, sort of the high beta currencies, the high carry currencies, everything was doing well. This is going to be the good credits doing well against the dollar, the likes of the Swiss, the likes of the Aussie, but most importantly, gold. I think this is a very important signal for gold. The Treasury buyback is a very important signal. The fact that they want to keep long end yields in check probably gives another lease of life to the gold trade.
You mentioned Japan. I did wonder whether Scott Bessent took some inspiration from his meeting with Governor Ueda, whether it's rubbed off on him.
I think independently, U.S. authorities are extremely worried about the long end yield. In fact, last year, go back to Liberation Day last year, right? Why did we see Liberation Day suddenly be reversed? Why did we see the tariff suddenly be reversed? It wasn't as much because of the stock market reaction as it was about the bond market reaction, right? Let's remember, interest costs in the U.S. are phenomenally high. Right? I mean, this is about 3.5% of GDP. So you want to keep debt in check.
Well,
otherwise,
then why not end the war?
That would be the sensible thing to do. Absolutely. Why not end the war? Why impose tariffs? These would be things like, you know, Wen spoke about core PCE being at about 3.3%. A lot of that inflation today is acyclical inflation. And this is why you have so much dissent from the Fed, because one part of the Fed says, I don't care where the inflation is coming from. It is my job to kill inflation, and that's why I'm going to hike rates. But the other part of the Fed says, I think rightly, that the Phillips curve coefficient for the inflation that you're trying to heal is very limited. It's zero. It's close to zero. How are you, the Fed, going to tackle tariff inflation? How are you going to tackle AI inflation or oil inflation from Hormuz? And that's why it doesn't make sense for the Fed to be very aggressive on monetary policy.
Well, yeah, when you look at the July inflation print and the payrolls numbers, do you actually think the market's still too aggressive when it comes to Fed pricing?
I think at the margin, absolutely. At one point, the market was pricing in about 68 basis points of hikes, and so nearly 3 hikes. That has come down, so that has reduced by half, a little bit more than half. I think it's going to come down further. So we don't see a rate hike this year, and we think the next move is going to be a cut in 27, potentially a cut in 28 as well. So that's why I think the 2-year rate is going to come lower, and that's going to anchor the long end rate. The long end rate needn't blow, it needn't rally very aggressively. You could see the 10-year stock close to 450, but if and only if the 2-year comes down, and we think it will. We think it will. We think inflation in the U.S. higher right now, but acyclical inflation will then fall off, and inflation will come lower. And the minute inflation comes lower, the Fed will reveal its true colors, which is a very dovish institution.
Well, how much of a risk event is Jackson Hole?
I think Jackson Hole, we will see a lot of this discussion about Phillips curves, different parts. Can we tackle acyclical inflation through higher rates or not? I think to what extent is the Fed able to do that? We'll have discussion around that. But I don't think we're going to learn a lot more about what the Fed is going to do in the September meeting or the December meeting.
I slightly joked, but being serious, with the Iran war, do you model that it's going to have to end soon because the midterms are coming? Because that seems the logical conclusion, but I mean, people have been saying that since the war began.
I think we're getting too close to that deadline for the Iran war to actually matter for the midterms, because it takes a while for high energy prices to flow into CPI, for CPI to hurt people's pockets, and for them to react politically. I think we're actually now too close to it. In fact, the closer we get to it, the lesser the Iran war is going to matter for the midterms. I think the window for the Iran war mattering for the midterms really was something May to July. I think the closer we get to it, I think it'll be less of a political consideration.
But if you don't have that incentive, then what oil price are you modelling around?
So we think because we are seeing tremendous leakages from Hormuz, we think oil prices, the futures are broadly correct. So we're looking for sort of 90 to 95 in terms of oil, with clear risks to the upside, right? That's absolutely true, that if the leakages from Hormuz stop, and actually you stop seeing a good chunk of the 20.5 million barrels a day that usually used to transit from Hormuz, if a good chunk of that does not transit, then of course there's a massive fat tail on the right side that oil prices could go significantly higher, which is why the risk to inflation is also to the upside, and the risk to rates is also to the upside. But these are risks, Lizzie, right? These are risks. The modal view for oil, I mean, the oil market has passed a major test, with Hormuz having been shut for more than 4 months, and oil prices are still trading close to 85 to 95. That's a major test pass. It's a very dynamic market. Oil is finding a way. And that's why we think the modal scenario really has to be that cyclical inflation is likely to remain in check, and the Fed is unlikely to hike. The next move is likely to be a cut.
Well, we're in that very range today. 92.82 is where we trade on Brent this morning. I just finally want to get your view on earnings season, because it's been pretty stellar stateside so far. But, you know, the market reacting less positively to CapEx announcements this season. Does it make you a bit more bearish at all, especially when we've had the bond story?
I mean, I think stellar is one of the adjectives you could use. You could use many more superlative adjectives for this kind of an earnings season, because again, look, where is US GDP? 1.8 to 2%, which is close to median. Where are US earnings? You know, somewhere between 35 to 45%, with margins equally high. So that is a 100 percentile outlook when your GDP is only at the median, right? I think this earnings momentum is very, very strong and can support the market into the near term. I think it'll be very difficult for the market to go against this. So you could see through the year a move up towards 8,100. That would be our base case. The next year could become more challenging if the margins come under pressure. So if you really dig under the surface, the revenues are high, but margins are very high, right? So it's the margins for those companies, and some of the ones that we would be watching are ones which are adopters of AI, right? Financial companies, legal companies, consultancies. If their margins don't remain high, their spend on AI may not be that high, and that would be some of the risks that we're thinking about from the market. Go to watch China as well, what kind of impact China has on the margins of some of the AI companies, right? Anthropic, OpenAI, what kind of margins will they be able to run if Chinese models are doing just as well? So these are risks 6 months out. Here and now, I think this was a phenomenal earnings season, and we know that the momentum trade can last for a little while.
Okay, Banu, thank you very much. That's Banu Baweja, Chief Strategist at UBS Investment Bank, staying bullish when it comes to the stock outlook. Well, let's turn to the geopolitical situation then. President Trump shifting his Iran strategy from military pressure to what he's calling economic warfare. The US president threatening severe consequences for countries that provide Tehran with an economic lifeline. And Bloomberg's news director for Europe, Middle East and Africa, Will Kennedy, joins me now for more. Will, what could this economic warfare campaign actually entail? Because surely President Trump is not going to want to drag China into it when we've got the Trump-Xi meeting coming up.
I think that's exactly the question, Lizzie. It does feed very directly into the US relationship with China, which is complicated, multifaceted, and reaching a critical juncture with that meeting, because economic warfare and escalation of economic measures against Iran probably does mean secondary sanctions against Iran's trading partners, and that includes China. It's worth bearing in mind that the US already has extensive economic measures against Iran, including right now, most importantly, the blockade against its oil exports. So anything it does now is going to be incremental, and the question is, how aggressive is it willing to be and able to be with Iran's leading trading partners?
And then we have the issue of the UAE deciding to sever economic ties with Iran. We know what a massive trading partner it was to Tehran. How damaging could that be?
It could be very damaging, and it does seem quite an important change. It's probably part of the wider US decision to try and target Iran's economy, and I suspect that Washington has had extensive conversations with Abu Dhabi about how to make that work. As you say, Dubai is the proximate financial center to Iran, that we know there's a deep trading, financial and wealth links between the two countries. So one of the things that we really need to track in the days and weeks ahead is how far the UAE is willing to and able to follow through on that severing of ties. If it really does do a lot to stop trade and financial flows between the two countries, that could be quite meaningful for Iran and its economy.
Oh, because in a sense it could shoot the UAE in the foot.
Well, it could. There are risks to the UAE. The UAE has benefited from its relationship with Iran, but it could also be a big problem for the Iranians as well, that it's not able to access, as it has been, the financial system inside the UAE.
Okay, one we'll monitor. Will, thank you very much. That's Bloomberg's Will Kennedy. Now, coming up, earnings from US retailers will test the resilience of the American consumer amid the higher energy costs, cooling wage growth and softer jobs market. We'll get you the details next. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
This is The Pulse. I'm Lizzie Burden in London. Just coming up to 9:20 a.m. here, and we're looking at US earnings now. Target raising its full-year guidance after quarterly results beat estimates, offering signs that the US big box retailer may finally be emerging from its prolonged sales slump. Bloomberg consumer reporter Maddie Parker joins us now for analysis. So Maddie, we've had a string of results from US retailers yesterday. Your key takeaways then?
Yeah, big week for big box retailers. They're obviously a very good kind of bellwether for how the US consumer is feeling. The good news first, obviously, is Target. They lifted their profit guidance, kind of evidence that CEO Michael Fidelki's turnaround effort is kind of working. They've kind of pushed into kind of coming with some more kind of trend-led products, leaning into like the protein craze and things like that. And people are responding. And the other thing responding, of course, is their stock shares up about 63% year to date. So very impressive. Kind of on the flip side, you had Lowe's yesterday, obviously the home improvement retailer. retailer. Less good story there. They had to cut their guidance, and it's probably a bit more reflective of how the US consumer is still feeling about the housing market. It's clear that discretionary spending on things like home renovation projects is still pretty low, and that's kind of reflecting how people are feeling about housing, obviously the cost of borrowing and mortgages as well.
And of course, all of these are kind of a barometer for the consumer in the US. Walmart, absolutely key, and that's later. What you're expecting?
Yeah, definitely. I mean, some analysts are expecting an earnings beat from Walmart later on. They're kind of interesting. They're a bit more insulated from some of the macroeconomic kind of factors we've seen, and that's partly because their customer base is very broad. They kind of appeal to the low-income end of the consumer as well as the higher income. I think a couple of things to look out for there is whether their kind of push into marketing, kind of their merchandising efforts, is indeed paying off, and also to keep an eye out on some of those tariff refunds as well, which have come through for a lot of the big box retailers this quarter.
Okay, a read on both parts of the K-shaped economy. Maddie, thank you very much. We'll look forward to your reporting later. That's Bloomberg's Maddie Parker. Now, let's turn to Europe's latest earnings season, drawing to a close as it is, but the fundamentals looking unusually strong. We've been looking at whether this quarter provides the foundation for a more durable rally for the rest of the year. I'm joined now by Tim Craighead, Global Chief Content Officer at Bloomberg Intelligence, who's been looking at all of this. You do a scorecard each quarter. What's the scorecard looking like for Q2?
Yeah, so our European strategy team with Laurent Dulay does have the scorecard, and right now we're running close to 60% beats versus a little more than 20% miss. So the skew is unambiguously positive. If you look at the actual growth rate for 2Q earnings, roughly 18% growth versus an expectation of 15%. And it's quite broad-based. We knew energy was going to be strong. It has to be, given what's going on with energy prices. But industrials playing off of the AI boom because of the data center build-out that companies like Siemens or Schneider, ABB play into were robust. Pharma was better than expected. Banks benefiting from higher interest rates, driving higher net interest income. So a lot of factors play through to quite a robust result.
I was talking to Barnum Buwasia just a few minutes ago, and he was saying that it's margins you really need to keep a focus on going forward. Is your outlook constructive in the coming quarters?
So interesting to take a look at some of what plays through it. At times you have a beat but no raise, and that's not great. In this instance, not only do we have better mid-year earnings, but full-year numbers went up. 2027 numbers went up. 2028 numbers went up. So that's good news from the standpoint of what the projections are looking like. It was also interesting that it wasn't just the big cap companies. The equal-weighted European indices went up a similar amount. So that's another broad-based element. And I suppose from a sustainability perspective, interesting, you were just talking about the U.S. consumer. You know, signs of U.S. economic surprise have rolled over, but signs of European economic surprise are indeed quite robust right now, which suggests better economic activity. Now, we do have to be careful about the weather. You know, I mean, that sounds a little silly, but we know how it's been. Food costs are going to go up. Transportation costs are high. We still have an energy issue because of what's going on in the Middle East. So, you know, it's not all a bed of roses, but there's interesting positives.
Yeah, the fire's certainly not silly. So then, if you do that comparison between Europe and the US, how does it all stack up in terms of earnings growth?
Yeah, it's interesting because if you look either at 2026 as a year or look into 27, there's no doubt the U.S. continues to have stronger growth. 11% is projected this year versus in U.S., 8% in Europe, and a like difference next year. But that said, you know, it's a case where you get what you pay for. Europe is trading at 15 times earnings. The U.S. is trading at 20 times earnings. So there is a differential. And I would say that there are a lot of indications of a continuing of broadening out of exposure beyond what is an undoubted overweight towards U.S. equities. It comes in any number of anecdotes, whether it's mutual fund or ETF flows. We see it when we're talking to clients. And, you know, if I take a broader step. You and I have talked. We think that there is an opportunity if Europe can get its act together. There's nothing. It's nothing like taking advantage of a great crisis. And right now, Europe is stuck in the middle between the U.S. and China on a geopolitical perspective, economic perspective, and there is an opportunity to drive innovation, to drive collaboration. You know, we put out this report a week and a half or so ago. It's a must-read for the summer holidays about what Europe can do to drive a future. And if they don't, Europe's relegated.
And so as I've said to you many times, Tim, 'twas ever the carrot dangled.
and it is, and it's all the more proximate right now. There is no doubt.
Well, I'm glad you showed that report off. Worth a read from Bloomberg Intelligence. Tim, thank you for bringing it to us. Tim Craighead there with the latest scorecard and the outlook when it comes to earnings. Let's take a look at the markets then. European stocks are pretty flat as things stand, just flat to the downside on the Stock 600. And coming up, we'll dive into more earnings. Novo Nordisk jumping after announcing its inaugural buyback programme. Why have they done that? We'll be asking the CEO next. This is Bloomberg.
How do you see AI changing gaming and game development in the future?
Look, I think the biggest thing that I'm thinking about is how do we just make sure it's solving problems. On the game development side, I've gone to a lot of our studios, you know, big and small, and I'm blown away with how they're using AI in the production pipelines, how they're using it for iteration and prototyping. That's not production ready, there's still work. And so, you know, 30% of game development is software, and so there's the traditional applications that we see in enterprise. At the same time, I do not think AI will replace AAA games. I think it's entirely possible, though, that AI represents a new category of games and a new type of development and enables more people to create and participate. And we'll keep an eye on that, and we'll see how we best serve that.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London, and these are your top stories. Global bonds rally boosted by US plans to buy back more longer-term treasuries. This as US public debt surpasses $40 trillion for the first time. Meanwhile, President Trump announces plans for economic warfare against Iran, threatening, quote, tremendous consequences for anyone doing trade with Tehran. Plus, Novonesis surges after announcing a €1 billion buyback programme and boosting its full-year guidance. And that is where we shall begin this half. Well, sticking with that story, Novonesis, the biggest gainer on the Stock 600 after announcing its first ever share buyback programme. The Danish biotech company reporting second quarter revenue that beat estimates and now boosting its full-year revenue guidance as well. CEO Esther Baiget, I'm pleased to say, joins us now. Esther, good morning to you. Let's start with the buyback. Why do it now when previously you've always told us that you prefer to spend your extra cash on CapEx? Good morning.
Good morning. And as you so nicely mentioned in the introduction, we are in a very good place, delivering a very strong start of the year with 8% growth, high profitability, and a very strong cash flow. We are continuing to invest on ourselves, on people, on R&D, on capabilities to be close to our customers, on CapEx, to deliver growth. This is the highest, best way we have to deliver sustainable return to our shareholders. And with the strong first half of the year behind us, with the strong cash flow position, we see that is now the time also to do a share buyback program to continue to maximize value creation for our shareholder. So we have initiated a multi-year program of a $1 billion. So we have initiated this multi-year program of a €1 billion cash flow as we are continuing to investing in growth. It's not one or the other. It is the combination of the two.
OK, it's not a mutually exclusive choice, but should we read into it that acquisitions are off the table now?
The beauty of a growing 7-8% growth, a guidance of 7 to 8, 37 to 38, aiming to the high end of the range, and a strong balance sheet, it gives you the power of the and. We continue to invest on us. We're giving back to our shareholders a strong return with share buyback. And yes, we're constantly looking at the market for bolt-ons. We announced only a few weeks ago an acquisition, Microbiogen. That's a good example of the space that we are in. Here we're talking about bringing yeast capabilities home, particularly in the bioenergy area, that's going to continue to position in a leading space in this very attractive and profitable market.
OK, so what else are you looking to buy that you can't build yourself?
We are investing on us, building capacity, and then we're always looking for the wall. We are in a really good place, but there is awesomeness also outside Novonesis. And to put you in perspective, we're looking for exactly this type of capabilities complementary to what we have. Capabilities from an R&D, capabilities of products that when we bring them home, they will be a win-win for our customers. And we're thinking on the space of 100 to 200 million bolt-on capabilities that we bring home, very quickly deliver returns and contribute to earnings and acceleration of the growth.
Just coming back to your results, you've also raised your guidance to see 7 to 8% organic growth. Should investors think that 8 is actually more likely than 7, given that you grew 8% in the first half of 2026? Or what could pull you down to the 7% end of that spectrum?
Excellent question. We are in a very good place, also seeing the momentum in Q3. So that gives us the comfort for raising the guidance from 5 to 7 to 7 to 8. Then there is 3 specific individual items, very punctual, that they have exclusivity and impact in the second half of the year. One, depleting of inventory of a one-off event that we announced and we communicated in Q1 that we had a customer in human health building up inventories, and with that has hindering the growth in second half. B, we're getting back some of the tariffs from the US government, and we're also giving it to our customers. That will also have an impact exclusively only in the second half. And then we're facing in a very isolated, specific place, softness or cautiousness in the North American market for dietary supplements. Continue to see good momentum on health overall around the planet and with our customers, not only in dietary supplements, but also in dairy with growing demand of probiotics. But those 3 aspects are going to be hindering the growth, organic sales growth of the for the second half with continued a strong underlying demand. That's maybe the only message I want to ensure it stays. Strong momentum, strong underlying demand. I'd stop.
Yeah, and you mentioned the tariff backdrop. Of course, the other part of the backdrop is the Middle East and higher energy prices. We've talked a lot about them already this program. How do investors think about the trade-off between higher raw material costs and that potentially stronger demand that you're talking about when it comes to bioenergy solutions?
Actually, what we see in the world, it is for sure we live in the same planet that we do. We have a very limited presence in Middle East, so for that aspect, very limited impact there. But then, particularly in bioenergy, we see countries and governments embracing the value of decoupling from fossil much more than the climate agenda. Now it is a geopolitical agenda. Now it is a social demographic stability, national security agenda, where here biofuels becoming an even stronger play. We see that in India, that was already in that momentum. We see that in Brazil, but we also see it in Middle East, in Southeast Asia, and driving partially the sales with higher exports from North America, but more importantly, a strong underlying demand from pipeline and growing projects with our customers.
Just finally, Esther, where's regulation holding you back? And where is it actually protecting Novonesis from new entrants to the market?
We would seek for a world where the regulation is embracing faster and bolder the answers of the future that they are already here. We already can produce novel protein that lead to cleaner, healthier foods, higher muscle weight recovery. It's possible today, but it takes 5, 6, 7 years to register them in the market. So that's the space that we're working with authorities on how we bring and equip the information that they need to put the regulatory framework that gives comfort, but it removes unnecessary barriers that make solutions that are already available hinder the speed of penetration. Then the muscle of Novonesis on regulatory and bringing new solutions on the market is a strength for us. It's not only the breakthrough and the innovation that we bring, driving higher yields and higher productivity and differentiated claims. It's also the intimacy, market by market, country by country, to bring those solutions in region. That's a strong value proposition that we bring in for our customers.
Okay, Esther, lovely to talk to you this morning. Esther Baiget, the CEO of Novonesis. Thank you very much for your time. Well, some of the other top stories that we're following for you today now around the world. The founder of Evergrande has been sentenced to life in prison after pleading guilty to charges including illegally taking public deposits as well as fundraising fraud. Hui Kai-yan was once Asia's richest man, but his property empire came crashing down after defaulting in 2021. Hui had binged on debt during Evergrande's expansion, and Chinese authorities concluded that his rise had been built on deception. Elsewhere, Bloomberg has learned that a tentative trade deal would lower US tariffs on certain Canadian exports of steel and aluminium to 25% and cut duties on Canadian auto exports to 15%. Sources say it's part of a broader pact that would see Canada drop retaliatory trade measures. The concession represents a significant win for Canada's auto industry and car makers, including Toyota and Honda, that export vehicles from Canada to the United States. And China is using new legal powers to block European Union scrutiny of alleged state support for its companies. Beijing barred organisations or individuals from assisting the EU with its probe of JD.com's planned takeover of German electronics company Seconomy. China Ministry of Justice said that the EU was arbitrarily demanding broad and unnecessary information. Now, a campaign of Russian attacks in the Black Sea, has virtually halted all Ukrainian grain shipments, and ports there account for about 90% of Ukraine's grain exports. The military strikes are causing severe economic problems as well. Bloomberg's Piotr Kozlov is here for more on this. And Piotr, first of all, just tell us how the Russian attacks in the Black Sea have managed to impact farmers so much.
Hello. So the Russian attacks on the Ukrainian ports of Odessa is the main, actually key port, export ports of grains of Ukraine. So it actually using alternative routes like railways or Danube River is slower and more expensive, which leads to the grain stockpiles in the country are rising, and the prices of insurance and freight are also rising, and farmers getting less money for their grains.
And how economically significant is the sector then? Because, it's surely could feed back into the political question of the war itself.
Well, the agriculture is a backbone of Ukraine's economy, and Ukraine is one of the world's biggest grain exporter. So it accounts to up to 10% of the world trade of wheat in the world, and also it has large share of corn, sun seeds. So it's a big source actually for the country, for jobs, for revenue, and the agriculture revenue for the last year is around 50% of the total exports revenue in the country, which means that if agriculture and if farmers actually don't get money, it can lead to the bankruptcies, it can affect the next season planting, and it also can lead to a country losing from 3 to 5% of its yearly GDP.
Wow, so a massive domestic economic story, but also one with global consequences for inflation then, perhaps?
Food inflation is a big question because, as I said, Ukraine is a very important supplier of grains, corn, and wheat. So right now we are in the moment when the season in the Black Sea the new season has started, which means that Ukraine and the other big player, Russia, normally they dominate the market with its quality and cheap grains. But today, given that the ports in the Black Sea in Ukraine as well as in Russia are blocked, so the world's market is not getting the cheap grains from this area, which means that the grains prices and the food prices are going higher. Last month, the futures for wheat actually reached 2-year high, and analysts say that it even can go up. So if the exports wouldn't resume, we think that the countries, especially the imports-depending countries in the Middle East and Africa and in Asia, can suffer the most.
Thank you, Piotr, for that analysis. That's Bloomberg's Piotr Kozlov. Just on the international significance and domestic economic significance of agriculture there in Ukraine. But coming up on the polls, cruising to record heights, Istanbul becomes Europe's busiest passenger airport. We'll get you the details next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
This is The Pulse. I'm Lizzie Burden in London. Now, China is closing the AI gap with the US and by several key metrics, usage and cost, and it's even actually taking the lead. Excuse me. The rapid ascent is now raising concerns for firms such as OpenAI and Anthropic, which are chasing trillion-dollar valuations based on assumptions about superior capabilities and money-making prospects. So let us get more now with our Bloomberg Asia tech reporter, Luz Ding, who's co-written today's Big Take. Luz, thanks for joining us. Just tell us how China's making this advance.
Yeah, thanks for having me. So as we have been seeing from the latest releases from Chinese companies like Moonshot, China AI's gap with the top US offerings from like Anthropic and OpenAI have narrowed from over a year to just a few months right now. And then, of course, at the same time, they're also gaining a lot of market share, as we're seeing that a lot of the some of the major U.S. tech companies like Airbnb and DoorDash have adopted Chinese AI. It's worth to note that users don't have to send data to China to use Chinese AI models because most of the Chinese top models are open weight, meaning that you can download, modify, and deploy them wherever you want. So that sort of lowers some of the security concerns for a lot of users. And then we're seeing, for example, Alibaba this month disclosed that their AI models, Sierra's Queen, have reached over 3 billion downloads, making them one of the most popular AI model families all over the world. And as talking about Alibaba, they're actually reporting their quarterly results in the next hour, so we will see more about their AI progress soon.
And you've done some really interesting customized tests to compare how these models actually perform in real-life scenarios, Luz. What did you find?
Yes, so we asked some of the leading models to make a coffee shop website named Bloomberg, pun intended. And what we found was that they are all quite capable, but they're different on prices. For example, Anthropic's Claude Fable 5 were able to build a very nice looking website within an hour for about $50 of token bill, which is already not super high for a website, but if you use China's Moonshot's Kimi K3 model, it's only a quarter of the price. And you can go even cheaper, for example, using Alibaba's top offering from the Queen series, or OpenAI also have a lower budget model, Luna, and then that can bring your budget to lower than $5. So it depends on how soon you need the product and how well you want it to be.
Okay, Luz, really fascinating research. Bloomberg's Luz Ding there. Thank you very much for talking us through it. Now, with the peak period for summer air travel in Europe nearing its end, boo-hoo, Istanbul has overtaken London's Heathrow as the continent's busiest passenger airport. Is it all because of the hair transplants, or could it be an unintended consequence of the war? Let's find out, and we can discuss the wider industry as well. We can speak to Selahattin Bilgen, CEO of Istanbul Airport. Really good to have you on the programme with us this morning. I have to hand it to you. You have been doing phenomenally good business. You've beaten your target passenger number last year. This year, you have broken your own and European records for daily passengers and daily flights. Can we expect upward revisions to your targets for the rest of the year and next? Good morning.
Good morning. Thank you. This couple of years has been a significant achievement for Istanbul. We've been moving upwards for several years now. We have achieved to reach the top spot, surpassing Heathrow last month. Heathrow was the busiest airport in Europe for more than 2 decades. Now it's Istanbul. And actually, this has been the result of several factors, including Istanbul's geographical location, which is at the crossroads of Europe, Africa, Middle East, and Asia. But this has been coupled with Istanbul Airport's efficiencies and customer experience model, which helped us a lot. Having the Middle East impact, we also have been adversely impacted as being now one of the major global hubs in aviation. But thanks to our connectivity, which we are now, again, the most connected airport in the world with more than 340 destinations, we've been able to make up the loss of the Middle Eastern demand with other destinations. And that's how we were now able to surpass Heathrow.
Well, which particular transit corridors have you seen the biggest increases in demand for? Because, you hint at the traffic that you could have taken off Doha, Dubai, Abu Dhabi. And where are you expecting the biggest increases for the rest of the year?
Actually, Istanbul had already been very good positioned with respect to its penetration in Africa, Europe, and Western Asia. But we have been seeing significant growth on the Asia-Pacific routes, China, and North America. Historically, these routes had been significantly under-penetrated for Istanbul. But with the increase in traffic rights between the countries, with the increase in fleet of the airlines, we are now seeing significant growth. For this year, for example, we have been seeing growth for more than 50% from China destinations. We've been seeing growth for Northern American destinations with double digits. So thinking of the positioning of Istanbul, where we put geographical advantage and coupled this is coupled with our KPIs, which are at the highest level in European standards, like delay performance, on-time performance, turnaround times, baggage loss rates, so on and so forth. Istanbul has become quite attractive for airlines. We are now, with respect to the number of airlines, again, #1 in Europe. So this helps us a lot in gaining market share in destinations like Far East and North America.
Yeah, and you have got some fabulous duty-free, it has to be said. So, Selahattin, how much has your stopover in Istanbul program been part of the success of all of this?
Actually, around 45% of our overall traffic is international transfers. And this airport has been designed in such a way to become one of the most significant global aviation transfer points. But on the other hand, Istanbul and Turkey is a very good destination itself. So we would like to also see at least a glimpse of Istanbul and Turkey when passengers come to Istanbul with transfer times that are enough to see the city. So these stopover programs, which allowed the transfer passengers see the city and see the environment, has also positively impacted our growth. But for the ones who have very short time for the transfers, we are also providing a flavor of the country with our exhibitions, with our museum within the airport, and with our Turkish hospitality program.
Oh, well, I had a fantastic time there where East meets West for Istanbul Fashion Week a few years ago. Lovely to see you there. Selahattin Bilgen, CEO of Istanbul Airport. Thank you very much for your time this morning. Well, as we mentioned earlier, Evergrande founder Hua Ka-yan has been sentenced to life in prison, and the property developer pled guilty to charges including illegally taking public deposits and fundraising fraud. Let's go now to Bloomberg's Trista Shin-Yi Law, who can bring us up to date on this story. Just give us the details briefly, Trista, for us, please.
So Evergrande's founder Hui Ka-yan has been sentenced life in prison, from the Chinese. We see the press release from Chinese media today, and he was, sentenced along with 56 people, including his two sons, and also Hui's personal asset will be all confiscated. It's kind of really the closing, chapter to his trial in mainland. But I think the next thing for a lot of people to watch is how this is gonna impact the offshore liquidation, if there's any, and then how the liquidated offshore gonna trying to, still seek some access, no matter from Evergrande's auditor, PwC, or Hui's global asset. They're just trying to fight hard to, try to cover money for creditors so far.
Trista, really appreciate the update. That's Bloomberg's credit reporter, Trista Shin-Yi Law. Thank you very much. Well, coming up later, the San Francisco Fed President Mary Daly will be on surveillance. That conversation coming at 1:30 p.m. London time as we look at futures now pointing lower stateside. Up next, Bloomberg Brief. We'll pass the baton from London to New York.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini.
We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Stocks wavering, the bond rally taking a breather as the market digests Treasury Secretary Bessent's intervention in the bond market with that surprise increase in debt buyback plans. This as total U.S. public debt surpasses $40 trillion for the first time, inching closer to the debt ceiling. And President Trump plans for increased economic warfare against Iran, threatening to target its trading partners.
Let's get a check on how markets around the world reacted to the Treasury's plans. Here's Winnie Su in Hong Kong for the latest from Asia. Winnie.
Yeah, good morning, Bonnie. Well, it's really all about that surprise U.S. Treasury buyback plan, and we are seeing Asia stocks tracking, Asia bonds tracking U.S. Treasuries higher, and we see that in Japan's 40-year yield specifically down as much as 10 basis point earlier today. Now, it's also supporting a pretty solid demand coming through from the 20-year JGB bond auction earlier today, as investors see the current yields as relatively attractive. Now, flip the board and take a look at how that's translating into the gains in Asian stocks today. We are seeing the MSCI Asia here up about 1.7%, having its best day in about 2 weeks, and that is also coming after 2 days of declines already. Tech stocks are leading gains today, so we see the tech-heavy Kospi index leading gains up by around 6% here. Now, top gainers include SK Hynix and Samsung Electronics, which both have announced pretty massive shareholder return plans.
Samsung following on from SK Hynix to be the first one to kick this share buyback program off. Thank you so much. Winnie Su there in Hong Kong. Now let's head to London for a look at Europe. And for that we go to Alex Morgan. Alex.
Good morning, Vonnie. Yeah, let's have a whistle-stop tour of Europe, shall we? And that calming breeze that Winnie was talking about there, blowing through bond yields after that intervention from the US Treasury. You're seeing that here. Yields pretty much flat across the continent. Very minor moves. Contrast that with the beginning of the week, where we saw Bunds and French 10 years reaching levels we've not seen in years. Let's flip the board to equities, though. Here we're seeing the benchmark stock 600 on course for its worst run since 2023. Pretty modest moves this morning. FTSE 100, that's also getting a drag this morning from miners, from oil stocks as well. But really it is, Bonnie, a Thursday in August on the equities picture here in Europe.
Absolutely, Alex. Thank you so much. That's Alex Morgan there in London, and he mentioned it. It was almost like a mini fiscal operation twist. Intervention in order to bring down yields at the long end of the curve. Well, it certainly did that yesterday, at least. We'll see if that continues today. It already is reversing just a little bit. Remember, Tuesday intraday, we hit 533 and change on that 30-year yield. Yesterday, we were down to 519. As you can see this morning, up 3 basis points to 522.35 after the Treasury announced, surprisingly, that it was going to double its buyback program for 10, 20, 30-year debt to about $4 billion at least. So on the front end, you did see a move, but absolutely nothing like it. And of course, the FOMC minutes came out as well and showed a very, very divided committee. And we didn't so much see a market move after that. So it clearly was this move from Treasury Secretary Bessent, who has always said the Treasury is going to be predictable, but as a person, perhaps isn't as predictable as he makes out the institution to be. Let's take a look at the implications for other asset classes, because the dollar significantly seeing an impact. We are actually seeing a lot of dollar weakness today versus other currencies, particularly the safe haven of the Swiss currency. Brent crude, as you can see, continuing to climb. We're up to 93.60 now on continued economic warfare threats from President Donald Trump. Gold, and you have to wonder if gold didn't presage this move from the Treasury, right? Because it was only at the beginning of this month that gold started to move higher once again. And we're hugging $4,500 now on gold. And look at Bitcoin, $71,500. Not fully just the Treasury story, because Bitcoin obviously was starting to stir yesterday morning at this time. We were talking about President Trump talking about the Clarity Act once again, but it certainly got a massive boost. And then there was obviously $1 billion worth of short positions liquidated in about an hour, so that also gave it momentum. And then stock index futures, let's take a look. We are basically unchanged at the moment after small moves higher and lower on the two major indices. The SOX index, though, was down 2.1%, it should be noted. Let's get to some individual movers now. For that, we'll go back over to London and Chloe Melly.
Good morning, Bonnie. We are seeing a big drop for Moderna this morning after the massive rally yesterday, which was due to Moderna and Merck reviving hopes for a melanoma vaccine. We had seen this huge surge and now quite a sharp reversal, and we're down about 11% there in pre-market trading. Moving on to crypto-linked stocks, which are up this morning after Trump met with a bunch of crypto executives. We also have this Bitcoin squeeze that is also leading those share gains. And so we're up for strategy, up about 8% this morning. And then staying in crypto, we also have Hyperliquid, which is up this morning. As Trump said, regulators are working to bring this crypto platform into the US, so taking some of this offshore market infrastructure onshore. And so that is also driving the shares this morning. We're up about 11% there for Hyperliquid.
All right, new narratives in town, Chloe. You gotta love it. Chloe Melly there. She'll be back later in the hour. Also coming up this hour, more on the Treasury's buyback plans and the growing US deficit with Sophie Hyun of BNP Paribas Asset Management. So, US government bonds mostly holding on to their gains after the announcement of the Treasury's plans to boost buybacks of longer-dated bonds, the move seen as potentially a turning point, with Washington taking a more active role in keeping its borrowing costs down. Let's get more with Bloomberg's Van Ram. Van, in a way, this is exactly what we should expect from Treasury Secretary Bessent, right? He's already talked about shifting the burden to the shorter end of the curve when it comes to issuing debt, and now he does this, and it's not that unpredictable when you consider his past life as a trader. This would have been one of his obsessions.
Absolutely. If Bessent fancies himself as America's top bond salesman, he's certainly making the effort. Whether or not he'll have something to show for the efforts over the longer term remains to be seen. What he's done is essentially put a Band-Aid over a bleeding artery. What is he trying to do? He's trying to salvage longer-term securities by doubling the buyback on them, the monthly purchases. But this Operation Twist is likely to fail because there are two reasons why yields have increased in recent months. One is the fact that inflation has been uncontained, has been running above target for several years now, and the Fed isn't doing anything about it. The other flank of this story comes from the Treasury itself, where they are failing to tackle deficits in a meaningful way. As you just mentioned, the public debt has reached 40 trillion in the US. That is several times the US GDP. So, you've got a deadly combination of uncontained inflation and uncontained deficits, and that essentially means higher term premiums. And until these fundamental narratives change, nothing vis-a-vis Treasury sentiment is going to change. So this is a short-term move. It's not going to work in the long term.
Yeah, and if anything, it hurts the dollar more than perhaps it helps in the Treasury market, right? It's so fascinating. Now, if all of those elements are at play, including short-term issuance surging, what does the Fed do? Because it's going to see short-term rates rise, and then inflation may continue to be a problem. We already know that many on the committee were looking potentially towards a hike, at least, if not, that particular month. So what does the Fed do now? Can it raise? How does it raise?
The Fed is in a tight spot, really, because, on the one, as you mentioned, the Fed minutes showed a deeply driven Fed. And, if they were not inclined to raise rates before the latest jobs data, they are less likely to do so after the jobs data, which is showing the economy going through a lean patch. So until the economy comes out of that lean patch, the jobs market recovers, it's unlikely that the Fed will do anything. So in effect, we are going to get yet more uncontained inflation well above target. Core PCE last year was hovering around 2.7%, 2.8%. Now we have passed that stage. We are now talking about 3.3, 3.4. So the implications are clear: higher for longer inflation and higher for longer rates.
All right, Van, thank you so much. Bloomberg's Van Ram from our MLive team there giving us loads of context. And tune in for our interview with San Francisco Fed President Mary Daly. That's at 8:30 a.m. Eastern. You won't want to miss that one. Brent crude above $93 a barrel now today. President Trump announcing plans to subject Iran to a, quote, economic D-Day, not specifying exactly which measures he'll take, but threatening to target Tehran's trading partners, for example. Iran calling the threat a diversion from America's own crises. Joining us now from Dubai is Bloomberg's Stuart Livingstone-Wallace. Stuart, this hasn't been codified in any formal way yet, if it ever gets done. But if it does, is that specifically telling, say, China that it can't do business with Iran? And will those kinds of trading partners listen to the United States?
Yeah, good morning, Vonnie. I mean, look, it's a complicated answer to that, so I think you put it into several camps. And number one, will these actually be secondary sanctions as most people would understand it, or does this stay at the rhetoric level and they're basically applying pressure through social media posts? Very hard to say. We've seen no documentation out of Treasury. Until we do, it's very hard to give you a firm answer on that. In terms of the trading partners, you saw that very powerful statement from the UAE yesterday. That was incredibly notable in terms of a very firm commitment to basically curb trade, financial transactions, and so on with Iran. As you point out, China is the other big one, but the question mark there is the US willing to take on China on this? You know, it is a much bigger beast to tackle. And fundamentally, is it going to take that risk? And then you have other trading partners where it could potentially apply some pressure. But the real issue here is that Iran has been under sanctions for decades. It is incredibly good about finding workarounds. So in the short term, could it have an effect? Yes, although as of today, it looks like the effect, more than anything else, is on the oil price.
Exactly, Stuart. And we know that it's questionable whether secondary sanctions have the impact that they're intended to have just generally anyway. And also, as you say, Iran is well used to this. Now, obviously, Iran has been suffering higher inflation than it's been used to, and its currency has been, you know, derailing a little bit. But its population seems to be managing this fine. Can it do that for several months more?
I mean, very hard to make that call. I mean, the Iranian economy has been in dire straits for a very long time, but the situation right now is pretty critical in the sense that you have a record low currency, you have hyperinflation knocking around the sort of 75 to 80% on an annualized rate, you have rolling blackouts across the grid because they just can't keep the infrastructure going, and this in a country with enormous energy reserves. So things are looking pretty grim, but as you know, the Iranian regime has a long track record of stamping down on any dissent or any protests, you know, in a pretty nasty way. So there may be a reluctance within that population to go out onto the street and protest again, as we saw at the beginning of this year. I think it's going to be very hard to predict what exactly is the tipping point. At least for now, it seems the regime is of the opinion that it can keep going, and it's willing to accept that higher pain threshold in return for what it sees as the leverage that it has over Hormuz.
Briefly as well, Stuart, I mean, Iran has been looking at military targets in Europe for something potentially if Trump were to escalate. What would it take for Iran to actually carry out an action? It's been very reticent to do so up to now.
Yeah, I mean, look, fundamentally, it's got enough on its hands as it is. You know, if you think about the number of countries that it targeted in the war that began at the end of February, you know, it's well over a dozen. And so it also faces some issues there about munitions. Yes, it can produce drones very cheaply and on a vast scale, but it also has to make the calculation that its stockpiles of, let's say, missiles are not infinite. And it has been using quite a lot of munitions since the sort of I won't call it a ceasefire because there hasn't been much of a ceasefire, but certainly the reduction in hostilities. It's continued to fire projectiles into the Gulf against shipping. And therefore, very hard to see what exactly the advantage would be to try and widen the war out.
Stuart, thank you so much for all the context this morning. Much appreciated. That is Stuart Livingston-Wallace in Dubai. Now, two other top stories trending on the terminal this morning. The US and Canada reached a tentative deal that would lower tariffs on certain Canadian products. According to Bloomberg sources, levies on Canadian steel and aluminum would be reduced from 50% to 25%. Duties on autos would be cut from 25% to 15%, though details still need to be finalized. Global luxury brands are facing a worsening sales slump in China as the country's plan to tax offshore wealth dampens spending. Sales at the 25 biggest luxury labels in China, Louis Vuitton, Dior, Gucci, they all dropped more than 10% in July. Pop Mart's first half sales growth decelerated. Demand for its Labubu toys cooling after last year's surge. Numbers reflect a broad trend of how once viral Chinese consumer brands are struggling to sustain momentum as economic pressures hit discretionary spending. Coming up, SK Hynix and Samsung surge on record shareholder return plans. This is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bloomberg Brief. I'm Bonnie Quinn in New York. Samsung now also adding to the record shareholder returns started by SK Hynix yesterday after all of their stocks plunged earlier this week over AI spending sustainability concerns. Money Day reporting Samsung set to announce a plan worth $72 billion as SK Hynix may pledge at least $130 billion in additional returns, according to JP Morgan. Joining us now is Bloomberg's Neil Campling. So, Neil, that Samsung plan is to use 50% of its free cash flow for shareholder returns. I mean, obviously, the stock volatility has been helping in some senses, but how do they coordinate that this happened the same quarter, within a day of each other?
It's interesting, isn't it? Those sort of buybacks are a theme of the week, aren't they? From bonds to boardrooms. Well, basically, the size that we're talking about here is reflective, actually, we have to remember, from what happened in June when, to avert a labour strike, there was talk about bonus payments being paid, which would amount to a significant piece of that $70 billion US. So it may be reflective of part of that, rather than actually just a shareholder return policy. So that's something to look out for. And then with the reports that potentially Hynix might also be able to pay another $130 billion of free cash flow into buybacks in the future, that's also reflective basically because the street has Hynix producing $330 billion of cash flow over 2026 and 27.
Incredible. Neil, will this pressure the US companies to start thinking in that direction as well? Will US shareholders start requesting more buybacks?
I don't really think so, Bonnie, to be honest, because I think most of the US corporates with the buyback policies are well in place, and also the free cash flow for the US companies is being used to fund the AI capex. So I think it's a slightly different, a different dynamic at play.
We get Alibaba reporting before the US markets open. What should we be anticipating, Neil, and what signals will it give us about the China economy?
So we need to look out for what's happening in terms of the Qwen adoption for their AI toolset, which they are doing almost frontier-like from the US models at a lower price. And is it going to translate into higher accelerating growth for revenues? Because it's only single-digit growth for the last 12 quarters. Can it come through? We saw from Tencent and Baidu in their reports that they are not seeing AI impacting better growth. So, with this stock Baba's stock having been up nearly 30% in the quarter to date, there are high expectations. We'll find out in about 15 minutes, I think.
All right, can't wait. Neil, thank you so much. That is Bloomberg's Neil Campling. And we're sticking with that very theme, Bloomberg's latest big take, focusing on how the US may be losing, or at least China may be narrowing the lead in the AI race. Bloomberg's Luz Ding from Hong Kong joins us now for more. So we've been very, cognizant of this over the last few weeks, in particular, Luz, with China constantly coming out with different updates to models and so on. Are they gaining customers overseas, and if so, how?
Yes, thanks for having me. So yeah, we're seeing a lot more adoption of Chinese models, especially from one of the data sources is OpenRouter, is a major AI access platform. We're seeing Chinese models use reached over 60% in July, and that's also reflected by a lot of the top U.S. tech companies adopting Chinese AI in terms. Including DoorDash, Airbnb, and Coinbase. It's worth to note that you don't have to send data to Chinese companies or China to use Chinese models, because most of the Chinese top AI models are open weight, meaning you can download and deploy them wherever you want. So that reduces some degree of the security concerns.
Yeah, and actually Bloomberg did a customized test to compare how these models perform in real-life scenarios. What did we find, Luz?
Yeah, in summary, they were all very capable, but they're different on prices. We asked some of the leading models to make a coffee shop website called Bloomberg, pun intended, and we're seeing that, for example, Anthropic's Claude Fable 5, it was able to build a very sophisticated website for us within an hour, but with around $50 of the token bill. It's already not super expensive if you want to build a website, but then if you use China's model, Moonshot's Kimi K3, you can have a similar website, but with only a quarter of the cost. And then if you want to go cheaper without maybe sacrificing some of the sophistication of the website, you can use, for example, Alibaba's Queen model, or OpenAI also has cheaper model options.
Yeah, exactly, Luz. It's going to be a fascinating ride watching how the two compete. Bloomberg's Luz Ding with that big take, and it's a must-read today. Coming up, a look at your headlines in your front page news. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield, and personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. It's time now for your front page news. First up on the New York Times. A court in China sentenced the billionaire founder of real estate giant Evergrande to life in prison. Evergrande collapsed under more than $300 billion worth of debt in 2021, pushing China's financial system to the brink and exposing the economy's dependence on real estate as a growth driver. Next up, the Wall Street Journal reporting the U.S. Army is phasing out an assault battalion established in January in Europe to master the art of fighting with drones and ground robots. The Journal says it's part of a broader back-to-basics approach by Defense Secretary Pete Hegseth's pick for acting Army Chief of Staff, this after having ousted his predecessor. And the Financial Times is reporting some leading executives are criticizing top legal firms for beginning to hire students in their first few months of law school. Some firms have said they'll start the application process before this Christmas for first-year students looking for summer associate roles for 2028 as the war over talent intensifies. Coming up, Sophie Hyun of BNP Paribas joins us to discuss the market impact of the Treasury's buyback plans.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open, and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm election.
Hear it first on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Stocks waver, the bond rally taking a little breather as markets continue to digest Treasury Secretary Bessent's intervention in the bond market with a surprise increase in debt buyback plans. This as total U.S. public debt surpasses $40 trillion for the first time, inching closer to the debt ceiling. And President Trump plans for increased economic warfare against Iran, threatening to target its trading partners. Well, this time yesterday morning, we were looking forward to FOMC minutes and a 20-year auction. It almost pales in comparison to what happened just an hour later with the Treasury announcing it would at least double its planned purchases of outstanding 10 to 30-year debt. We saw a massive drop for the 30-year yield in particular, down to 5.19. As you can see, we're back up 3 basis points today. Regarding the rest of the curve, we also saw a drop not as steep by any means, and the 2-year yield is back up a basis point. We're literally around where we were yesterday, 4.1727 there. Now, we did see a bigger impact on the dollar as well. Lots of dollar weakness. Many questions surrounding the credibility of the Fed, surrounding whether foreign investors might flee, what the Fed will do in terms of rates if shorter end yields rise as well. And then you also saw Bitcoin rallying. We're close to $72,000 a coin now, and Brent crude also near $94 a barrel. And we also have gold at $4,500 an ounce, or just shy of it. So serious implications from that announcement. Now, as you can see, we have futures wavering. The SOX index sold off 2.1% yesterday, but it was small gains and declines for the S&P and the NASDAQ 100. The S&P was up about 0.2, NASDAQ down 0.2. All right, let's get to some individual movers with Chloe Melee in London.
Good morning, Vonnie. We're seeing a sharp reversal in Moderna's shares after the 177% surge that we saw yesterday when Moderna and Merck revived hopes of a skin cancer vaccine. So we are down about 10%, more than 10% in pre-market trading this morning for the pharmaceutical company. Moving on to a very different sector, we're going over to crypto after the big rally in Bitcoin, which triggered a wave in short liquidations, and then also Trump meeting with a bunch of crypto executives. And so both of those things have been seen as very positive, things that have been driving those stocks, including Strategy, which is up about 9% this morning in pre-market trading. And finally, let's end with one final crypto stock, Hyperliquid, which is also up this morning more than 12%, as Trump said that regulators were working on bringing this crypto platform into the US, so essentially bringing this offshore market infrastructure onshore and really confirming the crypto enthusiasm from the administration. And so we're up very strongly there for Hyperliquid.
All right, Chloe, we will likely see that move continue today with Bitcoin continuing to rise. That is Chloe Melee in London. So the latest rally on Treasury is starting to fade just a little bit. That after the Treasury Department took action to rein in long-term borrowing costs with an increased buyback plan.
Market reaction suggests that this is an important tactical move.
The US Treasury has, $2 billion worth of funding to do per annum at its current pace. It needs to roll over about $2 billion of debt every month.
But I don't think it changes the fundamentals of big fiscal deficits and a Fed on the sidelines.
It's not going to change meaningfully the trajectory. If it's a one-off,
just shifting the problem around,
we get to see more sense of how that term premium is going to be addressed.
Joining us now is Sophie Hune, Portfolio Manager at BNP Paribas Asset Management. Sophie, we've had almost 24 hours now to digest this move. What is the consensus at BNP Paribas about the implications of this move for the market, how long they'll last, and whether it's helpful or hurtful?
I think, if anything, this news is basically showing the willingness to cap the yield curve at this point. But I think more importantly, we think that the ripple effect and the implications are going to be mostly a bearish dollar move we could have, which is by ripple effect bullish dollar. But taking a step back, I think overall, it's going to reinforce the view that we could potentially have a bit more risk taking in the short term.
All right, let's dive into some of what you said. Let's start with the fact that you said it is likely to be dollar bullish. We're seeing the dollar sell off, and there's also the possibility of foreigners maybe fleeing at this point because the government might intervene in the bond market at any time. So why is it dollar bullish?
Oh, it was a mistake, actually, dollar bearish. So I think in terms of positioning, what you've seen is since NFP, since CPI, but also the retail sales, the dollar has been hit with positioning moving really on negative territory. I think at this point, when you start to cap bond yield, but also uncertainty about what the Fed is going to do in September and October, we think that overall it's going to reinforce further unwind of dollar longs. And we think there's more room for that. And that's why we could easily see euro dollar at 118 in the next couple of months.
All right. Well, what is the consensus now around what the Fed will do? I mean, the Treasury is kind of engaging in a little bit of fiscal maneuvering here. The Fed needs to do some monetary maneuvering of its own, but do the two intersect or collide?
I think it all depends on the next data print. Like one thing we saw from yesterday is like post the FOMC minutes, the market pricing on the September and October hike didn't really move at all. If anything, the latest print from NFP and CPI and retail sales were much more important data points. We're still waiting for the Philly Fed, waiting for the jobless claims. That will be important additional data points to monitor in order to understand if a hike is credible or not in the next meeting.
Just more on this Treasury move. I mean, it is a pretty small fiscal operation. At the same time, it did have a major impact on long-end yields. Does that impact need to have legs, Sophie, in order for this to be successful, or will the Treasury Secretary have to do something more?
Overall, I think it caps the yield curve, but if you take a step back, it's much more important to have a clear understanding of what's going to happen with Iran. Oil price is back to $92 per barrel if you look at Brent. If you look at products margins, so the gap between product prices versus like Brent or WTI, it's an all-time high. I think this will be much more important to monitor in order to understand where inflation expectations are going to go. And that itself has been like putting a dent on how much risk-taking we got in the market post the July momentum unwind.
What did you take away from the FOMC minutes yesterday? They almost seemed to be an afterthought for the market, but they did indicate that many officials were, very, very unclear about the path forward.
Yeah, but it's all depending on where inflation is going to print. So I think the next data points on inflation, on jobs, are going to be like giving much more insight. The worry on inflation is one thing, but if it's all about oil at this point, you want to understand how much the potential energy shock is putting a strain on bond yield, especially at the back end of the curve with the fiscal ripple effect. But I think overall, we've been waiting for some cracks on the economic outlook due to a potential energy shortage for a while. But now if you look at energy inventories, it's starting to be at quite critical low level. So there is like this breaking point where higher oil prices forever, or are we going to have at some point such low inventories that you're going to have to start pricing demand destruction? And I think that are going to be the story for the rest of the year.
Sophie, in terms of portfolio management, which you have to think about, I mean, are the short positions all closed now in the Treasury market? Is that it? Have we seen the highs in yields for the year?
Positioning-wise, I think what you've seen is, if you look at the CTA signal on the Treasury, we're not at trough yet. So there could be a bit more momentum there in terms of like a bit more pressure on higher bond yield. But the buyback announcement yesterday is clearly putting a cap on that. I think what is more concerning for asset allocation perspective, it's much more this ongoing positive correlation between equities and bonds, and this inflation uncertainty and the fact that at the back end of the curve, we're not going to have that much rally if anything happens. So how do you manage this environment at a point where hedges and portfolio hedges are becoming much more rare at the moment?
Would yesterday's move make you more interested in other countries' debt, or were you already getting more interested anyway because it was providing, great competition for the United States?
It's clear that it's going to create much more cherry picking. So countries where the fundamentals are a bit weaker, inflation has already turned, versus countries where you have worries on the fiscal side, worries on inflation. So I think rather than look at duration like as a whole in portfolios, there's going to be much more cherry picking countries where, let's say, you have much more carry, and that's why in our portfolio we've been cherry picking within the EM space. So long Brazilian bond, long Mexican bonds, and long South Africa.
All right, Sophie, thank you so much. That's Sophie Yun of BNP Paribas Asset Management. Don't miss our interview with San Francisco Fed President Mary Daly. That's at 8:30 a.m. Eastern. It's one you won't want to miss today. Now to other top stories trending on the terminal this morning. Bitcoin almost at $72,000. That's the first time in 2 months it's above the 70,000 mark. It's getting a boost from the Treasury's buyback plan, obviously, but also Trump's high-stakes meeting with crypto executives. Unitary Robotics says humanoid robots will reach mass market popularity within a decade. Its founder said the market will take off once robots can handle 80% of tasks given them by voice instruction in unfamiliar surroundings. Unitary plans to spend nearly half the proceeds from its IPO to develop the humanoid brain. A group of Democratic lawmakers urging Fed Chair Kevin Warsh to disclose any conversations he's had with President Trump since starting in the role. The written request states that effective monetary policy relies on transparency and accountability. Recent reporting found Trump has spoken to Warsh over the phone periodically and in bursts and continues to urge Warsh to have the Fed lower interest rates. Coming up, an economic D-Day. President Trump doubles down on his economic threat towards Iran. That's next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Historically, bubbles were characterized by a notion of if you build it, they will come. In the late 90s, when we were building out data networking equipment, people were putting huge amounts of fiber in the ground on the assumption that it would come. And economists like to go back for reasons that are unclear to me to the railroads. They were also, if you build it, they will come. What is unusual about AI right now is the builders are so far behind the demand, it's absurd. We have a backlog of more than $25 billion of demand. That there are none of us, not AMD, not NVIDIA, that can keep up with the demand that your employees are driving. That's, in a lot of ways, the opposite of a bubble. We are chasing. Our customers and their customers are moving at the speed of software, and we're moving at the speed of real estate, data centers. Right, and so we are behind.
Good morning, this is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. President Trump reiterating his hard line against Iran with a, quote, economic D-Day, including measures targeting Tehran's trading partners. He didn't specify what those measures would be. Joining us now from Washington is Mika Solner of Bloomberg Government. Mika, this would be the next step, but nothing has been codified as far as I know, and it wouldn't come necessarily from the White House. It would be a separate bureau, right, that would put these together. When should we expect some kind of formal announcement, if at all?
Yeah, I think that we are closely monitoring this potentially today or tomorrow for the next steps. As you mentioned, the president has not specified specific actions, but this is an escalation in terms of the steps that he wants to take to try and mitigate some of the tensions in the region. Iran, clearly the president has said that some of the talks have stalled, and he's really struggled to end this war right now, just months before the midterms, as growing concerns and growing exhaustion. There's growing exhaustion in Washington. So we're going to see what the White House's next plan is here, but the economic approach is definitely new.
Yeah, absolutely. Secondary sanctions in particular, and you know, it would have to include countries like China, and this would be before Xi's visit and so on. Tariffs-wise, we did see that 3-day pause, and then at the 11th hour, the US decided to cut tariffs. Can you give us some of the backstory and the details?
Yeah, I mean, this is a huge decrease from the president putting out a surprise announcement last week that he wanted to impose the 50% tariffs on Canada. We're seeing this heavily backtracked to about 15% now. I think this plays into kind of the growing economic tensions that we're seeing between the U.S. and Canada. This was a huge problem in Trump's first administration. And I think that, I think the White House is very cognizant right now about shaking up markets too much, especially as these concerns grow in the country with everyday Americans' pocketbooks too. So I think that they're very cognizant of that and treading very carefully into tariffs. But the president is still not backing down, of course, on his trade policy. This is kind of his signature approach that he has, kept close to his chest in both this administration and Trump one.
Yeah, absolutely. Mika, thank you so much for all of that. That is Mika Sollner of Bloomberg Government in Washington. Alibaba out with earnings now with a 9% jump in revenue thanks to strong demand, in particular for its AI business. Bloomberg's Neil Campling is back with us for more. So Alibaba once again proves it can pivot, Neil. It is a genius at just pivoting to the right thing, right?
Yeah, so obviously what we're trying to wait and see is to get some more colour on Quenwork, so their AI initiative, and to see whether their models are now getting the lower price ones needed for approaching the frontier models type of returns. The one thing, though, that I would point out is that the top-line results themselves were pretty much in line with consensus, and the triple-digit AI revenue growth number, which they mentioned within the transcript. Let's put that in context, though. It's only 5% of revenues, and that's why the entire company is only growing, really, in reality, at a single-digit clip. So it's much lower growth in absolute terms relative to some of the big US tech companies. And that's probably why it's trading lower in the pre-market, I think.
Yeah, trading lower in the pre-market also hasn't had the best year, but neither has Tencent, right? So how much is this a reflection of China's economic growth and how that may lag its plans, and how much is it a reflection of what these companies are actually doing and how fast they can gather steam on the United States AI companies?
Yeah, so there's obviously two opposing forces at play. You have got sort of some tepid growth in the underlying Chinese market, which is an issue. But then you need to pivot and invest aggressively in the AI models to try and reinvigorate the growth longer term. So that's a problem for them. But it's about performance now of the AI models and whether that translates into global opportunity and high revenue growth in the future. But it looks like we are seeing Baba, just like Tencent and Baidu, struggling to really reignite interest in the stocks, I think. Although Baba, don't forget, had rallied 30% this quarter into the print. So expectations were pretty high.
Yeah, exactly. Neil, let me ask you about the new shareholder return plan that we got today. So obviously we got SK Hynix yesterday. It was Samsung today. Tell us a little bit about it.
Yeah, so we haven't, Hynix was confirmed yesterday. Samsung is reports, so it's not yet confirmed. It will take some time. This is really about paying out lots of the free cash flow back in terms of the corporate buybacks. But we have to remember that for Samsung, there was a labor strike risk back in June, and they said they'd make bonus payments. And this could be a facility to allow that. But clearly what's happening here is there's massive free cash flow at these memory companies, and there's likely to see significant shareholder returns in the future. Hynix, for example, expected to do over $300 billion of free cash flow this year and next year combined.
Yeah, a whopping amount, and certainly using it for something else, something different to what US AI companies are using their free cash flow for. Neil, thank you so much. Bloomberg's Neil Campling. More retail earnings on deck with Walmart set to report before the bell. Ross stores after the market close. Joining us now is Andrea Felstead of Bloomberg Opinion. What should we look forward to, having seen particularly Target yesterday, Andrea? We were down 3% when the market opened, and we finished the session for Target up more than 4%.
I think it's all going to be about where the US consumer is. The first quarter, while gas prices had started to rise, that was really, insulated by higher tax refunds. That's going to fade a bit. This will probably give us more of a read of how the consumer is being impacted by that higher inflation.
And also, yeah, I mean, oil prices, but clearly, tariff impacts and also refunds and so on. There's so many little strings to draw on. What should we take away from a better performance from Walmart? Is that a good thing or a bad thing?
I think it will be seen as reassuring. There's actually a bit of nervousness going into these Walmart numbers. There's worries about the impact on the pharmacy business from legislation, and also on the impact on the things that we like to buy, those nice-to-have items like clothing, home furnishings. They're the first things that consumers pull back on when they're under pressure. And actually, although Target was very good yesterday, the clothing business was pretty flat. So we'll be looking to see whether that's the same in Walmart. And those nice-to-have items tend to have higher margins, which is very welcome when grocery is such a low-margin business.
Yeah, exactly. And Andrea, we did get a little bit of a red flag from the home improvement retailers, both Lowe's and Home Depot, right, saying that consumers were pulling back on the bigger DIY, maybe more discretionary type of items. And should that tell us anything about where the consumer sits?
Yes, the consumer is still nervous of taking on like big home improvement projects. They're much more comfortable about buying smaller projects or buying things like plants to liven up their garden. It's those big ticket items that we really need to see come back.
A money plant, Andrea, that's what we all need. Andrea Felstead, thank you so much. That's Andrea Felstead of Bloomberg Opinion. Coming up, we'll get you set up for your trading day next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Mumbai. This is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now look at what's ahead today, or what we know we can expect at least. Certainly yesterday didn't turn out the way we were expecting. First up, Walmart and Deere set to report earnings before the bell. And then we get another round of jobless claims coming at 8:30 Eastern for another look at the labour market. And then you definitely don't want to miss this interview, 8:30 a.m. Eastern, San Francisco Fed President Mary Daly on Bloomberg TV. Let's take a look at some movers before the bell. Moderna, it looks like it's a big pullback, but honestly, yesterday we were up 177% after that breakthrough on a cancer mRNA drug. And it is great news for Moderna and for the world. And the stock was really well rewarded. Coty down almost 6%, dropping despite a revenue beat. The beauty conglomerate didn't provide a forecast either. And then strategy, well, this is a Bitcoin play, and these Bitcoin stocks could continue to rally today with Bitcoin almost at $74,000 now. Of course, it began with Trump and the Clarity Act, and then, of course, yesterday's buyback plans from the Treasury also gave things a boost. So let's take a look at your macro picture then, because the market is still digesting that buyback doubling. The 30-year yield back up to 522.24. We've only just erased a little bit of the move from yesterday, but we were down to 519 after that announcement. Brent crude is also above $94 a barrel as threats continue to be lobbed from President Trump. And then the dollar index also weaker after that announcement yesterday, a surprise announcement from the Treasury. Well, that is it for Bloomberg Brief. Surveillance is next.
Day 7 at the Cincinnati Open. Iga Swiatek reached her 30th career WTA 1000 quarterfinal with a dominant win over Diane Parry. The former world number 1 dropping just 6 games in the victory. World number 2 Elena Rybakina awaits in the Elite 8. And don't forget, you can watch all the action live daily and head on over to tennischannel.com to download.
Famous dogs, you have they look like balloon kind of figures to some extent. How do you make those?
In the case of the balloon dog, I blew up a balloon dog. So I had this balloon, which is kind of like a latex type of piece, molded it, cast it, and then blew that up in scale and put it into a clay, and eventually had that transformed into stainless steel.
So when you have a balloon dog, let's say, a regular size one or then a big one, did people say, Jeff, you're crazy? Were you shocked that people were willing to pay very high prices for this?
When I was making my first balloon dog, one of the purchasers was Eli Bro. And originally I thought I could make a balloon dog for around $300,000 that I could manufacture. It's a large piece, over 10 feet long, or 12 feet long, 10 feet high. But it turned out that the fabricator came back to me and said, you know, Jeff, I can't do it for $300,000. It's going to be $650,000. But eventually, then they raised the price again. And they finally brought it up to $1.6 million. And I told Eli that this is the reality of it. I showed him everything, and he ended up paying for the production costs.
Key
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We're in a secular shift here that's not getting enough attention.
Risk markets are starting to pay attention to the bond market.
There's a time to be worried. Now is not the time to be worried.
It has been strong earnings growth that has forgiven all sins for this market.
People, I think, are viewing the equity earnings story as a little bit insulated from higher yields.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, bonds attempting to stabilize. Treasury Secretary Scott Bessent stepping in to support the market, just as the Federal Reserve is debating whether to hike interest rates, and the national debt pile is crossing the $40 trillion mark for the first time ever.
And this goes connected with what we heard from Scott Bessent. In other words, how much can a tactic overcome a fundamental problem, which is really exemplified by the $40 trillion of U.S. debt? The problem isn't just the overarching amount of debt, it's how quickly it has risen. It has doubled in the past 10 years. All of a sudden, we're looking down the barrel at a fiscal shock paired with a supply shock, paired with a Treasury Secretary with lots of creative maneuvers, but maneuvering does not solve the problem.
Will it stick? Will it hold? Look at the move this morning. 2s, 10s, and 30s. Yields starting to bleed higher again at the longer end of the curve, up by 3 to 522 on 30s. There's so many different angles to cover with this action from the Treasury. How about Kevin Walsh? Quote, "What I've been really trying to do is get an unfiltered message from markets. That ain't happening." What does it mean for Fed policy in a few weeks' time?
Especially if the U.S. Treasury is selling a significant portion of its debt on the front end of the yield curve. Remember, this is what we heard under Janet Yellen. This is what we saw. But it only accelerates that move at a time where suddenly Fed policy gets that much more connected to fiscal expenditures than it has been in the past. Talk about politicizing the Fed inadvertently or advertently, saying to the Fed, you are setting interest payments for the U.S. government. Choose so at your peril.
You mentioned Janet Yellen. When she was doing things like this, it was then Scott Bessent of a hedge fund manager who was maybe going to become Treasury Secretary, having scathing criticism of her. He at one point said she has taken control of monetary policy through Treasury issuance, and now we see a very assertive Treasury Secretary in him.
Only a few weeks after the quarterly refunding announcement, right? Basically teeing up the next quarterly refunding announcement. And that's the divide on Wall Street, I think, this morning, and you alluded to it. Either you believe that's the first step of many as we work towards November and maybe trim long-end issuance, or you sit here this morning and say, structural problem, this ain't a structural solution, yields are going to keep creeping higher at the long end. Some evidence of that so far this morning.
Not only are you going to see the long end creep higher yet again, but you're going to see the release valve of the dollar. Because if you have a Treasury Secretary who's panicking without fiscal authorities that are panicking in tandem, you aren't going to solve the problem. You always talk about how when authorities panic, that's when the market starts to feel confident. The wrong person is panicking. Treasury Secretary Scott Bessent cannot solve this problem with tactics, and that is the problem that this market is grappling with.
The dollar weaker again this morning. Let's just sit on the dollar theme. There are always trade-offs, and that was the release valve just yesterday, and that's the problem. If you're not going to allow the market to find a clearing price in yield, then you're going to see the adjustment through the FX channel. How much more of that are we going to see? The moment you saw those headlines cross yesterday, yields came in, equities went up. What else happened? Dollar got slammed, gold rallied. They were the moves that spoke to exactly what you're highlighting this morning.
George Servalos of Deutsche Bank came out and said Operation Twist is here, and said if there is a perception that the Treasury Department is trying to use some of these measures to lower long-term yields, with the Fed remaining on hold, not offsetting this on the other side, watch for the dollar to keep on plummeting. And that is what we're seeing maybe a little bit this morning and over the past couple of
we've got space for a generational rant as well. Can I sort of squeeze that into?
There's always
let's make space for this. We've got time.
Generational rant.
There is a generational divide on Wall Street, and those who are a little bit older want to flex that they were around when this was normal. So when you see yields climb and we get towards 5% on 10s, they'll come on this program and they'll say things like, this is normal, right? This is okay. We can go back to the pre-GFC world. And I'm sitting here thinking, okay, how normal are things? How much have changed in the last 20 years or so? The Treasury Secretary has told you in the last 24 hours, stop the normal crap, right? I don't want to go back to pre-GFC. We can't handle rates at these levels.
It is not normal to see the expense tied to the interest costs of the United States of America supersede what we're paying for the Defense Department. That is not normal. It is not normal to see an $85 billion interest payment, the semi-annual payment that was a record just on Monday. These are not normal ratios to GDP and to the overall budget of the United States, and that is the problem.
We've got a lot to cover this morning. Coming up this hour, Peter Shea of Academy, as the Treasury attempts to take some heat off long-term bonds. We'll catch up with Colin Martin of Schwab on Secretary Besson's growing willingness to intervene in markets, and Krishna Gua of Evercore, as Fed officials warn sticky inflation could trigger hikes. We begin this hour with stocks steady and bonds attempting to stabilize as the Treasury ramps up debt buyback plans. Peter Shea of Academy writing, I do think we have been on a path towards yield curve control. Not sure this is the next step or a temporary one off measure. Peter joins us now for more. Pete, good morning.
Morning.
What are you leaning to this morning? What's at the start of?
You know, I think it's really going to be important to see what Warsh does. Can he launch Operation Twist? Because as a standalone effort, this was kind of mediocre, right? We got a nice pop yesterday, 9 bips move, but okay, if we're buying $2 billion or $4 billion instead of $2 billion at each operation, that's not going to move the needle that much, right? QE was $120 billion a month or something. So I think we're either going to need Operation Twist, we're going to need really strong rhetoric that we're going to cut rates, something out of Warsh, or else this is going to fade fairly quickly.
I quoted Kevin Warsh from that last meeting. I can go through the quotes once again. Market participants are learning to play the ball, not the referee. Okay. What I've been really trying to do is getting an unfiltered message from markets. He's not getting one anymore. When you see the kind of action we saw yesterday and the Treasury determined to keep a lid on long-end yields, what does that mean for how the Fed needs to manage the front end?
I think they have to be pretty aggressive. They have to really talk about cutting. They've got to take hikes off the table, because if they don't,
You think they've got to accommodate the additional issuance coming from the Treasury?
I think they're going to have to.
That screams sour the dollar, to Bramo's point.
Yeah, but again, I think under Trump, right, he probably views a weak dollar as a feature, not a bug, right? He always thought, links weak dollar to trade, so I don't think he cares about that.
At what point is that insufficient, the idea of cutting rates at the short end and buying back peripheral bonds at the long end, not necessarily in mass? I mean, at a certain point, won't there still be a rebellion given how much supply is coming from hyperscalers and everyone else?
Well, I did just spend the last couple minutes looking at the all-time highs on 2s versus 30s. I think it was 400 basis points. So, I think you're going to see steep curves. I think they're going to have a lot of trouble controlling the long end if they cut rates, but it's the only hope I think they have at this point to bring it down. And by the way, as you mentioned, I think everyone who becomes in charge of the Fed instantly moves like 3 or 4 levels more dovish, because you're now responsible. And I think that's a real thing. And then separate from that, we're so far away from Besson's 333, they've got to do something.
Doesn't inflation then resurge in a massive way if essentially you're having yield curve control in the United States, a la Japan during the 2000s and 2010s?
I'm less concerned if they don't grow the balance sheet much. So Operation Twist doesn't bother me as much. You take some duration out of the market, it helps. I get really concerned if we go back to QE. I do think QE is very inflationary. We haven't yet seen QE, right? This is just really Operation Twist, take less out. I think we can be okay on inflation. I'm not that
Hold on
concerned.
a second. You think that the market's going to be okay with yield curve control in the United States, given the fact that right now they are pushing back and they are saying you have a problem? This is concern coming to the fruition in a pretty significant way.
There's another element that I'm struggling with listening to Pete right now. How does yield curve control work without the balance sheet?
Right. So how
does that work?
So I don't think we're at yield curve control yet.
Okay.
But having said that, again, this isn't just this administration. I think Yellen started it. Bernanke started. We keep moving incrementally closer to yield curve control, right? And at some point, you're going to see someone say, well, I know what the yield should be, not just at the front end. I know what the yield should be all across the board. And I would expect the first thing that we start doing is seeing some sort of QE, but not a specific number, but with target yields. We may or might not buy treasuries at certain levels. And I think they will try and use that. They'll try and jawbone the market. I don't know how successful it'll be, but I think that's the direction we're headed.
But that's not the Kevin Warsh I heard from a few weeks ago.
No, and I guess, necessity is causing things to go wrong.
Okay, this just sounds absolutely crazy, Pete. As I work through it in real time, let me go through this with you. So you're suggesting that what we could see, and I'm not saying we won't see it, I'm just going through it. You're suggesting what we could see is that a lot of the issuance will shift further towards the front end. A lot of people are on board with that. The Federal Reserve will have to accommodate it and won't be able to hike interest rates, right?
Correct.
But they won't be assertive with the balance sheet.
Not yet. They'll start with Operation Twist.
If I'm in the market, the one place I can push right now, there's two. I'll be pushing into the dollar, I'll be selling it hard. The other piece, I'll be selling the long end again. If you're going to control everything at the front end, I'll just be selling. Who wants to buy that?
Right, and I think it's actually have the reverse effect on mortgage rates. Again, people shy away from things that feel artificially low, right? I think that's always the problem. Look at Bitcoin. I know there was a meeting yesterday on the Clarity Act and things like that, but you're at 71,000 in part because people are moving away and looking for the assets that will do well if we debase our economy again.
So is Kevin Warsh rewriting his Jackson Hole speech today?
I don't think he is rewriting it because I think he was always going to come across as very dovish. Again, I think when we look at this, there's two main sources of inflation right now, the AI compute build-out. Hiking is not going to stop that, right? The hyperscalers don't care about 50 basis points, right? They're trying to make 20x, 30x. That's not going to stop it. The war in Iran is probably the other big, element of inflation. Hiking's not going to stop that. And again, you can look at Trueflation, you can look at real-time Zillow rents. There are other things that don't point to quite the scary inflation story. So I think he's going to make a pretty strong case, and I continue to believe that these task forces are going to be the most interesting thing that's come up, because I think there's a lot of legitimacy to rethinking how the Fed behaves.
Peter, do you think we're going to see more creative intervention-like ideas from this administration? Something like, I've always thought maybe they'd remark gold ahead of the midterm elections, but maybe they just start selling it if it keeps going up.
I would love to see that. I think that would be a big thing. One, I don't really understand why we have gold reserves. I can't believe that anyone really trades currency looking at how much gold do they have, what's the currency worth. I feel, I'm not quite in the barbaric relic sort of camp, but I would be very comfortable selling a bunch of gold. You book some profit. It would actually reduce the deficit immediately, right? Because we book the profit there, raises some money. I think they're supposed to be looking at these alternatives.
I'm just super happy that Brammer got some rest and took a long weekend, because if Lisa had started work on Monday and not on Thursday, I can only imagine where this desk might be in the studio, like upside down.
I think a chair would have been thrown at the glass. Look, I'm old enough to remember when people cared about Fed independence. And what you're saying is essentially a Fed that is ultimately completely beholden to the Treasury Department and, frankly, the president's agenda. And that used to be concerning to markets. That seems like it's the best possible option from what you're putting out there.
Again, when we've been in crisis, I'm not saying they were in a crisis mode, right? They always work very closely, right? COVID, it was a joint effort between the Fed and the Treasury Department, right? The Treasury funded all the buybacks of ETFs. No one complained that much at the time, right? And
is this a crisis?
I don't think it's necessarily a crisis, but on the other hand, I also think some of what we did then was insane, right? We announced we're going to buy these fixed income ETFs. They immediately gap tighter. Credit spreads immediately straightened, and then we went ahead a month later and bought credit for month after month after month on a pre-prescribed notion. So I do think we can be a bit more creative in how we use the balance sheet.
I think Brammer's just asked a great question, though. We've just had a quarter of profit growth north of 30%. Unemployment's close to 4, GDP's close to 2. And we're doing crisis-like interventions in the market. What does that tell you?
Well, I think it's not necessarily for the equity market. I think, as your point is, our deficit's now gone crazy, and this is now the biggest component of the deficit, right? We're not Greece or anything, but you sit there and but these things are not going in the right direction. So again, I think you do bring out some of these toolkits. You sell some of this gold at wherever you are now, 4,500 or whatever, right? And take some profits, book something. I think you have to work on the deficit. It's become crucial to do something about that, and we're losing control.
Given how you think they're going to control the deficit, can we bring up the US dollar and just look at DXY? DXY, given everything you've said, I think you can construct an argument with some conviction it's at the wrong price, right? It's at 98 right now. Where should that be?
Significantly lower, maybe back down to 95, where we've got...
That's not significantly lower, right?
As a starting point. Again, we have not yet seen the government put this, and I think that's why stocks didn't react as well yesterday as they might have, right? I think people are still viewing this potentially as more one-off. It's a little Band-Aid done by Besant, and I think we really need to see other things take place to get that much bigger move, right? NASDAQ 100, which usually acts like, crack cocaine when yields go, did nothing yesterday, right? It rallied at first, went off. So I think that shows that there is some skepticism about whether this is really part of a bigger thing. Jackson Hole, though, I think got a lot more interesting.
Oh, without a doubt. Brammer's going to be there. At least if we get a dovish speech from the Fed chair and not a hawkish one, or some of the moves you might see at the long end of the curve and in FX could be rather large.
Watch out below for the dollar. I'm not looking at 95 for DXY, and I don't think George Saravillas is either. A real question here, though. It is a committee still, remember. So how does Kevin Warsh get the rest of the committee on board, given that some are still talking about rate hikes and many are very concerned about inflation?
We'll speak to one of those committee members a little bit later in the program, 8:30 Eastern Time. Look out for the San Francisco Fed President Mary Daly joining Bloomberg Surveillance in a few hours' time. Peter Scher's going to be sticking with us. Peter Scher of Academy. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, good morning, John. The minutes of the latest FOMC meeting showed several officials favoured hiking rates last month, and many indicated that policy tightening would be necessary if inflation doesn't decline. Officials described the labour market as stable and inflation outlooks as highly uncertain, due in part to the re-escalation of the war in Iran. New details emerging about the tentative US-Canada trade deal. Sources telling us here at Bloomberg it would lower tariffs on certain Canadian exports of steel and aluminum to 25%. Those on cars could be cut to 15%. It's all part of a broader pact that would see Canada drop retaliatory trade measures. Moderna shares surging by a record in Wednesday's trading, and Merck gaining double digits as a personalized vaccine against the deadliest form of skin cancer showed promise in that large late-stage trial. Moderna vaccine combined with Merck's immunity drug Keytruda prevented melanoma from returning after surgery. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, maintaining pressure on Iran.
We can't let Iran have a nuclear weapon. We have possession, complete control of the strait. We've had a lot of oil coming in, a lot of oil.
Up next, Tyler Kendall down in Washington, D.C., plus more from Pittichir of Academy, live from New York City this morning. Good morning.
Going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
8:30 Eastern Time, some jobless claims just around the corner. Before we get there, in about 40 minutes' time, we'll have some earnings from Walmart, so look out for that as well. Another read on retail in America. Here's a read on the equity market right now. Equity futures on the S&P 500, on the NASDAQ, on the Russell, on the S&P just about unchanged after snapping a 3-day decline in yesterday's session. In the bond market, a 15 basis point round trip from the high of Tuesday to the low of Wednesday on a 30-year bond yield. This morning up again by 2 basis points of 521.61. How bad was that 20-year auction about to be yesterday afternoon before the Treasury Secretary stepped in?
Yeah, it was still bad, which gives you a sense of just how bad it could have been, which might have been what they were trying to stave off. It's the reason why people said it kind of screamed a panic, something that Emory was talking about a lot last week with some of the rhetoric we saw from Scott Bessent. That said, will this be enough? And ultimately, I'm still wrapping my head around what Pete Scheer is saying, which is the cooperation of the Federal Reserve cutting rates at the short end to have full yield curve control and possibly using their balance sheet at a time where we're seeing record profits and huge build out of the AI sector.
One thing you might lose control of is inflation. Weaker dollar and higher crude prices right now. Pushing 94 on Brent. We're up by 2.4% on Brent crude. WTI is now pushing 90 again at $88 a barrel. Under surveillance this morning, maintaining pressure on Iran.
We can't let Iran have a nuclear weapon. We have possession, complete control of the strait. We've had a lot of oil coming out, a lot of oil. It's not going to be perfect, but it's a lot of oil coming out.
So here's the latest this morning. Crude climbing for a fifth straight day as President Donald Trump declares economic warfare on Iran. The president citing new sanctions designed to launch a, quote, economic D-Day against Tehran. Bloomberg's Tyler Kendall has the latest. Morning, Tyler.
Hey, John, good morning. Well, this threat further underscores the president's mounting frustration. He didn't really specify exactly what measures he is looking to take, though he did give us some details. He went on in that post on Truth Social to say that the threat would target countries that allow their financial institutions to give any sort of lifeline to Iran. He said that this includes cash transfers, swap lines, ship registries, or any sort of avenue that would allow Iran to smuggle its oil to market, adding in part, quote, you know who you are. That's raising questions about whether Washington would target Chinese purchases of Iranian crude, though that could risk the U.S.-China truce about a month away from Chinese President Xi Jinping visiting the U.S. President Trump has previously floated the idea that he would impose a so-called secondary tariff of 25% on any countries that do business with Iran. At this point, we know that Iran's economy has already been severely hit, but at the same time has also weathered waves of sanctions. A few other options on the table, according to our analysts at Bloomberg Economics. We could see some more targeting of the so-called shadow fleet, as well as that the U.S. could move to confiscate frozen Iranian assets that are already under its jurisdiction, though that may be a little bit more complicated because a third-party country would likely have to get involved. Now, John, the president's threat did get a pretty big boost yesterday. The UAE announced it was cutting all financial ties with Iran after reported missile strikes. That is considered a pretty significant move since the UAE was Iran's top trading partner last year.
Tyler Kendall down in Washington. Tyler, thank you. Peter Chiv Academy still with us around the table. Pete, the president didn't say China. Did he mean China?
I think he has to mean China. If we're going to put real sanctions on Iran that are going to be effective, I think it has to go after China. I'm not sure what that does for our economy, though. I think, right, will China then retaliate? We still have not solved anything with the rare earths and critical minerals in terms of China's control of that market. They're now dumping cheap compute on us as well. So this seems like a really risky strategy. I think it's probably the only way to get something done, but I think it's going to have problems across the world. And then also, right, that would probably mean China actually has to buy oil in the global market. That price goes up, and at the same time, I question how much more we can release out of the Strategic Petroleum Reserve. We're under 300 million barrels, and that was as of last week. There's, talk about some structural integrity at some level. I don't know where we're there. We do not have all the levers, so it will be really interesting to see if this is yet another, we're going to bomb the civilization, out of existence, and nothing ever happens, or this is real.
How does he do this ahead of Xi Jinping visiting and the midterm elections?
I think it's very dangerous, right? I don't see any way that you enact this without seeing oil rise. I think China winds up having to say something. It probably affects some of the other countries in the region, Turkey. And at the same time, you now seem to be catering to Kim Jong-un and, pushing against Xi, which from any sort of economic standpoint, who really cares what we do with North Korea? We care a lot what goes on with China. I feel that this is one of those things that we're going to hear a lot of talk and nothing really happens, because I just don't see a strategy that gets us anywhere good by really forcing this issue with China.
Where do the allies stand right now? The very dangerous story in the Financial Times, incredibly concerning about how Iran might actually start to target Europe and U.S. installations in Europe. At some point, is Europe going to try to step in a little bit more alongside the United States?
I think we're a ways away from that. At this stage, our understanding is the Gulf states right now have been kind of telling the U.S., listen, you're doing a decent job protecting us, but still 5 to 10% of the missiles are coming through, and if Iran is going to attack us, don't escalate this. So I think that's why we've moved to this economic pressure. I think we're going to far more likely to see additional attacks on the Gulf before we see any sort of threat into Europe. I do think that risks bringing Europe into this. So right now I think it's going to be isolated within the Middle East, but we will see whether Iran actually goes ahead and attacks infrastructure in the Gulf states. That gets really scary again.
Would we be dealing with this issue at the long end of the yield curve if it weren't for the war in Iran right now?
I don't think it would be as much. I think the bigger issue, that would be a part of it. to me, it's still the amount of debt being issued by the hyperscalers and the compute and the data center. And again, a lot of that's 10, 20, 30-year debt, right? It's not really coming at the 2 to 5 year. Separate from that, I do believe all sovereign nations are spending more on defense spending. So that sovereigns tend to issue across the curve. But again, I think there's just global pressure on yields. And I do think that the U.S. went from being the gold standard. If you wanted to own the safest asset in the world, you own U.S. Treasuries. And I think U.S. Treasuries are very generic. If you're in Europe, maybe I just buy bonds. If you're in Japan, I buy JGBs. I don't necessarily need the U.S. Treasuries. And if I want to allocate to the U.S., I'm kind of really interested in the AA and AAA issuers that are issuing at T plus 80, T plus 100. You're picking up really nice yield. And guess what? They actually have good corporate governance, unlike what the U.S. currently has.
You're more interested in buying AA alphabet debt, maybe the longer than you are the Treasury?
Definitely. I would be very underweight Treasuries and very overweight U.S. corporates and overweight foreign sovereigns. I think that's kind of the way to play it. I think that's what's playing out in the markets, is that U.S. Treasuries have just become a little bit generic. And now, as you're saying, you're adding in all these elements where, you know, we're buying some, we're not buying some. What's the true price? So I kind of lean towards those corporates. I think you're getting good spread. There might be some valuation equities on the equity side of some of the hyperscalers, but I think on the credit side, they're rock solid. You're getting paid nicely. That's where I'd be heavily overweight.
Bram, we found another one.
Yeah.
Right, the list is growing.
Well, what this indicates is that there are an increasing number of fringe buyers that potentially could toggle between corporate and government debt, and that's a fascinating development. In the past, it wasn't like that. There were yield-insensitive, price-insensitive buyers of the U.S. Treasury Department. That has shifted to more price-sensitive buyers, which fundamentally changes the equation on yields for this debt.
Pete, this was interesting. It's good to see you, as always. Thank you, buddy. Peter Chipman of Academy. It's great.
Good way to start the morning.
It's interesting. It's a lively debate. At the end of February, before this war started, 461. The yield on a 30-year maturity, 60 basis points lower than where we are this morning.
Two-pronged. On one hand, inflation expectations. On the other, how much debt has been sold by the likes of Japan to support their currency as they are hit by a terms of trade shock.
Up next on the programme, we'll catch up with Colin Martin of Schwab as the Treasury Secretary, Scott Bessent, leans into his role as the nation's top bond salesman. Plus, Yahira, how's your morning movers? Crypto-linked stocks getting a lift this morning, a lift across the board. Live from New York City, you're watching Bloomberg TV.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
So chill first thing this morning. See Lisa, good morning. Do you have a nice break? It's like bouncing, smiling in ways you've never seen before. Then we start talking about bonds. Oof. Hey,
my shoulders are up here. I don't know. I think I need to go back on vacation. It's so stressful to see the potential of where we could go and see all the potential negative scenarios, but I'm not going to go there.
I'm going to go there.
Oh, boy.
I'm going to attempt to take you there. Let's get into it. Equity futures this morning on the S&P 500 just about unchanged after snapping a three-day losing streak in yesterday's session. On the Nasdaq 100, firmer by 0.1%. The action from Treasury Secretary Scott Bessent just unlocking some gains in the equity market in the last 24 hours, unlocking a rally as well in the bond market, the long end of the curve. But that move's not holding. 30-year bond yields this morning up by 2 basis points. The 30-year at 5.2130, and it has been quite a range. From high to low, from the high of Tuesday to the low of Wednesday, a 15 basis point move on 30s, encouraged by the action of the Treasury Secretary. Will it stick? Is the trillion-dollar question.
And a lot of it has to do with what kind of follow-through there actually is. What the Treasury talked about was doubling, or at least doubling, the maximum size of the buybacks of 10 to 30-year denominations of Treasury yields. That is going from $2 billion to $4 billion per operation issued between September 9th and the middle of October. So question is, what are they actually going to do? When are they going to do it? How much power do they have? And what's their balance sheet like? What's the Fed's position on all of this? And ultimately, that might be the most important question.
The release valve right now, Lisa was talking about it about 30 minutes ago. It's the US dollar. You would have seen this take place yesterday. Equities up, yields down. What else happened? The dollar sold off and gold rallied. The dollar move is sticking this morning. We're down by 0.25%. And if you believe we're about to see increased coordination between the Treasury and the Federal Reserve, and that's a debate with no conclusion right now, there is reason to believe this dollar can go a heck of a lot lower.
One after the other FX strategists came out with notes overnight. I'm talking about Kit Jukes, who previously was already bearish in the dollar and said, well, this just turbocharged that. Because ultimately, you need to see a market expression of what we're actually demonstrating here with some sort of potential coordination from the Fed and Treasury, or even just the Treasury, techniques and tactics to band-aid over a fundamental problem.
Are they working together or against each other? I'm trying to figure that out. That's a real point of tension this morning. Only a few Wednesdays ago, you had the Federal Reserve Chair, Kevin Walsh, in a news conference talking about the unfiltered market signal that he was receiving from the long end of the curve. We were sitting around this table talking about a Federal Reserve that was about to outsource monetary policy to the long end of the yield curve, which may reduce the likelihood of hiking interest rates. And now we're sitting here this morning with the Treasury Secretary stepping in and wondering whether we'll see a completely different Kevin Walsh in a week from now.
Yeah, next week. Jackson Hole has just gotten a whole lot important. That blank page, he's probably been filling in, maybe making some edits after Bessent stepped in yesterday. But this is what we were also talking about yesterday. Last year, when yields got too high and, quote, yippee for the president, he reversed course. This is an administration that makes it incredibly clear. They have a threshold in terms of policy when it comes to yields. They will do anything to bring it down.
Yields this morning higher at the long end of the curve by a couple of basis points. 3 hours away from the cash open. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with Deere. Shares popping 5% in the pre-market after a better than expected quarter. But the bigger story is the company's confidence that the worst of the farm equipment downturn may finally be behind it, with the CEO saying that 2026 should mark a bottom of the cycle with the rebound coming next year. Now, we know that farmers have been squeezed by higher costs, tariffs, but there are some signs that things are starting to improve. For example, grain prices have been climbing, so farmers could finally have more money and more reason to start buying new farm equipment, and that would benefit to Deere. Meanwhile, we are seeing a rally in crypto-linked stocks like Coinbase and Strategy, up nearly 10%, and there are a few reasons behind this move. First, that drop in treasury yields we've been talking about gave Bitcoin an early boost yesterday as investors moved into riskier assets. But then you had the president meeting with crypto executives at the White House, saying that Congress should pass the Clarity Act, and that rally really took off. Bitcoin jumped, shorts were forced to cover, and that added even more fuel to the move. And we end on hyper-liquid strategies, because also at that meeting, President Trump said that regulators are working to bring hyper-liquid to the U.S. And this is a fast-growing crypto platform, best known for trading things like perpetual futures and leverage trading. The stock jumped 30% yesterday after President Trump's mention, up another 8% today. John?
Yahira, thanks for the update. More from Yahira in the next hour. On our radar this morning, yields rising across the curve, appearing to shake off Treasury Secretary Scott Bessent's attempt to rein in borrowing costs. The Treasury announcing it would at least double planned buybacks of 10 to 30-year debt. The U.S. national debt topping $40 trillion for the first time, more than doubling over the last decade, and the hole is expected to get even deeper, with interest costs now representing the third largest part of the budget. And finally, the minutes from the July FOMC meeting revealing growing internal friction at the Federal Reserve. Several officials favoring an interest rate hike, with many indicating sticky inflation could lead to policy tightening.
This is a reason why it's going to be hard to get such easy Fed-Treasury coordination, because the Fed is a committee. And there are many who see the potential of inflation as being a serious issue that is the preeminent threat to the central bank. Most were on board with this idea of holding interest rates steady. What you are seeing in terms of Fed funds rates is increasingly pricing out a rate hike for this year, because ultimately it did not seem like there was a critical mass of people who are behind the idea of hiking rates and even being prepared to at the last meeting.
I saw a silver lining, though, in these minutes, and that's that you guys might have maybe less Fed shows.
Six, apparently.
Six, apparently, yeah. Confirming what the New York Times and Scoop they had. The chairman observed that 6 scheduled meetings per year, held roughly every 2 months, would allow more information to accumulate between meetings than under current practice. So they get more time to digest this data and, meet less.
Lisa's taking the rest of the year off.
Clearly.
After the last 24 hours.
I think I need to go back on vacation.
She's fired up.
Well, honestly, I enjoy hearing from Fed officials. I think it's actually more important currently. And I know we always joke about Fed communication being a little bit overdone. I welcome it, because right now, unless they're talking to us, and frankly, unless they're giving us some indication of exactly where there is consensus on this committee.
The San Francisco Fed President Mary Daly joining the program in 2 hours' time. Welcome whenever she wants, daily, if possible, right? Can do it every single day.
Could be a segment, daily.
Wasn't the intention. Let's talk about this Treasury market. Investors digesting the very sudden bond market maneuver.
Market reaction suggests that this is an important tactical move from the Treasury. I don't think it changes the fundamentals of big fiscal deficits and a Fed on the sidelines. You got to take some policy action here.
The Treasury Secretary, Scott Bessent, leaning into his role as the nation's top bond seller, as his latest market move could be running out of steam. Colin Martin of Schwab writing, the Treasury's desire to act may give investors some solace that there are additional levers to pull to try to prevent yields from rising much further. Colin joins us now for more. Colin, good morning and welcome. Echoes of 2023, middle of October, yields push towards 5% at the long end of the curve, and you start to see Janet Yellen at the Treasury blink. And by year end, we dropped over 100 basis points. Colin, does this have echoes of 23 for you, or is this moment different?
I do think it's a little different, because when you think about, how the different administrations react to the changing in interest rates, we know that this administration is very attuned to the long end of the curve. And in fact, we saw long-term yields rise, and I was kind of scratching my head over the past few weeks that we knew that's something that President Trump and Bessent have specifically signaled that they're paying attention to. So I think they are a little bit different here in terms of how they're doing it. I think a lot of it in 2023 had to do with duration mismatches at various banks. But what this is showing us here is that the administration is looking to pull some levers, and that there is some sort of pain threshold that they're looking for. And with long-term yields moving up and kind of the trend continuing, That's a risk they know domestically if you're a potential home buyer, what that impact is on mortgage rates. So I don't think it's too much of a surprise, but we generally share the view that most people that you've shared in clips here, and we see it in quotes across numerous articles, in that this appears to be a short-term fix, and the deep-rooted issues and factors that have driven long-term yields up are still very much present.
One of those factors, Colin, many people have argued on this program, is the Federal Reserve contributing to high yields at the long end of the curve. Where do you think this leaves the speech from Kevin Walsh next week in Jackson Hole?
Yeah, to be determined, I think, was it Anne-Marie saying he's still kind of filling in the blanks right now. We do appear to have kind of diverging paths right now, where Treasury is looking to get long-term interest rates down. Walsh has acknowledged that long-term interest rate increases can do their job for them. And we know we have a minority, but potentially growing minority of officials who think higher rates are necessary. So we already were expecting something interesting next Friday from Kevin Walsh, maybe an update on the task forces, maybe an update on how he actually views monetary policy or what he's looking for to potentially change that view, although I think the odds of that were pretty low. Now he might feel the need to address this and maybe how they're working together, or maybe how they're working in different directions right now and what that looks like going forward.
If the Fed were to cut rates right now, Colin, would you buy or aggressively sell the long end of the yield curve?
Well, if compliance was on here, they wouldn't want me to say aggressively do anything, but I'd be a seller. I'll give you that much. We think there is a risk here on both sides, whether it's fiscal or monetary, Fed or Treasury. There could be a credibility issue. I say could be because we don't think we're there just yet. In terms of the Fed, I don't think a potential lack of credibility is what drove yields higher over the past few weeks. It's a global phenomenon. There's a lot of factors driving that. Same here with Treasury. The Treasury and Secretary Bessent, they have every right to kind of change the potential makeup of their auction sizes if they want to do liquidity buybacks. But if this became a sustained issue, I do think credibility is on the line. And whether it's Treasury or whether it's monetary policy or the Fed, that's something that keeps us up at night. And if you see that lack of credibility, you'd likely see the dollar decline, you'd likely see long-term interest yields spike, and you'd likely see inflation expectations rise. So given all this, this just adds more kind of fuel to our guidance to not be aggressively adding duration right now. We've gotten those questions recently, with the 30-year above 5%, the 10-year closing in on 4.75% is now the time. And we're still saying be patient right now, and we still favor more short and intermediate term maturities.
When you're up at night thinking about what you want to do, how much are you looking overseas, potentially to Europe or some other places, saying, look, we're getting some duration?
I hope he's not thinking about the bond market when he's up at night.
I think that he is. He's up at night because he's worried about Fed independence and the loss of credibility. So, Colin, what do? Do you actually start diversifying away from U.S. dollar-denominated debt?
Maybe a little bit. That's not our case right now. We still do see value in the dollar and in U.S. Treasuries, but we acknowledge that we just have this rising debt load, and we need to find those marginal buyers. There's still, trillions of dollars looking for homes, looking for a home with U.S. Treasuries, whether that's with foreign central banks, whether it's with foreign private investors. But there doesn't appear to be an end in sight with our fiscal issues and our Treasury issuance. So that means we need to keep attracting more and more dollars. Doesn't look like central banks are interested in buying any more. So that means foreign investors need to do more of the heavy lifting, or private investors rather. And when we're seeing global bond yields rise everywhere in other developed markets, that does present more attractive opportunities maybe for a foreign investor. If you're U.S., maybe you can diversify out a little bit. We do think that domestic investors are probably serially under-allocated to global bonds. We think they're under-allocated to bonds in general, but there's definitely a home bias. So maybe getting some international developed market exposure could help today, mainly because we think a lot of investors aren't really focusing there right now.
Colin Martin of Schwab. Colin, good to see you. I think we know what Bramo does at night, right?
Oh, absolutely.
Gets charts of the S&P 500 and rotates them so it looks like they're down and not up, and then goes back to sleep.
And then just stresses and then comes in fired up. That's really, you think that I manipulate negativity to try to fire myself up in the middle of the night?
Yes, without a doubt.
My family is so happy.
Let's give you an update on news worldwide this morning. With your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump announcing plans for what he's calling an economic D-Day against Tehran. Trump posting on Truth Social, this will be economic warfare and isolation on an unprecedented scale. The president adding, we need all of our allies to stand with the United States to isolate and defeat the Iran threat. A Chinese court sentencing the billionaire founder of Evergrande to life in prison. The real estate giant collapsed under more than $300 billion worth of debt in 2021. Hui Ka-han pleaded guilty in April to several charges, including fundraising fraud, misuse of funds, and securities fraud. Democratic senators are urging Fed Chair Kevin Warsh to disclose any talks he has with President Donald Trump, citing Fed independence. Sources telling us here at Bloomberg, Trump and Warsh have spoken by phone periodically since Warsh took the role in May. And that is your Bloomberg brief. John.
Vonnie, thank you. Thanks for the update. Up next on the program, the bar for a September hike.
I think we're actually very, very close to a September hike. Even though it's not our base case, the bar is actually incredibly low. The curve would flatten materially on a rate hiking cycle.
Up next, Krishna Gua of Evercore, live from New York City. You're watching Bloomberg TV.
We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Stocks this morning just about unchanged. Here's an update for you on the Nasdaq. We're positive by 1/10 on the small caps. We're negative by 0.1. In the bond market, 2s, 10s, and 30s. Will the move hold? A lot of attention is going to be on that throughout this morning and into this afternoon. Yields higher at the long end again by close to 3 basis points, 521.70 this morning on a 30-year. Under surveillance this morning is the bar for a September hike.
We think they actually try their best to hold through it. Obviously, the risk case is by September, by October, that you actually get enough to hike rates. I think we're actually very, very close to a September hike. Even though it's not our base case, the bar is actually incredibly low. The curve would flatten materially on a rate hiking cycle.
So here's the latest this morning. Minutes from last month's FOMC meeting revealing several Fed officials were in favor of raising interest rates, and many indicating they could be ready to pull the trigger on future hikes if inflation doesn't drop. Krishna Gua of Evercore writing, minutes are not particularly hawkish. The FOMC is likely not currently minded to hike in September. Krishna joins us now for more. Krishna, welcome to the program. That was some new information, potentially. The bigger piece of information came from the Treasury and Scott Bessent. To what extent do you believe that action might influence the decision of the committee in the coming weeks?
Well, it certainly complicates things for Walsh and for the rate outlook. I mean, remember, Kevin Walsh has made a point of saying that he wants to step back and let the market form its own yield curve. Let the market determine what the appropriate degree of restraint across the yield curve is, and suggest that the Fed, in some senses, should be a little bit more differential to that, perhaps, and not try to guide or shape that in the way that his predecessors have done. And he sort of also argued that, in a sense, in the interim, can make sure that monetary conditions are appropriate for the economy, giving the Fed time to think about what it should do. Now, it's a lot harder to appeal to market yields when the Treasury Secretary is actively intervening in that marketplace. So I think it does have to push Walsh a little bit more into the mode of a more conventional focus on monetary policy. Obviously, to the extent that Bessent's able to hold down yields, if he is, dollar weakens, other things, that needs to be taken into account in setting of monetary policy. But I do not think that this is, at present, a game changer for September.
What do you think would be a game changer?
So I think what we've seen very clearly in those Fed minutes is that the committee is reasserting a traditional form of data dependence. They wanted to see how the inflation data, broadly considered, so that's inflation, it's also oil, more broadly, any signs of overheating in the real economy, how did that data evolve over the summer before making the call on rates in September? Most Fed officials, per the minutes, do expect that inflation will moderate over the balance of the year. And I think under that old school data dependence, the data is coming in so far good enough not to go in September.
That said, how much does potentially a weaker dollar and a question about what the Treasury is going to do with buybacks in the longer end of the Treasury curve increase the importance of a September move? In other words, is the signal that they're getting from that giving them a little bit more of a guide to whether they should cut or hike come September?
So I think if you thought that yields are backing up because of concern about Fed credibility, because of a rise in inflation compensation, right, then there would be quite a strong case for a Fed rate hike in September, a hike or two over the next few meetings. You might anticipate that that would have a material effect on bringing down those longer-term yields. But that's simply not what you see. You guys know, you've talked about this, the move is in real rates, the move is in real-term premium, and it's being driven by the tidal wave of issuance across the AI hyperscalers on the one hand and global sovereigns, including the US, on the other. In this type of world, if the Fed just raises rates once or twice, I don't think it has any appreciable effect on longer-term yields. It's perfectly possible longer-term yields could even go up a bit if the Fed was seen as validating the view that the neutral interest rate will, in some permanent or persistent sense, be higher going forward. Remember, the ECB and BOJ hiked rates earlier this year. What happened? Their yields kept going up.
That said, there is a question here about credibility and what exactly we get from other Fed members that are concerned that there could be a loss of it by the central bank if they don't hike rates in the face of rising long-term yields and some stickier inflation. Do you see that as a concern and any signs of that in the meeting minutes?
Well, for sure, that's the debate. You're absolutely right. And, as you know well, there's, close to half the FOMC who, hold some version of the view just articulated. And what I would say is, though, that the governing majority still, it's not a huge majority, but the governing majority still, views that inflation is likely to come down, was willing to hold hold rates where they are, provided that the summer inflation data showed some progress. It has shown some progress. And I think that that majority will still take the view that looking at inflation expectations and looking at the data, it is reasonable to take a pass on September, and then in effect, December becomes the new September. Let's see what we then learn over those subsequent 3 months. Remember that there's no sign in those minutes of real sort of head of steam building for a September hike. It's data dependent and conditional, and so far that data is going their way, and so far Besant's buybacks have not contaminated inflation expectations. If they did in a serious way, that's different.
Krishna, is everyone just looking through October because it's so close to the elections?
Look, and the short answer to your question is yes. I don't think that this is because we think that the Wash Fed is heavily politicized. I think it's just standard Fed practice that there's a high bar for any change in the sort of the directional pattern of monetary policy right in front of an election. So if you're already in a gradual hiking cycle, if you're already in a gradual easing cycle, I think you could just continue, in that vein in October. But to spring a hike in October is a pretty high bar for that.
Krishna, always enjoy hearing from you. Thank you, sir. Krishna Goa of Evercore, heading into Jackson Hole next week and a Federal Reserve meeting in the middle of September. It's not without risk to shift all the issuance to the front end. And you're taking a major bet on the future of interest rate policy at the Federal Reserve. And if the Fed is cornered and they can't hike interest rates, and you've talked about this dynamic repeatedly, Bramo, you end up in a situation where all the issuance is at the front end of the curve and the Fed is locked into a corner and can't hike interest rates because of what's happening with the Treasury and the deficit. The action you could see elsewhere in response to that across financial markets could be very, very bad.
Well, and we're seeing that with the dollar, right? I mean, ultimately, that is the release valve. But what you could get in terms of inflation expectations would be a massive problem. And as Krishna was saying, you're not seeing that yet. Five-year forward break-evens haven't spiked higher. Nonetheless, if you get a protracted move weaker in the dollar, we're importing inflation at the same time. There isn't a resolution in the Middle East, and that is a toxic brew for the inflation backdrop going forward.
There is no free lunch here. There are trade-offs, and the trade-off right now, at least in the last 24 hours, has been a weaker US dollar. Coming up next, we'll catch up with Jack Manley of JP Morgan Asset Management, the PGIM Vice Chair, Dilip Singh, Jeff Jacobson of 22V Research, and Guneet Dhingra of BNP Paribas. Futures this morning on the equity side of things, just about unchanged on the S&P 500. In the bond market, everybody laser focused on the long end of the curve. Yields higher again by 3 basis points. 30s this morning, 522.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid? I don't think I was reading magazines until I was in them. You are on the cover of all of these. Oh, and there's many, many more, but we just don't have time. Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise Ahead or Gattaca?
Maybe somewhere in the middle.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
When the bond market speaks, people listen.
The pressure is on for Warsh to say something more.
What is uncertain is if Warsh cares about the long end as well.
The market is going to want to see action.
You've got global risk premium. It's not just a U.S. story.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action the scores look like this. Equity futures on the S&P 500 just about unchanged on the S&P. On the Nasdaq, positive by 0.1%. In the bond market, 2s, 10s, and 30s. Yields on quite a round trip in the previous 2 days. Yields bouncing back this morning by 3 basis points. 30s around 5.22. In about 90 minutes' time, we'll have some more economic data for you. Jobless claims at 8:30 Eastern Time. Some PMIs heading into the weekend. The focus is on the U.S. economy right now, with numbers from Walmart. Drop in, Bremo, just seconds ago.
Yeah, and unclear. It's kind of a mixed read. On one hand, their full-year adjusted earnings per share slightly above the target, $2.80 to $2.87 versus a $2.75 to $2.85 range. That said, U.S. stores comp sales in the second quarter, removing gas, were up significantly below what the expectation was. So I'm going to look through this, and we'll be discussing it throughout the morning. But the real question here is, how much did Walmart make up for margin being squeezed on U.S. products with efficiencies and other product lines, given how much they've expanded their online presence, their entertainment business, and frankly, their advertising sectors?
In June, the CEO said if this war continues and we continuously see an uptick in energy prices, then that is potentially going to hit us in the sense that we're going to have to pass some of this on and increase some of our prices. And we'll see whether or not potentially that is going to, on the margins, mean that some consumers are going to have to push back.
We'll stay on top of that story and keep tracking the stock move. It's down in the pre-market by 4% on Walmart this morning. Let's turn back to fixed income, 2s, 10s, and 30s, and a big focus on the 30-year piece of the yield curve. 30s with a massive round trip Tuesday through Wednesday. Tuesday at the high to Wednesday at the low, a 15 basis point move, accelerated by the action coming out of the Treasury.
Yeah, and a real question about how far it will stick. You've been talking about that all this morning. The idea that yields are back up, not great for Treasury Secretary Scott Bessent. Key question, where's the meat behind this? If they are going to double the repurchases of longer-term debt in the United States, it doesn't increase their total balance of what to work with. They have to increase the front end of the yield curve and ultimately issue more there. Then over to you, Federal Reserve, which sets the rates for a lot of that issuance, and that is where the discussion about Jackson Hole comes into play.
And as we have these rising yields, Mohamed El-Erian is out with a piece this morning in the New York Times talking about how if you take all of this into account, we get a yield surge like no other, driven by all of this combination of tech energy, higher inflation. And he talks about the fact that the economic and political risk could tempt the Trump administration into a new phase of market interventions to tame the so-called bond vigilantes. We saw that yesterday. The question is, how much more does this continue, and what else can they do?
So in the last few weeks, what have we seen from the Treasury? We've seen them attempt to prevent the Japanese from monetizing dollar reserves. We've seen them double the buybacks, liquidity support. I'm not sure you can call this liquidity support. It certainly looks like something else. And the question now is whether that is the first of two steps that leads to a third step, which is to tighten up duration, tighten up issuance at the long end of the curve going into November. Most people speculate that's the direction of travel now in the next few months.
Yeah, you know, I have another suggestion. Maybe cut costs. The Treasury Department...
Address the deficit.
Address the deficit. I mean, the one person who's not freaking out is the collective body of Congress. Where are they going to come out? And guess what? The willingness is non-existent. But the acceleration of the deficit is the ultimate problem. And the fact is, when you have a glut of debt being issued, people have more selectivity when they decide what they are going to buy. And ultimately, if you just pour money into that, well, what do you expect? The yields are going to go up.
Where do you cut? Social Security and Medicare, 22%, 14 to 15% of the budget. That is the makeup of what we spend. And if you are any politician and you try to campaign on, well, you know what? Good luck. Yeah, good luck. I interviewed Nikki Haley. She said we should maybe increase the retirement age. Guess what?
She got hammered for it.
The Trump administration clipped it and ran it everywhere. It's not going to work. We could skim a program here or there and make it less, but it's not going to make a dent.
They will fix it when the situation is bad enough that they'll get elected to do something about it.
Yep.
We're not there yet.
That's when Lisa runs.
That's when Brahma runs.
Yep, 100%.
I've been screaming about the deficit
You
since I
bring the
was
tea
5
party
years
back.
old.
I have the clips ready to go. I'll make your sizzle reel.
Look, this is part of the problem. You say it's, you know, the market relaxes when officials, when central bankers and treasury secretaries freak out. Well, the wrong person is freaking out to address this because just the Band-Aid isn't going to solve the underlying
I can see Brahma running, right?
I think so, yeah.
As an independent.
You could be the chief.
Why not?
You could be her chief.
You're giving me a role?
Yeah.
I
You could be
appreciate
head of the her economic policy. I'll do comms.
Okay, thank you. Who's doing the show?
I don't know.
No? Okay.
We'll do the
All
show
right.
too.
Debate this another time. Coming up this hour, Jack Manley of JP Morgan. With stock stalling as bond investor nerves begin to calm, PGIM Vice Chair Dilip Singh on the US plans to buy back longer maturity debt, and Ganeet Dhingra of BNP Paribas on what the Fed needs to do before yields can stabilize. We begin this hour with stocks struggling to maintain momentum after the government unveiled a strategy to ease pressure from a recent bond market rout. Jack Manley of JP Morgan Asset Management saying it's a move that caught the market off guard. He writes the following: I'm not buying duration because it's a wild card, but I'm still not sweating the hiking narrative. Jack joins us now for more. Jack, good morning.
Good morning.
Two separate points there. They're connected, but let's start with the first one. Just on the issuance and buying 30s, why is it not a game changer given what we saw in the last 24 hours?
I would say there are just too many competing factors out there that are moving long yields, and even small moves in long yields are going to have enormous impact on the prices of those bonds. And one of the things that continues to just shock me is that we've had, I mean, relatively speaking, an enormous amount of cumulative easing on the short end of the curve over the past couple of years, and yet the 30-year Treasury is yielding more than it was back in September of 2024 when the Fed first started cutting rates. I don't think anybody was really anticipating that move. Perhaps not a commensurate move downward, but certainly not a move higher, right? Especially when we're talking about what's happening on the short end. I just don't want to put my eggs in that basket. There's too much potential pain that I can be exposed to. I'd rather shorten up on the curve and clip a relatively healthy coupon and just sit out the duration conversation.
Is there some corrective action that would change your mind?
Do we go back to talking about the deficit?
Lisa
you know, like, I'll be your VP. I don't know. Like, you know, like
in the midterms would change your mind.
You know, I mean, you're talking about a multi-trillion-dollar Treasury market. A couple extra $1 billion here or there is not going to move the needle when you hear about a $40 trillion debt number that came out earlier this year. That would ultimately be what helps to put some real downward pressure. I think there's also a political component in here, obviously related to the deficit, but these persistent government shutdowns that appear to be happening more frequently, politicians on occasion discussing the idea of, hey, maybe we'll default on this debt. There is incrementally more credit risk associated with U.S. Treasuries than there's probably been at any point in, I don't know, as long as I can remember. And that would have to be a problem that could solve too. How do you do that? I have no idea.
Let's just say that the Federal Reserve cuts rates.
Yes.
Pushes you out of that nice coupon-producing short-term debt, says, you know what, you don't have a free lunch. You have to go pick some other options. Does that push you into duration, or does that push you over to Japan or Europe?
That pushes me into stocks. I mean, honestly, like when I think about what's happening with the interest rate environment, I own bonds, and maybe this is the wrong way to think about it, but I own bonds purely as that ballast, purely as that insurance policy. I'm not looking for something to juice my portfolio returns. I'm not trying to get cute with it, especially when you're looking at global equities, U.S. equities in particular, that have been performing so well on the back of very strong fundamentals. So if that hurdle goes down and I got to figure out some other way to make money, I'm just pivoting into the S&P.
That sounds great, but you wrote about AI that it certainly looks like the emperor has no clothes, which made me say, whoa, 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 hold on a second. How are you sounding so constructive if you think that AI is a bubble with a lot of money going towards something that really isn't going to be what it's promised to be?
Yeah, well, it's a cheater's answer. The cheater's answer is, I think, beyond the next 12 months, right? I mean, like, we're long-term investors. We talk about long-term investing. I don't think I've sold a single equity in my portfolio since I've been an investor. You ride the wave, because I have no doubt that artificial intelligence is here to stay. I have no doubt that all these people that are pumping all this money into this stuff will figure out an effective way to monetize it. You're already seeing interesting news on the enterprise front, a whole lot of spend going towards powering that infrastructure. It's just not going to happen, I think, in the next 6 to 12 months, which is why we're having more sort of short-term diversification conversations. I've long been something of a bear on international equities, but I'm leaning into them a little bit more than I typically have as that ballast, as that quote-unquote hedge against that exposure. But I'm still a big believer in U.S. equity exceptionalism. I still believe in a long-term overweight to U.S. stocks.
Thinking 12 months out, and I'm going to get, I'm sure, boos if you're watching at home, the U.S. is going to hit its debt ceiling next year. In the middle of 2027.
Yeah, that's fine.
We're on the same page here.
A lot of people are. Yeah. Given the environment we're in right now and the fact that Congress doesn't want to act, I mean, how concerned are you actually about this happening?
About hitting the debt ceiling? I mean,
well, yeah, and then not actually taking action.
It will be yet another source of volatility that we have to look forward to. It's something that feels like it happens a lot more frequently than it should. I still fundamentally believe that cooler heads prevail and that the adults in the room will figure out how to deal with this. I don't think anybody can fully appreciate how disastrous it would be for the United States to default on its debt. That is a box that is once opened never gets closed. So many of the privileges that we have in this country are due to the fact that our credit rating is about as close to solid gold as it possibly can be. And despite all the rhetoric and despite certainly the rise in populism we've seen on both sides of the aisle, I think at the end of the day, behind closed doors, the right decision gets made.
There's a camp on Wall Street, and it's growing, that they would do anything they can to inflate their way out of this. And that the action we saw in the last 24 hours was evidence that they're doing everything they can to avoid tighter financial conditions. And it was a green light to buy stocks, to buy real assets, to buy gold. It's exactly what we saw take place yesterday.
Yeah, and how far can that go? Ultimately, how much are you going to sell the dollar? You just wonder, though, can you inflate your way out of a problem that continues to accelerate? I was looking at the Peterson Institute, and they put out data that said if we don't reform our budget, we will hit $50 trillion in just 6 years. So we doubled to $40 trillion in less than 10 years, and then we would hit $50 trillion in just 6 years. The acceleration of the expansion of the budget is really notable and concerning for a lot of people.
Jack, appreciate it. It's good to see you. Jake Manley there of JP Morgan Asset Management. Bramo's running.
For what?
Right.
Running for the weekend.
Bramo's running.
Yeah.
For year end.
Yeah.
Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Walmart shares lower in the pre-market. The big box retailer reporting posting its slowest U.S. growth in 6 years as shoppers spend less per trip. The company's pharmacy business weighing on U.S. sales due to federal drug price negotiations that have led to lower prices. Shares of Deere, meanwhile, rising in the pre-market. The company narrowed its annual profit outlook as the agriculture sector stabilizes, expecting net income between $4.75 and $5 billion. Deere's CEO sees 2026 as the bottom of the agriculture equipment cycle. U.S. public debt, as you've been saying, topping $40 trillion for the first time. The Treasury Department ramps up its buyback program for longer-dated securities to stabilize yields. The rise in debt is expected to continue, with interest costs now the third largest part of the budget. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thanks for the update. More from Vonnie in 30 minutes' time, a little bit later this hour. Up next on the programme, backstopping the bond market.
Has the administration done enough to stabilize the bond market after yesterday?
Well, I think it is, but I mean, it's very sad. Every time we do great, we announce great numbers, the interest rates go up. We're powering through these ridiculous interest rates.
Up next, the PGIM Vice Chair, Dilip Singh, live from New York City this morning. Good morning.
countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with the crypto, only on Bloomberg. When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Equity futures this morning just about unchanged on the S&P 500, slightly negative on the Nasdaq. We're down by a tenth. One single name in the pre-market to look for is Walmart. Walmart's down by 6%. Not typically the move you'd expect to see after a company raises guidance into year-end for adjusted EPS, but that's what we see from Walmart this morning.
There already had been a lot of positivity baked into these the numbers that we had gotten this morning. Same store sales at U.S. stores slowed much far below the expectation. It's the slowest expansion in more than 6 years. The concern here is after a rapid fire expansion, it's just difficult to keep up that kind of pace. It's also getting a little bit more choppy given the uneven economic backdrop. Expect a lot of discussion about the K-shaped economy throughout the morning. Either way, this to me gives a sense of what we've heard from some of the sentiment surveys as well as what we got from the economic data that's meh, but not amazing recently.
Is this one of those moments when Walmart is good, it can't be good because people are trading down, and when Walmart's bad, it must be really bad? Is it one of those moments?
Of course it is.
Right, okay.
I mean, Walmart is, a negative indicator regardless of what it is.
But Target did well, and then what are we going to say? It's only because of the
turnaround.
It's not because people are still out there spending.
Exactly.
It's high expectations. The bar was high. They came in. They didn't show the same pace.
Let's talk about bonds.
Thanks.
Right.
Absolutely.
2s, 10s, 30s. Yields look like this. At the long end of the curve, yields higher by 3 basis points. 30s, 5.22. Under surveillance this morning, backstopping the bond market.
Has the administration done enough to stabilize the bond market after yesterday?
Well, I think it is, but I mean, it's very sad. Every time we do great, we announce great numbers, the interest rates go up. And they go up because they want to stop inflation. We have a very powerful country, and we're powering through these ridiculous interest rates.
So here's the latest this morning. The Treasury Secretary, Scott Bessent, taking action to lower long-term government bond yields as the U.S. debt pile tops $40 trillion for the first time. The Treasury saying it will at least double its planned buybacks of 10 to 30-year debt. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, all of this is becoming a politically fraught issue as financing costs feed through to the broader economy. Now, we've heard the Treasury Secretary Scott Bessent previously talk openly about the idea that he wants to lower bond yields in a bid to lower mortgage rates and other borrowing costs, but that hasn't gone as planned, in part because the U.S. government continues to run large deficits regardless of what the department does with its repurchases. And in part, that is because at the moment it is pretty difficult here in Washington. That's the reality when it comes to cutting spending, especially during an election year. If we dig into some of that Treasury Department data that was released just yesterday showing that public debt surpassed $40 trillion, that includes the record budget deficit from July, which was fueled by a surge in healthcare costs and Social Security, and that interest on the federal debt continues to be a key driver. Last month, there was a 15% increase in debt servicing costs year to date. John, it further adds to the pressure as Republicans are trying to figure out their economic messaging getting closer to November, and that's now prompted the White House, though, to float potentially new tax cuts as it keeps asking for an increase in defense spending.
Well, they've got a few years to get it together, Tyler. Otherwise, Bramo's going to start primarying people in a few years' time.
Do you care about the deficit? How much do you watch the 10-year yield?
There you go.
Out.
Tyler Kendall down in Washington. Tyler, thank you. PGIM Vice Chair Dalip Singh standing by writes the following. Many have worried about this as a financial repression endgame, but Treasury does not have enough firepower by itself to change the supply and demand equation. Dalip with us around the table. Dalip, good morning.
Good to see you.
Bramo can make it in politics, right?
You said not a chance.
I like your fire.
Yeah, no, not a chance.
Dalip, what's happening here?
Look, I mean, when you're in government, there's enormous pressure to do something, to act when there's a bad news cycle or there's a troubling financial development. But, in my experience, more times than not, the best response is no response. And so, look, I think the Treasury buyback announcement yesterday, and I would also say the intervention from earlier this month, they're examples of when you don't have fundamentals or overwhelming firepower on your side. And look, I think the trigger pullers know when there's blood in the water, and they may see this as a de facto peg that they seek to break. So I think the lasting imprint of this action is going to be higher rollover risks. You're going to have higher term premium because Treasury's less regular and predictable. I think it's more likely the Fed will have to hike because you're loosening financial conditions and you have higher interest expense. I mean, I don't think it's crazy to say you are creating the conditions for a front-end doom loop. So I don't like it.
Do you see this toward the direction of a Treasury-Fed accord between Scott Bessent and Kevin Warsh?
Well, that wouldn't exactly be a balance sheet reduction strategy, which is where I thought the Fed under Chair Warsh was headed. I mean, ultimately, the reason I said Treasury doesn't have enough firepower by itself to change the supply and demand equation is, even if you max out on this buyback program over the course of a full year, you're talking about less than 5% of total gross long-end issuance beyond the 10-year point. So you really do need to bring in the Fed. You need that as your bazooka if you want to change market sentiment. And that would require, if you want to just imagine what it would sound like, Kevin Warsh and Scott Bessent holding hands and saying, we are going to engage in a market functioning QE program to anchor long-end yields in line with long-term fundamentals. Now, I don't think that's going to happen, but that's what it would take.
During the Biden administration, Janet Yellen issued on the front end, and you expect Bessent, who was then quite critical of it, to follow in her path?
So there's some big differences. Back then, the bill share was about 15%. Now it's 22%, so pretty close to the highs outside of a crisis. There was also about $2 trillion sitting idle at the Fed's overnight repo facility, and the Fed had just hiked over 500 basis points. So the initial conditions were very different. I think debt managers should do what they can to get the lowest cost for taxpayers over time. But you pick your spots. This isn't a great spot.
You were saying you think that the Fed is going to have to hike rates in response to this
Not in response to this. I think it makes it more likely.
It makes it more likely. Other people, including Krishna Guha, would say, well, the reason why the long end is selling off has nothing to do, even with the deficit. It has to do with AI issuance. And what does the Fed have to do with that? It doesn't have to do with inflation expectations. And look, you can see it hasn't been really bleeding through in break-even rates. What would your response be?
I mean, I would leave it to others to do the relative attribution, but it's clearly a function of loose fiscal policy, loose monetary policy, price-insensitive supply, both from corporates and from the government, and more price-sensitive demand. I think the reason to hike rates is we still have a decent share of our economy that's rate-sensitive. The housing market, we have wealth effects, we have big consumer durable items that are sensitive to rates, and you have wealth effects. So the Fed should control what it can. It can't change the fact that hyperscalers are issuing at record levels. It can't change the fact that there's no political appetite to reduce deficits. But what it can do is reduce demand and shore up inflation expectations.
If the Fed does not hike in September, are you more likely to buy overseas? Are you more likely to protest U.S. assets just by virtue of a lack of faith in a reaction function that is tied to the economy?
Well, I think markets are telling you what they will do if the Fed continues to sit on its hands. It's going to continue to sell the long end. It's going to continue to sell the dollar. It's going to buy gold, buy digital assets, buy non-dollar currencies. That trend would continue. So I'm hoping that at Jackson Hole, we get more of a message that, look, we understand we're living in a world of connected, repeated, and compounding supply shocks that are net inflationary. We understand that policy right now is loose, and so are financial conditions. And we don't think that bygones are bygones. We know we've missed the target for 65 months, and that inches us closer to a psychological tipping point that's really costly to recover from. If Chair Warsh delivers that message, I think September, October, and December would be live. That would be a good thing, because it would be on the path to reestablishing a nominal anchor for the world we live in.
That's the speech you want.
That's the speech I hope we receive.
What's
That's
the
one I want.
speech that we'll get?
Look, I have to say, I think Kevin Warsh is a highly credible Fed chair. He's his own man. He is not a sock puppet. And I think people are mistaken if they think he's going to deliver a dovish speech, especially because of what we just saw Treasury do. That's a mistake.
What would it mean for the front-end doom loop if he does make that mistake?
If he does not deliver a hawkish message, well, then I think the long end loses its anchor. And so it's not a front-end doom loop, it's a long-end doom loop. Yes. And so you're going to see what we've experienced over the past month, some multiple of that type of pain in the long end. And so there's no way out of this other than to tighten monetary policy.
I don't want to start a fight with you and Robert Tipp over at PGIM, but Robert is one of those individuals that talks about the return to normal.
Yes.
And the return to pre-GFC interest rates. Is that incompatible with the current debt dynamics of the United States?
Robert's a lover, not a fighter. I mean, look,
But are you a fighter, not a lover?
Probably yes. I have said we're returning to what I call the old normal. Okay, so the Great Moderation was the geoeconomic anomaly. We're back to a world of fiscal dominance, economic warfare, energy insecurity, and a CapEx race to the commanding heights of cutting-edge tech. All of those forces push up inflation, they push up nominal GDP growth, they push up yields. The difference is, and this is, I think Robert would acknowledge this, we have a debt stock at 100% of GDP. We have all-time highs in interest expense. It consumes 20% of our federal revenues. And we have a price-sensitive buyer base. So that means your room for policy error is really small. And I'm afraid we're committing some of those errors, with all due respect to Treasury.
Could speak to you all day. Dilip, appreciate it.
Thanks a lot.
Thank you. There'll be no fights at P, Jim. They're all kind guys. We know that, right?
Well,
right?
yeah.
Yes, Bramo, you say yes.
Yes, they are all kind guys.
Greg Peters not going to throw hands, is he? Come on.
Hold on a second. Just because they're kind doesn't mean that there are some very serious, rigorous discussions about what we do with the deficit, which is clearly on everybody's mind.
We've got to have those serious, rigorous discussions right now because the fundamentals right now all equal. They all equal a higher clearing price to get treasuries away, a higher clearing yield. And the Treasury is going to do everything they can to fight that. The question is whether the Fed steps out or steps in and comes along for the ride.
And whether that will help or hurt, given how much they could potentially come in.
Thank you, Dilip. Thank you, sir. Up next on the program, Jeff Jacobson of 22V Research warning that high yields could begin weighing on housing stocks.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about. The
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Equities pulling back here, a few hours away from the opening bow. We're down a few tenths of 1%. No drama just yet, but down 0.2 on the S&P, down by 0.3 on the Nasdaq. Plenty of drama at the long end of the yield curve. Check it out this morning, 2s, 10s and 30s. Yields this morning at the long end of the curve actually rising by 3 to 4 basis points. Now, I wonder if this is where some of the pain is coming from in the equity market. Now, I don't want to make too much of a 0.2 of 1% move on the S&P 500, but I'll make some of this. I'll make something of this. 4 basis points on 10s, up by close to 4 on 30s. That's to watch today. If this move from the Treasury yesterday doesn't hold and you start to see yields creep back towards 530 again, we may have a bigger problem than one we had before.
It's a credibility problem with what the Treasury Secretary can do, but not to mention what the Fed's response might be. It starts to raise questions about why there is panic, given where yields are, given that so many different people were saying before it's only because the economy is going so well that yields are higher. Why then is it turning into something more like a crisis?
Yeah, this 30-year yield, if it keeps grinding higher, it's not going to be a happy birthday for the Treasury Secretary tomorrow when it comes to this, because no one really thinks that they did this to have more liquidity. This feels like an intervention to try to bring yields down, and it feels like a Band-Aid.
The move in crude won't help. We're higher by more than 3% this morning, approaching 89 on WTI. Brent crude this morning at 94 and up by close to 3%.
Not good. And honestly, Peter Cheer talking about the fact that we are 40-year low of our SPR. Potentially there's damage that's being done. At these levels, the United States can't go out and buy and fill up. The president is talking about more economic pain to the Iranians. Well, that's going to mean having to go after the Chinese. Does anyone actually see that happening before Xi Jinping comes and a midterm election?
You've got higher crude prices and a weaker US dollar in the last 24 hours. If you're at the Federal Reserve, I think a basic question, and we'll speak to Mary Daly of San Francisco in 60 minutes. Are we seeing an unwarranted easing in financial conditions, lower yields, a weaker dollar, that would cause them to look at this and say this is something we need to respond to? I don't think we are just yet, but you start to wonder if that's the direction of travel. That's the conversation they're having already. Are we sufficiently restrictive? And if you start to see yields low at the long end because the Treasury's snapping in and a weaker dollar, we'll see if any of this holds. That's something they have to confront.
Yeah, where is this in your dashboard of economic data if you're increasingly data dependent, especially between now and September?
Mary Daly, 60 minutes away as we count you down to the cash open a few hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. It was a rare sales miss for Target and shares are, for Walmart, and shares are really paying for it, down 6.3% after U.S. comparable sales grew at the slowest pace in more than 6 years and below even the lowest target on Wall Street. And there are some signs the consumer is pulling back. Shoppers made about the same number of trips, but they spent less each time. Lower pharmacy prices were also part of the problem for this company. Walmart, however, did raise its full-year outlook, suggesting it may see some of this weakness as manageable. Meanwhile, we're seeing Alibaba shares also falling down just under 3.7% after its results showed profits plunging more than 75%. The big drag is all the spending it's doing on AI, while a broader slowdown in the Chinese consumer is hurting its e-commerce business. The earnings call is underway right now, so no doubt they will be asked how much more spending they are planning. And we are seeing a rally in crypto-linked stocks like Coinbase and Strategy, and there are a few reasons behind this move. That drop in Treasury yields helped Bitcoin as investors moved into riskier assets. And then you had the president meeting with crypto executives yesterday at the White House, urging Congress to pass the Clarity Act, so you have a risk-on mood in crypto. John?
Yahira, thank you. More from Yahira in the next hour. On our radar this morning, a tentative trade deal is emerging between the US and Canada. Sources telling us here at Bloomberg the agreement would lower tariffs on some Canadian steel and aluminum exports to 25%, while cutting duties on auto exports to 15%. Elsewhere, oil extending gains as the US ramps up pressure on Iran. The president announcing, quote, economic warfare and isolation on a unprecedented scale, warning any country that helps Tehran will face tremendous economic consequences. And finally, the Treasury Secretary, Scott Bessent, increasing purchases of longer-dated US debt. Strategists at JP Morgan warning the move could...
That JP Morgan note for a minute. They talk about the potential perceived lack of credibility should this persist in
this
terms
from
of this sell-off. From Jay Barry, saying absent real fiscal consolidations, that would be where the lack of credibility would come from. In other words, you can't fix a fundamental problem with a tactic, and that is the ultimate question that market participants have. At what point do you have to address the underlying problem, or can we just inflate our way out of this?
Good luck addressing our budget concerns. We have a massive military budget. 60% is basically the stuff no one can really start, slicing and dicing away in Congress. It's Social Security, it's Medicare. And then on top of that, we're paying some $3 billion a day just on net interest payments. And no one is doing anything about wanting to bring this down. And yesterday was a huge milestone, 40 trillion.
I'm right there with you. The supply-demand backdrop is getting harder, not easier. Dileep put it really well. Dileep Singh of PGIM was with us about 10 minutes ago. He said, increasingly we have a price-insensitive supplier from not just the Treasury, because they have to issue for all those issues, but also from big tech, and increasingly a price-sensitive demand backdrop. It's not a great mix right now, is it? It really isn't.
So Barclays put out a note earlier last week that I thought was really important, where they said official demand for Treasuries coming from governments, both domestic as well as international, only accounts now for about 50% of overall buyers, down from 73% a decade ago. The rest are price-sensitive buyers. In other words, the number of people who are saying, show me what you got in terms of yield is increasing, and are the price setter when it comes to these Treasury auctions.
Home buyers, of course, are paying the price for some of this, for rising borrowing costs, a 5-month rise in yields pushing mortgage rates to their highest levels in about a year. Jeff Jacobson of 22V Research warning the move could start to impact investors as well, writing, we are possibly coming to a tipping point in the areas that are traditionally tied to rates, are likely to put pressure on the housing stocks. Jeff joins us now for more. Jeff, welcome to the program, sir. Can we just start with the housing sector? How much stress is there out there in this economy, in the housing sector?
Well, we're starting to see signs of stress. Whether you're looking at the collapse in lumber prices over the last month, a lot of the public home builders have been saying, that they've been have to increase their incentives to get buyers to the table. We know that there's, clearly affordability issues, and rates being where they are just not helping the situation. And to your point earlier, if this, intervention, if you will, in terms of what the Fed is trying to do, if it fails and rates move higher, we know, what's going to happen in terms of the sentiment in terms of the rate-sensitive home builders.
We haven't really seen higher yields affect overall equities so far. I mean, it has been sort of tempering some of the more economically sensitive areas, but otherwise you've seen a rally despite the sell-off in long-term rates. At what point does that start to materially shift in a broad-based way?
Well, that's my concern. I mean, the market overall has done a phenomenal job of pretty much ignoring the move higher in yields. Home builders, yes, they've absolutely underperformed, which makes sense. But on an absolute basis, they haven't done that poorly. My concern is if we do start to see weakness in the overall market, I would think it would be certainly led by the rate-sensitive sectors, assuming that it's yields that's the main concern of the market. And that was my main point of the note.
Why do you think housing has held in so well, given the fact that we've seen sales numbers decline significantly, affordability has dropped off a cliff, and prices haven't declined enough to make it truly competitive versus renting in many different municipalities?
I think they held up well. First of all, we've had periods of rotation in the market. So as money has come out of, say the tech or AI trade, it's worked its way into the more cyclical parts of the market, like home builders. That's certainly given it a bid. I think in general too, the home builders, which are obviously more sensitive to new home construction, had actually benefited because there's a lack of sellers because people didn't want to sell their houses and move from a 3% mortgage to say a 7% mortgage. That may have dried up for now. You've basically you're possibly at a point where you've just run out of home buyers in terms of affordability, and that would also be a concern for the new construction home builders that they're levered to.
Jeff, are you expecting any policy when it comes to housing out of Washington? I mean, there was a lot of mulling around Washington that the president was going to declare a housing emergency at the State of the Union in January, and it still hasn't happened.
Yeah, I mean, that's been talked about for a while. We haven't really seen anything yet. And again, I just don't know at this point how much they can do, again, with home affordability where it is and certainly where yields where they are. I'm not sure, what they can do to really boost the market at this point.
When it comes to where mortgage rates are right now, are you getting a sense from this administration, given what we saw from the Treasury Secretary yesterday, that is one of their concerns, to try to bring down mortgage rates, even though it might not even help?
I mean, I think that they're concerned about bringing rates down, unilaterally. Again, I just don't know how much it's going to help and at what costs. I'm not sure at this point. A slight move lower in yields on the long end in terms of mortgage rates is going to do enough. Again, against the backdrop of affordability being at some of the worst levels we've seen, and I'm just not sure a small move lower in yields at this point is going to be enough to boost demand at this point, or affordability.
Jeff, it's good to see you. Thank you. Jeff Jacobson there of 22 Fee Research. Jeff's not alone. Ultimately, you need to see rates back to what, 5? And at the moment for mortgage rates, we're closer to 7. Either you're going to see that or you're going to see a correction in price. But no one wants to vote for a correction in house prices lower, right? Well, no one wants to vote for that. No one wants to vote for a tighter deficit either.
Especially if they own housing, which is the large part of older Americans who tend to vote more aggressively and have more purse power when it comes to donations. Look, I'm a homeowner. You hate to see prices go down significantly, but there has to be some sort of right sizing for there to be some sort of clearing levels. We saw sales levels last week fall off a cliff, and this is just a continuation of a trend.
But you feel better if you sit on a 3% mortgage, right?
Exactly. It softens the blow of the deficit and everything else until the economy around you collapses. And
no, but it makes you feel good too.
It's a massive flex.
It's a huge flex, isn't it?
It's massive.
It's literally like saying you've got a Lamborghini on the drive.
Yeah, it's
3% mortgage.
It's literally my only flex because I didn't buy in the depths of a pandemic. There's nothing else that I've succeeded in, so my one flex is a 3% mortgage. Hallelujah.
Congratulations.
Thank you.
Bramo.
I've been basking in it for the past.
Is this how you're running for
10 years?
Right. My one success.
And
come with me.
And I
remortgaged at the right time.
And I can bring one to you.
Got more than that to offer, Bramo. I'm excited for it.
Thanks. I appreciate it. Protect the bears.
There we go. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Thanks, John. The U.S. is reportedly conducting an operation to transport oil through the Strait of Hormuz. Axios is reporting that U.S. officials are saying they're using a southern route along the Oman coast. Ship tracking data shows 3 China-linked supertankers U-turned in the strait, though, in the past 2 days. North Korea denies any direct communication between Kim Jong-un and President Donald Trump. The denial comes as Trump says he expects to meet with Kim this year. A statement from Kim's sister says while relations between the leaders remain excellent, hostile U.S. policies toward the North haven't changed. Data centers quickly becoming a midterm election issue. President Donald Trump praising the AI build-out, but saying the industry needs an image revamp.
The jobs are enormous, and the money paid, the taxes paid, are just enormous. And if you don't take it, you're going to be left behind. Maybe he can use a little public relations help. But if I were a governor or mayor, I would want that plant in my community.
President Trump going on to share he will be meeting top AI voices next week. And that is your Bloomberg Brief. John.
Data centers in Mar-a-Lago. Is that what's next?
He's asking for it.
Basically,
I highly doubt it.
I doubt it too.
I highly doubt it.
I doubt it.
There's no wind turbine there.
Put one of them by the golf course.
I mean,
don't see that happening.
No red or blue state right now. Direction of travel is they're hearing what people have to say and voters have to say, and they don't want data centers.
It's probably easier to say those things when you're not running.
Yeah.
Right. Anyone who's running right now is saying something very different about data centers.
I think Josh Shapiro is running. He was talking about that. He just put a limit in
guardrails.
Yeah, guardrails around it.
Competition,
increasingly.
Yeah, what's your data center?
What's your policy on data centers?
It's going to be important for the midterms in 2028.
Just wait for my Jackson Hole speech.
Inquiring minds want to know. I look forward to that speech. Up next on the program, taming long-term rates.
At this point, I'm like, go ahead, just hike and move on with it. In the absence of clarity of what the Fed will do with inflation, the inflation data makes it look like the Fed doesn't need to hike.
Up next, Ganeet Dhingra of BNP Paribas.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insights with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Down 0.25% on the S&P 500. Near session lows down 0.4 on the Nasdaq. This is worth watching. The long end of the yield curve right now. Yields creeping higher again. Going into that decision, that announcement from the Treasury, yields were around 526-ish, going into 830 yesterday. We're only 3 basis points away right now, Bramo, higher on the session by 4.
Yeah, people questioning how much firepower the Treasury really has to do something in order to buy back enough of longer-term debt, in order to reduce the supply-side problems. Can you just defer it all to the front end? How much are they actually going to do? We don't get a sense of what the action will be until September 9th. We have a lot of AI issuance until then, and frankly, we've got a lot of questions around the Fed and policy coming out of Jackson Hole.
The effects of the intervention in Japan weren't durable. They weren't sustained. There'll be a big question mark about whether this will be in the Treasury market. Under surveillance this morning, taming long-term rates.
At this point, I'm like, go ahead, just hike and move on with it. In the absence of clarity of what the Fed will do with inflation, you get a rally in twos and think, okay, maybe we're not going to get a hike next month. But the long end comes up because of concerns about that. The inflation data makes it look like the Fed doesn't need to hike.
So here's the latest this morning. The rebound in long-dated treasuries running out of steam as the Treasury doubled its debt buyback in a bid to rein in long-term borrowing costs from multi-year highs. Guneet Dhingra of BNP Paribas writing, the July FOMC has left 30-year bond yields especially vulnerable, where either they keep rising as Fed credibility remains in question, or the market needs to price 3 to 4 hikes before yields can stabilize. Guneet joins us now for more. Guneet, good morning.
Good morning.
I give you a shout out often because I go back to a note you put out a couple of months ago on the 30-year saying that 5% was not a ceiling, that something here had changed. Can we start there? What's changed about the backdrop for long-dated rates?
Yeah, look, I think the fundamental picture is very, very different from what it was last year. I think the issue with Fed credibility is really top of mind right now. You mentioned it at the beginning of the program. The issue is, if you have this problem with credibility, now the market finds itself in a situation where it's darned if they hike, darned if they don't, right? If they do, maintain their silence, don't offer any new information, the market continues to push the credibility theme. And that's why in the last, 2-3 weeks, we've had this K-shaped bond market, right? 2-year yields are down, 30-year yields are up. That K-shaped bond market is very rare. It's a sign of faltering credibility. So if they don't say something to fix that, let's say at Jackson Hole, that K-shaped bond market continues, long end yields are higher. Alternatively, to regain the trust, they will have to do more than what they were promising before July. So 2 hikes may not cut it now, maybe 3, maybe 4. That'll be a good start.
What's the scenario that you'd bet on right now?
Yeah, so our scenario, as you know, the BNP call is we start with hikes in December, 3 back-to-back hikes, December, Jan, March. Can the hikes start in September? Given the economic data we have, I think they can. I think it's not a foregone conclusion that September's not going to happen.
The pushback is that ultimately yields are not rising in response to higher inflation expectations. This isn't coming as a result of an economy going gangbusters or even inflation accelerating in certain key economically sensitive areas. Why would the Fed hike rates if the issue that's tied to the yield picture in the back end of the yield curve is tied to other factors?
Yeah, so that's a very interesting point. I think the issue comes from the fact that people look at the break-even market and they often conclude that inflation expectations are well contained. If you look at 10-year break-evens, they're about 220, 230, very benign levels compared to history. The problem with that market itself is the market's a very broken signal. The market doesn't respond to actual inflation moves. It responds to risk on, risk off, trading conditions, whatnot. So I think this is a fallacy in what the Fed also says sometimes. They think the break-even market is a vote of confidence for their sort of credibility on inflation. I think it's a very misleading, a mythical thing which people don't refuse to look at. That's a myth that we have to stop looking at break-evens and start looking at outright yields.
Although people would argue that the economic data we've gotten over the past couple of weeks hasn't been that great, that we've actually seen the economic surprise index inflect negative. We saw negative payrolls print on the headline level. Why would you say that this is not reflective of the potential inflationary heft still in the market?
Yeah, look, I think the data is mixed in the last few weeks, but generally the big picture data in the last 3 to 6 months has been sticky inflation. We're well above 3% on core PCE. We're obviously printing 3% growth numbers in second quarter. I think the other thing also is, I want to say this, long-term yields at 5.3% in 30s aren't necessarily restrictive. They're simply keeping up with where the level of the economic growth is, right? This is the issue where, if you look at, for example, stock markets, the small cap stock market index has gone up relative to the S&P 500. Equal weight S&P has gone up relative to the overall S&P. Those are signs that the market's saying, look, yes, rates are higher, but the growth picture is even better, so stocks can continue to do well in a world of high rates.
So you think that where rates are right now is actually normal for the environment we're in?
Absolutely, absolutely. I don't think this is restrictive at all. In fact, that's why I say the Fed needs to start hiking. Already there's a question of credibility, and 3 to 4 hikes in our mind is not even like a massively restrictive start. It's a very catching up to where things are kind of move.
The issue is that the Treasury won't tolerate normal. It's incompatible with what the Treasury wants. Who wins that fight?
Yeah, look, I think we've seen the intervention with the yen. It's not a guarantee that all the interventions will work. Now, it might be a speed bump in terms of yields going higher, like we saw yesterday. But as you mentioned at the start of the program, we're about 3 basis points lower. In fact, 520 is the level we were on the day of the July FOMC. So even if you believe 520 is the landing level right now, the market is still not the Fed off the hook. We're still at the level where the Fed credibility was in question. And if you keep going higher from here, that challenge remains.
In 23, Yellen blinked. A lot of people think Besson just blinked. In 23, when Yellen blinked, that was a big buying opportunity at the long end of the curve into year end. We had a move of more than 100 basis points. Why is this one different?
Yeah, because the fundamental story is different, right? The AI backdrop did not exist in 2023. I would say, in fact, you look at the buybacks that they announced yesterday, put that in a chart in the context of the hyperscaler issuance, you need a magnifying glass to identify the impact of the buybacks. It's that small. And so I feel like this long and big spend of the hyperscalers is going to drown out the T-bill and chill of the US Treasury.
Ganeet Dhingra of BNP, thank you. I'm still trying to get my head around how bad this could get. Really, seriously, how bad this could get if some big things don't change anytime soon.
It could get really bad. I mean, this is when suddenly you could start seeing the warning signals being sent to Washington, D.C., and for Congress to wake up to bond yields and to deficits and have to respond to them means that things are getting pretty negative. And at this point, that's the freak out that people are looking for, to have some sort of fundamental change in markets before they actually materially move their portfolios.
We've heard this a lot in the last 24 hours about the signal, the importance of the signal coming from the Treasury, the signal that he's willing to do something about it. There's a different signal, and it's a negative one. It's how nervous he is about the situation in the Treasury market, the action with Japan alongside them, the action we saw yesterday, only a few weeks, by the way, after the quarterly refunding announcement, right? Only 2 weeks afterwards did we get that move from the Treasury Secretary, which, again, signals concern.
There were a couple of key data points. Number one, the interest payment that the U.S. Treasury paid of $85 billion, a record. $40 trillion, the U.S. deficit crossing that threshold for the first time. And then the holdings, the international foreign government holdings of U.S. Treasuries fell significantly for the first time in a while, stemming from, guess where, Japan and China. Japan potentially in response to the intervention they did the first time when they had to liquidate treasuries. This is a difficult backdrop for Scott Besson.
And is this regular and predictable? That's what he promised us in November of last year.
This is irregular and unpredictable.
Yep.
Right now, yields this morning up 5 on 10s, up close to 5 on 30s. Up next, Mona Mahajan of Edward Jones, David Bellinger of Mizuho, San Francisco Fed President Mary Daly, Nita Richardson of ADP. The third hour of Bloomberg Surveillance just around the corner.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Historically, bubbles were characterized by a notion of if you build it, they will come.
In the late 90s, when we were building out data networking equipment, people were putting huge amounts of fiber in the ground on the assumption that it would come. And economists like to go back for reasons that are unclear to me to the railroads. They were also, if you build it, they will come. What is unusual about AI right now is the builders are so far behind the demand, it's absurd. We have a backlog of more than $25 billion of demand. That there are none of us, not AMD, not NVIDIA, that can keep up with the demand that your employees are driving. That's, in a lot of ways, the opposite of a bubble. We are chasing. Our customers and their customers are moving at the speed of software, and we're moving at the speed of real estate, data centers, right? And so we are behind.
Every weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersetchi in El Ola, Saudi Arabia, and this is Bloomberg.
We're in a secular shift here that's not getting enough attention.
Risk markets are starting to pay attention to the bond market.
There's a time to be worried. Now's not the time to be worried.
It has been strong earnings growth that has forgiven all sins for this market.
People, I think, are viewing the equity earnings story as a little bit insulated from higher yields.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action looks like this. Session lows in the equity market, down a third on the S&P, down 0.5 on the NASDAQ. Session highs on bond yields. Look at this right now. 10s and 30s, higher by 5 basis points. On 30s at the moment, 524. Look at it over the last 2 days on a chart. We are filling the gap very quickly and taking more than half back of what we got off the back of the Treasury action yesterday.
Yeah, this is problematic for the Treasury Secretary, Scott Bessent, given the fact that the goal was to try to curtail some of the move higher in benchmark yields. At least that was the perception, based on his plan to at least double the size of the buyback auctions for operations for 10 to 30-year Treasury yields. Question is, number one, how much can that really stave off the supply issue, the U.S. just selling more debt? Number two, how does the Fed respond? And number three, and this is an important one, how much is the yield picture going to be manipulated by that type of action when a lot of this has to do with a global shift higher in yields, a strong economy, and a glut of AI-related long-term issuance?
And $40 trillion, which we surpassed yesterday in terms of our debt. It worked for what, 24 hours, Jonathan? This statement dropped 8:30 yesterday?
Not even.
That's it.
Right.
So the Treasury Secretary comes to the rescue in a sense for 24 hours, yields go lower, and now they're grinding back up. What do you do next?
This is the other half of Wall Street. Ultimately, it sounds like this. You said it earlier. We've got a structural problem that requires a structural solution. This is a Band-Aid. You wake up this morning and see a move of 6 basis points to the long end. I'm not going to make a massive deal of a 6 basis point move to the long end of the curve, but I have to say, with this move here, given this is happening with the action of yesterday, I'm more concerned now than I was yesterday morning before they delivered the action at 8:30 Eastern time.
Jay Berry of JP Morgan, I think, put it really well when he said, absent real fiscal consolidation, we fear the markets will view this action as lacking credibility. This morning, taking back the move that we saw yesterday just signals maybe this is the beginning of pushback or a loss of credibility.
Hello, the Federal Reserve. About 27 minutes from now, Mary Daly of the San Francisco Fed, ahead of Jackson Hole in a week's time. Where does this leave this committee heading into September?
Deeply divided, and that is what we saw from the Fed meeting minutes. Deeply concerned about inflation that's remained above target for more than 5 years, and deeply questioning just how much hiking rates will actually do to accomplish reducing some of that inflation. I mean, a real question here about what their role is when the economy isn't amazing right now. I mean, the Walmart numbers coming out, this was one of the few misses that they've actually had in same-store sales in the United States. Decelerating pace of growth. Is this a Walmart issue? Is just some of the other competitors eating their lunch? Or are you starting to see even a greater slowdown of lower-income consumers? What does the Federal Reserve do with all of that, given the fact that the bond market seems to be pushing back on the long end and saying, you guys need to get this thing under control? It leaves them in a very uncomfortable spot.
Things like this often happen in August. These are like the dog days of summer, right? The last 2 weeks of August, a lot of people on Wall Street step away. It's a pretty unforgiving backdrop already in fixed income. It's not good right now. It's really not good.
It's the reason why people are looking at Jackson Hole and saying, all right, Kevin Warsh, are you going to come out dovish and saying you're going to cooperate with Scott Bessent in some sort of Treasury-Fed accord? Or are you going to come and be much more aggressive and hawkish and indicate that this means there needs to be a Fed action to prevent a front-end doom loop, as we were hearing from Dalit Singh.
Or a long-end doom loop at this point as well.
Pick your poison. Right. Choose your own adventure.
5:25 on 30s. Coming up this hour, Mona Mahajan of Edward Jones. A stock snapper 3-day slide. Let's see what we get today. David Bellinger of Mizuho reacting to Walmart earnings, and San Francisco Fed President Mary Daly joining us in about 25 minutes' time off the back of these bond market moves. We begin this hour with stocks failing to hold on to gains as bond yields continue to climb. Mona Mahajan of Edward Jones writing the Treasury announcement may help ease near-term liquidity pressures and improve market functioning. However, it does not address what we consider the key factors driving yields. Mona joins us now for more. Mona, welcome to the program. Look, it's easy to get dramatic whenever we see yields start to drift higher, but how concerned are you about what's happening at the long end of this yield curve?
Yeah, look, I think we have seen the 10-year over this cycle, over the last several years, hit a 5% plus level. It didn't stay there long, but could we be heading in that direction? Absolutely. And I think that is really kind of the line in the sand for a lot of investors. At that point, some quantitative investors do tend to step back into the market, but could this time be different in that we have no resolution, to your point earlier, on the fiscal deficit? We have a massive amount of AI issuance and supply coming to the market. And by the way, global yields are trending all in the same direction. Now, keep in mind, what does rising yields do to the real economy? Well, yes, it puts upward pressures on cost of borrowing for consumers, for corporations. But it also creates an alternative to equities. And keep in mind that old adage, there is no alternative. Well, now with 30 years at 5+% and the 10-year at 4.7 or so, could there be an alternative for those that are seeking yield, maybe in retirement, near retirement, or just looking for income opportunities? That we think is the silver lining here. For those that are looking for relatively risk-free income opportunities versus what we've seen in this rally in equities, there could be some opportunities on the horizon here.
Following this tick for tick now, it's now a 7 basis point move for the long end. I think it's fair to say, based on where we were at 8:30 Eastern yesterday morning, we've taken back all of the move post the announcement at 8:30 from the Treasury. Mona, let's just stay on that, because of all the research we've all read in the last 24 hours, most of it talks about 2023 and echoes of 2023. And the moment you got the whiff that Yellen was blinking, that was the moment to buy. There is a group on Wall Street that suggests we've just seen that moment from Treasury Secretary Scott Bessent. There's another group on Wall Street that says this is a very, very different, unforgiving bond market backdrop. It requires a much bigger solution. Which camp are you in?
Yeah, look, I think this administration actually is quite focused on the yield picture. And we saw it last year, too, when tariffs were creating a massive amount of uncertainty. It wasn't the equity market selling off that created this or caused this administration to blink. It was actually bond yields moving higher. And so this administration in particular is quite sensitive to this rapid move higher in yields, and it is actually taking steps to try to kind of reverse some of the function we're seeing. Now, all that being said, to your point, this is putting a bandage on a very, very much bigger problem. And so, increasing long yield purchases from $2 billion to $4 billion in a 20 trillion plus economy doesn't really do much. And so what we really need to see is the structural change that we are all talking about, but no administration historically has taken on that task. And so I think that's a tall order. All that being said, we are also in an economy where we are seeing massive secular tailwinds from AI. The earnings story remains intact. We see an Atlanta Fed GDP now at 4%. And by the way, the consumer, despite some of the near-term headwinds, has held in there, especially that upper income consumer. And so not an environment where we are seeing yields rise and a recession on the horizon. So there is still opportunity, we think, in the equity market, and maybe some opportunity for those yield income consumers as well.
So you're still bullish, despite the fact that we've seen yields rise at the long end?
You know, overall, we think the backdrop of this macro backdrop has not shifted, and we do think that equities make a lot of sense here. Now, to your point earlier on seasonality, we had a really nice run in equities through June and July and early August, and we're heading into September and October, which historically have not been great months for the equity markets. But keep in mind, we're also in a midterm election year, and historically, post-midterm elections, equities tend to rally as some of that uncertainty is lifted. So could some of this play out? You know, history doesn't always repeat itself, but it could rhyme to some extent. These could be issues that we face in the near term, but we'll have to see how not only the Treasury market plays out, but how the Fed reacts to some of what we're seeing. Do they think that the Treasuries are doing some of the work, some of the restriction for them, or will they have to act regardless? And that could really be the game changer in terms of how equities play out.
So in other words, Mona, you don't see the rise in long end yields necessarily affecting the overall dynamic in terms of being bullish of both equities and maybe short end bonds. But if the Fed takes action, hikes rates, that's the game changer that would make you more negative on stocks. Would it make you more positive on bonds?
You know, I think generally with an earnings backdrop of 30% this year, it is tough to fight the tape in terms of what's happening in the equity market. If the Fed has to raise 1 or 2 times, we don't think that derails the broader story. Now, in terms of yields, you know, our team is looking at 10 years between 4.5% to 5%. If we get much above that, we could reconsider our stance on equities as well. As we noted, you know, there's an alternative then, the valuations come under pressure, there could be a shift in the narrative. But for now, we remain contained in that 4.5% to 5% yield range. We have the strong earnings backdrop supporting us. And the Fed, by the way, we think is torn. We've seen a couple of better than expected inflation prints. We'll get one more on September 11th before the September 16th meeting. And we've seen a labor market and consumer that has really been mixed. So not one where the Fed may want to continue to put pressure on and cause some other concerns in the macroeconomy as well.
Mona, it's good to see you, to get your reaction. Mona Mahajan there of Edward Jones. Check it out. Let's start with the bond move. 2s, 10s and 30s, and the long end of the curve making all the headlines in the last week or so after breaching levels we haven't seen since 2007. To start the week, the Treasury Secretary steps in, attempting, many believe, to cap long end rates, and then yields start to climb again this Thursday morning, higher by almost 7 basis points at the long end of the curve. We're looking at 526 this morning, and off the back of that, session lows in the equity market down by 0.5 on the S&P 500.
Yeah, this is really a key question that the Fed addressed, or at least Kevin Warsh, the Fed chair, addressed at the last meeting, where he said the bond market is doing some of the tightening for them. And it raises a question, how restrictive, and we were just talking about that a moment ago, how restrictive are benchmark yields at the long end at this level? Torsten Slok put out a note earlier this morning, and he indicated higher rates have been slowing the economy significantly less than in prior cycles because of this rate-insensitive component tied to artificial intelligence and a lot of the dynamic. That's an interesting component. Maybe this is not necessarily doing the work for the Federal Reserve in the same kind of way that it would have traditionally.
I want to be nice. I don't want to be mean all the time.
But?
Each day that passes by, that news conference looks worse and worse. Each day it gets worse and worse. When you go back to the comments, and you alluded to them from the Fed chair in that news conference about what was happening in the markets, market participants are learning to play the ball and not the referee. Just think how embarrassing that now sounds for the Fed chair, given the action from the Treasury in the last 24 hours. What I've been trying to do is get an unfiltered message from markets. Just think how embarrassing that sounds now, given the action from the Treasury in the last 24 hours.
100%. He has a pass for the first couple of meetings because he is new and a lot of different Fed chairs have messed up in the beginning. After that, not so much. And Jackson Hole, given the move that you've seen in the long end of the yield curve, is going to be that much more important for him to reestablish his credibility or his credentials as he goes into that with a real issue in the bond market.
I think the question is the tension that needs to resolve itself, Lisa, is between the Treasury and the Federal Reserve. And what's notable about how embarrassing the last few weeks has been for the Fed chair is that the individual doing the embarrassing right now, the person embarrassing the Fed chair, is the action from the Treasury Secretary in the last 24 hours. And the question that I have, and maybe we'll get some insight on this in the next week or so from this Fed chair, is are you working together or against each other? Which one is it right now? And if it's one and not the other, you're going to see some very different price action in financial markets.
If the Fed hikes rates, that could support the dollar in a significant way. If the Fed cuts rate, well, the bottom's really going to fall out from underneath the dollar.
Yeah, but a weak dollar is actually okay for this administration. I know that Bessent will come out and give a lip service of we agree with and we want a strong dollar policy, but the president has said multiple times he would be encouraged by a weak dollar because what would it mean for the manufacturing world? And that has been potentially the help of Main Street individuals that he's trying to have this manufacturing revolution, renaissance. It's just all happening at an incredibly awkward time, especially ahead of the election.
Equity futures down by 0.5 on the S&P. Bond yield to the long end higher by about 6 basis points on 30s. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. U.S. public debt topping $40 trillion for the first time as the Treasury ramps up its buyback program for longer-dated securities to stabilize yields. The rise in debt is expected to continue, with interest costs now the third largest part of the budget. A new aircraft carrier is on its way to the Middle East to replace the USS Abraham Lincoln. U.S. CENTCOM says the George Washington is moving now through the Arabian Sea today to relieve those sailors. Service members on board the Lincoln have spent the last 9 months at sea as part of war with Iran. The battle between Netflix and YouTube is heating up. Sources telling us here at Bloomberg, YouTube is offering creators millions of dollars in temporary exclusivity to keep their videos off Netflix for a time. No deals have been finalized. Negotiations are all still ongoing. And that is your Bloomberg brief. John.
Vonnie Quinn, thank you. More from Vonnie in about 30 minutes' time. Up next, the morning calls, plus David Bellinger of Mizuho reacting to Walmart earnings. That stock dropping in the pre-market following that release. That conversation in just a moment. Live from New York City this morning. Good morning.
For U.S. markets, we are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
The Treasury buyback announcement yesterday, and I would also say the intervention from earlier this month, they're examples of when you don't have fundamentals or overwhelming firepower on your side. The lasting imprint of this action is going to be higher rollover risks. I think it's more likely the Fed will have to hike because you're loosening financial conditions. You are creating the conditions for a front-end doom loop.
That was the PGIM Vice Chair, Dilip Singh, on the programme a little bit earlier on this morning. This is the price action so far at 8:18 Eastern Time, 1 hour and 12 minutes away from the cash open. Equity futures on the S&P 500, negative and at session lows. We're down by 0.5%. Following that move in the long end of the curve, yields higher by close to 7 basis points on 30s.
This is a huge problem as we see a lot of the move yesterday taken back in today's trade. Again, what will it take for people to say, okay, any kind of action from the Treasury can stick and hold? Would it require some sort of cooperation from the Federal Reserve?
The Federal Reserve has their turn next week. Jackson Hole, the annual get-together, and a speech from the Fed chair a week or so away. 30s this morning at about 5:26. That's the price action. Let's get you some morning calls. First up, Wells Fargo raising its price target on Target, citing evidence of its turnaround plan taking hold. Your second call from Citi, downgrading TJX to neutral, noting a tougher competitive landscape. And finally, Bernstein cutting its price target on Lowe's, highlighting its second quarter comparable sales miss. That stock this morning slightly lower. Shares of Walmart, that is lower this morning. The retailer posting its slowest U.S. growth in more than 6 years. David Bellinger of Mizuho writing, this is a very messy print and one of the biggest misses in years. David joins us now for more. David, good morning.
Hey,
What
great,
went
thanks
wrong?
for having me on.
What went wrong with this stock and these earnings this morning?
Yeah, so I'd say there was a lot of expectation movement down into the print, some alternative data out there that Q2 sales growth might be somewhat weak. We did get that headline number of U.S. same-store sales growth, only 2.6%. There is some regulatory pharmacy issues in there. A lot of these drug prices got pushed down, part of the Inflation Reduction Act that's hitting now. So that was about 125 basis point headwind. But with such a high multiple on this stock, you've got to be pinpoint. You've got to hit your numbers each and every quarter. Even though there's some optics off here, it's just caught people by surprise.
Is this a hiccup off the back of a change in leadership? What would you call this?
I would say that there's probably some of that in here. I think there's a few factors, right? You had John Furner take over as the CEO. There's been some domino effect of other leaders leaving Walmart post that. Maybe there's a little bit of a operational disruption. You have Target doing a lot better. That I think maybe that's a little piece of this. Amazon getting into grocery. And then I'd also say just the lower income consumer stress that's been out there. Nothing totally new, but I think that ate a little more into Walmart this quarter.
How much is this an economic story, and how much is this a Walmart versus competitor story as the likes of Kroger's and Target reduce some of their prices to compete more significantly with Walmart?
Yeah, it's a great question. So I think a lot of those price investments from these other grocers, I think that's reactionary to what Walmart's done over the past several years. So it's more of them catching up. There's some fears of this the price war starting up in grocery. Maybe there's a little element of that in Q2. But again, a bigger picture, Walmart seems like a bigger share taker, not just grocery, but other general merchandise type companies. And that's where they've seen all this uptick.
So you see this as more of an economic story, a broader story than just one of a competitive landscape. How much is this a read of a slower consumer, and how much is this a read of people's expectations just having been too high and a normal consumer?
Yeah, I think it's more the latter. So there's a little bit of the low-end consumer stress. I don't think that's necessarily gravitating up towards middle income or higher income just yet. I don't know if that happens, but for today, I don't think that's happening. And you've seen good numbers elsewhere. Costco had great July sales. Five Below is comping in the double-digit range. So it doesn't seem like a widespread consumer thing. Maybe just lapping some big numbers from Walmart, some of these pharmacy headwinds, almost a perfect storm that led to this, I'd say, worst-case scenario for the second quarter for Walmart.
They warned about higher energy prices having to impact how much they can pass along to consumers. Are we seeing any of that happen?
Yeah, so last quarter they flagged it was almost $1 billion for the full year of incremental fuel costs. So that could lessen the price cuts that they want to get to consumers. You had some of the tariff refunds start to flow in Q2. Walmart has not given a specific number on how much that benefited them in Q2, but other retailers are getting a big windfall from tariffs just recently, and you're seeing a lot of that pushed into the back half for lower pricing, just trying to stimulate the consumer a bit more. And I think we'll see more of that, and I think we'll hear that on the Walmart call today.
What do you make of Target? Because it's been a fantastic turnaround plan. Numbers yesterday were very good. Is this almost the peak, though, for them?
Tough to say. I think the start to Q3 has also been very good. But if you take a step back here, just what they've been lapping has been so bad. Some of these very deeply negative same-store sales comparisons that they're up against maybe inflated the numbers a bit in Q1 and Q2. but they're definitely doing the right things and getting there. I would say that the biggest and more strenuous parts of the turnaround are still ahead. So apparel and home, those are big categories for Target. They make up a good piece of the margin picture as well. So that those have slower inventory turns and longer lead times. So that's more of a 27 story. So it's almost as if the easiest part of the turnaround has been completed and doing really well. It's more of, can they take that next step? And I think the market has yet to determine that.
Can I sell you a 30-year bond this morning? Do you fancy that? No.
Say that again?
Don't worry. David Bellinger of Mizuho. David, thank you. 30-year bond yields this morning higher by 6 or 7 basis points. When you ask that question, they just pretend they don't hear you.
Yeah, can you imagine? Aisle 15, 30-year bonds.
Absolutely not, no.
Totally in stock.
Sell everything else at Walmart.
Yeah, exactly. Everything else is on discount, but that one, man, they got to cut it to like, what,
This yield move gets your attention this morning, 6 to 7 basis points higher after a 9 to 10 basis point rally in yesterday's session, following what we will call intervention from the Treasury Secretary, Scott Bessent. Gets your attention because we're moving in the wrong direction once again. And if this continues through the session, the pressure is going to build and build and build. And the emphasis, it just increases into next week for Fed Chair Kevin Walsh.
What is the cause of yields going higher? What is the signal coming from the sell-off in the bond market? Is it a signal of just a lot of supply coming from AI? Is it a signal of a robust economy? Is it a signal of a lack of credibility in official institutions? Or it is a signal that $40 trillion of debt and the degree of the deficit per GDP in the United States is just too high? Either way, the Fed has to respond to this at a time where we're getting really questionable signals coming from the economy. On one hand, solid. On the other hand, kinds of jobs numbers last week. I mean, there are a lot of conflicting data points that are pointing in many different directions, and you see the FOMC committee very, very split.
If you're at the Treasury, you're fighting fundamentals. That's the hardest piece of all of this. This is the clearing yield to get supply away for everything you described, but also because the backdrop is actually pretty good. Unemployment's close to 4%, GDP is close to 2%, profit growth is fantastic. If you're taking risk elsewhere, you're being rewarded, which is why Treasuries need to make this move. This is the clearing yield. That's a problem because it's totally incompatible with the debt dynamics of the Treasury right now. We've been talking about the global bond market backdrop. Anchors away. I said it a few weeks ago. Every anchor that's held back yields over the last 30 years is gone. It's gone worldwide.
Part of the reason why is because the savings-led economy is over. We're now spending the money on artificial intelligence, on the Industrial Revolution. Required, yes, but potentially problematic for a lot of governments that have built up a lot of debt.
That's the point of tension. This yield makes sense for everything we're seeing, but it's incompatible with the debt dynamics of the Treasury. Up next, an important conversation, the San Francisco Fed President, Mary Daly.
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary. We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Equity futures this morning down by 0.5 on the S&P. We're down by 0.8 on the Nasdaq. This move in the bond market still the focus of attention for so many of you around the world and on Wall Street. Higher by 6 to 7 basis points on 30s with very little catalyst this morning. Yields of 5.2561 at the long end. Twos around 4.18, up 2 basis points to the front end. Claims about to drop. Lisa, claims 210 is the estimate, and around 200 is where that claims number has been stuck for weeks and weeks and weeks. 206 is where it prints this morning.
Yeah, it just revised slightly higher for last week, but coming in slightly below. Look, it's been basically flatlining at this level, which is fine, right? I mean, it's relatively low. It's not giving much of a signal except for the low, higher, low, fire type of dynamic. Big question about whether the negative payrolls print is a signal or whether it is a blip as a result of a take back from World Cup hiring. Ultimately, not getting much of a signal from the labor market right now.
Not at all. And the current standing by down in Washington, D.C., Bloomberg's very own. And welcome to the program. Jobless claims then basically in line with expectations. To Bramo's point, how much have we learned about the labor market from the incoming data over the last few weeks?
Well, I think the monthly payrolls data, John, has certainly put a bit of a different picture over the jobs market story. It had been one of stability. We didn't just have that most recent soft print. We had the previous revisions suggesting maybe employment isn't as strong as we thought. And now these jobless figures this morning, of course, they do speak to the idea that the layoff story isn't yet happening. Whatever softness is going on in the market might reflect slower hiring rather than layoffs per se. But I will say it was interesting looking through the minutes at the Fed yesterday. The officials there were making clear that they felt the jobs market was in good shape, and they'd said that publicly as well. But of course, the data since that meeting, I think, has put a bit of a different look on where jobs are at the moment.
And Karen, thank you, sir. Heading into Jackson Hole in about a week's time, and an important speech just around the corner from a so far tight-lipped Fed chair, Kevin Warsh. We'll hear from him in a week's time. Joining us now to extend the conversation on the Federal Reserve, the San Francisco Fed President, Mary Daly, joins us for more. President Daly, always good to hear from you, so thanks for making some time for Bloomberg Surveillance.
Glad to be here.
I want to bring up the bond market, and I'm sure you anticipated I would go there first. The long bond and the rise we're seeing in yields. President Daly, from your standpoint, what signal, if any, do you take from the sell-off at the long end?
Well, you know, when you look at the long end, it is typically driven by structural factors like fiscal sustainability, geopolitical rebalancing, the massive AI investment for this industrial renaissance, which people are very excited about, and those factors are driving this. The thing that I look at specifically is this is happening across the globe. It's not just a U.S. phenomena, it's a global phenomena. And it doesn't give us a lot of signal about what we should do in the policy adjustments or the policy calibration for the Fed. And there, we look at the short end more than the longer end, paying attention to the longer end, but really focusing on the job number one, which is restoring price stability right now.
Do you think, President Daly, that the long end of the yield curve is doing some of the work for the Federal Reserve by tightening monetary conditions in a more significant way?
You know, I always hesitate to say that the market's doing our work, but what I will say is it begs the question, what problem are we trying to solve by adjusting policy preemptively? You know, there's a lot of discussion about our credibility. There, I don't see our credibility at risk. I also hear a lot about should we be making preemptive cuts, or hikes rather, and I don't see a lot of evidence that that's an urgent problem to solve. So really this is about watching the inputs from the financial markets, looking at the 30, the 10, and the 2, and asking, are we getting mixed signals or different signals? And you know, right now on the shorter end of the yield curve, markets seem to have priced in a little bit more tightening, but they're reacting to the data just like we would expect them to. Inflation prints a little softer than they expect, the labor market a little softer than they expect. They push out rate hikes that they had priced in and adjust as the data comes. So I think they seem to be signaling to us that they understand our reaction function. And importantly, I'm looking at inflation compensation and inflation expectations, and you don't see any worrisome swings in those pieces of data either. So I think policy's in a good place, but watching this 10 and 30 to see what we need to think about, what are the structural factors, it's giving us a signal about something. And I think one of the big signals is the AI demand.
President Daly, we'll get into AI demand, but I am curious about the reaction function. You said that the market seems to be understanding the Fed's reaction function. What is your reaction function in terms of incoming information that would make you think that an adjustment higher for rates would be required?
Well, you know, last week I gave a speech where I talked about really there's many scenarios that could occur, but 2 seem very important for me at this point. One is the one that I would suggest is the modal outlook. My modal outlook is that, and also you saw in the minutes, it's a majority of the participants' modal outlook, that inflation is being driven up by a series of shocks, and those shocks will roll up, they'll roll down, they'll roll through, and as that dissipates, then inflation will return to target, in part because we have policy at a very slightly restrictive level. So there's that dynamic. But then there's the dynamic of maybe the fact that we have so many shocks coming at once and they're overlapping, they can have an independent compounding effect. That means that the total effect is greater than the sum of its parts. The conventional dynamics of shocks just aren't working like they were. I'm not seeing evidence of that right now, but I definitely think we should keep that in mind and watching. If that happens, we'd have an inflation problem that we would want to treat with tighter policy. In the meantime, I was very supportive of the July hold and continue to look at the information that comes between now and the next meeting about whether any signs of that worrisome dynamic would be forming, and I haven't seen them yet. And the recent prints on both inflation and the labor market didn't really change that picture for me at this point.
There's been kind of a paradox forming right now where you've seen inflation above target for more than 5 years at the same time that the labor market seems to be kind of meh. I mean, it's okay, but people keep talking about low hire, low fire, and that kind of dynamic with real wages not keeping pace for the past 5 years will lead inflation to go lower. Why hasn't it, right? I mean, when does that relationship reassert itself?
Well, one of the things that is true is that we've had many periods in our history with, essentially if you're thinking in economics terms, where the Phillips curve is very flat, and you just don't see the relationship between the labor market and price inflation. And it also kind of illustrates why the shocks have been a big component of overall inflation. The tariff shock, the oil price shock, and now the AI investment boom shock. And in all of those, you have to ask, what is the expectation of their duration? Are they spreading to other sectors than the ones that they directly affect? And what do we think they will do if they compound with each other? Will that make a difference or will it not? So I think that's what's really driving it. I wouldn't look to the labor market. You don't see any signs that the labor market is contributing to inflation. And I really think at this point, you have to look at these other factors, because that link between, wages and price stability is often weak. We came off a period where it was very strong because we saw a very frothy labor market, very strong labor market, and people were saying that they were worried about a wage price spiral. I think I've talked to you both about that. But we're way past that, and now we have to look at these other factors driving inflation. And so I'd say the main contributor to why inflation has persisted for so long, even when we've had restrictive policy, is because have these shocks. And then, of course, service price inflation is just stickier. It takes a while to come down.
President Daly, I'm just going to keep our audience on top of the moves we're seeing in the bond market at the long end of the curve, up by close to 7 basis points, 30s at the moment, if you bring up the board, around 526. Yields higher through the levels. This is important. We've taken back much of the rally, in fact, all of it, since we had that Treasury announcement this time yesterday at 8:30 Eastern Time. Off the back of this move in the bond market, equity futures lower by 0.6% on the S&P 500. President Daly, I can imagine you'd love to avoid all the conversation about Treasury, the department, and issuance, but forgive me, I have to go there. There are many people who believe we'll see a continuation of this Treasury Department under Scott Bessent, of the policies that we saw under Janet Yellen, and that we'll see less issuance at the long end and more supply at the front end. If T-bill issuance continues to climb and account for more and more of the issuance coming from the Treasury, President Daly, how does that change your view on what to do and what not to do with policy? What does it mean for the everyday workings of the Federal Reserve, who is very focused on managing short-term rates?
Well, I'd say these are early days, and I wouldn't want to be preemptive in sort of discussing those types of things until we've had a chance to think through those issues. But, you know, the Treasury Secretary is different than the Fed. The Fed is talking about price stability and full employment. And what I do know is, and we've historically been able to do this, is that we have a goal, and we can achieve those goals through our policy implementation, and we will find a way to do the job that Congress gave us, which is restore inflation to 2% as our goal as we define it, and do that price stability. So I think we don't want to worry about the mechanics of how to do that as much as the commitment to achieve it.
Forgive me for going there, but is it in conflict with what you're trying to achieve? When you see the Treasury Department attempt to manage prices and yields?
I think this is really important, but it's the Treasury Secretary's job, not the Federal Reserve's job. And we have our own job, which is very important, but also we're not quite there yet, so I'm going to focus there.
The Treasury Secretary at the moment, and you'll forgive me for pushing, is actually trying to influence financial conditions. You could see that yesterday, yields came in. You could see the dollar weaken as well. Given the moves happening elsewhere in financial markets, particularly in crude, you do have to wonder, President Daly, if that's an increasing challenge for the Federal Reserve that they might have to confront.
It sounds like that's something you're interested in, but again, I really am I work for the Federal Reserve, and I think importantly, you know, and I'm pushing back in this. The important thing the American people need to know is that the Federal Reserve cares about its independence and its credibility and sticks to its remit. You know, we take in all the information. We look at everything because those are important inputs, but we know what our job is and we focus on doing that. And that, you know, if you want to talk about inflation compensation and expectations and Fed credibility, I'm happy to talk about those things, the labor market, but I really do think that with our job right in the importance area here, and we aren't meeting our target yet, we really have to focus there.
President Daly, how would you characterize right now the overall economy? I mean, we've talked about how there is this sort of heat coming, but right now, do you think that it's solid? Do you think it's expanding? Or do you think that it's decelerating?
You know, what I'm really seeing, and it's an interesting time, you know, I think people say it's confusing. There's contradictory data. It is true that the typical historical ways we think and measure the economy, the dynamics and the interrelationships don't seem to be squaring up like they would typically do. So then what do you think? What do you look at? When you talk to businesses, they're cautiously optimistic. And they're cautiously optimistic beyond the AI sector where they're just optimistic. And they're optimistic, they think of this, they call it an industrial renaissance. We are in the next industrial revolution. So they have all that enthusiasm. But what I really watch is what are other businesses saying? What are other businesses thinking? And they're focused on the fact that consumers are trading down and feeling a little bit tighter in their pocketbooks and their spending. But they're also focused on, they keep coming to their business. They keep wanting to do things. And importantly, I start to see these businesses, I'm seeing these businesses using AI, really working hard to see how can this technology, which is in the development stage really, how can it affect their business processes, even the physical world that they work in, and what can they do to make things better? So I'd say that there's all this enthusiasm about the future and a lot of anxiety about the present. And that is a colliding piece. Now, if you talk to the consumer, they're still there, they're still spending, although it's slowing and they're trading down, but they do feel more precarious. You can see that in the sentiment surveys, either of confidence or workers. And I think it's in this low hire environment that they feel it's an uncomfortable stability. It's an uncomfortable stability that we're not really accustomed to. But the policymaker, as a policymaker, we have to ask, is it sending any weakening signals? Do we see any sense that things are fragile? And I just don't see that yet, and you saw that in the claims data today. You just don't see signs that the labor market is faltering. You simply see signs that it's running around at a very low level. And the most important question I'm asking CEOs right now about the labor market is, where are your, cutting back plans? You were in a low hiring, low firing, but do you have those plans moved to the front of your desk, and are you watching them carefully? And right now they're there. They know what they would do, but they still see that cautious optimism of trying to meet output growth where it is and be not the last in line to do that, the first in line to do that.
President Daley, you mentioned artificial intelligence and the idea that a lot of these companies were trying to deploy AI tools in lots of creative ways. Right now, is it still more inflationary than it is disinflationary in terms of productivity? Is that something that the Fed needs to combat or address, or is that something that the Fed can look through with the hopes that there will be more productivity on the other side?
This will all come down to something that we have to watch, which is this a relative demand shock? Is it changing the relative price of technology goods, or is it spreading more generally into, think of data center build-outs? Is that pushing up the price of construction workers everywhere, or is it simply, you're getting specifically trained people, or people are coming to do those things? Right now, I'm not seeing a broad spillover in the broader inflation measures. I am seeing a rise in software and technology goods. Those are pushing up, but that's a relatively small sector of the overall price indices. And so I haven't seen evidence of that, but that's what we would have to watch. And so the investment growth is very, very strong, and that's affecting interest rates, as you see, long-dated yields. But you don't see that pushing itself into price inflation writ large, although you definitely see it if you're trying to buy a high-end technology good, you see some effect there. So we'll watch that, whether that spills over into consumer prices, consumer goods and services. So far, haven't seen a lot of that, but we will. That's definitely, if your coffee maker starts rising in price because the chips that go in it, if you buy one of those new fancy ones, then if that starts going up, that's a sign of broader-based problems, or automobiles. But yet we haven't seen that of yet.
President Daley, you've mentioned that policy is in a fairly good place right now as all of the members look at the incoming data. Is there anything that's transpired that makes you question that, or has the data been more of the same to indicate that the Fed is in a good place to keep watching the data for a while longer?
I'm on the latter point you made. I think we're still in a good place to keep watching the data. As I mentioned, the two prints that have come out on inflation and the labor market didn't really clear much up for me. I'm not going to get on the bandwagon of we had a softer inflation print. We should stop worrying about the risks of higher inflation. I don't think that's right. And I don't think the labor market print suggested that there's any impending weakness there. But we have to continue to watch these things. And importantly, I think with inflation elevated for as long as it has been, we have to constantly discipline ourselves to watch what's happening to inflation expectations, what's happening to producer instinct to raise prices. Are they able to? Right now they say they're not. They're really not pushing all their input cost increases through to prices, consumer prices. So those are the dynamics to watch, and continue to watch the labor market. But if I look at the two, we are missing on our inflation goal quite a bit, and the labor market is relatively stable. So a lot of my attention is on that inflation miss and how to get this back down to 2%, and when do I have a sufficient amount of confidence to say we're on our way. Right now, I think that's the modal view, but I don't think it's so modal. The probability isn't so large on that front that you can't watch these risks.
Am I in the penalty box now? I feel like I might be.
You could ask her.
Like I might be.
No, you try. This
We're
is
still
what
good.
we do, so you're not in the penalty box.
You know, always try. I'll always try. Mary, it's good to see you. Thank you. The San Francisco
Nice to
Fed
see you.
President, Mary Daly. Thank you. Thank you very much. on this bond market, this backdrop for inflation?
Look, it's a difficult moment for Fed officials, and you can tell that it's awkward because they want to remain purely focused on the economic outcome. But but the truth is, it's important to ask because it's what the market is asking. So ultimately, this is something that Kevin Warsh most of all needs to address in terms of the focus in his rhetoric and his tell with respect to reaction function. Mary Daly was very kind to spend time with us to give her view, but we haven't heard from the Fed chair and what his view is and what his reaction function, and I think that's key.
Yields up 5 at the long end, giving up some of that move earlier on from this morning. 5.25 on 30s. Up next, we'll set you up for the day ahead. We'll get some reaction from Nita Richardson of ADP from New York City. You're watching Bloomberg TV.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
I always hesitate to say that the market's doing our work, but what I will say is it begs the question, what problem are we trying to solve by adjusting policy preemptively? You know, there's a lot of discussion about our credibility. I don't see our credibility at risk. I also hear a lot about should we be making preemptive cuts, or hikes rather, and I don't see a lot of evidence that that's an urgent problem to solve.
That was the San Francisco Fed President Mary Daly joining the program just moments ago. Looking at that conversation, the backdrop right now for that chat, this right here in the equity market. Just off session lows on the S&P 500, we're down by 0.5%. Small caps down by 0.7%. In the bond market, yields higher again this morning. Not as high as they were about 20 minutes ago, but still up by about 5 basis points. 30s around 524. Nita Richardson of ADP, you're listening to that conversation. She joins us now in anticipation of Jackson Hole, Wyoming, and the annual Fed get-together next week. Nita, welcome to the program. How much pressure is on this institution heading into next week's get-together?
I think they're under a lot of pressure because it's coming from all directions, and some of it, the pressure is solvable, and some of it, frankly, isn't. Tensions in the Middle East, not solvable by the Federal Reserve. But what's going on to get to the 2.5% target, they're making good progress, and that's good news. But I want to draw a sharp distinction between what's good news for the markets and what's good news for the worker, because that has been growing in the gap. We have a new paper out, not keep pace. And that's because employers, those very employers that the Fed is listening to, tend to have structural permanence in their wage increases. They all tend to give about the same amount of wages to the same amount of people. It's usually about 3%. It's usually whole numbers. And when inflation soars to 7%, workers lose ground. And when those inflation shocks are unexpected, those that loss of purchasing power can persist for years. Fast forward to just last week, we saw consumer sentiment fall by 12.4%. And where was it the largest? Older workers, who are least able to keep up with inflation increases for a variety of reasons. And so when you circle back to the Fed and what really the inflation backdrop means for the consumer and the household, you have consumers whose wages are just not keeping up from past inflation, let alone current bouts of inflation that we're seeing right now.
Neela, what happens when you include people who change jobs and maybe got a pay increase?
That's the power of the worker. That's the only way, really, that workers can really use their leverage in the workplace to outrun inflation. We saw that. We called it the Great Resignation. And we saw that workers were switching jobs. But guess what? These were low-wage workers mostly that were able to take advantage of it. The advantage didn't last long, because once you switch a job, you're still stuck in that permanent sticky wage increase. And so it didn't have lasting effects. 37% of workers, whether they switched jobs or stayed, saw real wage increases in those 4 years, according to our paper. And that's why when you go back to the Michigan Sentiment Survey, only 8% of respondents said that their real incomes are going to keep up with inflation. That's a very low number.
Lisa's thinking of switching in 2028. A few years' time.
When I run on the deficit?
Big change of industry.
Yeah, I think that, I don't think that's going to fly very long. I think we should cut our budget.
Fiscal discipline.
Fewer benefits.
I don't think it pays very well, but you do get some privileges around investing, Bramo, that we don't have as journalists.
Oh, I can short sell things and front run.
So you can do whatever you want.
That's fantastic.
Apparently.
Evidently,
So I hear.
I'm going to be here.
Nita Richardson of ADP. Nita, thank you. Coming up tomorrow, Jack Caffrey of JP Morgan Asset Management, Dirk Weller of Citi, Rob McNally of Rapid, Julie Beal of Kane Anderson Rudnick from New York City this morning. Good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot. Very, very strong alignment. 3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of
making it seamless online to store.
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent, but when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Mumbai. This is Bloomberg.
Happy Thursday. Stocks log a decline after yesterday. We broke 3 straight days of declines. It's 30 minutes to go until the start of your cash trade. I'm Danny Berger. Bloomberg Open Interest starts right now. On today's show, Walmart's earnings disappoint, sending a warning signal across the retail sector. The 30-year rally unravels as Besant's bid to tame yields faces a skeptical market. And President Trump threatens Iran with economic warfare after failing to reach a deal. Some of the big earnings that we got this morning, I mentioned Walmart. We'll talk with Nora about this in just a moment, but shares are down 6.75%. They fell short of expectations. There was a sales miss. Comparable sales rose only 2.6% in the last quarter. That's the slowest in over 6 years. Over in the world of tech, sources telling Bloomberg that Meta has now become one of Microsoft's biggest AI customers. It's spending hundreds of millions of dollars a year to access AI through the Azure cloud services. We'll get into that story in a bit as well. But first, let's start with the Walmart earnings and the disappointing share slide we have seen. Bloomberg's Nora Melinda joins us now. Nora, what went wrong for Walmart?
Well, when you think about Walmart, this actually gives you a great read on the consumer, and they called it a few things. Of course, there was the first rare sales miss that we've seen from the company in a while, but also a drag on Walmart was the pharmacy space. Now, we weren't essentially seeing a lack of volume for transactions in their pharmacy department, but essentially it was all due to the federal drug price negotiations actually making drug prices lower. And so, of course, as you can imagine, that's actually going to weigh on Walmart. But we did still, of course, see tariff refunds in focus. We're also seeing shoppers that were avoiding some of the grocery store section based on a lot of those foodborne illnesses that we've been talking so much about as of late. So there's a lot of different areas that Walmart's essentially been grappling with. And when we think about this in light of the other retail earnings that we've been getting, it really gives you a great read on the U.S. consumer in this moment.
I say a messy quarter. How much of it, though, was not just the consumer, but particularly a lower-end consumer that keeps facing inflationary pressures?
See, that's the thing. So it wasn't essentially a consumer that was hitting the emergency brakes, right? But they're essentially being more selective. They're doing certain trade-offs. They're saying, hey, maybe I'm not going to get this most expensive thing. I'll just get a small thing here and there. So it does show you that consumers are being quite selective and very choosy with where they're putting the money that is coming in to their wallet, where they are interested in deploying that, and where they're actually holding back.
Nora, thank you very much for joining. We'll catch up with you later in the hour. That's Bloomberg's Nora Melinda. And we're going to get more on Walmart also later this hour. Evercore ISI Senior Managing Director Greg Melich will be joining us around 9:40 a.m. Elsewhere, Meta has quietly become one of Microsoft's biggest AI customers, spending hundreds of millions of dollars a year to access AI models from Microsoft's Azure cloud services. Bloomberg's Neil Campling joins us now on this story. So getting a view into Microsoft's business, talk to me about that relationship between the two companies.
Yeah, so it's a interesting setup here. I mean, partly what it tells you, Meta has said before that they cannot get access to enough compute. So in some sense, it makes sense perhaps that they are getting the compute power from Microsoft. But we haven't really got any AI services out of Meta yet, so that raises one question. What might be happening here, which hasn't yet been discussed, is that actually perhaps Meta are arbitraging the costs of AI. So they said before that they had offers for substantial prices above what they're paying for compute from third parties on their platform. So maybe what they're doing is arbing out the fact that token costs have come down significantly so they can rent them cheap from the likes of Microsoft and then sell services themselves, AI compute from their platform, much higher prices to other people. So that could be going on.
Meta has been making various moves, you know, replacing some of the technology used from Microsoft previously with in-house, building its own business to sell access to various AI models. Does all that suggest, Neil, that this is just a snapshot of a moment in time and Meta ultimately does want to move away from Microsoft?
I think the ultimate end goal would be to try and move away from Microsoft for sure, because you know these partnerships work for short term, but you want to have your own AI frontier model effectively. You know, there's not enough room in the world probably for Anthropic, OpenAI, Microsoft, Meta, Amazon and Google all to be the significant winners in this particular race. So it makes sense that they want to have their own platform, but how this shakes out remains to be seen.
Hey, Neil, thank you very much for joining us. That's Bloomberg's Neil Campling. The Treasury rally, sparked by Scott Bessent's surprise intervention, is now fading. San Francisco Fed President Mary Daly weighed in on what the Fed can do during this time.
There's a lot of discussion about our credibility. There, I don't see our credibility at risk. I also hear a lot about should we be making preemptive cuts, or hikes rather, and I don't see a lot of evidence that that's an urgent problem to solve. I'm looking at inflation compensation and inflation expectations, and you don't see any worrisome swings in those pieces of data either. So I think policy's in a good place.
For more, we're joined by Bloomberg intelligence rate strategist Ira Jersey. Ira, you and I were having this conversation around the same time yesterday, and you were saying, look, this is likely short-term because of these long-term structural issues. Did you expect it to be so short-term that treasuries essentially have mostly erased their gains of yesterday?
Yeah, I mean, it was the knee-jerk reaction yesterday that I thought would fade a little bit. And when we talk about the size of these buybacks, they're not particularly big in the grand scheme of things. Now, they do affect a little bit some liquidity in that it takes out a lot of long duration or some long duration debt off of, say, dealer balance sheets. But affecting liquidity doesn't necessarily affect the level of yields or the longer term trading. That's going to be driven by fundamentals and also supply-demand imbalances that can be affected by what's going on in the global rate market.
One thing that hasn't changed course of direction, and that is the dollar. It's barely changed this morning, but still slightly weaker. Ira, a conversation also seems to be building that what the Treasury is essentially doing is trying to keep yields in check at the sake of the dollar, and something that could lead to inflationary pressure, commodity super cycle, and kind of lead an inflation-driven commodity cycle rather, not a super cycle, and lead to this kind of dangerous feedback loop. To what degree is a weakening dollar after yesterday's move a concern for this market?
Well, I think it's been a concern at least since the beginning of the war, right? And one of the issues has been, will there be a shift in capital flows out of the U.S. or if not out of the U.S., then maybe slower flows into the U.S. And other jurisdictions will benefit. So I think even yesterday when we chatted, we talked about the Japanese yen. And if you hedge the Japanese yen back into certain currencies, it actually yields more than U.S. Treasuries. And so that makes it more appealing for a certain group of investors. So you're not necessarily seeing a lot of selling, but you're just seeing, I think, a bit of a buyer strike. And the thing is, when you have a buyer strike like this, it's going to be hard for the market to rally very significantly unless something changes either fundamentally in the U.S. or you wind up having a reason, like some kind of structural reason for people to be buying U.S. debt. Now, there is, right, that we still have very large insurance companies and other types of flows And you did see that yesterday. Like I was talking to an investor in Asia last night, and they did say, hey, we saw a lot of flows into the long end, both of the U.S. and Japan last night from Asian life insurance companies. So it did have some psychological effect, but as you mentioned, it's not going to last very long because nothing's changed fundamentally.
Well, one of the structural issues that at least Barclays has been pointing to over the last 24 hours is just the place where demand is coming from for treasuries has changed, that the Fed has backed off along with other foreign official buyers. And instead, what's taken their place is private buyers. They say the statistic, private buyers like mutual funds, foreign investors, banks, households, they used to hold 50% of treasuries a decade ago. Now they hold 73% of treasuries. Does having a more price-sensitive buyer, does that lead to the kind of boycott or the pause that we have seen on buying treasuries as yields drift higher?
Yeah, it does, and that's been a longer-term trend, right? So since the Federal Reserve stopped buying bonds during the QE program a couple of years ago, you have seen these more price-sensitive buyers become larger and larger market participants. Now, some of them have to. Like, keep in mind, like if you're an insurance company and you have U.S. dollar liabilities, say because there's shipping offshore or something like that, you have to own some type of U.S. dollar asset. So the question is, what's the one that you want? Do you want to own corporate debt? Do you want to own treasuries or something else? So there still are some captive buyers, so just not as many of them. And like you mentioned, they are price sensitive. So they're going to say, like, look, if we think that debt to GDP is going to continue to rise in the United States and it's going to become a problem at some point, why do we want to own 30-year debt? Maybe we'll own 5-year debt or 10-year debt, but we're not going to buy out that far on the curve. And it's clear that we're at a point where there's not enough liability-driven investors in the long end to keep up with the supply that the Treasury Department keeps selling to us. And another $4 billion a month takedown is not going to really affect that supply-demand profile because there's just so much of that debt outstanding.
Ira, really great to catch up with you again this morning. Ira Jersey of Bloomberg Intelligence. Let's get a check on your markets. 20 minutes to play for until your cash trade begins, and we are down 0.4%. We did have a broad-based rally yesterday, largely led by that move in treasuries, although tech did fall. So tech falls now for another consecutive day, down 0.5%. Yields popping higher, 5 basis points. We are only 2 basis points away from being at the exact level we were before the Treasury's announcement yesterday morning. Brent crude also not helping up 2%. Coming up, President Trump calling for economic warfare against Iran. More on his latest threat. That's coming up next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Guerrero.
I'm Lisa Mateo. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly. Welcome to my workplace. Do you feel pressure? Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard. Oh boy. Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah, probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Let's get you some high-interest stories, a look at what's making headlines around the world. The U.S. national debt has topped $40 trillion for the first time, more than doubling over the last decade. And the hole is expected to get even deeper, with interest costs now representing the third largest part of the budget. AI is taking center stage at the Fed. July meeting minutes reference AI tech 18 times as officials debated whether the investment boom could fuel inflation, reshape employment, and create financial stability risks. Policymakers also warned that disappointment over AI's productivity promise could hit consumer spending and lenders. President Trump says the U.S. is now waging economic warfare against Iran, threatening to isolate Tehran and countries that help it trade. The warning puts China, Iran's biggest oil buyer, in focus. Beijing says sanctions won't resolve the conflict, while Iran is accusing Washington of economic terrorism. For more on Iran, we are joined by Bloomberg chief political correspondent and co-host of Bloomberg Surveillance, Anne-Marie Horduran. Anne-Marie, what does economic warfare mean in this context?
Well, we've had economic warfare in terms of the United States on Iran for years, especially this administration has at points have had maximum pressure. They've also, in the midst of this conflict, also gave a huge lifeline to Iran. If you remember in June when they actually lifted some of those sanctions and Iran for a short period of time was able to sell in the global market, they thought maybe they were coming in closer to a deal. So right now, the United States really has a ton of sanctions on the regime. The issue is, of course, is that Iran is able to still get oil out to one of their biggest trading partners, and that is China. And China buys the lion's share of Iranian crude, any crude that's able to get through that U.S. blockade, which the blockade has been working. And there is a pretty aggressive U.S. posture there. So this would mean the United States having to go after those networks, these other trading partners. And this creates a very awkward dynamic for the administration, given the fact that Xi Jinping is coming to meet with the president in September. And if they were to carry through on this, potentially what would then be China's reaction? Maybe going after things again like the United States and making it harder to get rare earths and those licenses. At the same time, if the United States was to double down and have more economic pressure on some of the entities Iran does business with, would we see higher crude prices? And that's also going to be a problem ahead of midterm elections.
So it seems like they don't have a lot of options here. What about pressuring other countries to do what the UAE has done, for example, and them cutting off economic ties? Could the Trump administration talk to their partners in the Gulf and try to have them exert pressure?
Well, I think the president has indirectly sort of done that, say, with the Omanis, saying you need to make sure that you are prioritizing your relationship with the United States.
Directly and saying, we'll bomb you once you do it.
Yes, but basically saying you need to prioritize your relationship with the United States and not the regime. But if you've ever been off the Gulf, the coast of Oman, you literally see the coast of Iran. These are very close neighbors to the Omanis, which is why they've been trying to do this deal with Iran to reopen up the Strait of Hormuz, but they definitely play both sides.
In the meantime, there are still issues closer to home that the president is dealing with. We're in the midst of this 3-day pause with Canada, and the reporting has suggested that they are lowering some of the tariffs or looking at them on things like auto and other metals. Where do we stand sort of in this relationship, in this standoff between the U.S. and Canada?
So it was like 11th hour tweet, basically. The president said, before midnight, I'm not going to go through with these tariffs, which basically, is taking some pressure off the relationship. The trade teams are working together, so maybe things like steel, aluminum, autos, you can see those tariff rates drop. This is a bigger story for the USMCA negotiations, and I just spoke with a source about how basically this brings Canada back into the fold when it comes to those conversations, because Canada has sort of been out there in terms of a very wide gap between the president and Prime Minister Mark Carney. Mexico has been having a lot of these chats with the United States. How are they going to renegotiate USMCA? And I think this could be a critical step towards that.
How much of this is factoring into what we're hearing from midterm primaries now, but just general races and what candidates are talking about?
Well, candidates continuously talk about affordability. The president himself ran on affordability, but if you see after survey, Americans still aren't feeling it. We have been dealing with in this economy a continuation, a snowball effect of shocks that continuously mean more price pressures. And that is why, if you look at some recent polling, the president is suffering some serious numbers when it comes to the war in Iran. I think a part of it is because Americans don't understand the true reason why the United States is there. When the president is asked about it, he has said things before like, I'm not thinking about Americans' financial situations. He means, and he said, when I am negotiating Iran to not have a nuclear weapon, but obviously the impact has been higher oil prices and higher gasoline prices. We've been maintaining across the United States above $4 a gallon in the past few weeks.
Anne-Marie, thank you so much for joining. Always appreciate it. That's Bloomberg's Anne-Marie Horder. Coming up, Lori Heinel of State Street, the global CIO, will be joining the show following Treasury's yields climbing back to levels that they were nearly at before Scott Bessent's shock Treasury intervention. This is Open Interest.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Treasury Secretary Scott Bessent's bond buyback announcement continues to reverberate through markets, with analysts warning his plan risks being a short-time circuit breaker at best. Bond yields now climbing back just 2 basis points away from the level that they were before his announcement. Joining us now is Lori Heinel, Global Chief Investment Officer at State Street Investment Management. Lori, great to see you. Thank you so much for coming in.
Yeah.
So at best, this has kind of been noted as a very short-term fix. At worst, you have people like JP Morgan saying that this risks credibility, having the Treasury step in the way they do. How are you interpreting yesterday's announcement?
Well, first of all, it's just a drop in the bucket against the upward pressure that we see on rates, at least in the short term. Certainly, we've got concerns about the deficits, and that's just aggravated the situation. You also have looming inflation inflationary pressures, which obviously puts upward pressure on bonds. And then you have massive issuance, not just by the Treasury, but by the hyperscalers and the other debt markets. So we think that this is really not something that's going to change the trajectory in the short term.
I mean, what even is the attractiveness of the long end of the curve at this moment? Because you have seen a lot of price insensitive buyers back out of the market, the Fed being an obvious one, and then other official government entities too, foreign entities, have also backed off of buying treasuries.
Well, look, you have to put it in context. It wasn't that long ago that we were talking about the fact that treasuries had zero yields.
True.
And so there was really no impetus for broader investors to have an interest. But now when you have interest rates at 4 or 5, maybe even higher, suddenly it becomes a bit more compelling from an asset allocation perspective. So we have seen institutional investors as well as individual retail investors taking advantage of the yield levels to actually deliver some kind of return in the portfolio.
So, other side effects that we've seen from this is dollar weakens, and it's more or less holding there. Gold also got a big boost from this too. If the Treasury move isn't enduring, does that mean gold's move isn't enduring as well?
Well, look, there are lots of reasons to think that gold has higher to go from here. First and foremost, as you mentioned earlier, some of the buyers, like the central banks, have actually been pivoting into gold, and so there's demand there. You have natural demand for gold through improving consumer postures globally, people wanting to buy, gold jewelry, things of that nature. And then there is this sort of overhang about the dollar, fiscal profligacy, debasement. Some of those things we think give support to gold as well.
So all of this, part of the reason, so deficit's a very clear reason why bond yields have been moving higher. The other is just the AI issuance in the corporate bond markets. And I wonder what you think of supply. If there is indeed a crowding out effect happening, maybe on the Treasury market or maybe even non-AI related bonds too.
Look, all of this is related. If you have a situation where the U.S. government is looking to raise more capital, they're running deficits, so you have the same time when other borrowers are looking to raise capital, increasing their outstanding debt, then investors have choices. And so if there's incremental yield to some of these investment grade hyperscalers or investment grade financial services companies or other investment grade bonds, obviously that's going to be a trade-off that investors will make.
What do the conversations look like with clients about bond portfolios and maybe how much more active they need to be? Because obviously just at an index level, the benchmarks contain much more tech than they ever did before.
Well, much more tech, but also much more treasuries. True. So we've been talking about this for many years as well, this idea that if you just buy the ag, if you will, you're getting a very concentrated bet on one thing. And so we've been talking about the need to really diversify your fixed income portfolio, including things like mortgage-backed securities, other investment grade, even private credit, things that actually give you incremental return and perhaps have a different sort of reaction function, if you will, to the rates dynamic.
Isn't private credit, though, also increasingly AI exposed as well?
It certainly has been and will be and probably forevermore, but it's much more broad-based than that. And I think the key element there is that you have investment-grade companies that are going into the private markets for reasons other than the fact that they just can't get capital.
So when you have Treasury yields drifting higher like they are, and yesterday just serves as a momentary blip, is there a point, Lori, where you get concerned for overall risk markets? The S&P has been declining, gained yesterday, fell for 3 days, but still pretty rich, still pretty close to all-time highs. Are you surprised that higher yields haven't weighed on risk assets more?
Well, look, the good news here is that earnings continue to be very compelling, and it's not just a monolithic story anymore. You've seen more broadening out, and you look across all the S&P sectors, for example, they've actually generated pretty compelling earnings growth over the last couple of quarters. So there's a period at which we're in this la-la land in a way, where even though rates are going higher, they're not high enough to choke off any kind of investment, as we're seeing with the massive issuance. They're also not high enough to offset that growth, but valuations are concerning. And I think the other dynamic here is that those sectors that are priced for perfection are potentially vulnerable.
Okay, Lori, stick with us. We have the opening bell to get through first. That's Lori Heinel of State Street. And a check on your markets ahead of that opening bell. We are declining, down about 0.5% for the NASDAQ as it underperforms. The S&P just slightly less than that. It doesn't get the benefit of a bond market rally this morning as 10-year yields move higher by 5 basis points alongside oil that's trading above $93 a barrel. On the other side of this break, your opening bell.
you're going to see disruption in certain job functions. I don't see how that's not possible. And I don't see how anybody can look people in the eye and say that's not possible.
What percentage of customer service gets displaced?
It can be a large percentage of customer service. I think that function, I forgot my password, you know, what's my billing amount? Those are all simple and easy things for an agent to go do. Like what we're seeing in our customer service right now is the rote stuff can be done by agents. More complex is a combination of an agent and a human working hand in hand to be able to satisfy that customer much better than either of them could do alone. And so I think you'll see all of those things happen, but I'm going to lean heavy, as I think all of my colleagues will, all of Fortune 100 will lean heavy on AI. You cannot be a part of this age without understanding the technological revolution. We have a responsibility to put serious money, resource, and effort into training not just our employees, not just people that are impacted, but the communities we serve as well, because that's the age we live in.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Let's get your trading day started. You are watching Open Interest. I'm Danny Berger. Matt Miller is still off on paternity leave. And we are looking at a market that sinks after yesterday's rebound. I should note that the NASDAQ did fall yesterday, but the S&P gained. Down 0.4, down 0.5. The Dow Jones also down as bond yields peak higher after yesterday's rally, which helped risk assets not doing the same today. This is something you don't see a lot. The same kind of company and same story ringing both bells. Both of them are defense tech IPOs. We have Lintris down at the New York Stock Exchange. They're IPOing. They do more AI defense tech. Down at the NASDAQ, we have First Breach. Again, another defense tech IPO, except not tech, I should say. They're more sort of ammunitions, full metal jackets, those kinds of things that they produce. But again, 2 IPOs in defense tech, and you know, you can guess why. It's a hot sector. The U.S. needs to rebuild munitions. Probably a good time to be going public. In other stock stories, Walmart shares are falling more than 7% this morning. They reported sales, a rare miss of expectations. Comparable sales rose 2.6% last quarter. That is the slowest in 6 years. I also want to show you what Meta and Microsoft are doing this morning, because sources told Bloomberg that Meta has become one of the biggest customers, or rather, one of the biggest customers of Microsoft in their AI offering. They've spent hundreds of millions of dollars a year to access AI models through the Azure cloud services. Both of those stocks slightly weaker, though we are looking at big tech selling off alongside Treasuries. So that seems to be the bigger impact there. We are back with State Street Global Chief Investment Officer Lori Heinel. Lori, we were just talking about earnings looking more strong, broad-based, but you have someone like a Walmart talking about a weaker consumer, especially at the lower end, and things like gasoline weighing on them. They have some weird one-offs, things around pharmacy and drug prices, but I wonder what you've gleaned from the consumer this earnings season.
Yeah, so first and foremost, we've been concerned about the consumer for a while. Certainly the employment numbers still are holding in okay, although we saw a pretty tough print last time. We've seen fracturing, particularly at the lower end of the consumer. The savings are somewhat exhausted, wage growth not keeping pace with inflation. So we think that there is vulnerability, and that's one of the areas that we've been watching closely.
Watching it or avoiding it too? When does that line get crossed?
Well, certainly from a sector allocation perspective, we've been reducing our weight to consumer, both durable as well as discretionary on this dynamic, as well as seeing other opportunities. Things like healthcare, financials look pretty attractive still.
Healthcare, yesterday's story was so remarkable with Moderna developing a vaccine which could essentially stop reoccurrence of a type of cancer of melanoma. The advancements in healthcare have been looking quite remarkable. Then you add AI into it. Right. How much about healthcare right now is just, this is a defensive industry, it's safety in a time where AI is really tumultuous, versus fundamental earnings growth from these companies?
Well, there are a couple things. First of all, the valuations were relatively attractive, and so you get a little bit of boost from that. Then you get a little bit of an upward surprise, and obviously yesterday's announcement was very compelling across the whole sector. But I think that is the story about AI. And one of the things that we've been talking to clients about for years now is that, yes, in the initial phases, it is about the hyperscalers. It is about the infrastructure, the data centers. But ultimately, it's going to be about how that translates into real-world applications, and healthcare is a great example of that.
How do you treat an index that at the broader level, though, is being subject to the volatility of the hyperscalers? One day they're up, one day they're down. Chip stocks do well, chip stocks sink. Yeah. What do you do in a market like that where the leadership looks incredibly choppy?
Well, I think it is a broadening out question, right? And so earlier this year when we did our 2026 outlook, one of the things we talked about was that broadening out, that you pivot away from those high-flying sectors into other real-world economy sectors, value stocks, small-cap stocks, because they are likely to actually outperform if they have any impulse and they actually see their earnings start to improve.
But how do you square that away with what we started out talking with the consumer?
Yeah.
How many of those are vulnerable to any sort of cyclical downturn, especially in the consumer?
Well, some of them are more so than others. I mean, certainly we've been still very cautious on things like real estate, and mortgage rates remain a real impediment to that sector in particular. And certainly if you think about the broader consumer impulse, it is the K-shaped economy. So you have to look for places where it's a little bit more impervious.
So you're still modestly overweight U.S. equities. What does it take to get the American Equity Index to continue to have gains at the pace we've seen this year?
Well, maybe we won't have gains at the pace we're seeing this year, because we're still having pretty incredible gains, but we still do think that it's the most attractive house on the block, if you will. It does benefit from a number of things. Obviously, U.S. growth has been quite resilient and continues to outpace many other parts of the world. You have the gearing towards AI and some of these thematics, which are outsized growth engines. And we still have a consumer that, while, as I mentioned before, is fracturing, it's still relatively healthy and still powering that economy.
How much of that is a, shall I say, optimistic but muted optimism? I feel like I'm not hearing full-throated bull from you, Lori.
We're not. And in fact, if anything, we've been paring back our overweight to equities generally globally. Partly because of concerns about inflation, partly because of concerns about growth slowing, geopolitical risk. There are all manner of reasons to be uncomfortable, but we still retain a slight overweight.
How are you thinking about geopolitical risk at the moment? We're back at $93 a barrel on Brent crude this morning.
Yeah, look, it's really tenuous. I think at some point the markets have just sort of looked through that, because it's hard to really predict what's going to happen this week, tomorrow, next week. And at the levels of oil prices right now, at some point it sort of exhausts itself in terms of the transmission mechanism into consumer prices.
I also feel like probably as humans, we also don't want to think of the worst. So that's also hard to factor in. When you're looking at things, though, to hedge more broadly, we've had a few people on this week come on and say, yes, the U.S. looks strong, but Europe, maybe it'll help you hedge some of your AI exposure because there's less in there. I know you also like emerging markets, too. How are you thinking about exposure outside the U.S., even though you prefer American risk the most?
Yeah, to that point, we've actually preferred emerging markets versus the other developed markets. We just think that Europe in particular is still going to be much more vulnerable to anything that's happening in the Gulf. And oh, by the way, while valuations are relatively attractive, as you say, the growth rate's just not there. So we see emerging markets as the place where there is that kind of good trade-off. And oh, by the way, some of those markets are highly geared to the AI complex as well.
It's true. And a lot of this, again, gets back to the build-out that we're seeing in AI and how important that is. When you're looking beyond the hyperscalers, for the companies that are benefiting from AI, we're talking about healthcare, how do you discern what is AI theater and what is actual progress and more sustainable margin compression, for example, from these companies that are being derived from AI? Is that actually showing up in the earnings at this point?
Well, it is in some ways. I mean, even when we talk about the retailers, you can see some differentiation there. And our job when we look at fundamentally what's driving individual companies is to discern those companies that are making good investment in technology and other capital expenditures and those that aren't. And so we've been looking for a while at markers like, do we see improved productivity? Do we see, a changing structure in how they're deploying capital? Do we see innovation? And those are the kinds of things that draw us to a company.
Laura, we're going to have to end it there, but it's been so great to have you in studio.
Yeah, no, thank you very much for having me.
Thank you for stopping by. That's State Street's Lori Heinl. Let's get a check on your markets. We're about 7 minutes into your trading day thus far, and we are down on the index, only 0.2%, or just less than that. We are looking at a breadth that is decisively down. More than 300 stocks are moving to the downside. Walmart is having a really, really tough run of it. I'm going to start in the down column because that's the worst performer. Walmart down 7.5%. It's taking off 4 points from the S&P. At one point, it was down 8.7% for the biggest decline since July of 2022. A lot of the big cap tech stocks are also down this morning as treasury yields push higher. Moderna, that comes back down to earth after it experienced those huge gains. It's down 16, 17%, but again, it had a giant rally yesterday, a lot of short covering in that name. The up column, you have NVIDIA, Broadcom, Micron, so a lot of the AI type names. Exxon Energy has been trading really well, reaching new highs. So let me show you what the various sectors are doing, because energy is at the top. We're back at $93 a barrel for Brent crude. That's followed by Infotech, largely helped by NVIDIA this morning. On the downside, staples, discretionary, consumer sectors are doing really poorly because of that Walmart miss. Their weakest sales, comparable sales growth in about 6 years. Coming up, we're going to talk more about that and the weaker growth over at Walmart. We're going to dig into the results with Greg Mellick of Evercore. That's coming up next.
We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television. Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
with Bess Friedman of Brown Brothers Real Estate. Anyway, in the meantime, Nora, let's get to you. I know you're looking at some top calls this morning.
I am. First up, Bank of America upgrading Etsy to buy and setting a street target high of $105 in their price target. The firm says Etsy's growth is starting to look more long-term as the company's strategy under its new CEO holds up better than expected, shares to the upside by about 1.9%. Next up, Morgan Stanley upgrading Merck to overweight and boosting its price target after its melanoma vaccine with Moderna delivered positive results. The firm now expects Merck's revenue to stay flat instead of falling 5%. You will see shares, though, to the downside, defying that move, down about 1.8%. And finally, TJ Maxx and Marshalls had a weak quarter. Bernstein saying sales are soft, and Jefferies questioning why growth is slowing so sharply. Meanwhile, eMarketer says Burlington and Ross are adding to the pressure. Shares of TJX down by about 2%. Those are your top calls. Danny?
Nora, thank you very much. And let's stay with retail. Walmart posting its slowest U.S. sales growth in over 6 years due to pricing pressure on its pharmacy business. Let's get more on Walmart earnings with Greg Mellick, Evercore ISI Senior Managing Director. He has an outperform rating and a $140 price target on the stock. Greg, great to see you. How much of this is just messiness in the quarter from things changing and pricing changing for their healthcare offering versus something that told us about weakness of the consumer, especially the lower end consumer?
Yeah, great questions. So the quarter was definitely a disappointment with the comp coming in at 2.6. We were thinking it would be around 3 to 3.5, and there was an extra 30 bips of deceleration from the Fair Pricing Act implementation. But that's going to stick around. So I think the reaction today is basically Walmart saying, you know what, we're going to go back to doing what we do best, which is if we have TRF rebate money, we're going to use that to offset a rising energy cost, but also really invest in price and help reaccelerate that traffic, which still nice at up 1.5% in the quarter, but last quarter traffic had been up 3%. So I think to help consumers out here, I think Walmart is doing what they do best, which is lean into price.
And they gain market share, and perhaps part of it is because of price, but we are seeing their competitors like Kroger and Target also looking at reducing prices. Greg, at what point does their ability to capture market share start to lessen because competitors are adopting the same strategy of value?
Well, it's a competitive market, and I think that's one of the things that we're seeing. We're calling it the food fight into the back half this year. But consumers have cumulative inflation over the last 3 or 4 years does weigh on consumers, and so one of the ways to keep them in the game is to do extra rollbacks. Walmart's up to 11,000 rollbacks. Target yesterday talked about reducing prices on 10,000 items. So you're right. If it comes into a food fight of basically who has the scale and who has the ability to invest to help reduce prices for consumers, I think Walmart is in that good competitive position. For them, I'd say the important thing was confirmation that a lot of the new businesses are growing north of 20%, in some cases even up to 40% if you look at advertising. And those are the things that will give them profit growth and outsized profit growth to basically do this while keeping the P&L intact. And that's what a lot of competitors don't necessarily have. So that's why I think Walmart will come out of this in a good position, but it does take some time to get that traffic back when you start this reinvestment.
In this food fight, how does Amazon complicate things in their push into groceries?
Well, Amazon has certainly been pushing in consumables. They've talked about 150 billion of grocery consumable sales. It's not so much food as it is consumables. Look at I think you have a situation now where Amazon and Walmart combine to about 20% of U.S. retail sales, and we think both of them have plenty of room to grow that to 25 or 30% over the next 5 years. And they're both doing it with membership models, and I think that's where Walmart still has it can compete effectively with Amazon, but they're going to make sure that whatever share Amazon takes out of grocery and retail isn't coming out of them. And likewise, I think Amazon is going to make sure whatever Walmart's able to do with growing Plus membership and getting into more middle and upper income households going to them also for good value and convenience, they're going to make sure they don't lose out on that either.
Greg, it feels like you're describing an environment for Walmart that is still very strong, but more competitive. And I wonder, given all of that, do you think that the reaction today looks overblown to you to see Walmart have its worst day since 2022? Is this just kind of an optics problem at the moment, considering the numbers that they put up, but underneath the surface, there's still fundamental growth to be had?
I love that conclusion, or I think that's fair. I mean, I'm not going to sugarcoat it. I mean, comps decelerated, and even traffic slowed 150 bips sequentially. I think part of that is last quarter. Basically, retail sales were stronger back in March and April when we had the benefit of all the tax cuts and the refunds from last year. But what you are seeing this quarter is a deceleration. I mean, Target had a good quarter, but they also had a deceleration of 150 basis points from their last quarter. So I think you are seeing a slower consumer environment, and I think Walmart has all the tools to compete effectively in that. And expectations, I think, got high with where the multiple had gotten earlier this year. And now the reality is, as we settle down, I think they can still grow numbers, still grow their earnings at probably half the rate of sales as we go into next year. I think ultimately that's why people will end up finding a nice bottom in Walmart here.
Greg,
it's still a good company with growth.
There was this narrative, though, around Walmart in quarters past that weakening consumer sentiment might be good for them because you have more middle and upper middle income consumers trading down and shopping at Walmart. Were they absent this quarter? Did that phenomenon not take effect?
I think that effect is still there. I think what's shifted a little bit, and this happens a lot of times with volatile energy prices, and it could speak to why maybe we'll see some of the other retailers still reporting, a lot of the dollar stores, et cetera, because their stores are further away from people. So sometimes when gasoline prices go up, they'll consolidate trips. That could be an excuse or a reason, a perfectly good explanation, or just because it might cost you $5 to fill up your car with gasoline to drive to the Walmart. Maybe you go to the dollar store where you can just walk there. So when we've seen this in the past, when we get volatile energy prices, that can be a consumer reaction, at least in the near term, while they remain volatile.
Greg, really appreciate your time this morning. Thank you so much for joining us. That's Greg Mellick of Evercore ISI. Coming up on the show, Deere's results point to a potential rebound next year for farm machinery. We'll have those results coming up. This is Open Interest.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The Geo report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
You're watching Open Interest. Let's get a check on your equity market 20 minutes into your trading day. The NASDAQ falling again today. It is its 5th consecutive day of declines. The S&P, though, that was able to move higher yesterday, but NASDAQ still leading the losses. Treasury yields moving back higher yet again. Let's see how close they are. We're now about 3 basis points away from the level that they were before the Treasury made their announcement of increasing buybacks on the long end at 523. They got to 526. And before that, they closed at their highest level since 2007. So we're still quite elevated here, but that's weighing on risk sentiment as a whole. As is this, Brent crude not helping things out. It's up by 2% as the president says that he will wage economic warfare against Iran to try to bring them in. Meta, Microsoft, we learned that Meta is one of Microsoft's biggest customers when it comes to their AI offering. Again, what is Meta doing in-house that they're now needing to move to Microsoft? Alibaba reports earnings. It's kind of the same story we've heard from the U.S. big tech players. Underwhelming is what analysts said about it, and they're spending a lot on CapEx, so that gets markets nervous. Coty, they are the beauty conglomerate. Poor set of earnings from them. Shares fall 6.6%. They own Hailey Bieber's brand. Look, it's a really crowded market for celebrity beauty. I think there's too many out there. Finally, Walmart. That is also a disappointment. Their weakest growth in about 6 months, and then 6 years rather, in Deere. Those are perking up nearly 4%. They raised the lower end of their annual profit outlook. There's a stabilizing agricultural sector, and that's pointing to a rebound next year for farm machinery. Joining us for more is Bloomberg intelligence analyst Chris Ciolino. Chris, it's been a difficult time for agriculture. What did we see in Deere's results that look so optimistic?
Yeah, it was a solid quarter and really good execution. And as you point out, it's still a very challenging ag market as we continue to bounce along the trough here. The 3Q results were better on both the top line and margins, really across all 3 businesses. I'd even highlight some notable strength in small ag as well as construction. They did also benefit from a sizable tariff refund, which was a meaningful contributor to the beat. But I think the most important thing coming out of this release was management's constructive commentary on their early order programs, which appears to suggest that we should see improved earnings next year. We'll need a little more detail on the call in terms of the magnitude of those increases and what the trajectory of a recovery may look like.
And in pointing to those early order program trends, Chris, we also heard the CEO say that they think this is going to mark a bottom of the current ag cycle. Is that what you're seeing too?
Yeah, that's our view. I mean, this year we're looking at large ag volumes kind of near the lowest level in more than 4 decades. What we're seeing now in terms of month to month, it seems like things are soft but relatively stable. So we think downside risk from here is somewhat limited. And we would anticipate, even in a flat retail market next year, just the fact that we're not going to be underproducing retail demand to bring down inventories, that should be enough to generate some significant operating leverage in the model.
Chris, for a lot of machinery companies, we've seen them getting more geared towards AI. How does Deere fare in this world? Are they adopting a lot of AI technologies? Are we going to start talking about Deere as an AI company one day?
Yes and yes. It's one of the biggest areas of investment, precision technology, precision farming, doing more with less. It continues to be a significant focus, not only here in North America, but down in Brazil. There's significant potential down there just given the sheer size of their farms and some of the large crop production down there.
How should we be thinking about that spending, though? The cost of it, the cost of compute, has been coming down. It's been weighing as these companies lay on this new cost layer in the form of AI. How is Deere handling that?
Yeah, so typically what we've seen from Deere is a lot of the new precision technologies and precision products. You're looking at typically like a 2-year payback window to really kind of entice farmers to make some of these investments because, the pricing and the upfront cost has been significant. They're still tinkering with the pricing model and the whole pay per acre and subscription model. But you're typically looking at a 2-year payback to try to get farmers, to increase adoption of these precision farming solutions.
Hey, Chris, we're going to have to leave it there. Thank you so much for joining us. That's Chris Ciolino of Bloomberg Intelligence. The latest on Deere as those shares rally more than 4.5%. Coming up in the next hour, Kara Murphy of Kestra Investment Management on market headwinds lurking beneath the surface. And Brown Harris Stevens CEO Bess Friedman joins us as home sales slide to the weakest level since the start of the year. All of that coming up in hour 2 of Open Interest.
mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise Ahead or Gattaca?
Maybe somewhere in the middle.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersachi in El Ola, Saudi Arabia, and this is Bloomberg.
ABC News. I'm Sherry Preston. After being slammed for days with back-to-back thunderstorms, cleanup is still going on across Indiana. And now thousands of people are wondering when their lights and air conditioning will be back on. ABC's Alex Perez is there.
We are now under a boil advisory.
In Griffith, Indiana, officers have been going door to door doing welfare checks, and angry residents packed the city council meeting demanding power be restored.
I'm diabetic and I have my medicine in a refrigerator.
NIPSCO, the Northern Indiana Public Service Company responsible for power in the area, says they are working around the clock to restore power, but even so, may not have it all restored until next Tuesday.
Those storms now heading east. In Pennsylvania, the NTSB is investigating a deadly mid-air collision between a small plane and a police helicopter just outside Harrisburg on Wednesday. The pilot of the plane was killed. 5 Americans among the 7 killed in a chopper crash on a safari in Kenya.
This is the latest in a troubling series of helicopter crashes we've seen in Kenya, which has a vibrant tourism industry and relies on these choppers to ferry people to specific areas.
ABC's Faith Abube. The national debt has now hit a staggering $40 trillion, double where it was a year ago, says ABC's Rebecca Jarvis.
It's tough to even wrap your head around this number, but I want to put the $40 trillion in real terms. First, it makes borrowing more expensive. A new mortgage, your credit cards, those costs can and are going up. 2, it fuels inflation. And 3, it makes it harder for the government to spend on things like healthcare, education, our roads, and our defense.
Putting aside concerns about security, tabloid spying, and allegations of racism, the Duke and Duchess of Sussex are moving back to the UK. Prime Minister Andy Burnham.
This is a private matter. It's a matter for Harry and for Meghan, and we wish them well in the move that they're making.
You're listening to ABC News. NASA Administrator Jarek Eisenman is now admitting a $30 million plan to extend the life of an Oregon telescope. Has it worked?
The launch of the refrigerator-sized Link robotic satellite on July 3rd was perfect. But within days, controllers realized that they couldn't stop Link's persistent tumbling. So hoisting the Neil Gehrels Swift Observatory into higher orbit would be impossible. Swift will burn up in Earth's atmosphere in a couple of months, to be followed sometime later by the Link robotic satellite.
That's ABC's Jim Ryan. The battle over AI-generated content online now has the children of the late Robin Williams reviving his social media accounts to get his real voice back out there. ABC's Rhiannon Alley explains.
The children of late movie legend Robin Williams aren't just protecting their father's legacy.
I ask you about love. Probably quote me a sonnet.
They're fighting back against what they call AI abuse. Zach, Zelda, and Cody Williams reactivated his Instagram account, fed up with the alleged AI misuse involving their dad's likeness, writing, "As technology evolves, we want this to be a safe, trusted place where the stories, photos, videos, and memories shared reflect his legacy with authenticity, warmth, and care."
The real Robin Williams. Walmart still did well in the second quarter, but the retailer reporting today the slowest sales pace in 6 years in the United States. Walmart offering a cautious outlook for the rest of the year. I'm Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well. Scarlett Fu, Paul Sweeney, this is the Bloomberg Intelligence Program. Coming up, we're going to check in with Ira Jersey, Bloomberg Intelligence Chief Interest Rate Strategist. We had some economic data. We got the Treasury stepping in the bond market. What does Ira Jersey think about all that kind of stuff? Derek Decollete, he is executive editor for Canada for Bloomberg News. Looks like the U.S. is set to cut tariffs on Canada metals, autos, in a trade deal. So that's good news, presumably. Nancy Daoud, private wealth advisor at Ameriprise Financial, will give us her thoughts on the market. Red Brown, Bloomberg consumer reporter. Walmart reported some numbers a little bit weaker than expected on the top line. Stocks down like 8 or 9% here. We'll get the latest there. And Adam Minter, Bloomberg opinion columnist. He's got a column out entitled, "Walter is an owner leagues want." But here's the catch. So we're talking about the owner of the Los Angeles Dodgers, the Los Angeles Lakers, all that kind of stuff. So a lot of news there. Right now, let's kick this whole thing off with Alexis Christophers and a Bloomberg Business Flash. Alexis.
All right, thanks a lot, Paul. The S&P 500 extending this week's losses as yesterday's bond rally fades. Investors are betting the Treasury's plan to curb borrowing costs is just a short-term fix and doesn't get to the root of the problem, which is the U.S. government's massive debt, which topped $40 trillion this week for the first time. The S&P 500 down 27 points or 0.3%. The Dow Jones Industrial Average slumping 385 points or 0.7%. The NASDAQ is down now 165 points. We've got the NASDAQ 100 down by 138 points. Oil, though, is higher with Brent crude at $93.98 a barrel. WTI crude at $87.94 a barrel. Bitcoin, meantime, is up about 4% at its highest level since June. Now at 71,800. This is after a positive crypto meeting yesterday with President Trump and the crypto leaders. He is urging lawmakers to pass landmark crypto legislation. In stock news, shares of Walmart down about 9%, biggest loser in the S&P 500 as its quarterly sales missed expectations. Deere & Company, though, up 4.25%. The company raising the lower end of its annual profit outlook. It says a stabilizing agriculture sector is pointing to a more pronounced rebound next year for heavy equipment. And Alibaba's profit plunging 75% after the Chinese company ratcheted up its spending on AI. We've got shares of Alibaba down 3.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christophers. That's a Bloomberg Business Flash. Back to Paul and Scarlett.
All right, Alexis, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube as well. Now, Bloomberg.com subscribers can shape the conversation on Bloomberg Radio. Submit questions for the experts and the guests on our show. Visit Bloomberg.com/AskRadio. It's an exclusive feature for Bloomberg.com subscribers and terminal clients. Visit Bloomberg.com/AskRadio to join the conversation. As Alexa was just reporting, we got some selling in the marketplace today. Let's take a look at some of the stocks on the move. We can do that with Carmen Reinecke, Deputy Team Leader for U.S. Equities from Bloomberg News. Carmen, what are you looking at today?
Yeah, so the top stock that I'm looking at today is Walmart. This is ticker WMT. Shares are down about 9% right now. This is the worst intraday move since July of 2022. So almost 4 years here. The company reported earnings, specifically quarterly sales that fell short of expectations. Looks like there was mostly pricing pressure in the pharmacy business. So some sort of federal negotiations have led to lower drug prices that's pulling those down. And this was also the slowest rate of growth that they reported in the last 6 years. So not a great sign for like the U.S. economy or just the consumer in general. Walmart's really looked at as sort of a bellwether of sentiment, I guess. So.
And we thought that they would benefit from people trading down because they're all about value and great pricing for people. So this definitely raises some questions about the strength of consumer spending.
Definitely.
You have basically chosen to do a lot of consumer companies for your stocks on the move today. You've got another one that's in the consumer space.
Yes. I mean, like, 'tis the season. It's consumer earnings week. So the next one I'm looking at is Advance Auto Parts, ticker AAP. This stock is down 21% right now, worst since August 2024. Also a pretty significant drop here after earnings. So second quarter sales fell short of analyst estimates. Citigroup in particular said the results were disappointing and missing some of the lower expectations. Truist noting it was a tougher quarter than expected. Peers like AutoZone and Genuine Parts are also falling here.
The average age of a U.S. automobile is 12.8 years. Unbelievable.
I know.
I didn't know it was
Well,
that.
no one wants to buy a new car because on average it's more than $50,000.
Yeah, I guess. All right.
It's expensive and interest rates are high. There's a lot going on there. All right. The last one that I'm looking at here is shares of Coty. So this is COTY. The ticker stock is down 10% right now. This is only the worst drop intraday since February. But this company also reported a drop in comparable sales and forecast a transition period in the current fiscal year. So this is a beauty conglomerate. They have a lot of different brands. I think the most notable one is Kylie Jenner's Kylie Cosmetics. But the stock has been under pressure through Wednesday's close. It was down 38% over the last 12 months through yesterday's close.
All right, thank you so much, Carmen Reinecke, Deputy Team Leader of our U.S. Equities coverage. And for more conversations like this, subscribe to our Stock Movers reports. These are 5-minute audio reports on the biggest winners and losers in the stock market. Stock Movers is available to you on Apple Podcasts, Spotify, or anywhere you listen. All right, you look at what's happening in the Treasury market. It's been a kind of bananas past 2 days.
Yep.
We saw yields come down, and then now they're
coming right back.
Coming right back. So that rally, that brief rally that was sparked by Treasury Secretary Scott Bessent's intervention does appear to be fading. San Francisco Fed President Mary Daly spoke to Bloomberg on what the Fed can do during this time.
There's a lot of discussion about our credibility. There, I don't see our credibility at risk. I also hear a lot about should we be making preemptive cuts or hikes rather, and I don't see a lot of evidence that that's an urgent problem to solve. I'm looking at inflation compensation and inflation expectations, and you don't see any worrisome swings in those pieces of data either. So I think policy's in a good place.
That was San Francisco Fed President Mary Daly. Let's bring in Ira Jersey. He is our Bloomberg Intelligence Chief U.S. Interest Rate Strategist on all of this, this intervention, the increased buyback from the U.S. Treasury. Ira, the intervention or the effect of the intervention didn't last for very long with yields higher across the curve. The White House, we know, is very, very focused on trying to bring down borrowing costs through the 10-year yield. Is this just the latest example of what else Treasury Secretary Scott Bessent has up his sleeve? I mean, is this, the start of a new regime where he's going to do much more aggressive interventions?
Well, it's an interesting question, Scarlett, because we don't know. And I think that that's why the market rallied so much, was because the market said, okay, maybe this is only the first thing that they can do and that they will do in order to try to bring down long-term borrowing costs. But I think part of the issue is that the Treasury Department has very limited ways to actually affect the shape of the yield curve. And the main way that it does is by suggesting how much outstanding in each bucket exists. And that's basically what they did by buying an extra $4 billion of 10 to 30 year debt than they had been before. But that means that they have to issue somewhere else, right? So the amount of total debt is still going to be the same and continues to grow. So I think that's one of the reasons why the market has continued to be a little bit skeptical about whether or not the long-term health of the U.S. fiscal situation is really going to be affected by these actions.
So, I started thinking more and more about this just because it's in the news of the U.S. debt and U.S. debt to GDP. And fortunately, on the Bloomberg terminal, we can get all of that data. And I look at the U.S. debt to GDP, which, when I started back in the business in the 80s, was around 40%. Now it's like at 128% debt to GDP. I don't know. I took a couple of economics classes. Should I be concerned about that, Ira? Is your market concerned about that?
Well, the market is a little bit concerned about it. I think that's the reason why the long-term yields have gone up, or one of the reasons that long-term yields have gone up. And this isn't, unique to the U.S. I think we keep on being a little bit myopic here, saying, this is a U.S. problem, U.S. problem, U.S. problem. Not only a U.S. problem, it's really a global problem. When you look at the U.K., you look at Japan, they've had similar situations to what's going on in the U.S., and their yield curves have been steepening, and you see much higher yields than they had just a year or two ago in those jurisdictions as well. So it's really a developed markets problem, in that we can't get out of this spiral of having to issue more debt in order to finance the existing debt, right? That's why these interest payments going up is such a large concern. But the issue is, in a lot of these countries, U.S. included, we have big structural deficits due to things like Social Security and Medicare payments, and the equivalent in a lot of other developed markets that have an aging population where governments continue to have to pay for more and more retirees that aren't contributing taxes into the economy. And we haven't really saved that money, right? We've lent that money to ourselves. And look, this is a problem that Paul, I worked in Congress 30 years ago, and even then we were talking about the Social Security problem and could there be reforms in order to make it sustainable for the long term, and we never did anything, right? Congress just sat on its hands and didn't want to touch and reform some of these entitlements, what do you call them, entitlements, mandated spending, whatever. Regardless, that's where we spend almost 50% of our federal budget. So, Congress can't do much, and there's not much that can happen that the government can really do in order to get those deficits down. Mm-hmm. So you're just going to see this happen more and more, where in sell-offs, you're going to see bigger sell-offs, and you're going to see smaller rallies when the economy slows down.
Yeah, well, there's not much Congress can do or is willing to do, because they need to be reelected to office, and no one wants to be cutting entitlements. Yep. There's this chart, or this number, I should say, that everyone's talking about. U.S. public debt hitting a new milestone of $40 trillion, and it includes both treasuries and so-called intra-governmental debt, which is, super wonky. But of course, the biggest contributors to that public debt is entitlement spending, Medicare, Medicaid, Social Security, and interest expenses. This is a huge round number, but as you've said, this is a decades-long problem. It's not new. We anticipated this. At what point does this start to really matter to people? At what point does the bond market take notice, or is this just like a slowly melting iceberg?
Yeah, I think it's the slowly melting iceberg analogy is probably a good one. And it's been growing over the course of several years, right? Like, basically since the Biden stimulus in 2021, we've been worried about having $1 trillion+ deficits. And, $1 trillion deficit but in and of itself probably isn't bad if the economy continues to grow very quickly, right? So the idea was, and this has always been the idea of Republicans, look, let's stimulate the economy, let's cut taxes, that raises the deficit deficit near term, but we'll have more income coming in later because the economy will be growing very quickly. And then the Democrats do it the other way, right, where they say, well, let's keep taxes basically where they are. You know, no one likes to raise taxes, but we're going to spend more money and thereby, you know, increase the economy and therefore get more taxes and everything else. Neither of those has worked, right? Because the debt has been growing much faster than economic activity, and that's why that debt to GDP number that Paul mentioned continues to rise. So the question is, can we get deficits? Just stop. Look, the only time that we really did a good job on deficits.
We're going to cut it there. Appreciate it. Just because of time. Ira Jersey, Chief Interest Rate Strategist.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
10:21 on Wall Street. I'm Alexis Christophorous from the Bloomberg Interactive Brokers studio. Stocks are lower today as Treasury yields reverse course from the decline we saw in the prior trading day following the Treasury Department's debt buyback announcement. Also, another rise in oil prices is putting inflation worries back on investors' radar. The S&P 500 is slipping 28 points. Dow Jones Industrial Average tumbling 423 points, or 0.8%. The NASDAQ Composite down 185 points, and the NASDAQ 100 100, giving back 154 points. We've got Brent crude up about 2% now at 93.25 a barrel, so off its highs of the morning. WTI crude up 2% at 87.54 a barrel, and the Bloomberg Dollar Spot Index slightly stronger at 1192.81. Shares of Advanced Auto Parts tumbling 22%. The parts provider reported second quarter sales that fell short of estimates. Citigroup also said the result was disappointing, and other analysts are saying it was a tougher quarter than anticipated. An ugly day for the beauty brand Coty, down nearly 11% after posting a drop in comparable sales. The company said it's in a transition period in the current fiscal year as it works to turn around its business. And Hudson River Trading has signed a multi-year deal with CoreWeave to build new trading research and models using the tech company's AI computing services. Shares of CoreWeave up now 1%. Bitcoin continuing its tear, up 3.5% now at $71,500. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Paul and Scarlett.
All right. Thank you so much, Alexis Christoforous. All right. As we focus on what's going on in the bond market, there's also trade negotiations taking place, and it looks like some progress is being made between the U.S. and Canada. There's a tentative trade deal. Let's bring in Derek DeCloet. He's our executive editor for Canada. And Derek, the tariffs against Canada were going to rise if the two sides didn't come to some kind of agreement. And it sounds like the reporting indicates that there is some kind of agreement. The most important question is my hockey equipment going to be subject to tariffs?
It looks like it won't be. It looks like those 50% tariffs, which were scheduled to go on hundreds of items, will not, although there's still some negotiating to be done, and there's a deadline that we're coming up against midnight tomorrow where that will be either those tariffs will be further delayed, or we will have a deal that takes them off the table. So not just your hockey equipment, but lots of other things too, things that home builders and industrial manufacturers in the U.S. Might be interested in, stuff like plywood, certain cement items. There's consumer goods. It was this sort of mixed bag of things that the U.S. put out there and said, we're going to hit all these things unless you start negotiating. And on the face of it, at least, that pressure tactic seems to have worked.
Derek, what's the feeling of Canadians as it relates to tariffs and the ongoing tariff, I guess, discussions between the U.S. and Canada? Is there just fatigue about it all? Is there a sense of anti-Americanism? What's the feeling up in Canada these days as it relates to
here? There was, I'd say, it's complicated, and obviously, it depends on the politics of who you talk to. So last year there was, I would say, at the beginning of this, the overall sense was betrayal. What do you mean there's going to be all of these tariffs? Trump signed a trade deal with Canada in his first term. That deal is not very old. So I would say it's now a little bit more mixed. That sense still exists. There are still anti-American signs and bumper stickers out there. There's also some fatigue. Within the business community, there is also a bit of a sense of, we have to get something so that we get certainty so we can move on, because the longer you had this hanging out there of tariffs could go up and down on any particular day, the harder it is, particularly for manufacturers, to make investment decisions. And so 18 months of this is quite a long time. And there has been a current of thinking in parts of the business community that, like, even if we have to accept something that looks like a bad deal, that is better than no deal. So it's complicated. If you look at public opinion surveys, there's still a lot of appetite for people retaliating, and there's still lots of people avoiding trips and tourism from Canada to the U.S. All these things are still way down. Yeah.
It's not just Canadians avoiding traveling to the U.S. for vacation or perhaps selling their second home, but also there are these bans on sales of U.S. wine and spirits. And I know this is something that the Trump administration has been very focused on. As much as there's a discussion between Canada and the U.S. on tariffs and whatnot, how much control or how much oversight does Mark Carney, the Prime Minister, and his administration have over what individual provinces do when it comes to banning sales of U.S. alcohol?
I mean, the provinces control that, but Carney certainly, he's got moral suasion, and that's what he's trying to exercise. He met with the premiers of the provinces yesterday to kind of outline, some of the broad terms of the deal. We don't know how much detail he got into because the deal is not done yet. Aspects of this are still being negotiated. He can't actually force the Premier of Ontario or the Premier of Quebec to put that stuff back. But what he can say, and what we believe he is saying, is, if you don't put it back, our whole deal is going to fall apart because that thing was such a visible, in your face kind of countermeasure. And the reason that the provinces did it it's actually one of the few levers they had, right? Provincial governments, they can't do tariffs, they don't control the border, but they do control that. And that's why they went down that route, and it clearly bugged the U.S. side, and that's why they stuck with it.
Derek, thanks so much. Appreciate it. Of course, Derek Declouet, he's executive editor for Canada, Bloomberg News. He joins us from Toronto there. Looking back at these markets here, sell-off continues in the marketplace. The S&P's off 28 points, the Dow's off 370 points, and the NASDAQ's off 185 points. Let's check in with our next guest, Nancy Daoud. She's a private wealth advisor at Ameriprise Financial. Nancy, thanks so much for joining us here. What are the conversations you're having with your clients these days? I mean, lots of volatility, but boy, stocks hitting all-time highs seemingly on a daily basis. Yields are higher. The VIX down pretty low, pretty quiescent, below 16. What are the conversations you're having with your clients these days?
I think that clients are starting to become a little bit nervous because I think that some of the things that are happening that could be a worry are starting to surface now, and the volatility has been, the big swings have been a little much from a day-to-day basis. However, having said that, there's the extraordinary earnings seasons with the S&P, has reached another record last week, and the S&P has been up 28 new closing highs just year to date. So they can't dispute that, but there is a little bit of a questioning, and I think the theme has been how could the market be doing so well when it feels like the world is crumbling around us? So there's some conversations around that.
Okay, so amid all of that, is the steady increase in yields a problem for your clients? Are they talking about it in terms of, oh, we're getting to a point where the treasury market looks attractive? I know no one wants to be exposed to long duration treasuries at the moment because there's so much volatility there, but have we gotten to that point where people might start looking at it as something enticing?
Well, yes, but we tend to be more proactive. So that move was done, several months ago when we began to reduce alternative strategies and be more in bond and treasury diversifiers because of the yield. So that's something that's already, if you're proactive enough, you kind of predict some of this, and although nothing is predictable, of course, but we did make those moves early on in the year to be positioned for getting the high yields. And in reality, it's just good old supply and demand. The reasons the yields are so high is because there's more demand than there is supply of the debt issues.
Nancy, how do you position AI for your clients here? There's, a lot of folks are looking at ways to really play this, maybe aside from owning simply the chip makers, the NVIDIAs, the AMDs of the world. How do you position that with your clients?
So we were in the initial phase, and there's certainly the continued enthusiasm for AI, and of course the easing concerns of inflation accelerating, although, that changes by the moment, it seems like. But the AI hardware and infrastructure, is what exhibited the strongest performance. But as the cycle progresses and matures, there will likely be, some new investment opportunities since there are signs of the next phase, which is deployment and integration. There was some signs of that showing up in July. And looking ahead, even after that phase, there's the AI-enabled discovery and the knowledge creation. There's such an excitement and a boom around this, and we are still really in not the early phase, but we're definitely still in the beginning phases of this. So that's what's really booming the market. What makes me worried is that I'd love to see a much broader return versus 50% of the market is still concentrated.
Yeah.
That's one thing that worries us. So we tend to try to really diversify as much as possible.
And we are seeing people do more of that, right? They're kind of moving away from being overly concentrated in the big tech names and trying to pick up some exposure in financials and healthcare and the like. That effort to rebalance their portfolios to diversify, how far along are we in that? Are we kind of, in the early innings, in the later innings?
Well, I don't see any reason why we won't end 2026 very positively. So when I look at someone's allocation, the equity portion has done so well that it's taken up a very large piece of the pie. So we have to keep calibrating back to the original risk tolerance profile. Everybody has a different level of appetite for risk, and we have to maintain that. And when stocks do so well, they end up drifting away from the individual risk profiles, and we have to keep rebalancing and taking some profits. And that's been very positive, actually, because, you're sort of keeping some of that gain and have potential for additional gain. And at the same time, diversifying a little bit, maybe getting some safety.
Nancy, thanks so much for joining us. Appreciate getting a few minutes of your time. Nancy Daoud, she is a private wealth advisor at Ameriprise Financial, joining us from Oxford, Connecticut, a little bit northwest of Hartford, if I remember right. It's close enough for pizza.
Yeah, well, pizza's all over the state.
I'm sorry, a little bit northwest of New Haven.
Yes, New Haven being the epicenter of Connecticut pizza, or a pizza, as they call it.
Which I haven't really had. Have you been up there to have pizza there?
Yeah. I like Modern. I like Frank Pepe's. There's a bunch of smaller ones I don't know as well. Sally's is really good.
That's the one I hear about a lot. All right. I think I'm a pizza guy, but I've never been up to really New Haven and tried that, and they say that's pretty good.
Got to make a day out of it.
Make a day out of it. Foliage and pizza up in Connecticut.
Wait, white pizza or red pizza? What do you prefer?
Red.
Okay, because the clam pizza is their specialty.
Is it?
Well, in New Haven.
Okay.
Yeah.
All right, I'll give it a shot. S&P down 25 points, the Dow down 350, and the Nasdaq down 190 points at 0.7%. We're gonna have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. I'm Alexis Christoforous. From the Bloomberg Interactive Broker Studio, we have got the major stock market indexes lower across the board as that bond rally we saw yesterday quickly fizzled, and oil is rallying once again. The S&P 500 down about 19 points, or 0.25%. The Dow Jones Industrial Average tumbling 346 points, or 0.6%, and we've got the NASDAQ down by 151 points, or 0.5%. NASDAQ 100 down about 110 points at the moment. We've got Brent crude at $93.10 a barrel. That is up 1.6%. West Texas Intermediate crude up nearly 2% at $87.50 a barrel. And the Bloomberg Dollar Spot Index flat at 1192.36. But the Japanese yen is down about 0.4% today at 158.77 against the U.S. dollar. A rare miss at Walmart. The retail giant posted its slowest sales growth in 6 years, thanks in part to higher drug prices at its pharmacy. We've got shares of Walmart down now 9%, one of the biggest losers for the S&P 500. The biggest loser would be Moderna. That stock down 20%. That's after yesterday's 177% rally sparked by a promising result from the cancer vaccine it's working on with Merck. We've got shares in crypto-related companies rising today. That includes Strategy, Coinbase, BitGo, all higher after President Trump had a friendly meeting with digital currency leaders at the White House yesterday. Bitcoin, by the way, has been on a tear. It is up more than 3.5% at $71,545, its highest level since June. And the owner of the New York Stock Exchange is looking at Polymarket's new funding round after investing more than $1.6 billion in their prediction market platform. Polymarket's looking to raise capital at a valuation of more than $20 billion, which would be more than double its valuation in October. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Paul and Scarlett.
All right, Alexis, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube as well. Alexis was just reporting on Walmart. I mean, man, the stock's down 9.2%. That's the biggest decline since like May of 2022. I mean, this is a big day for Walmart.
Walmart stock does not move up or down by that kind of size. I mean, it just doesn't. It's a blue chip stock. Yep. I mean, it moves up or down 0.5% on most days.
$825 billion in market cap, so some real money's being traded here today. Red Brown joins us here. He's a consumer reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Red, what happened with Walmart and their results? Why is the street so down and out on this name today?
Yeah, I mean, the size of the move also kind of made me pause as well, because it's extreme, especially for Walmart of all people. So I think the reaction really is coming from this top line miss. So Walmart's U.S. same store sales missed even the sort of most pessimistic outlook among analysts. So I think that's probably kind of leading to some of the move that we're seeing. A big piece of the company is calling out is lower drug pricing was kind of a factor in that. But even when you strip that out, sales only grew 3.4%, which still would have been a slight miss, which is still kind of a rare happening for Walmart. So I think that the conversation sort of shifts to like kind of what can they do now and what does this sort of mean for the wider economy?
Yeah, the fact that within the earnings that got my attention was shoppers spending less per trip during the quarter. You would think that in this kind of environment with inflation being so persistent, gas prices staying high, that people would double down on a place like Walmart. What is the company saying? What did it reveal on the earnings call about how it's going to move forward then?
Yeah, I think the most interesting thing that came out in an interview my colleague did and also during the call was that they cut prices on 11,000 items. That's almost double what they usually do at this time of the year. So I think that sort of speaks to how Walmart is going to be moving forward. The strategy has been to continue to prioritize market share. You'll hear this kind of across consumer companies. P&G, sort of similar, sort of economic barometer, saying very similar things. And I think that is the sort of path forward here is we have to cut prices to keep people coming in. You know, we saw foot traffic, even though ticket was down, foot traffic was also missed results. So it's not down, so up slightly, but yeah, people are cutting back in terms of the number of times they're shopping, and when they go, they're also probably putting less things in their basket as well. So the way forward seems to be kind of continue to cut prices, but at the same time, there's prices that are outside of their control, right? So fuel and inflation, not inflation, sorry, interest rates, all these things that are outside of Walmart's control are weighing on the business as well.
51 analysts cover the stock, which just shows you the terrible economics of sell-side research. Who needs 51 analysts covering one stock? 45 buys, 5 holds, 1 sell. The street's still bullish on Walmart. Is there any reason to believe their sales softness was a Walmart issue versus more of a kind of a macro consumer issue?
That's a good question. I guess I could probably make an argument for both. Look, some of the strategies they're making are going to going to contribute to lower sales, right? Like if you are cutting the price of a lot of items, that's going to lead to kind of a slowdown of the top line. But at the same time, if you're also seeing that less people are coming in than expected, even with these lower price items, there's probably some sort of read that you could make about kind of the health of the consumer in general. Obviously, we've seen consumer sentiment come down as well. I think some of the lower levels we've seen in kind of recent history. So that also sort of kind of leads me to believe that this is a wider issue. We're all feeling it, right? Like we all see every single day the things that we're doing. We have to cut back. We have to make decisions about maybe stretching for a higher priced item. I don't think that there was a ton of discussion around sort of those items as more discretionary pieces, but that would also be sort of an issue that would probably make us conclude that people are just needing to trim, and it's impacting even someone like Walmart.
Within the earnings, recent foodborne illnesses also weighing on demand for things like packaged lettuce and strawberries, because groceries is a huge part of Walmart's business.
Yeah.
Red, I know you also cover the restaurant companies. Is there anything new in that how tainted lettuce or tainted vegetables issue right now?
Nothing new off the top of my head that I could say in terms of like maybe where the outbreak is going. But what is interesting to me is sort of like secondary effects of that. So it's like, you have to think about like things like croutons, right? Like if people aren't eating as much salad, like do I need croutons? Do I need salad dressing, right?
Good
so
point.
there are these sort of like knock-on secondary effects that
Do I need my cherry tomatoes?
Exactly, right? There's so many things that you're just like, nuts, whatever, you're throwing on the salads, right? It's just like it does have sort of a ripple effect to other parts of the economy. So I guess that would be sort of the newest thing that I guess we're going to keep watching, is just like who else sort of has to deal with some of this fallout.
Today is salad day for me, by the way.
Are you still going to get a salad?
Yeah.
Really? You're not deterred by this at
No,
all?
please.
You've made no adjustments?
None.
Is a salad
Whatsoever.
place less crowded than it used to be?
I'll tell you what, the salad line is less crowded and the sandwich line is very crowded. But the salad line, I breeze right through. So, I mean, again, born and raised in New Jersey, I've consumed every carcinogen there is known to man, and I'm doing just fine. I'm immune to all this stuff. How about the supermarket side of Walmart? Again, that drives traffic. They're not. How's that business? They're not cutting prices there, are they, on the supermarket? Or
I believe so. It's if you're cutting 11,000 items, like it's obviously gonna be there displayed on the e-commerce, but the company said, like the stores are still obviously an incredibly important part of our business. So and that oftentimes if you're gonna cut back too, there's all these prices that come with e-commerce as well, right? Like there's delivery fees, maybe not less so for someone like Walmart who can kind of minimize some of those, but like if I'm going to be going to get gas, I'm going to be making all of my sort of grocery and errands in one trip, right? I don't want to be driving as much as I need to be, right? So, it does matter kind of what's going on with the stores. And, they're having to make adjustments even at the sort of a keystone of the business.
Before we let you go, was there anything said about spending on AI? I know they spent a lot on the e-commerce business, but did they mention AI at all in the earnings call?
Off the top of my head, I'm not... I think they did say something that it's still kind of driving traffic and things like that. Like they're still investing there. Obviously, like, big push on e-commerce and trying to get people to, surface new things or trying to sort of predict what people might need, making sure the ads are in the right place. So definitely still part of the sort of tech drive, especially with the new CEO who has been kind of heavily involved in that with the business. So I don't imagine that investment will probably be going anywhere anytime soon.
All right, Red, thanks so much. Appreciate that. Red Brown, consumer reporter for Bloomberg News. Trying to scare me out of getting my salad today?
No go.
No. I mean, I'm going to go. I mean, what's the worst that can happen? Come on. Looking at the market here, S&P down 21 points. The Dow down 360. And the NASDAQ down 175 points. It's about 0.7%. In the bond market, yields inching a little bit higher here today. The 10-year's up 4 basis points, 4.69%. WTI crude oil up another $2, just below $88 per barrel. Here we go again. John Tucker paying more at the Wawa on Route 36.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney, we're live here in a Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube as well. Well, owning, a big league sports franchise, NFL, NBA, Major League Baseball, whatever, it used to be the game for millionaires. And then it became the game for billionaires. And now you could make the argument it is the game for institutional investor types. Think Mark Walter, the owner of the Dodgers, the owner of the Los Angeles Lakers. Well, he sold the Los Angeles Lakers, announced last week, $12.5 billion, less than a year after taking control of the team for like $10 billion. So he's got some pressures on him here. Adam Mintner joins us here. He's an opinion columnist for Bloomberg News. Adam, the NBA, Mark Walter is arguably the kind of owner the NBA or the NFL would like to see. He's got institutional investor money behind him. What went wrong here? What's going on?
Well, what went wrong is what happens when you get these really big investors. We're not talking about families owning these things anymore. Right. You're talking about guys and gals who own financial empires. And when something goes wrong in one part of a financial empire, it usually infects the rest of the financial empire. And that's what's happened with Mark Walter. There's an investigation into how he's managed money with his insurance companies. The federal government's looking into him. And as a result, he needs to get cash quickly. So he owns all these sports franchises. And he did what an investor does. He looked to liquidate something so he has cash. That's what an investor does. It's not necessarily what we as fans or leagues who look at teams as something that need to be stewarded. That's not what they necessarily want. And so we're sort of seeing this conflict here between, a high risk investor and what it usually means, traditionally, historically means to be an owner in a league like the NBA or the NFL or MLB.
And Adam, it feels like every entity is now investigating him, the DOJ included. Did the sellers of the various teams that sold to Mark Walter ever do their due diligence? What level of due diligence is there by the seller or by the league as a whole? And we're talking across different leagues here because of his exposure to all these different teams.
Yeah, it's a great question. Certainly they do their due diligence. The first thing they want to know, the most important thing they want to know is, does he have the money? And Mark Walter clearly had the money. He could write the check, if you will, for the Lakers. They also want to make sure that there's nothing, untoward about the money. If there's investments, if there's sources of revenues that, contradict a league's, image, adult-oriented enterprises, that kind of thing. They don't want that kind of owner there. But the leagues are not generally going to get into the mechanics of, if he's taking money from, and just speaking, theoretically here, taking money from one part of his empire and putting it into another. It's interesting, when he purchased the Dodgers over a decade ago, there were concerns about where the money was coming from. Not that there were untoward places, but that, again, he was making deals where he was using insurance money from his insurance companies to finance the Dodgers. This was looked into, and it was ultimately at the time decided that he hadn't done anything wrong. But again, this issue has now come up again, and it raises the question about whether the leagues, NBA, NFL in particular, because they're the ones with the most expensive franchises, should be taking a more careful look at how these complicated deals are being financed by these financiers, by these investors.
Adam, we've seen a trend over the last decade or so of leagues like the NFL and the NBA permitting private equity to take a stake here, limited stakes. Has that been deemed successful, a good thing? It certainly pushed up valuations, I would think.
Well, yes. From the point of view of the leagues, it's successful because it's pushed up valuations. And on top of pushing up valuations, it's given a lot of teams, a quick source of cash if they want it. If you're a team owner who's looking to build a stadium, why not sell off 10% of your franchise to a private equity firm who has a non-voting interest in your team, and you can use that cash then to build the infrastructure you want and further build out your team. So far it's been successful. I think it's important to note, Mark Walter is not private equity, but he comes from that world of institutional investors where you have, sort of different motivations. You are willing to take risks and you are willing to maximize your return. A guy like Walter is accustomed to when the price is right, you sell. And let the chips fall where they may. With the Lakers, they're falling in some uncomfortable ways. I mean, since Walter bought the team less than a year ago, they've had 2 rounds of layoffs. You have players who have said, we're going to commit to this franchise. Now they have to wonder, what's this new ownership group mean? You have the Buss family who owned them before Walter came in. They're now in a feud because they still own less than 20% of the team, but Jeannie Buss, one of the 6 siblings, was the acting governor. What's going to happen to her? So it's, this sell quick ethos has really turned things on their ear.
Yeah, it's gotten messy very quickly. Adam, we have about 30 seconds left. What will you be watching for as this Mark Walters saga continues? It feels like we're always ready for another shoe to drop.
Yeah, well, I think the shoe that I'm watching and a lot of people are watching is, what is he going to sell next? It's been reported, including by Bloomberg, that he's looking to sell his stake in Chelsea, the Premier League football club. He has other assets as well. Will we start seeing rumors that he's looking at selling the Dodgers, which is sort of the crown jewel that he has remaining? So he has a lot of other sports assets to sell, and so that's what I'm watching.
All right, Adam, thank you so much. We appreciate it. Adam Minter, he is opinion columnist for Bloomberg News, joining us from Minneapolis via that Zoom thing. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metal. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in just moments with the stocks selling off here. The S&P off about 18 points, off about 0.25%. The Nasdaq's off 170 points. That's about 0.6%. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
This is Bloomberg Intelligence, broadcasting live from the Bloomberg Interactive Brokers studio in Midtown Manhattan. Paul Sweeney, Scarlett Fu, and Matt Piper with you for this second hour of the program. We have a lot to get through. We just have a new headline that just crossed the Bloomberg terminal. Switzerland and China agreed on a new trade agreement that almost entirely removes tariffs on Swiss exports into China. So as the U.S. wreaks havoc with the global trade picture, we see Switzerland and China making moves to make the trade between their countries a little more seamless. Watches, yes, chocolate, among other things. Swiss gold bars, too. Yes. So let's not forget about that. All right, coming up in this second hour of Bloomberg Intelligence, Bitcoin, believe it or not, has moved past $70,000, even as stocks and treasuries post decline. So we're going to check in with Mike McGlone on that. Christopher Cialino, he is our senior U.S. machinery analyst, will recap Deere's earnings because that farm equipment maker has reported results. David Kudla is founder, CEO, and chief investment strategist at Mainstay Capital Management. He'll join us to talk about what he sees out there in financial markets. And Mandeep Singh will be with us. He is our global head of tech research on Meta and what's going on there with that trial. Certainly some big dollar signs there in terms of the risk that Meta faces with any kind of settlement. All right, let's get to the news at hand right now. We're going to bring in Matt Piper for our Bloomberg Business Flash.
Hey, Scarlett, thank you so much. We are seeing a bit of a drop on Wall Street for your Thursday. Stocks are falling as rising oil prices put inflation risks back on investors' radar. We check the markets for you all day long here at Bloomberg. The Dow right now is down 278. The S&P is down by about 10 points. The NASDAQ is down 129. The Bloomberg Dollar Spot Index is at 1191. The dollar is little changed while Bitcoin is trading above $70,000 for the first time since June. Right now, Bitcoin is at 72,000. Crude is moving higher. Brent is at $93 a barrel. WTI is at about 87.5. Bonds have unwound gains that followed Treasury Secretary Scott Bessent's plan to increase buybacks of longer-dated debt, a sign that investors see it only as a short-lived remedy to curb borrowing costs. Mary Daly is the San Francisco Fed president.
Right now, I'm not seeing a broad spillover in the broader inflation measures. I am seeing a rise in software and technology goods. Those are pushing up, but that's a relatively small sector of the overall price indices.
San Francisco Fed President Mary Daly, who was on Bloomberg surveillance. Well, Meta has quietly become one of Microsoft's largest AI customers. Meta is spending hundreds of millions of dollars a year to access artificial intelligence models through Microsoft's Azure cloud service. Microsoft is especially reliant on a handful of tech sector customers. OpenAI, the company's longtime partner, provided about 70% of Microsoft's overall AI revenue in its most recent fiscal year. Microsoft right now, by the way, is down about 2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper. That's a Bloomberg Business Flash. Paul and Scarlett.
Thanks so much. Appreciate it. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Red headline crossing the Bloomberg terminal. Secretary Bessent saying that buybacks could be bigger than the $4 billion we announced. So we'll keep an eye on that. All right, folks, Bloomberg.com subscribers can shape the conversation on Bloomberg Radio. Submit questions for the experts and guests on our show. Visit Bloomberg.com/AskRadio. It's an exclusive feature for Bloomberg.com subscribers and terminal clients. Visit Bloomberg.com/AskRadio to join the conversation. God bless you. Let's get going with this. We got some stocks on the move here. The stock just selling off here today, as Matt was just talking to us about. But let's see where some of the stock movers are today. We can do that with Tatiana Dari. Tatiana, what are you looking at today?
Well, we have to talk about Walmart, down nearly 10% here, and its biggest drop since May 2022. And the culprit is comparable sales, which rose 2.6% in the quarter, but that was shy of analyst estimates and the slowest in nearly or over 6 years, rather. Walmart said that this is because of their pharmacy business, which weighed on sales due to the federal negotiations that have led to lower drug prices. Shoppers spent less per trip. Also, during the quarter, though, the number of transactions stayed at similar levels. And the company now also expects more than $2 billion of fuel-related costs this year, higher than its previous outlook, and this is all contributing to jitters that the big box retailer is showing some sort of deceleration in the economic momentum and some of those consumer jitters that we are seeing in a survey. And today's sell-off has flipped the stock's year-to-date performance to negative now. I have to say I am contributing actively by buying all the Paw Patrol toys, and they do have the best prices there for kid toys. So I don't know what's going on.
But maybe you're buying less of other things at Walmart as well. So that might be part of it.
Spending it all on toys.
Spending it all on toys. You've got your priorities straight. Tatiana, what else are you looking at?
Well, sticking to the consumer, looking at Coty in the beauty industry here, shares down 10% after reporting a drop in comparable sales and forecasting a transition period for the current fiscal year. Net revenue did increase, but on a comparable basis, it declined. That includes headwinds from the Middle East conflict, and it also marks its 7th straight decline for this particular measure. It also had somewhat a lackluster guidance for revenue to decline by low to mid single digits there. So it looks like, much like its rival Estée Lauder, it's still ongoing, this transition. It sort of, the results are slow to show off, but executives are saying that there are early signs of stabilization, even though the recovery will not be linear.
All right, Alibaba.
And Alibaba here shares down about 2% now after profits plunged more than 75% after the company increased its capital spending to about $10 billion on AI. It's all about AI when it comes to the online retail giant over in China. It reported a 9% jump in revenue in line with estimates, but net income and free cash flow really taking a hit from those AI outlays. The company said it aims to recoup its investment within 3 years, which is kind of nice to see because I haven't seen many of those estimates out there. And annualized revenue from AI products nearing about $10 billion for the current quarter. So that is all a little bit encouraging here, with shares also off their lows.
All right, Tatiana, thank you so much. Tatiana Darrier, of course, our strategist for Markets Live. You can check out her work at MLiveGo on the Bloomberg terminal. And for more conversations like this, subscribe to our Stock Movers reports. These are 5-minute audio reports on the biggest winners and losers in the stock market. Stock Movers is available on Apple Podcasts, Spotify, or anywhere you listen. One thing that's kind of surprising in today's market is just how much Bitcoin is gaining. And I know 4% for Bitcoin is not a big deal, but the fact that it's got a green arrow next to it when stocks are down, when Treasury's down, is kind of notable. Mike McGlone is our senior commodity strategist for Bloomberg Intelligence. And Mike, I thought Bitcoin was a risk asset, but here it is doing something totally different than stocks, for instance, or Treasuries, which, you know, is no longer a safe haven, it feels like.
It's a bear market that's bouncing, Scarlett. We have to put it in context. It's August. It's a perfect time of year to flush out the shorts in a bear market, get everybody excited, and then go back down. So it's finally bounced above its 200-day moving average, which is rolled over. But the key way I look at Bitcoin is it's a horrible performing asset with a high correlation to the stock market, and it has a major risk of going down more. Good examples on the year, it's down about 20%. Stock market's up about 15%. On a 5-year basis, it's up 40% or so. Stock market total returns around 80%. So I put on my risk manager hat and I say, yeah, this is a horrible asset. It's high volatility, high correlation, and there's unlimited supply of cryptos now. So I will be on the record that this is a dog. I think it's going to roll over by the end of the year. And the only thing that will support it now is the stock market has to go up.
So who trades Bitcoin these days, Mike? Retail versus institutional. Who's doing it these days?
Exactly. That's what it is. It's a trading vehicle. Now there's millions of them. Go trade. I'm an ex-trader. I get it. You're supposed to trade it, but most of them just like to buy it to go higher. That trade's over. Like even precious metals, that big rally is over. All those traders have shifted over to the stock market, but who's trading? They can trade all they want, but I look at it from an institutional standpoint. When people say institutions are coming in, I'm like, why? It's a horrible performing asset, high correlation. Just from a risk management standpoint, it's just a bad asset. Something's got to change. The bottom line, though, is for me, for a whole crypto spaces, there was one in 2009, and now there's millions. It's way oversupplied, and it looks like the whole thing just needs a purge, and this is just a bounce within the purge.
Mike, you probably know this, but I co-host Bloomberg Crypto every Tuesday, and the price action of crypto has really not been anything too exciting since last October. But the industry has moved on to things like prediction markets or tokenization, all these other ways of transforming the financial industry from what was traditional infrastructure to something that incorporates the new blockchain technology. Is that kind of movement towards this new technology going to at some point have an impact on the price of Bitcoin and the other digital currencies that kind of underlie all of this?
Well, you nailed it, Scarlett. That's the key thing about this space. The technology is overwhelming. The proliferation of crypto dollars, stable coins, the tokenization of assets makes real value, and really value, that's my key point, is anything you see that tracks like a dollar of an asset, that has a basis. But all the other cryptos like Bitcoin, there's no basis. They track nothing. It's all hopium. We just need to purge a lot of those excesses. But I think that's the key thing from all along is I love the technology, but the key thing to remember is Bitcoin was started out as peer-to-peer cash. Well, you don't need that anymore. We have crypto dollars. And that's part of what I think people are learning global is I can exchange dollars on my phone via stablecoin. I don't need to take the risk in a highly speculative digital asset anymore. And by the way, there's an unlimited supply of those.
All right, let's switch real quick before we let you go, Mike, over to crude oil, higher yet again over the last several days. I guess reflecting some increased tensions in the Middle East. What's the oil action telling you here?
Well, definitely a key thing, Paul. Let's watch that first contract expires today. That's September. We move to October tomorrow, and that's around 86. The front contract's around 88. So that's going to happen. It's all about Mr. Trump. The key question I need to ask myself is, you look at January natural gas in the U.S. That's the apex of the #1 measure of heat, electricity, and fertilizer. It's down 15% on the year as we approach winter. I have a feeling that crude oil is going to follow it and get lower inflation and energy inflation into the year end. And the #1 person who can control that is Mr. Trump. So what he does, I don't know. But the bottom line, as we're seeing right now, is the rest of the world's purchasing a lot of crude oil, most notably U.S., Canada, Guyana, Brazil. All these countries are on record exports now, and record production. And we're finding out the Gulf is important, but it's becoming less important as the rest of the world shifts to more production and less demand.
Mike, always a treat chatting with you. Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence from our Miami office. Yes, we have Bloomberg Intelligence.
That's very appropriate that he covers Bitcoin from Miami.
Yeah, of course, because it is the self-proclaimed crypto capital of the world for that nanosecond that people cared about that stuff. But people tell me they still care about crypto. We just don't talk about it as much, I guess.
Well, wait for the price action to get to something like, 90,000 or 100,000, and people will care very quickly.
What they care about are Deere tractors. Deere reported some numbers, pretty darn good numbers, and they're calling maybe the end of the cycle here, that we could have an upcycle coming. And the stock's up 7% today, up 34% year to date. We want to talk about all those tractors and machinery stuff. We talked to Chris Ciolino. He does all that stuff for Bloomberg Intelligence. Chris, you're locked in on Deere. What did we hear from them with their most recent earnings?
Yeah, it was a really solid quarter and good execution in what is still a really challenging ag market as we kind of, just bounce along the trough of the cycle here. They put up better than expected sales and margins across all three businesses, with notable strength in some of the smaller ag equipment as well as construction. They did also benefit from a tariff refund in the quarter, which was a meaningful contributor to the beat. But I really think one of the most important takeaways from this quarter was that management noted, particular strength in their early order programs for next year. So their early order programs were up mid-single digits, which was much better than we were expecting. We were looking at something more of like a flat retail market next year. So I think this certainly provides some optimism as we move into 2027.
And just a red headline here crossing the Bloomberg terminal. Scott Bessent, the Treasury Secretary, says he or they, someone at the White House, will be holding a press conference on Monday on Iran plans. So, of course, we will keep you posted when that happens. But again, the White House or Scott Bessent will be holding a press conference on Monday on Iran plans. All right, let's get back to Christopher Ciolino on Deere's latest results. Chris, what have we learned about the U.S. ag cycle, farm cycle, versus those outside of the U.S.?
Yeah, so I think one of the takeaways from this quarter is that in North America, demand is still soft but relatively stable. We haven't seen further deterioration. You're starting to see a little bit of improvement in terms of crop prices. You still have elevated input costs. Net, things haven't really changed much. We're kind of bouncing along the bottom. The two regions that we're watching that you saw some deterioration during the quarter were one, Europe, and two, South America. Europe obviously has some hot, dry conditions, and then a little bit more of an impact there in terms of input costs in the Iran conflict. And then down in South America, you continue to have credit constraints. Financing remains a challenge, and you have an upcoming presidential election in October. So I'd expect demand in that market to remain really challenged until we get to the fourth quarter, at least from a calendar year perspective.
So the U.S. farmer still challenged. Is that what we're hearing, Chris, from the Deeres of the world?
Yeah, there really hasn't been a lot of movement, and I'd say like the improvement we have seen in crop prices, while it's encouraging, we're still, at historically low levels. There's just still a lot of uncertainty around input costs. The input cost hit is going to come a little bit later in North America than compared to what you'll see in South America because of the double cropping, and then obviously in Europe. But really, sentiment hasn't really changed. Starting to see a little bit of signs of optimism, but I think the biggest read across in terms of the health of the farmer and their appetite to go out and spend on equipment next year was the early order programs that Deere mentioned and that mid-single digit increase. So again, we're coming off a low base, but it is certainly encouraging to see that we're have really kind of solidified that 26 will be the bottom.
Chris, is there any kind of tariff story here with Deere, whether their goods are being tariffed when they're exported to other countries or whether parts for their equipment are being tariffed?
Yeah, so the tariff impact certainly played a part in their 3Q results. It was roughly $110 million refund benefit in the quarter. So we estimated contributed about 29 cents of the 39-cent beat. So certainly meaningful. It doesn't sound like Deere anticipates further refunds moving forward. They did have a bigger refund in their fiscal 2Q. Net for the entire year, we're looking at a gross tariff headwind of somewhere in the neighborhood of $1.1 billion. That's slightly better than they anticipated in the prior quarter of about $1.2 billion.
Right.
And we're looking at 2027 run rate kind of in that $1 billion range. So still a headwind as we move into next year on a gross basis.
All right, Chris, great stuff as always. Chris Giolino, Senior U.S. Machinery Analyst, breaking down the Deere earnings. Again, some good numbers there. Stock up almost 8% today. And up 34% year to date. So it's a good time for those green tractors out there. I had a push mower when I was mowing my lawn as a kid. My brothers had the riding mower, but I had the push mower. Tough life. This is what.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Matt Piper. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k, tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Well, some relief created yesterday after the Treasury Department moved to ease pressure from the bond market is being erased today. Add to that, Treasury Secretary Scott Bessent has just said buybacks of Treasury securities could be more than $4 billion per issue. We check the markets for you all day long here at Bloomberg. The Dow right now is down 360 points. The S&P is down by 25. The NASDAQ is down about 215. The Bloomberg Dollar Spot Index is at 1192. The 2-year yield is up 2 basis points. The 10-year yield is now up 5 basis points. Crude oil is moving higher. Brent is at $93 a barrel. WTI is just nearing $88 a barrel. We've been hearing a lot about Walmart today. It saw its slowest U.S. sales growth in 6 years. Despite that, Walmart raised its full-year guidance for sales and adjusted operating income. Walmart shares right now are down about 11%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash. Paul and Scarlett.
Matt Piper, thank you so much. We appreciate it. Looking at these markets, as Matt was just reporting, we got some selling out there in the marketplace. We've got the Treasury Department, I guess, buying bonds. And what does all this mean for investor? Yeah, but first off, before we go to our next guest, right now, Treasury Secretary Bessent is taking questions right now. Let's take a listen. Here, hold on. Here we go. I see him out there. I see him. He's out there. He's at the White House, I believe.
There you go.
There we go.
Neil McCabe. Mr. Secretary, Target received a $1 billion refund for tariffs. What does that say about the size, besides the fact that it was done so quickly and efficiently, the refund, but what does it say about the amount of Chinese-made goods and foreign-made goods that our retailers are still selling in the United States?
Yeah, well, what it says is that the Democratic attorney generals who filed a ridiculous lawsuit against this administration wanted the money to go back to the payer of record. So that is corporate welfare. The American people had that money. And if I hear another Democratic legislator make the inane remark, the American people should get the money, the American people had the money in the U.S. Treasury, and we were forced to give it back. But using the 301s, which have survived more than 5,000 suits, that we will get that tariff income back. But what you are seeing is that we don't know the discount that Target got from the Chinese suppliers. So, this is a corporate bonanza, which I said it would be at the time.
Secretary, real quickly, a message to Iran, sir. Message to Iran, sir.
All right, that was Secretary Bessent answering some questions and on the policy here, which is what some people are calling Operation Twist, buying back some long-dated bonds, increasing the buyback there and trying to push down interest rates. Let's talk to a professional about this market stuff. David Kudla, founder, chief executive officer, and chief investment strategist for Mainstay Capital Management. David, thanks so much for joining us here. What did you make of the move yesterday by the Treasury to step into the bond market?
Well, it is Paul, it's an act of desperation. It's not a structural change. It's an intervention. We've seen this with Japan over many, many years to defend the yen, and it'll last some period of time, and we've already seen a lot of unwind of it today. It's an act of desperation. They're in panic mode.
It feels like Treasury is throwing a lot of things against the wall to try to keep borrowing costs down. This is not the only thing. They also intervened with Japan in the currency market to support the yen, and a lot of people say that's to prevent Japan from selling treasuries and pushing yields higher. What would actually make a difference in terms of having a lasting effect?
stop spending. Scarlett, they right? I mean, we all know it. They need to stop spending. They've literally, the U.S. has literally doubled. We just passed 40 trillion. It's been all over the news, but half of that debt was created in the last 10 years alone. We've doubled it in 10 years. So the problem is, the problem is that the problem continues to get worse. There's no political will to solve it, but in fact, they continue to make it worse. And we all wondered, when will deficits and debt really start to affect the markets? Because for a long time, there was that belief that the deficits and debt could continue to grow. They didn't matter. They didn't matter in certain quarters. And I think this is evidence now of how this is coming home to roost. And it's probably been accelerated because of this vicious cycle we're in. Some call it a doom loop, but this vicious, I call it a vicious cycle. They have debt that is growing, so they have more debt to finance. Now, interest on the debt or debt service is higher than defense spending, the third highest expenditure in the federal budget. And as they borrow more, or as the debt service increases in cost because of rates or just increases more debt to service, they have to borrow more money, which we just end up in this cycle, this vicious cycle that it's extremely concerning.
Right. So how does that impact your investment outlook here, David? Stocks, bonds, commodities, all that?
Yeah, so for a while, I would say, for many years, it hasn't been a significant impact, but we knew this was coming. So take a day like today, right? Stocks and bonds are both down. What's up? Commodities, gold, silver, miners, the soft commodities. One of the funds that we like, and we've talked about it before on the show, is HGER ETF, the Harbor All Commodity ETF. It's a third in gold, a third in oil, and a third in soft commodities. So if we looked at what oil has done here over the past couple of months, we look at what gold has been doing over the past month and a half, and we have soft commodities like wheat, rice that are setting multi-year highs. That fund has done extremely well for us. And that's what we did. We talked about this, Scarlett, last year about this time, about how much we like the silver and gold trade, that we broadened that to broader commodities. We've come back into gold a little bit here recently, but the broad commodity trade is where it's at in this kind of environment, this inflationary and spiraling debt issue. Hold hard assets.
Hold hard assets, yeah. Perhaps real estate as well if you've got it. And we certainly see a lot of green arrows in the commodities complex. David, thank you so much. David Kudla is founder, CEO, and chief investment strategist at Mainstay Capital Markets. All right, CFTC Chairman Michael Selig says the crypto industry, and we see crypto higher as well today as well, is going to get market structure rules even if Congress fails to pass the Clarity Act. And so far, there's no movement on that Clarity Act. Selig also says the CFTC is working on rules in prediction markets that will soon be finalized. Selig spoke exclusively with our Tyler Kendall about policing those prediction markets. Here's part of that conversation.
We're utilizing all of our authorities to police these markets. They are derivatives markets within our exclusive jurisdiction. We take that responsibility very seriously. There's two things that we're looking for. One is insider trading, as you mentioned. The other is just fraud and manipulation. We saw a number of cases, some of them have become public, others we're still investigating, where there's just fraud, right? Somebody makes a statement and then takes a position on the other side. That, of course, is not legal within our framework, but there's also insider trading where people are misappropriating non-public material information that they obtain, whether it's from their employer, from their client, whatever, right? They take that information and they trade on it. That's insider trading. It's no different if it's a security, a commodities contract, or an event contract. And so we take that responsibility very seriously.
But any firm guidance from your agency ahead of Election Day?
We've put out a number of advisories and reports and that sort of thing. We've settled a handful of actions. We'll continue to do so. In terms of our enforcement advisories, we believe that the rules are very clear, our statute's very clear. there isn't really any needed guidance necessarily on insider trading or manipulation. We may put out further advisories, but we're focused on building the policy side, the rulemaking, and then policing these through actual investigations and bringing actions against bad actors.
Just as you did bring up investigations, very quickly, can I ask you, related to news of the day, the markets are watching any sort of update when it comes to the conflict in Iran. Can you give us any update on your investigation into those suspicious daytime trades linked to the war?
I can't talk to any investigations. I appreciate the effort there, but no, can't speak to that.
All right, let's think broadly about legal strategy and the CFTC. We saw this federal judge the other week rule against you in Wisconsin when it comes to sport events contracts, letting state regulators move forward in terms of classifying them as gambling. Can you just talk to me a little bit more about your strategy and how the agency plans to sustain this exclusive jurisdictional argument if you keep getting these mixed rulings from the lower courts?
We haven't lost in a single federal appellate court. We don't intend to. If we do, that's going to create a split, and we'll see it at the Supreme Court. That's our focus. We want this to be clear, codified law in the books, and we'll take it all the way up to the Supreme Court.
So if it goes to the Supreme Court, though, and the judge rules that sport contracts are gambling, how will that impact the CFTC and these companies that you regulate?
To the extent the Supreme Court were to rule against us, of course, we'll follow the law.
All right. I wanted to ask you about the agency's June 2026 proposed rule, which does put some of these guardrails in place. Do you think that you'll be able to finalize this before the end of the year? And with everything that is going on in this market right now, what is most important to you in terms of anti-manipulation and also consumer protections in terms of really getting it on the books?
We're making fantastic progress in finalizing these rules. We received a lot of really substantive and helpful comments, both through the advance notice of proposed rulemaking and the newer Rule 40.11 rulemaking proposal, and we're hoping to finalize that very soon. We're also moving forward with, we've proposed some rules on record keeping and reporting. We're hoping to finalize that, and we'll have some new rules proposed very soon.
And that was CFTC Chairman Michael Selig. He was speaking with our Tyler Kendall. You can hear the full conversation on Bloomberg Radio and television at 1:40 p.m. Wall Street time on Balance of Power. Prediction markets, it's something that I think older investors don't really look at as something more than betting, but there's a certain cohort of Gen Zs who look at it as a form of investing, and perhaps rather than buying stocks, for instance, they are now putting their money in prediction markets.
Yeah, which is odd. You know, it's all over the ads for those prediction markets are all over my social feed. Just come everywhere.
Is it usually sports related, or is it like economy and markets related too?
It's probably sports related more. Maybe that's the reason why. But I mean, but it's out there, and I think the young folks are using them big time. So the question is, how do you regulate it? I think is a big issue.
Well, the CFTC says it's all good.
Yep. Okay.
The states disagree.
Right.
And that's something that's being litigated in court right now.
Yeah, and if you're the betting site, you're like, wait a minute, this isn't fair. I'm not allowed to go in certain states yet.
Well, then they're like, let me get in on it too. While we're waiting for some clarity, right? This is Bloomberg Intelligence on Bloomberg Radio with Paul Sweeney and Scarlett Fu. We'll be right back with more.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. I'm Matt Piper for this Bloomberg Business Flash. We are seeing stocks not doing so hot today. They're falling as rising oil prices put inflation risks back on investors' radar. We do check the markets for you all day long here at Bloomberg. The Dow right now is down about 430 points. The S&P is down 34. The NASDAQ is down about 260. The Bloomberg Dollar Spot Index is at 1192. Bitcoin right now still doing hot. It's at 72,000 right now. The U.S. will begin what President Trump calls unprecedented economic warfare against Iran after failing to reach a deal. No details, but it does have oil moving higher. Brent right now at $93 a barrel. WTI is at $88. The dollar is barely changed. U.S. bonds have lost all the gains that followed Treasury Secretary Scott Bessett's plan to increase buybacks of longer-dated debt. The moves highlight skepticism over the impact of the new measures, which will see the Treasury Department boost the size of liquidity support buyback operations by at least double for securities dated from the 10-year to 30-year sector. Ira Jersey is chief U.S. rate strategist at Bloomberg Intelligence.
So you're not necessarily seeing a lot of selling, but you're just seeing, I think, a bit of a buyer strike. And the thing is, when you have a buyer strike like this, it's going to be hard for the market to rally very significantly unless something changes either fundamentally in the U.S. or you wind up having a reason, like some kind of structural reason, for people to be buying U.S. debt.
Ira Jersey with Bloomberg Intelligence. And Paul and Scarlett, put the booze down. Americans are still going easy on the booze, sort of. Just 54% say they drink. That's a little down, apparently. That's a near historic low.
Really?
But for those who do, the uptick has actually gone higher. For those who drink, they now on average drink 3.2 drinks, up from 2.8 drinks. That's all according to a Gallup poll, who apparently just found drinkers and asked them some questions.
I want to see what that looks like when you ask them if they're smoking pot. And how that looks.
Gummies.
Or the gummies, right. Any kind of cannabis.
Yep.
Right? Because that's what's taken off.
Yep.
For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Matt Piper. That's a Bloomberg Business Flash.
Is that just correlation or causation?
Good question. I don't know. I think it's substitution is what it is.
There you go.
All right, Matt, thanks so much. Appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, we all know about the K-shaped economy, the upper part of the K. Those are the folks that own real assets, stocks, bonds, real estate. They're doing more than fine. It's the bottom half of the K who maybe don't own real assets, and inflation's hitting them harder and harder in their paycheck to paycheck kind of thing. Some folks are saying the closing of the K is upon us here. I don't know about that. Barry Ritholtz, he's the host of Masters in Business on Bloomberg Radio. He's also got a day gig, founder of Ritholtz Wealth Management. Barry, are you buying some recent claims of the closing of the K?
I would love to see data that says the K is closing. Unfortunately, wherever we look, we're seeing the opposite. We just had Walmart earnings, and that is the lower arm of the K. Not great numbers. We've seen retail sales, not spectacular. It really shouldn't be much of a surprise. You have inflation hitting food and energy, which disproportionately affects the bottom, pick a number, 50, 60, 70%. And on the flip side of that, you have this giant AI CapEx spend that's helping the owners of equities, especially technology and related companies. So the data isn't saying that it's a C or an E. By the way, I hate these attempts to reduce a $32 trillion super complex economy into one letter. It's just silly. All that said, I would be thrilled to see that income and wage and wealth inequality is starting to narrow, but the data does not support that.
I mean, the promise of the U.S. and living in the U.S., working in the U.S., is that you can become a part of the upper leg of the K. You have that opportunity to do so. You've looked into the sources of wealth of that upper arm of the K. Talk to us about what you've learned. I mean, Paul mentioned real assets, stocks, bonds, real estate, for instance, among other things. But what does it come down to in terms of what the sources of wealth of those who are wealthy, and not just wealthy, but, you know, very wealthy and independently wealthy, and can kind of continue to build on that wealth, can compound that wealth, even in tough times?
Sure. So, everybody, this K chatter sent me to Google to do some deep research. So between Google and Claude and the Federal Reserve and Fred, there's just, and the CBO and Census, there's just a ton of data out there, but you have to look for it. And first and foremost, and remember, if we're talking about the top half of the K, we're talking about everything from comfortable to fabulously wealthy. The single biggest number that shows up in the data is starting and owning a business. And I'm not talking about, Mark Zuckerberg starting Facebook or Serge and Larry starting Google. I'm talking about very mundane, run-of-the-mill businesses that we all run into every day.
Boring businesses.
Yeah, trash collection, car dealerships, beverage distributors, HVAC companies, medical practices, law firms, just construction firms. Just you start a business, you own it, you have the equity. Sometimes the liquidity event is you merge with a larger company. Sometimes it's private equity. Sometimes you just get earned out by your partners. Law firms and accounting firms are really good at setting up the next generation of partners, basically funds the buyout of the previous generation. That was number one. And especially when you look at 25 million and up, the top, let's call it 0.1%. The second level, the second group of wealth creation was equity, but not in your own company, in somebody else's company. So if you're an employee at a startup, if you're an executive in a C-suite, if your company IPOs, if you even are at a mature company, but you get restricted stock units or options or any sort of shares over a full career, that accumulates lots and lots of wealth. And then the next levels, all right, inheritance was number 3, kind of surprised me. It was even that high in this country. There's a lot of talk about $105 trillion wealth transfer. I'm not sure that number is going to come to pass between boomers spending the money down, donating it to philanthropy, and other sort of expenses. I think the great wealth transfer has been overstated. And then number 4 and 5, and I looked at 10, but 4 and 5 shouldn't be a surprise to anybody. Real estate is a huge creator of wealth. And then the world of finance, whether you're anybody in this field, tends to do pretty well.
In this wintertime when there's nobody down at the Jersey Shore, we'll drive up and down the shore, and I'll see thousands, tens of thousands of homes, usually somewhere on the bay somewhere, couple $1 million homes, $1 million boat in the back. I'm like, who are these people? And they are people that they own the air conditioning heating company that got 10 trucks, 50 people working for them. That's where so much wealth has been created, Barry. So I'm glad that came in at number 1 on your list because, man, I see it, and it's amazing.
Can I tell you, I can't begin to give you an endless run of examples. Every time I'm at some event, and outside of our world, but a car event, Cars and Coffee, where someone will recognize me, and I'll say, hey, nice ride. What do you do for a living? 9 times out of 10, I own this small couple of chains of restaurants. I have 10 McDonald's. I have 2 car dealerships, or in some cases, 12 car. It's just when you drive down the street and you see all these thriving businesses, hey, somebody owns them. And for the most part, they're not publicly traded. And so it's genuinely like we overlook the commonplace for the more exciting, but truly owning your own business in America is a pretty solid path to the top half of the K.
All right, Barry Ritholtz, fascinating. And I love how you divulge your sources too, going to the different AI engines as well as the official data too. Barry Ritholtz is founder of Ritholtz Wealth Management. He is also the host of Masters in Business on Bloomberg Radio. And Paul, the lesson here, according to Barry, the bottom line is that nobody gets wealthy on salary and a 401k.
Yep.
That's for chumps. I don't want to say it that way, but you're not going to be able to get to that level.
Yeah, it is. It's just amazing. Although there is a group, if you started at Apple and Microsoft back in the day, just held onto your stock.
Early employees. Yeah. That does it for Bloomberg Intelligence right now. We have the S&P 500 lower by 4.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Into that whole streaming thing. A lot of stuff going on in the tech space. I want to focus a little bit on Meta here. A couple things struck me here. And we're going to check in with Mandeep Singh, Global Tech Research Head for Bloomberg Intelligence. Meta Platforms is spending hundreds of millions of dollars a year to access artificial intelligence models through Microsoft's Azure cloud service. That surprised me. Should it surprise me?
It can, because Meta is one of the biggest spenders on CapEx to build these data centers. So the natural question anyone would ask is, why do they have to use someone else's cloud
That
if
was
you've
where
got,
I was coming from.
you know, so much capacity? And I think in this case, they are trying to develop a model that's kind of neck and neck with the frontier labs like Anthropic and OpenAI, but they are still trailing. So the purpose of using Microsoft Cloud could be just to benchmark against OpenAI. So OpenAI's models are available on Azure. And if Meta really wants to benchmark the performance, then they can't do it on their own infrastructure. They have to use a cloud infrastructure. And in this case, I would say they have selected the one where they are least competitive with. You know, I can't imagine Meta using Google Cloud or Amazon. So it's more like Microsoft is friendly to everyone, and it doesn't surprise me that Meta is one of their customers.
Meta stock is off 17%-ish year to date. Is that because the street's questioning their AI spend? Is it concerned about this court trial they're in? What's kind of behind this here? Because I'm actually concerned about this trial, although Matt Cheltenham yesterday from Bloomberg Intelligence says, I don't have to worry too much.
Yeah.
But what do you think is impacting the stock from it?
I think it's more to do with the lack of monetization on this AI spend. So with Microsoft, with Amazon, with Google, they have a cloud business to show the monetization tied to this infrastructure build out. With Meta, yes, their top line is great, but they don't have that cloud line. So, and Mark Zuckerberg did talk about renting compute the first time, but that's a lower margin business for a company like Meta, which has incremental margins of over 50%. So from that perspective, they would rather be in that model business where they are having other companies use their model that they're training. And that's where, because the model has been behind the frontier labs, no one is using their models right now. So they want to get up to speed and you really kind of get at that frontier where the hope is they will eventually figure out, like open weight models have caught up to the frontier models, and all these open weight models like Kimi and DeepSeek, they're challenging now the frontier labs. Why can't Meta catch up? And that's the part that has been the biggest drag on the stock, in my opinion.
Does a company offer a timeline when they think they will have a competitive model?
I think they will have a harder time raising 2027 CapEx if they're not able to figure that out, which is why the fallback option is to rent compute like SpaceX did to Google and Anthropic. Okay, look, we can't make revenue on anything else. We can make revenue on renting our data center to Google or Anthropic. So same thing Meta could do as well. They could start renting their data center capacity to a Microsoft or someone who can make better use of it at the model layer. And so that's the fallback, but Mark said that's his least favorable option. So he would rather not go in that direction yet.
I mean, CapEx in 2024, 37 bill, 89 billion. I guess in 2026, 139 billion.
Yeah.
Going to 200 billion next year.
Yes.
Is that all so that they can have an AI model?
And they use a lot of AI internally. But look, if a Google is running its Google search and all YouTube and still able to generate $100 billion in Google Cloud revenue, then you have to ask yourself, why can't Meta do the same? I mean, Meta has family of apps.
Is that the strategy for Meta, to have a cloud business?
They have to have some form of cloud, whether it's renting compute or renting APIs, use of their models via APIs. They need to have some external monetization. You can't just say, I'm using entire $200 billion worth of infrastructure for my internal consumption. That is not going to fly. You need to have an external customer-facing element, and that's what they need to show.
Are they given a timeline when they will have that?
I mean, they keep saying their models are getting better, but like the proof will be when they start monetizing it through APIs the way Google is doing it.
That sounds like what some companies will call, we're in a transition period on this whole spending, and that's what this market typically doesn't like, transition periods.
And especially if there's a risk like Metaverse where you just blow through 50 billion plus of CapEx and then say, we didn't get anything out of it. That's what I think the stock is reflecting right now, the fear around that.
In hindsight, how do they talk about the metaverse these days?
That we still believe in it, but we have pivoted towards AI. So.
Wow. So now it's another bet on Zuckerberg to come through.
The difference is all the other hyperscalers believe in this too. With Metaverse, they were the only ones. No one else kind of was investing the same way as Meta was. In this case, everyone is bigger than Meta in terms of their spend.
Okay. All right. It's a big, big bet tech investors are making. But everybody, or most people, say it's going to be worth it. Mandeep Singh, thanks so much. Appreciate that. Mandeep Singh, he's Global Tech Research Head for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker studio. Not mailing in from Nantucket as some are wont to do. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Top stories and global business headlines are coming up right now. This is Bloomberg. Good morning.
ABC News, I'm Wayne Cabot. The FBI is making moves on a former congressman, seizing Eric Swalwell's cell phone and devices as part of what sources tell ABC News is an ongoing criminal investigation. Agents also serving a search warrant at his Washington, D.C. home. The USS George Washington has now arrived in the Arabian Sea to replace the carrier with a record-long deployment at sea, the USS Lincoln, with reports of substandard conditions for those on board. President Trump's threat yesterday of an economic D-Day for Iran has oil prices today up 2%. Here's ABC's Rachel Scott.
President Trump once again trying to ramp up the pressure, overnight announcing the U.S. will enact the most crushing economic operation ever taken, saying it will be an economic D-Day. President Trump warning any country that allows its financial institutions, businesses, airports, or government entities that help Iran evade sanctions will face tremendous economic consequences.
Iran's foreign minister responded to Trump's D-Day comment by pointing out America's debt is now $40 trillion. Today is Thursday. It could be Tuesday or longer, power companies say, before a very long outage ends. ABC's Alex Perez in Gary, Indiana.
It's been more than a week since storms pounded Gary and northwest Indiana, and there are still downed trees and power lines across the area. Residents are desperate to get the power back on, and many feel the utility company is just not working quickly enough.
Pennsylvania State Police say one of its choppers was doing a training exercise at Carlisle Regional Airport when it collided with a small plane whose pilot died.
The impact tore the plane apart and sheared off the helicopter tail and rotor blades before it rolled onto its side. Inside the wreckage, 2 troopers were trapped. Authorities say one trooper kicked out a window, then pulled his bleeding partner to safety.
ABC's Aaron Katersky. Dow down 450 points right now. The NASDAQ down 230 and the S&P down 31. You're listening to ABC News. Sources tell ABC News the DEA is now joining the death investigation into the Heroes actress Hayden Panettiere. ABC's Trevor Alt with the details from Los Angeles.
TMZ says law enforcement sources are conducting the investigation to see if some illegality is behind the 36-year-old's death. Police report claims her on and off again boyfriend Brian Hickerson and his brother Zach were there and called 911. Yesterday, he was seen for the first time since her passing, spotted leaving a Burger King hours after Greenville police officers responded to a call for a welfare check at his family's home.
Police say their preliminary investigation has found no signs of foul play at the scene of Hayden's death. NASA is giving up on rescuing the Swift Space Observatory, which has shown us so many beautiful images.
The space agency had been working with the startup company Catalyst to design, build, and launch a 3-armed robot called Link to grab hold of the Swift telescope and gently haul it to a higher altitude, buying it several more years of life. But trouble started soon after Link made it to orbit. Malfunctioning thrusters meant that controlling its movement was nearly impossible. Now Swift, which has captured brilliant images of star explosions, will itself die in a fireball when it enters Earth's atmosphere as early as October. Jim Ryan, ABC News.
The FDA upgrading its frozen berries recall. Green Wise organic whole berries and whole mixed berries could be contaminated with E. coli. Wayne Cabot, ABC News.
In a recent survey.
Live from Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Hey, bond traders, I'd like to have a word with you.
Welcome to Balance of Power. I'm Kaylee Lyons in Washington, where once again, the Treasury Secretary, Scott Bessent, is trying to talk down long end rates. After announcing yesterday that the Treasury would be buying back even more long-dated debt, he said it could be even greater than what was announced yesterday. Markets aren't necessarily responding how he might like them to, though, and we'll have a check on those in just a moment. Plus, we'll touch base with Enda Curran and Ira Jersey of Bloomberg Intelligence. We have to talk to Tyler Kendall at the White House, as well as President Trump is promising a coming economic D-Day against Iran. But first, let's check in on Treasury rates, stocks, everything else moving in financial markets as we turn to Matt Piper in New York. Hey, Matt.
Hey, Kelly, thank you. Live from the Bloomberg Interactive Studios, I'm Matt Piper. A rally in bonds is fizzling, as Kelly's hinting at, and stocks are falling as bets the Treasury plan to curb borrowing costs is just a short-term fix. We check the markets for you all day long here at Bloomberg. Right now, the Dow is down 462 points. The S&P is down by 32. The NASDAQ right now down 234. The Bloomberg Dollar Spot Index is at 1192. Bitcoin is trading above $70,000 for the first time since June. Bitcoin right now at 72,440. Crude is moving higher. Brent is at $93.50 a barrel. WTI is just shy of $88 a barrel. Walmart's quarterly sales fell short of expectations, a rare miss that's likely to stoke concern about the leading big box retailer decelerating alongside a slow-growing U.S. economy. Sales rose 2.6% in the second quarter, shy of estimates. That rate of growth, the slowest in more than 6 years. Greg Mellick is Evercore ISI Senior Managing Director.
Cumulative inflation over the last 3 or 4 years does weigh on consumers. And so one of the ways to keep them in the game is to do extra rollbacks. Walmart's up to 11,000 rollbacks. Target yesterday talked about reducing prices on 10,000 items.
You can hear more of that conversation on the Bloomberg Open Interest podcast. You can download it wherever you get your podcast. Walmart shares, by the way, right now are down about 11%. Applications for U.S. unemployment benefits edged lower last week, staying near historically low levels and suggesting few layoffs across the labor market. Initial claims decreased by 6,000 to 206,000 last week. The median forecast in a Bloomberg survey of economists called for 210,000. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash. Now back to Balance of Power with Kaylee Lyons.
All right, Matt, thank you so much. Incredible to see the 30-year yield back at around 525 or so today, erasing a big chunk of the gains we saw yesterday off the back of the announcement from the Treasury just 2 weeks after its initially announced quarterly refunding, saying that the buyback for the long end was going to be at least double the size of what was planned. The market clearly has some skepticism about that. But Scott Bessent isn't ready to give up the fight, it seems. He said in an interview on another network today that the buybacks could be even more than $4 billion per issue, and shared this with reporters gathered at the White House earlier.
Anything that happens within a 24-hour period is noise. And, I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market, I think, I'm confident that bonds will continue declining.
So let's get more on this now as we turn to Bloomberg's Enda Curran, who helps us cover the economy from here in Washington, D.C. So, Enda, he talked about this portion of the curve being thinly traded, clearly trying to paint this as being about liquidity management, essentially. But is this not a signal from the Treasury, from Bessent in particular, that the bond market's freaking him out a little bit?
It does seem like he's under some pressure on this point, Kelly. To your point, he seems to be stressing the idea that it's thin liquidity at this time of year, and all the Treasury is doing is intervening to smooth that out, to make sure the market's reflecting underlying fundamentals. And that may be fair. It is a thin time of year. People are on holidays. But the bigger picture is a lot of people say this intervention by Treasury is a sticking plaster on the bigger topic, which is surging government debt. Mm-hmm. We had that figure yesterday coming out from Treasury that total public debt is over 40 trillion now. The level in itself doesn't necessarily matter per se, but it's the trajectory where public spending is going. No real appetite to either rein in spending or raise revenue through taxation by either side of the political divide. And the end result is we have this kind of juggling act now in the Treasury market. And that's what Treasury Secretary Besson is trying to do.
Well, and even more striking than the $40 trillion figure is the fact that we got to $40 trillion by doubling the national debt in just a period of 10 years, which kind of gets to the question of the fiscal consolidation that the Treasury Secretary was hinting at. What could that realistically entail, if not hiking taxes or cutting spending in a massive way?
Well, this has been a talking point from this administration for some time. Now, all administrations are guilty of not necessarily grabbing the nettle and taking on fiscal consolidation. Nonetheless, we haven't yet seen what clear evidence the Treasury Secretary means by this. There was, of course, a stream of income coming from tariffs last year before the Supreme Court ruling. That was then reversed. Those tariffs are now being slowly put back in place. That will be a new source of income, of course, for the administration going forward. But in terms of game-changing metrics whereby either spending or revenues being changed up that would really radically alter the fiscal outlook, there's no sign of that on the horizon. And by the way, there's no public appetite for it either. I mean, we're heading into this midterm election season. There doesn't seem to be much commentary from the public about, hey, we all need to tighten our belts. We want lawmakers in DC willing to take the hard decisions. I mean, that's just not on the agenda.
Yeah, that's why no one ever actually talks about reforms to entitlements like Social Security, because it's politically toxic. When we consider then, knowing that perhaps that pursuit is politically toxic and it's going to be difficult, the Treasury Secretary also talked today about other tools in the Treasury's toolkit to try to bring down the long end. Aside from buybacks like they're announcing, what else could we realistically see out of the department?
Well, they need to be big tools, by the way, Kelly, because even today we've seen that yields have rebounded.
Right.
Yesterday, the Treasury announced this intervention. We're going to buy these longer-dated bonds to bring down yields, and that will bring down everyone's borrowing costs. That worked yesterday, but today those yields are back up. That means the market's doubting the size of the toolkit. So we'll have to see. I mean, there is all kinds of plumbing that the Treasury Secretary can do in financial markets. They can pull different levers. But again, it goes back to the point I was saying earlier. Short-term fix, sticking plaster. The bigger story here is the scale of government borrowing at a time when companies are also borrowing, and that isn't going to change anytime soon.
All right, Enda Curran, appreciate it as always. And as we consider, as Enda pointed out, the fact that yields are retracing a lot of what we saw yesterday off the back of the initial announcement, we turn now to Ira Jersey, Bloomberg Intelligence U.S. rates strategist, who is back with us 2 days in a row on Balance of Power. Ira, appreciate you and your expertise coming back on the program. You, of course, are skeptical of the long-term impact of this when we spoke yesterday. The market has joined you in that today, so perhaps you're not surprised to see yields climbing back up. But when we consider the notion that the Treasury Department may want to be more interventionist in the bond market moving forward, if that's the signal here from Scott Besson, does that change things if he is willing to take this even further than what he announced yesterday?
Well, when it comes to the supply side, there's the only real levers that they have is what's the average maturity of the debt outstanding, right? So they can say, because the absolute amount is really done by Congress, right? Congress decides how much they're going to spend, so they decide at the end of the day what the deficit's going to be. So, but the Treasury Department could do an Operation Twist. So he mentioned on another network just a couple of minutes ago that they might do more than the $4 billion per maturity bucket, like you mentioned earlier in the show. If they were to make this $8 billion per bucket or $10 billion per bucket, right, some other big number, then that's going to look a lot like an Operation Twist. And when I say Operation Twist, we think about what the Fed did 15 years ago when it sold short-term debt to buy long-term debt. Well, this would be the same thing except the Treasury Department doing it. There is precedent for this, but you have to go back to before I was born. So you have to go back to the 1960s in order to find the Operation Twist that Treasury did back then. And that would change the maturity profile. The risk of that is that now you have more short-term debt outstanding. What happens if the Fed has to raise rates to fight inflation? Well, your interest on the debt goes up even faster than if you do that type of Operation Twist.
Yeah, so this could actually have the reverse effect than intended in the long term, right, Ira?
Yeah, exactly. And that's one of the big dangers. The other thing that they could do, which would have the same basic effect, would be that they could cut in November the amount of long-term debt that they're issuing. So they can lower the amount of 30-year and 20-year debt that they're issuing every quarter. That would have basically the same effect as buying back more debt. I actually like the buying back more debt a little bit because that does help liquidity, because what happens is these off-the-run bonds that were issued a year ago, so 29-year bonds now, they become pretty illiquid and they get stuck on dealer balance sheets, so dealers can't trade enough. So the advantage of buying those bonds instead of saying reducing the 30-year is that it does help bond market liquidity overall by this market structure function.
Well, that's one of the things the Treasury Secretary was talking about today. He said it's thinly traded, especially at this time of year, trying to manage that liquidity situation. But he also suggested...
Which is really funny, by the way, because they're not actually starting these bigger operations until September.
Until September.
So,
yeah.
So
good point.
Saying that it's thinly traded now, it's like, I don't get that comment. That was kind of strange.
Yeah, point very well made, Ira. But he also was talking about the notion that he's trying to get the market to focus back on the fundamentals. And I wonder if you think currently treasuries are mispricing the fundamentals when you consider the inflation outlook and when you consider our debt level that just topped $40 trillion.
So I don't think so. I actually think, 10-year yields probably are maybe 15 or 20 basis points too high, maybe the same in the 30-year. When you look at the level of nominal GDP, and like in the longer term, you expect nominal GDP and long-term interest rates to more or less have a similar level. And nominal GDP growth year on year has been 6.5%. So we're still not at 6.5%, which, when we go back and we look at history, we go back to the 1980s and 1990s, when we had 6.5% nominal GDP growth, we had 30-year yields are around 6%. So from a historical perspective, I don't think you can say that we're particularly, we're particularly cheap in terms of where the bonds are trading. Now that being said, we do have a somewhat different environment. We have different demand profiles and the like. So should we be at 5%, not 5.25%? Maybe, but we're like you said, we are in thin summer trading, and there's also a lot of other factors going in, like other debt being issued.
Yeah, that's exactly what I wanted to ask you about, Ira, is this notion that obviously there is a lot of demand for capital right now. You're seeing a lot of corporate issuers coming to raise money in the markets, in large part to fund the build out of AI infrastructure. So is that AI that is powering the equity market actually exacerbating the issues in the bond market?
Yeah, I think it is. There's not any one thing that's causing 30-year yields to be this high, right?
Sure.
So it is issuance, yes, AI-related hyperscaler issuance for sure, but also issuance in Japan and in the UK. So the fiscal situation globally for government bonds is also deteriorating. So you have all of these things going on at once, which just it means that if you're an investor, you're actually having a field day, because you're saying, okay, I get to set the price now, and I get to pick which of these instruments that I want to buy for to match my long-term liabilities. And at the end of the day, you have to pick something, and if there's a lot of it out there, the price has to go down and the yield has to go up.
All right, Ira Jersey, U.S. rate strategist for Bloomberg Intelligence, joining us on Balance of Power. Thank you so much. And we'll have more coming up on the economic D-Day that the president is promising Iran. That's next on Bloomberg.
It is 12:21 on Wall Street. I'm Matt Piper. A jump in oil prices is worsening worries about inflation, sending bond yields higher. That's erasing some of the relief created the day before after the Treasury Department moved to ease pressure from the bond market. We do check markets for you all day long here at Bloomberg. Everything is down. The Dow at this hour is down 463 points. The S&P is down 33. The NASDAQ is down 232. The Bloomberg Dollar Spot Index is up about a point at 1193. The 2-year yield is up nearly 3 basis points. The 10-year yield is up 5 basis points. Crude oil is moving higher. Brent is at $93 a barrel. WTI is just at about $88. As for stocks we're watching, shares in crypto-related companies, they've jumped after President Trump had a friendly meeting with digital currency leaders at the White House. Trump is calling on Congress to pass a major cryptocurrency bill that would tilt regulation in the industry's favor. Those companies, Strategy right now up 7%, Coinbase up about 11%, American Bitcoin up about 0.5% at this hour. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash. Back to Kaylee Langs.
All right, Matt Piper, thank you very much on this, joining us on this edition of Balance of Power as we talk about what's happening economically, domestically here at home, and the pressures that exist in the bond market. But they're trying to build economic pressure abroad as well, specifically trying to build it on Iran. As President Trump took to Truth Social to announce what he's describing as economic D-Day, he says, and I quote, "No one has given the Islamic Republic of Iran a greater opportunity to make a deal than me. Tragically for them, they have failed to take it. Therefore, today, I am announcing the most crushing economic operation ever taken against any country." This is, of course, the pursuit, he says, of a non-nuclear Iran and a reopening, in theory, of the Strait of Hormuz, as he talked about yesterday at the White House.
You can't let Iran have a nuclear weapon. We have possession, complete control of the Strait. We've had a lot of oil coming in, a lot of oil. It's not going to be perfect, but it's a lot of oil coming in.
So for more on this, we turn to Tyler Kendall, Bloomberg Washington correspondent, as well as Adam Farrer, Bloomberg Economics senior geoeconomics analyst, who are both with me in our Washington, D.C. studios. Tyler, if we could begin with you on what exactly this crushing economic operation is really going to entail. Do we have any fine details?
Well, we may get those details on Monday. We heard from the Treasury Secretary Scott Bessent moments ago, really telling reporters at the White House that there will indeed be a press conference where they are going to outline some more of this, because there have been questions about what sort of economic pressure the administration can apply, considering that Iran has at this point already weathered waves of sanctions. We do know that there are still tools that the U.S. could ultimately implement, and a lot of people are drawing on some of the president's words in that Truth Social, including, quote, "you know who you are," in terms of regarding to wanting to see action to take against smuggling oil out. That's raising questions about whether we could see a targeting in China and Chinese imports of Iranian crude. But that, of course, has some other risks to it, since we know that Xi Jinping is coming to Washington in about a month's time. I will quickly add a couple other things on the table we're watching, maybe some more targeting of the so-called shadow fleet. We could also potentially see the U.S. move to seize frozen assets in their jurisdiction, but that may be a little easier said than done.
Well, Tyler raises China, and Adam, you're an expert on the region. Is China likely to participate in this? Is the president's calling on essentially the help of other countries? Why would China oblige him?
So I think the answer so far we've seen throughout this war is no, right? I mean, China will certainly continue, as they say, to play some sort of moderating and mediating role where possible. But they have a strong relationship with Tehran, and one that they continue to value and that they've been balancing with their relationship with the Gulf. And I think the real question here is whether the United States and President Trump is willing to risk his relationship, as Tyler brought up, with President Xi to expand sanctions, secondary sanctions, onto the entities within China that are supporting the Iranian economy, both through oil and other goods.
Well, and of course, as we consider the Iranian economy and the U.S. focusing on the economic levers it can pull, how much of this, Tyler, is because of the reality that kinetically the U.S. may have limited options as it considers its own strategic positioning and a depletion of munitions that has occurred over the course of the last 6 months.
Well, if you ask the administration, they have repeatedly said that they would prefer to opt for the diplomatic route instead of restarting full-scale military operations. We're not even at a diplomatic point in time right now. I was at the White House yesterday when President Trump was asked directly, are you interested in restarting these talks? And it didn't really seem like he was going to do that. Instead, he says they are opting for this economic pressure campaign. The administration did get some help yesterday, actually ahead of the president posting this. We saw the UAE move to totally cut ties, financial ties with Iran. It's considered to be a rather significant move since the UAE was Iran's top trading partner last year. But I bring that up because it also goes to remind us that there are a lot of regional partners in this conflict that are either the source of retaliation or the source of mediation. And we are constantly looking to those partners for updates on exactly where those efforts stand.
Well, you mentioned being at the White House yesterday. A lot of things were discussed at the White House yesterday. The president also was questioned as he was talking with reporters about North Korea, keeping in mind that it was earlier this week that he ordered the Pentagon to pull back on joint military exercises with South Korea, feeling that it was disrespectful to North Korea and Kim Jong-un, who he feels he has a good relationship with. This is what the president said yesterday.
But I get along with him. And you know what? The fact that I get along with him, that's a good thing, not a bad thing. He has 57 very powerful nuclear weapons. Should have never allowed it to happen. They should have never allowed it. If I were president, I wouldn't have allowed it. But he's got them.
So, Adam, as we consider this, he's got them, the president says, and so it's better, therefore, I guess maybe it's a keep your enemies close situation. As he talks about, it's a good thing to have a good relationship with him, not a bad thing. But could it also be a bad thing if it makes North Korea feel that they are in somewhat of a position of security?
I think it's been incredibly interesting to see this pivot to Korea since Sunday, right? Yeah. I mean, I think it caught many of us by surprise to have this last-minute decision to curtail this exercise, and even within that message to have a complete split on his messaging. On the front end, you have his strong relationship that he has made clear he values with Kim Jong-un, but at the end, a real attack on South Korea and claims that South Korea has just not lived up to his expectations. And even the day after, when he was asked about, and he made these consequential comments that maybe he is in talks with Kim Jong-un. He also then spent the majority of time criticizing Lee Jae-myung and the South Korean president for not coming to the U.S. aid in Iran and not providing the compensation he feels is necessary to support U.S. troops in the peninsula. And so here I think he's certainly approaching this of two minds, I think a lot of this actually has to do with how he views an increasingly negative relationship with South Korea, a little less on this potential of some sort of new grand bargain with the North.
Can we get a little bit more of the regional view, if I can jump in here with a question? Because we saw North Korea deny that talks are going to happen. We actually saw them testing these ballistic missiles in response. Seemed like a pretty negative response to President Trump. But then, on the other hand, when President Trump announced this, we didn't necessarily get such a negative response from South Korea that actually said that they would welcome dialogue with their northern neighbor. We also got a rather positive response from China that echoed that same rhetoric. Can you give us some insight here just about these regional ties and how it kind of all fits together?
The dynamics are certainly complicated, and you hit on all sorts of different parts of that right there. I think on the South Korea side, you're absolutely right. The Liberal Democratic Party that Lee Jae-myung is part of actually has a large effort underway to try and restart ties with North Korea, and he has sought in his own ways, the president, to curtail these exercises since he came to office. And so the actual act of curtailing them doesn't bother him immensely. He likes the opportunity to hopefully bring North Korea back to some level of negotiation, although we saw North Korea completely throw that out in their response. But the problem in what Trump did in terms of alliance relations was not the actual act of curtailing the exercise, but it's how he did it, right? Without any consultation, minutes before it started. On the North Korean side, you're right, we saw a very clear response from Kim Jong-un's sister, Kim Yo-jong, and she not only came out attacking South Korea, But she explicitly said there were no communications going on between Trump and Kim Jong-un, and that's quite stark for a country that often lives in the gray and doesn't give clear answers to questions. And I think that says that Trump maybe went a little further than they had expected him to, and that they are not at this point looking for some sort of large negotiation right now.
Well, Adam, I want to return to the point you were making about this maybe being more about a problem with South Korea than about a good relationship with North Korea. This comes back to the Strait of Hormuz and South Korea not stepping in to help, right? Tyler, the president is still very caught up on the allies who did not come to the aid of the United States in his mind.
That was sort of tacked on to the end of that post where President Trump announced this, but very clear that there has been mounting frustration at this point for months from this White House when it comes to ally support. South Korea has been part of those discussions about a potential maritime coalition, but importantly, like most allies, has signaled that they don't want to deploy assets until there's more stability in the region. And at the moment, there really isn't that, as we continue to see attacks in the Strait of Hormuz, even as the U.S. says that it is ensuring that they can escort tankers through. That doesn't necessarily mean that there's safe passage.
Well, and when we consider our positioning in the Middle East, the USS George Washington is now in that theater to relieve the USS Abraham Lincoln, which of course has been at sea for a record amount of time. But because the Washington is there, it is not in the Indo-Pacific. Adam, so where exactly is our force positioning in that theater? What position are we in should something occur?
I mean, it's incredibly interesting to see how much of the U.S., particularly naval assets, have been pulled into the Iranian theater as this war has dragged on. Currently, we're looking at a gap in carrier coverage in the Pacific, right? A massive maritime environment, right, where naval forces are essential to any type of contingency you could think of, whether it be a Taiwan crisis, an issue in the South China Sea with China, or even some sort of natural disaster. And, in our research, we found that this is probably only the third time in the 21st century that the United States has not had an active carrier in the region. And we don't know how long it will be until maybe one of the carriers that's in the U.S. moves into the Pacific. But again, it just highlights this wide-ranging resource straw of the Iran war that adds to the munitions depletion as well. And not only is the aircraft carrier gone, but a whole host of other naval assets, including destroyers, many of which are actually normally responsible for ballistic missile defense of allies like Japan or South Korea, are now in the Middle East. And so while we're certainly not expecting some sort of near-term crisis with North Korea or China, they pose a real threat potentially to Japan and South Korea. And right now the United States has many of its key assets designed to protect them elsewhere.
Well, the United States also has its attention divided, possibly. Tyler, in our final minute, I just want to ask you briefly about Canada negotiations. There's a meeting that's supposed to be underway right now, right, with the USTR and Canadian officials?
Yep. They're trying to get this over the finish line. We have some pretty incredible reporting. Our colleagues are starting to put together the contours of this deal. Does seem like we're going to see some of those sector-specific tariffs come down, most notably on metal, steel, and aluminum, expected to be halved in some cases, down from a very high level of 50%. We have been talking about this for over a year, whether or not Canada would get relief on this front. We're also expecting auto tariffs to come down from 25% to 15%. We'll need to see this all in writing, but both sides have been pretty optimistic they're actually going to get something done.
All right, well, we'll see if that happens. Bloomberg's Tyler Kendall and Adam Ferrer of Bloomberg Economics. We went around the world together. Thank you both so much for joining me on Balance of Power. And still ahead, we'll be joined by our political panel as we consider another key departure at the White House. The Director of Legislative Affairs, James Braid, is leaving, and we'll get into that up next, right here on Bloomberg.
It's 12:40 on Wall Street, live from the Bloomberg Interactive Brokers Studio. I'm Matt Piper. Stocks still down at this hour. We do check markets for you all day long here at Bloomberg. Right now, the Dow is down 416 points, or 0.8%. The S&P is down 26 points. The Nasdaq is down 187, or 0.7%. The Bloomberg Dollar Spot Index is up above 1% at 1193. The dollar is little changed, while Bitcoin is trading above $70,000 for the first time since June. Right now, Bitcoin is at 72,475. Crude oil is moving higher. Brent is at $93 a barrel. WTI is at $87. $88. Walmart is in the news today after reporting the slowest pace in U.S. comparable sales in 6 years, and the retailer has offered a cautious outlook for the year. Comparable sales in U.S. stores, those coming from stores open at least a year, as well as online sales tied to those locations for the company's fiscal second quarter, rose 2.6%. Walmart shares right now are down 10.5%. With reaction, Greg Mellick, Evercore ISI Senior Management Director.
I think the reaction today is basically Walmart saying, you know what, we're going to go back to doing what we do best, which is if we have TRF rebate money, we're going to use that to offset a rising energy cost, but also really invest in price and help reaccelerate that traffic.
Hear more of that conversation on the Bloomberg Open Interest podcast. You can download it wherever you get your podcasts. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you do get those podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash. Kaylee.
All right, Matt Piper in New York, thank you so much. I'm Kaylee Lines in Washington, a rainy Washington, might I add. The weather's not going to be great for the next couple of days. It might not be great this weekend either, and I wonder how disruptive that might be to the Indy cars that are going to be whipping around the U.S. Capitol. As yes, that race is this weekend, the Freedom 250 Grand Prix. It has made traffic a nightmare in Washington and for several weeks as they have to do the takedown after the buildup. They had to even weld down manholes. They had to take medians out to make way for all these Indy cars. It's been quite an effort. That race, of course, is on Sunday. It'll be quite the image to see these cars buzzing around the Capitol building and the National Mall. I'm not sure how many lawmakers will be in town to see it. They haven't been gracing the halls of the Capitol themselves in recent weeks because we are still in the thick of the August recess. The House comes back August 31st, the Senate not for a week or two after that. But they still have things they need to accomplish when they return. Questions linger about government funding, for example, a budget reconciliation effort in part to fund the Pentagon, even things like the Clarity Act, that long-awaited, long-stalled crypto market structure legislation. There's still a lot of legislative effort that they're going to try to make, and perhaps they're not going to have a key voice engaging in that effort at the White House now, as it was announced formally by President Trump today that James Braid, the Director of Legislative Affairs, is going to be departing in September. The president announcing this on Truth Social, writing in part, quote, James has played a critical role in our many accomplishments with Congress, including the One Big Beautiful Bill, beating the Democrats in 2 shutdown showdowns, passing the Genius Act, defeating a record number of war powers resolutions, and the confirmation of my cabinet at the fastest rate in decades. He goes on to say this has been and will continue to be the most successful Republican Congress in history. I'll leave it to our political panel to tell me whether or not that characterization is true and if it can continue without Mr. Braid's help. Let's get into it now as we turn to Rick Davis, Bloomberg Politics contributor, Republican strategist, and Stone Court Capital partner, joined today by Democratic strategist Caitlin Legacki, senior fellow at Third Way. Welcome to you both. Rick, you know well, obviously, how crucial the legislature's role actually is. How hard is it going to be for the president to fill James Braid's shoes?
Yeah, I would say that they have fulfilled every expectation that the president put on the legislative team to get legislation passed. I mean, it has really been a struggle because of such a small margin of majority, but they've done a great job. And the reality is that Braid won't be very far away, right? He's been on leave to basically do some political chores at the president's political committee. Obviously, the midterms are going to be existential to his agenda going forward after the elections. And I wouldn't hold my breath to think that he wouldn't come back into the administration election in another role.
Well, Caitlin, weigh in here on the suggestion that Rick made, which is true, that most of what the president has asked of Congress, he actually has been able to get, including the confirmation of some pretty controversial members of his cabinet, like Pete Hegseth or RFK Jr. This job hasn't been easy, but arguably it has been successful, no?
It has, and I think it speaks to a couple dynamics. One is that the Republican Party in Congress has basically fallen in lockstep with the president in a way that I think a lot of Democrats really would envy, especially Joe Biden. But also, you know, Trump is very active himself in terms of maintaining his relationships on the Hill and ensuring that his priorities get passed. And so, you know, Rick knows that landscape a lot better than I do, but it wouldn't surprise me to hear that he's not going far and that he'll still be at, you know, the president and the administration's disposal, be helpful as much as he wants or needs to be.
Yeah, I guess to the extent he's able to do that from the private sector. But Caitlin makes an interesting point, Rick, about how the president largely advocates for himself on Capitol Hill as well, or he isn't afraid of doing so, of whipping votes when need be, of calling members as the votes held open on the House floor and trying to get those final holdouts in line. We raised this question when the press secretary, Caroline Leavitt, announced she'd be leaving at the end of this month. Does the president really need another press secretary when he so frequently speaks to the press himself? Does he need a legislative affairs director when he's always willing to call members?
Yeah, because he needs to know who to call. He needs to have the follow-up after the fact. He needs to understand the issues from his team so that he can make the best argument he can. So, yeah, the president, he serves as both the President of the United States, the Speaker of the House of Representatives, and sometimes the Majority Leader of the United States Senate. And I think he wishes he was on the Supreme Court from time to time. But the reality is he needs a team around him to be able to execute. And I think it's a real tribute to Braid that he's executed as well as he has and gotten what he's wanting to get done with so many people opposed to his agenda. It does really reflect, I think, a pretty keen staff who don't get much attention in this administration because Donald Trump himself is in the eye of almost every story in Washington and overwhelms anybody else getting attention within his own administration.
Well, and when we think about the president's desires, whether or not he actually does want to be on the Supreme Court, I think only he knows, and maybe he'll share that with us one day, Rick. But we know that there are some legislative things that he still does want to accomplish. He wants to see Reconciliation 3.0 get through. He desperately wants to see the Save America Act, at least as much of it as possible, pass Congress. Rick, is he going to be able to do those things realistically with anyone else, someone new at the helm, or does that just make this uphill climb an even steeper one?
Yeah, the president's got a pretty good bench, and so I have no doubt that they'll be able to fill the shoes that Braid is leaving. And don't forget, I mean, like all these judicial acts that are like holding up the library or holding up the ballroom and things like that, they may ultimately need congressional approval, and those are really going to get sticky. So confirmations, as you point out, really big agenda item. He's got a lot already on the plate that seem to be running into trouble. So there's not going to be a let up in what the president and the White House wants to do on Capitol Hill, even when they're blowing in to a very limited amount of time between now and Election Day and a mounting election crisis headed their way, because a lot of these elections are going to take a lot of the president's time too.
Mm-hmm. Well, okay, so the president obviously has a lot of things demanding his attention, and recruiting for this legislative affairs director potentially to that list. The list that already, as I mentioned, Caitlin, includes the next press secretary. It's not clear who's going to step into Caroline Leavitt's shoes, if we will maybe see the rotating cast of characters from the cabinet in the briefing room once again. Remember when Marco Rubio and J.D. Vance did their briefings, even Mem and Oz came in and really couldn't talk about anything other than Medicare and Medicaid. There's been a lot of buzz in Washington, and if you read the playbook this morning, you would have seen all the reporting around Scott Jennings, the CNN contributor, who seems to be pretty publicly auditioning for the role of press secretary. Does that fit make sense to you, Caitlin?
You know, I think it really just depends, and I think the risk that Jennings is playing is obviously Trump loves a reality show. He loves people to audition for things. But there's also a very fine line for him between somebody like showing that they want the job and being too desperate or being too thirsty. And so I think that that's a fine line that Jennings has to walk. And I think the risk is trying a little bit too hard to show that he wants it and turning the president off.
Do you agree with that, Rick? Does he need to play it a little lower key? Are there other candidates in your mind that might be better in this role?
Yeah, I actually think the idea of applying this to a reality TV show is exactly the right approach, because that would define the entire Trump political
It's like
world.
The Apprentice.
Exception in 2015. And so, yeah, I think a lot of that applies. But the reality is I think they've had their eye on Jennings since even before. There's some reporting that indicates that they were interviewing him before that Caroline Leavitt even indicated she was leaving. So I think there's more of a plan that's being executed in front of us than an audition in this regard. So it would be unlike this White House to not be prepared for a transition. But there's absolutely theater going on, because whatever is happening behind the scenes, all we're seeing is the theater, and it's tons of fun. I mean, look, Scott Jennings is probably the most beat up man in American television. I mean, kudos to CNN for having him on there. But he's been a punching bag since 2017. And I must admit, he's probably got the only job in America where it'll be easier for him to be the White House press secretary than the current has.
Well, it's all relative, isn't it, Rick? I want to hit you both as well on a new development from the Cook Political Report, because this is fascinating. They've just released some new ratings. They're shifting 4 key statewide races in Texas and Iowa. In the gubernatorial races in those states, in Texas, they go from solid R to likely R, as Greg Abbott has been seeing a narrowing in polls against his opponent, Gina Hinojosa, who was on this program earlier this week. Iowa governor also goes from toss-up to lean Democrat. Then when it comes to the Iowa Senate race, goes from lean R to toss-up, as does the Texas Senate race, also now rated a toss-up from lean Republican. Caitlin, what do you make of those ratings changes?
I think it speaks a lot to the quality of the candidates that Democrats have recruited in these races, both at the Senate level and the governor's level. I think it also speaks to the strength of the campaigns that they're running, but then also the landscape continues to look worse and worse for Republicans going into these midterms. And so I think that both in Texas and in Iowa, they're very difficult seats to pick up. But the movement is there to give Democrats hope. And I think the campaigns are top to bottom strong enough to pull this rabbit out of the hat if all of the other pieces fall into place.
Rick, do you buy the toss-up ratings in either or both of those states?
Yeah, I think, like you said, I mean, it's a landscape issue right now for a lot of these elections. I mean, you see consistently Democrats being elected at the state house level, special elections and whatnot. It's 31-0 since Trump became president of the United States that Democrats have won and Republicans have lost. So this isn't anything new. Democrats are winning, plus Trump 15 districts at the state house level, state Senate level, all over the country. I mean, and we see the rebuke in Kansas and Missouri during their primaries, where statewide, initiatives supported by the entire Republican-led, infrastructure in the state went down in amazing defeat. 83% in Missouri voted against the initiatives that the governor and the entire state legislature were supporting. So there is a real mood in the country, and that includes Republicans who are not going to just buy whatever this administration is going to sell. So I really think the onus is on the administration to start making this case. There have been lots of initiatives by the president to say he was going to make this about him, this election cycle. Well, whether he likes it or not, it is about him now. And if he doesn't start to take a much more active role in campaigning on behalf of these initiatives or individuals, it's really going to be difficult.
Just quickly, Caitlin, we're almost out of time here, but how much is this also due to the fact that you have these Senate candidates and gubernatorial candidates on the ballot together? Can you separate the fates of, say, James Tallarico in Texas from Gina Hinojosa, who's in the gubernatorial race?
A little bit. I think, again, the main question is, how big is this wave going to be? But because of the way that Senate campaigns are nationalized more than governor's races, I think there is going to be a little bit of a gap between them, but I do think that if we are winning a Senate seat in Texas, we're also probably winning a governor's seat in Texas.
All right, Caitlin Legacki and Rick Davis, our political panel on this Thursday. Thank you both, and they'll be back for more in the second hour of Balance of Power, which is just ahead, right here on Bloomberg TV and radio.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
President Trump says the U.S. is waging economic warfare against Iran, while the Treasury Secretary is waging a war of his own against higher long-term rates. Welcome to Balance of Power on Bloomberg TV and radio. I'm Kaylee Lines here in Washington, where the Treasury Secretary, Scott Bessent, says he will hold a press conference on Monday on the economic levers the U.S. is getting ready to pull to bring Tehran to heel, as he also suggests that the bigger buybacks the Treasury announced just yesterday could be even bigger than what was initially described. We'll have the latest with Bloomberg's Tyler Kendall, as well as analysis from Anna Ashton of Ashton Analytics and our political panel this hour. Plus, you'll hear an important conversation that Tyler had earlier today with the chair of the CFTC, Michael Selig. It's all ahead, but first, we have to begin with the markets and the bond markets that perhaps aren't doing exactly what Scott Bessent would like to see them do today. And for that, we turn to Matt Piper up in New York. Hey, Matt.
Hey, Kaylee, thank you so much. Live from the Bloomberg Interactive Broker Studio, I'm Matt Piper. Bond yields still on the upswing, erasing most of the pullback they saw the previous day after the Treasury Department announced an intervention aimed at easing pressure on longer-dated government debt. We check the markets for you all day long here at Bloomberg. Right now, the Dow is down 409 points, or about 0.8%. The S&P is down by 25 points. The NASDAQ is down by 173. The yield on the 30-year Treasury bond, which is the primary focus of this accelerated buyback, right now is up 5 basis points. The 2-year yield is up 2 basis points. The 10-year, the main benchmark for mortgages, car loans, and credit card debt, is up at 5 basis points, just like the 30-year. The dollar is little changed. Bitcoin is trading above $70,000 for the first time since June. Bitcoin right now at $72,700. Gold is up at 23%, or $4,568. Oil is moving higher. Brent crude at $93 a barrel. WTI at $87 a barrel. Stocks we are watching: Moderna, mRNA on the Bloomberg terminal. Shares are pulling back following yesterday's 177% rally. That was the biggest in the S&P in the past 25 years. That happened following highly successful phase 3 trial results for its experimental mRNA-based personalized cancer vaccine. Today, a different story. Moderna shares are down 44%. Walmart, they're all about rollbacks in stores. Today, a rollback in its stock. This after it saw its slowest U.S. sales growth in 6 years. Its quarterly shares hit 2.6% in the second quarter, less than what was expected. Despite that, Walmart raised its full-year guidance for sales and adjusted operating income. Walmart shares right now are down 10%. And a Starbucks shred. The coffee giant has just eliminated 104 roles as part of a restructuring meant to boost growth, laying off workers who declined to relocate to its new Nashville office from Seattle. They like that Pacific Standard Time too much. Starbucks shares right now are down 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper. That's a Bloomberg Business Flash. Now back to Balance of Power with Kaylee Lyons.
All right, Matt Piper, thank you so much. So much to watch in financial markets today, in the bond market and the equity market. Pretty incredible to see this move on Walmart that Matt was just talking about. The worst day for that stock going back to February of 2024. It's at the lowest level since November of last year on the back of that weaker than expected print. And of course, in large part, that is due to the drug price negotiations that the administration has been engaged in, but still could very well send a signal about the health of the U.S. consumer and the economy overall, which of course President Trump repeatedly contends is hot and is doing great. At the same time, he also has repeatedly said that Iran's economy is suffering, pointing to higher inflation rates and a weaker currency due in large part to the U.S. naval blockade that it is still maintaining in the Strait of Hormuz. The strait, of course, which the president says is still entirely in U.S. control, as he said at the White House just yesterday.
You can't let Iran have a nuclear weapon. We have possession, complete control of the strait. We've had a lot of oil coming in, a lot of oil. It's not going to be perfect, but it's a lot of oil coming in.
And the president's getting ready to go even further than just the blockade, if you take him at face value, and what he posted on Truth Social, announcing perhaps what he described as an economic D-Day against Iran, writing, quote, "No one has given the Islamic Republic of Iran a greater opportunity to make a deal than me. Tragically for them, they have failed to take it. Therefore, today, I am announcing the most crushing economic operation ever taken against any country." So what exactly will that look like? Maybe Tyler Kendall knows, our Washington correspondent who is here with me in the D.C. studio. So, Tyler, the most crushing economic operation ever taken. That operation would entail...
Well, we're waiting for that answer, of course, not to not make good on all that anticipation that you led me with. But we'll have to see. On Monday, we very likely will get some firmer details. The U.S. Treasury Secretary Scott Bessent did announce that he will hold a press conference focused on what this could entail. President Trump did give us a few clues, if you will, in that Truth Social post. People are picking up on the fact that he says that this will be geared toward other countries, those that he says allow their financial institutions to supply any sort of lifeline to Iran. He outlined that that includes cash transfers, swap lines, ship registries, or any avenues to smuggle its oil out. And that is what everyone's picking up on. Adding in part, quote, "You know who you are." That is raising questions on whether or not that means the U.S. is going to more strongly target Chinese purchases of Iranian crude, though that in and of itself has a risk to the Beijing-Washington truce about a month away from the Chinese President Xi Jinping coming here to D.C. There's a few other things that we're tracking that are sort of on our list of potential ways that the U.S. may exert economic pressure, some more targeted actions against the so-called shadow fleet that actually moves the oil for Iran. We could also see the U.S. move to try to seize frozen Iranian assets that are within their jurisdiction, though I was speaking with one analyst who says this may be a little easier said than done because even if it's in the U.S. jurisdiction, you have to get third-party countries involved. But it's definitely something to watch against the background that the president has already threatened so-called secondary tariffs, 25% on any country that does business with Iran. Whether or not he follows through on that remains to be seen.
Okay, so we're going to have to wait to see and hear detail, I guess, from the Treasury Secretary on Monday. In the meantime, Tyler, we're hearing from the Treasury Secretary about a separate issue today. Once again, he's trying to talk down long-end rates, it seems, suggesting that the Treasury could be buying back even more long-term debt than it announced yesterday, which was larger than what it announced 2 weeks ago. He essentially says he's trying to bring the market back to equilibrium. He told reporters this at the White House earlier.
Anything that happens within a 24-hour period is noise. And, I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market, I think, I'm confident that bonds will continue declining.
And Tyler, you were at the White House yesterday when the president was asked if Americans should be concerned about volatility in the bond market. His answer was no, and yet the Treasury Secretary seems to be suggesting he's a little concerned.
Yeah, and willing to take additional action, as well as saying that the administration will be unveiling a new fiscal initiative to address borrowing costs. Of course, this is becoming a politically fraught issue here in Washington as financing costs make their way through to the broader economy. This month, we're seeing that mortgage rates hit their highest level since July of 2025. I picked up on this quote from the Treasury Secretary. He said, "All we're trying to do is get people to focus on the fundamentals and not trade the headlines." He didn't specify what the new fiscal push would involve, nor what headlines he was referring to. But yesterday we got one in terms of the debt load reaching $40 trillion. And if we dig into some of that Treasury Department data, that includes a record July budget deficit fueled in part by a surge in Medicare costs and Social Security, as well as the interest that we pay on that debt. But I don't need to tell you that it is politically difficult right now in Washington to cut spending, especially during an election year.
Well, of course, Scott Bessent has blamed this in part for the fact that a lot of the tariff revenue they were counting on isn't coming in because of the Supreme Court decision and refunds that have to be issued. On tariffs, just quickly, are we about to get more tariff revenue from Canada or not, Tyler?
Well, the USTR Jamison Greer is meeting right now with his Canadian counterpart. I don't have my terminal in front of me. I'm not sure if we're getting headlines on it quite yet, but we're waiting for this finalized deal. Maybe something is in the works. We have reporting, Kaylee. It looks like that we are going to see lower tariffs when it comes to autos, maybe 25% to 15%, and metal tariffs potentially cut in half. But that could maybe open the door for a little bit more trade access between the two economies, according to this White House. But we still need to see those finalized details on paper.
We're waiting for details on a lot of things. Tyler Kendall, thank you so much, our Washington correspondent here with me in the D.C. studio. And I want to return to what Tyler was talking about, the countries that apparently know who they are, that the U.S. may be looking to as it tries to tighten the economic screws against Iran. China, of course, the first one that comes to mind, at least for me, and perhaps so as well for Anna Ashton. who, of course, is the founder of Ashton Analytics and a former China analyst at the Department of Defense. She's here with us now on Bloomberg TV and radio. Anna, welcome back to the program. It's good to have you. China has responded to what President Trump announced, suggesting that it does not believe that pressure and economic sanctions are going to work, that diplomacy is what has to be pursued here. Is that China basically telling the president we're not playing along with this effort?
More or less, yes. I think, that the White House is probably trying to ratchet up pressure, not just on Iran, but a little bit on China ahead of the September visit of Xi Jinping. It's been sort of de rigueur for Trump to ratchet up pressure ahead of major talks. But behind the scenes, we have to assume that Xi is pretty committed to reaching some sort of agreement, getting something done during this visit, and that Trump is too. So, how much of this is theater is I think, the most important question.
Well, on the subject of that visit, I actually discussed this on Balance of Power earlier this week with the former National Security Advisor to President Biden, Jake Sullivan. I asked him specifically who has the stronger hand, frankly, in that meeting that's coming up in just a few short weeks. This was his answer, Anna.
One of the biggest things America has historically brought to the table in the competition with China is a network of powerful, robust alliances in both the Atlantic and the Pacific. And China has had a long-term strategy of wanting to undermine those alliances, to weaken them, to divide the United States from its allies. And they're looking right now and saying, wait, President Trump is actually doing our work for us. And I think it does mean that President Xi will come with a certain swagger in his step, because he believes that they are making progress economically and technologically, they're making inroads diplomatically, and the United States is losing or is degrading one of the most critical assets that it has.
I wonder if you agree with that characterization, Anna.
I couldn't agree more. The reality is that not only is China looking at a United States that has weakened its relationships with its allies, but on top of that, China is looking at a United States that has depleted a significant percentage of its weapon stockpiles, that is trying to both announce that it is going to become more reliant on itself in things like AI and drones, and then at the same time needs critical resources from China still, and for the foreseeable future will still need those critical resources from China in order to be able to compete. There is definitely a change in terms of who seems to have the upper hand. And at present, I think Xi Jinping likely feels like he does.
Well, and as you talk about some of those critical materials that the U.S. needs to power a lot of things, the defense sector included, how quickly, if the U.S. were to actually do what the president is suggesting and punish those who are still going to purchase Iranian crude and not abide with a tighter economic chokehold that the U.S. wants to get on Iran, if President Trump were actually to say, okay, then China, here are higher tariffs that you have to deal with, how quickly does that spiral into, say, fresh export controls of critical minerals and rare earths?
I think that that's exactly the right question. I think, too, that is the lever to look at. How quickly China pulls that lever, I don't think it would be, a significant ratcheting up of export controls immediately, unless what the United States did was explicitly targeting China and hit really hard in terms of punishing China's ability to compete internationally because it couldn't receive oil from Iran anymore. But that's a really hard thing for the United States to do. I mean, the reality is that China is actually quite diversified in terms of where it gets its oil and gas. And although it is dependent on the Strait of Hormuz, like so many other countries, it has plenty of fallback options. So I don't think that that's the lever that the White House thinks it is.
Well, and on oil specifically, I've been told many times throughout the course of this conflict and the difficulties in the Strait of Hormuz that in large part why oil prices haven't moved higher is because of China, because they've pulled back as a buyer on the global markets and have been leaning on their massive oil stockpiles. How easy would it be for China to decide also to pressure the global oil market to drive prices higher by coming out and buying in force again?
That's an interesting question. And I can't honestly answer that one, but I think that it is worth exploring.
Well, let's go to another area then that is definitely top of mind when it comes to China. I hope you can weigh in on artificial intelligence. We are having a massive conversation here in the United States around data centers, the infrastructure that powers AI. The industry, of course, will tell you we have to have these data centers. We have to allow these models to advance, because if not, we cede ground to China. Obviously, the domestic pressures in communities and concern over water and energy prices, utility bills would suggest a pullback. Is there merit to the argument that China is within a breath of being able to surpass us on artificial intelligence if we slow down even slightly?
I do think that there's merit to the argument that China is catching up fast. And one of the reasons it's catching up is because it has a very different ecosystem in terms of its energy resources and its ability to bring these huge data centers online. That's cheaper and easier for them than it is for us. And so that is one way that they're going to continue likely to outcompete us. However, in terms of what their AI capabilities are, the experts seem pretty firm on their conviction that China's not actually within a breath of catching up to us. I guess we'll have to see.
Well, and how much of that is dictated by the controls that the U.S. has put in place, the export controls around chips that power this critical technology? A headline crossed the Bloomberg terminal just a few minutes ago, Anna, from The Information, that NVIDIA is plotting a new chip for Chinese customers that perhaps, I guess, would get around some of those export restrictions. We haven't confirmed that here at Bloomberg, but apparently this chip would be compliant with the export control rules. Does that suggest that the export controls are working, or that there's so many loopholes at which China is still able to access that they aren't as effective?
I think the export controls have been working to slow China down because, it is much harder to achieve the goals that they want to achieve in terms of AI capabilities without those chips, and they don't have them yet. But, the export controls have also guaranteed that China is pouring more and more and more resources into developing them, and is determined to be less and less reliant on sources like NVIDIA for those chips. It's great for them in the near term if they can buy some NVIDIA chips, but in the long term, what they want is to not need them. And they're working hard to do that.
Anna, we have less than a minute left here, but how do you think China is viewing and interpreting the president's rhetoric in the last few days around the Korean Peninsula, attacking South Korea, talking about a good relationship with North Korea? Does drawing back on joint military exercises with South Korea also send a signal to Beijing?
Certainly does, and I'm sure it's a positive signal from Beijing's standpoint. And we also, have been pulling our aircraft carriers out of the region. I mean, we just are giving numerous signals that we're sort of abandoning the Pacific as an area of primary focus.
All right, Anna Ashton, great to have you back on the program, joining us from Ashton Analytics. Thanks so much. And indeed, we have seen the carrier, the George Washington, leave the Pacific. It's now in the Middle East to relieve the Lincoln. We'll have more ahead here on Balance of Power on Bloomberg TV and radio.
It's 1:21 on Wall Street, live from Bloomberg Interactive Brokers Studios. I'm Matt Piper. Treasury Secretary Scott Bessent's bold intervention to stem a potentially damaging rise in U.S. borrowing costs has some investors saying the dollar will ultimately pay the price and could push investors toward alternatives. To the big board we go. Everything is still down at this hour. The Dow is down nearly 500 points. The S&P is down 39. The NASDAQ is down 235. Oil is moving higher following President Trump's latest threats to Iran. Brent is at $93 a barrel. WTI up about 2% at $87.79. This is a bad dive. Alibaba, BABA on the Bloomberg terminal. Alibaba's profit diving 75% after AI spending hit $10 billion for the company. It reported a 9% jump in revenue, but net income did tumble. Alibaba expects annualized revenue from AI products to near $10 billion this quarter. Alibaba shares right now not doing as bad as earlier in the day. They are still down, though, about 0.3%. SpaceX shares are also down. They're down by about 9% as a second tranche of stock is released from a post-initial public offering lockup period. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash. Kaylee.
All right, Matt Piper, thank you so much. Matt pointing us, of course, to the bond market. Well, yields at the long end are on the climb back up today, erasing a lot of the gains we saw yesterday off the back of the Treasury's larger buyback announcement for the long end. And the Treasury Secretary, Scott Bessent, of course, today went even further to say that that could be even larger than $4 billion per issue. And yet we're still climbing 5 basis points on the 30-year, which is sitting just around 5.25% as we speak. The issue here may be that the market is clinging to the illness, like inflation and the debt, which, of course, as we told you yesterday, has crossed $40 trillion, doubling in just the last 10 years. The Treasury may instead be trying to address the symptom, which means it could be a near-term fix, but not a long-term one, as I heard yesterday on Balance of Power from Jason Furman, the former chair of the Council of Economic Advisors under President Obama.
There's two solutions. You can cut spending, or you can raise taxes, or you could do some combination of the two of those. There's two things pushing up inflation. One is pushing up interest rates. One is expected inflation. Now, the good news here is the market seems to believe, and I agree with the market, that the Fed is going to keep inflation under control, but they're going to keep it under control by raising interest rates. And second is just the general upward pressure that comes every time there's a voracious demand for capital. And that's what we have right now. And I just don't think any of those are going to change, short of a recession or a bubble bursting or some bad event like that. Higher interest rates, to me, are likely here to stay.
But of course, higher interest rates are exactly what President Trump doesn't want, as he said again repeatedly at the White House yesterday that he thinks rates should go down because the economy is strong, not up. But if the things that might bring interest rates down are raising taxes or cutting spending, as Jason Furman told us, there's a real question as to whether or not Washington is ready to deliver on either of those things. And it's on that note we turn now to today's political panel. Rick Davis is with us, Bloomberg Politics contributor, Stone Court Capital partner, and Republican strategist, alongside Democratic strategist Caitlin Legacki, senior fellow at Third Way. Welcome to you both. Rick, higher taxes or cutting spending, which one of those is politically appetizing?
Well, I think if the American public starts realizing that the amount of debt that is represented in this $40 trillion number represents $120,000 per American, they start to get a little edgy about that. And we haven't gotten to that point. It hasn't become a real salient political issue at this stage. But we've seen it when it has, and things change. And so you do see Congress in the past, when they've had pressure from constituents to make changes to the amount of spending they have, they impose all kinds of different measures to stop spending. They rarely actually cut back on the actual spending. And so I don't think you can be very optimistic that either taxes are going up or spending is going to come down. But I could see in the very near future, certainly by the 2028 cycle, a real effort to start reining back on the growth in spending, which would send a good message to the market. But the idea that taxes go up and spending goes down, very optimistic and probably unrealistic.
Well, so let's talk about where you could see cuts in spending. This administration, at least, doesn't want to see them come in one of the easiest discretionary areas, perhaps, or the largest that you could target: defense. They want a bigger defense budget. You still have to pay interest on the debt, Caitlin, so that leaves the non-defense discretionary areas, which aren't really enough to make a dent. And then it leaves the mandatory spending and entitlements. Is there going to be any candidate, maybe not in this cycle, but in 2028, who's going to talk seriously about reforms to Social Security or to Medicaid?
I don't think they'll be focused on Social Security or Medicaid, but I do think that you raise an important question, which is, you know, as we are going into a presidential primary, we're going to have a lot of candidates throwing out big ticket spending ideas. And I do think that we have to be very serious about addressing how we plan to pay for those ideas, how we plan to pay for those programs, and then also ensure that we're delivering those services effectively. I think we saw from the Doge episode that Americans agree with the idea of cutting waste, fraud, and abuse, but we also saw that it's really, really hard to do that without hurting people. And so that's going to be an important balance for any candidates to strike. And unfortunately, I don't have like the highest degree of confidence that they're going to focus on that.
Well, what about when it comes to the revenue side, to the idea of raising taxes? Because there are plenty of people on the left, Caitlin, who are floating ideas around taxing the rich. You see the wealth tax that's on the ballot in California in this cycle. If Democrats do get power back in Washington, is that realistically what should be expected?
I think that there's going to be a lot of conversation about it, but I have a hard time seeing the rubber meeting the road and it actually getting done in a comprehensive way, just because the kind of majority it's going to take to pass that kind of revenue raiser is the kind of majority that's built on a lot of red and purple districts and seats. And those candidates are not going to want to go into a midterm election talking about how they raise taxes. And I think that's part of why this is so hard, because we do need to start raising revenue again. And we do need to simplify and make our tax code fairer. And it's hard to do that without actually generating more revenue and ensuring that, you know, billionaires and corporations are paying their fair share.
Well, yeah, so a lot of this is hard, I think, is the lesson we're learning from you both. And Rick, if there are no easy answers, the Treasury Secretary at least is searching for some that he can use in the immediate term, with things like buybacks, trying to talk down the long end of the bond market. I wonder what you make of the Treasury Secretary, this administration, frankly, because we have seen this from President Trump as well. Remember, he pulled back on the initial tariffs from Liberation Day in April because he said the bond market was getting yippy. It seems that the Treasury Secretary is also worried about the bond market getting yippy here. What is with this administration and taking cues from fixed income specifically?
Yeah, look, when the president came in, everybody was talking about how non-interventionist they're going to be. They really thought that these were the policies that they could pursue. And I think, you know, right now, Secretary Bessent may go down in history as the most interventionist Treasury Secretary of our time. And that's saying a lot considering what we've seen in the markets over the last 25 years. So I'm really stunned by the approach. They don't seem to be willing to bite the bullet and to try and do the hard stuff. Look, this administration is at the end of its next 2 years, right? They'll never run for re-election. They have an opportunity to actually get the fiscal house in order without paying a political price. And it's amazing to me that the only resolution they have right now in this bond crisis is to just, you know, continue to buy long-term debt. That has a limit to it. And I'm not sure how effective that is in curbing inflation, in helping to spur growth. If anything, it has the opposite effect. So I think this administration's got themselves in a bit of a pickle. I would disagree that doing things like reforming Social Security and Medicare and talking about things like a flat tax are politically dangerous. I've seen candidates do very well when they talk straight talk to the American public and say, Social Security is not sustainable past 2030. We have to do something to fix it. And in the process of fixing it, maybe we can reduce the debt that the American public has. And people like the idea of a flatter, simpler tax cut. And by the way, there are a lot of billionaires who would pay a lot more in tax if everyone got on a flat tax.
Well, that is certainly a point well made, Rick, as we consider the amount of wealth that is percolating out there in this K-shaped economy that we are dealing with here in the United States. Caitlin, just on the point that Rick was making about how interventionist this Treasury Secretary in particular has been, knowing how much he criticized his predecessor, Janet Yellen, for frankly similar behavior when it comes to the different maturities that the Treasury is issuing as it tries to obviously fund all of this spending that we've been talking about. What does that say about, is it about this administration or just a changing nature of the role of the Treasury in financial markets that has now been forever reset, perhaps?
Well, only Nixon could go to China, and I think only Trump could intervene in the markets the way that he has. But it is setting a new standard and a new set of norms that, 3 years ago were simply not conceivable. And, when you look at the way they've, taken stakes and equity in private companies, the way they've influenced the private sector, and it is unheard of. And I think the risk now for the private sector is Democrats are going to see this and they're going to want to do it also. And so this is a little bit of a Pandora's box that has been opened, and I think we'll have to see how it plays out long term.
And before I let both of you go, I also want to ask you about the president's promised economic D-Day against Iran. Caitlin, we are awaiting the details here, but it seems like what this actually is the U.S. asking a lot of other countries to play along with it in trying to tighten the economic screws. Is the Trump administration likely to get that?
It's hard to say, but I think the bigger issue is that this should have been the first step before they started launching bombs. And what we have seen in the past and what we've seen historically is that this kind of economic sanctions is usually a good way to avoid unnecessary wars. And because we're doing things a little bit backwards, I think it remains to be seen whether that's actually going to be effective.
And Rick, in our final minute here, is economic D-Day really going to be a D-Day?
Yeah, we've been hearing economic D-Day for a long time. We've had sanctions on this country for 50 years. And I'd like to hope that they would actually be more effective today than they have been, but you can't hold your breath on that. The reality is we're not putting pressure on Russia. We're not putting pressure on China. And now we're making friends with the North Koreans, all of whom are supporting the Iran war for Iran. And so until we actually get straight with who our friends are and who our enemies are, I can't imagine economic D-Day is going to have the impact that the real D-Day did.
All right, we'll leave it on that note. Rick Davis and Caitlin Legacki, great stuff, guys. Thank you for joining us on Balance of Power. And we still have more coming up ahead on the program. An important conversation between Bloomberg's Tyler Kendall and the chair of the CFTC, Michael Seelig, as we consider the fate of the Clarity Act when Congress returns from recess. That's just ahead here on Bloomberg TV and radio.
It is 1:40 on Wall Street, live from the Bloomberg Interactive Brokers Studio. I'm Matt Piper. Treasury Secretary Scott Bessent says the administration will unveil a new fiscal initiative to address the highest borrowing costs in years. It all has stocks not doing so hot. We do check the markets for you all day long here at Bloomberg. The Dow is now down more than 1%. Down 540 points. The S&P is down 44 points. The NASDAQ is down 246. The Bloomberg Dollar Spot Index is at 1193. The 2-year yield is at up 2 basis points. The 10-year yield is up nearly 6 basis points. The 30-year, we don't always talk about that one, but it is the primary focus of the accelerated buyback. That is up 5 basis points as well. Bitcoin up at its highest price all summer, above 72,000. Crude oil is moving higher. Brent is at $93 a barrel, WTI at $88. As for stocks we're watching, Deere shares are jumping after the company says it's seeing a boost in orders for its machinery, raising hopes that the agriculture sector is poised for recovery. Deere shares right now up 43%. Let's talk travel and look at airlines. Southwest Airlines stock has climbed about 40% in recent months. Now, that could be due to the demise of rival budgeter Spirit. The air industry overall, though, is down thanks to rising labor costs and concerns about aircraft delivery delays. Southwest Airlines right now is down 1.1%. Delta is down 2%. American not doing so badly compared to the rest. That's just down 0.3%. United is down nearly 4%. Speaking of travel, the hottest travel souvenir, not that magnet for your fridge. It's learning something new. Some are treating time off like an investment, using their vacation to learn a skill from surfing to cooking. According to a survey from MasterCard, 48% of us are planning a trip this year specifically to learn something. However, these skillcations, as they're called, can cost more than a normal trip, depending on the destination and, of course, the type of activity. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper. That's a Bloomberg Business Flash. Kaylee.
All right, Matt Piper, thank you so much. I personally never really want to use my brain on vacation. The whole point of vacation is checking
no
out.
Skydiving, right?
For me, but, you know, more power to you if you want to use your free time to expand your brain and your horizons. Matt, appreciate it, as always. Speaking of expanding horizons, James Braid is expanding his horizons to the private sector. He's getting set to depart the White House in September, according to President Trump. James Braid, of course, is the White House Director of Legislative Affairs, and the president credited him in his post announcing his departure on True Social with many of the big accomplishments Congress has made during Trump's second term, including the One Big Beautiful Bill, beating the Democrats in 2 shutdown showdowns, the president says, and passing the Genius Act, as well as a number of other things. The Genius Act, of course, was the stablecoin legislation that did get across the finish line. It was part 1 of what Congress wants to accomplish when it comes to crypto lawmaking. Part 2 is the Clarity Act, which may have to find its way through the United States Senate without the help of James Braid, unless someone is quickly put in his place to try to get it across the finish line. The Clarity Act, of course, is the market structure legislation, divvying up which digital assets should be regulated by which regulatory agency, the SEC or the CFTC. It gives a lot of jurisdiction to the CFTC, which today is holding its inaugural Innovation Advisory Committee meeting. It kicked off yesterday at the White House. The president actually greeted not just the CFTC chair and SEC chair, but heads of the major exchanges as well as the big crypto companies, got them all together and called on Congress to pass the Clarity Act. And we'll see whether or not that happens after recess. The question, of course, if it doesn't, is where it leaves things. If there's no firm rules of the road written into the law when it comes to crypto, is it all just up to the regulators? That's where Bloomberg's Tyler Kendall began her conversation with the CFTC chair, Michael Selig, and they got into a number of other subjects as well. Let's listen to their conversation in full.
We're very optimistic that we're going to get clear rules of the road for crypto asset market structure on the books, and this vote is critical. We've got to get the Democrats to come along with us. They have really obstructed. We want their support. This should be bipartisan. The bill passed the House in a bipartisan fashion. We've got this bill in the Senate. It's very similar. We want to get it across the line. It needs to be a fair bill, a bill that isn't targeting the president or anybody else. It should be neutral and apply to everybody in the same way. We're really excited to get this bill across the line. CFTC stands ready to implement upon the passage of the bill.
Just to quickly follow up on that, was there any discussion yesterday about any updated ethics provisions related to the bill?
Well, the ethics provision is under negotiation. We're looking forward to seeing a fair ethics provision that's not targeting the president or anybody else, as I said.
If clarity stalls or fails to pass, the CFTC has signaled that it's prepared to unilaterally dial up oversight. What would that look like? What sort of rulemaking are you prepared to take in that scenario?
The CFTC has a lot of authority, and we're not afraid to use that authority. The president has promised market structure for the crypto industry, and that's what we're going to do, whether we have a bill or not. But we're optimistic the bill is going to set the standard. We really want the United States to lead, and having legislation, clear law on the books is the most surefire way to lock in crypto market structure, and so that's what we're focused on today.
But for my clarity, if clarity doesn't pass, you're still going to pursue regulation related to this?
Well, absolutely. It's really important that we have market structure. We can do that through rules. We can do that through laws. The CFTC has a lot of authority under its existing statutes, as do other agencies. And if we have to utilize that authority to create rules without the supporting legislation, we'll do it. But of course, legislation is the priority. That's what we want to see. America needs clear rules on the books. We'll use rules if we have to, but we're going to focus on the law today.
Right, because in theory, or not in theory, in reality, the Clarity Act is there to codify this into law. So I'm just wondering how you're thinking about the future here to ensure that if there's a Democratic CFTC under a different administration, it wouldn't unwind all the work that you'd be doing.
We're, of course, going to look to the bipartisan efforts on the Hill no matter what. If we have legislation, we'll implement that legislation. If we don't have legislation, we'll, of course, utilize that existing work that's been developed on the Hill and utilize our existing authorities and do what we can to set rules of the road for crypto. But the bill's really the priority. The bill has to get passed.
Last question on this, just to try to get a little bit more information. Is there a timeline that you're looking at where you would act? Are you already preparing any of this action, or does it have to happen once we see ultimately the fate of that bill?
I've asked the staff to explore and evaluate potential rulemakings utilizing our existing authority, but we're focused on the bill today. Until we get that across the line, until we have an answer on where the bill is going, we're not going to propose any new rules.
Okay, fair enough. I have to ask you about the other side of this remit as well, of course, prediction markets. This might be the first election where the public at large seems hyper aware of prediction markets. How are you thinking about policing against insider trading when it comes to political event contracts? And in particular, should we expect the CFTC to release any specific guidance ahead of the midterms?
Absolutely. We're utilizing all of our authorities to police these markets. They are derivatives markets within our exclusive jurisdiction. We take that responsibility very seriously. There's two things that we're looking for. One is insider trading, as you mentioned. The other is just fraud and manipulation. We saw a number of cases, some of them have become public, others we're still investigating, where there's just fraud, right? Somebody makes a statement and then takes a position on the other side. That, of course, is not legal within our framework, but there's also insider trading where people are misappropriating non-public material information that they obtain, whether it's from their employer, from their client, whatever, right? They take that information and they trade on it. That's insider trading. It's no different if it's a security, a commodities contract, or an event contract. And so we take that responsibility very seriously.
But any firm guidance from your agency ahead of Election Day?
We've put out a number of advisories and reports and that sort of thing. We've settled a handful of actions. We'll continue to do so. In terms of our enforcement advisories, we believe that the rules are very clear, our statute's very clear. There isn't really any needed guidance necessarily on insider trading or manipulation. We may put out further advisories, but we're focused on building the policy side, the rulemaking, and then policing these through actual investigations and bringing actions against bad actors.
Just as you did bring up investigations, very quickly, can I ask you, related to news of the day, the markets are watching any sort of update when it comes to the conflict in Iran. Can you give us any update on your investigation into those suspiciously timed trades linked to the war?
I can't talk to any investigations. I appreciate the effort there, but no, can't speak to that.
All right, let's think broadly about legal strategy and the CFTC. We saw this federal judge the other week rule against you in Wisconsin when it comes to sport events contracts, letting state regulators move forward in terms of classifying them as gambling. point. Can you just talk to me a little bit more about your strategy and how the agency plans to sustain this exclusive jurisdictional argument if you keep getting these mixed rulings from the lower courts?
We haven't lost in a single federal appellate court. We don't intend to. If we do, that's going to create a split, and we'll see it at the Supreme Court. That's our focus. We want this to be clear, codified law in the books, and we'll take it all the way up to the Supreme Court.
So if it goes to the Supreme Court, though, and the judge rules that sport contracts are gambling, how will that impact the CFTC and these companies that you regulate?
To the extent the Supreme Court were to rule against us, of course, we'll follow the law.
All right. I wanted to ask you about the agency's June 2026 proposed rule, which does put some of these guardrails in place. Do you think that you'll be able to finalize this before the end of the year? And with everything that is going on in this market right now, what is most important to you in terms of anti-manipulation and also consumer protections in terms of really getting it on the books?
We're making fantastic progress in finalizing these rules. We received a lot of really substantive and helpful comments, both through the advance notice proposed rulemaking and the newer Rule 40.11 rulemaking proposal, and we're hoping to finalize that very soon. We're also moving forward we've proposed some rules on record keeping and reporting. We're hoping to finalize that, and we'll have some new rules proposed very soon.
I'm wondering what lessons you've learned when it comes to some of the more convoluted geopolitical contracts. There was a lot of talk at the beginning of the conflict related to the Ayatollah, for example. What lessons have you learned more broadly this year that you're applying going forward?
Well, when I came into the seat, Pandora's box was sort of opened, right? There were all of these novel instruments and contracts trading in our markets. You mentioned the Ayatollah contract. We've had all sorts of interesting contracts, both within our U.S. markets and offshore. So I've evaluated these contracts, and we've began to provide guidance, implement rules, and address some of these edge cases. A lot of these contracts, to the extent they involve war, terrorism, assassination, gaming, will be subject to the special rule. That means we get a special evaluation of these contracts, and they have to be able to be traded, in a way that supports the public interest. And so we're going to evaluate that. We've put out some standards and rules as to what the public interest factor should be, how we should evaluate that, because the commission is not the public, right? We're not the ones deciding what's in the public's interest. We need to put that out for notice and comment, and so that's exactly what we've done, and we're hoping to set standards around that. For all the contracts that do not involve war, terrorism, assassination, gaming, illegal acts, and therefore are subject to this special rule, we have to consider just whether they're readily susceptible to manipulation. We don't have special authority to, say, throw out a cultural event contract or something else that's not really subject to these more severe rules under our statute. So we'll evaluate the contracts. We're building a regulatory framework for these. We've heard the commenters loud and clear that they want more consumer protections for retail, and we're going to implement that as well.
In the final minute I have you, I also wanted to ask you about your opening comment when it comes to AI compute futures. Do you think that these are the right products to help lenders, but also tech companies and those in the AI industry to hedge against their costs?
If America is going to win the AI race, we have to dominate the compute markets. This is the most important commodity, I think, of our time. This is essentially a digital oil. Some have called it the gasoline of the technological revolution. We've got to have these markets here. We want the prices to be discovered for this valuable commodity in the United States, the benchmarks to be here, and we want it to trade here in markets where it's transparent, where we have kind of an open order book and all of the things that have made our markets the best in the world. So we're working very hard together with Secretary Lutnick and the Department of Commerce to set the standard here in the U.S. I don't want a bunch of, bad products trading in the U.S. We want the best of the best, and we're going to lead in these markets. And so we put out a request for comments yesterday on this issue, and we'll continue to build that regulatory framework so that we can win the AI race.
But with this much excitement, do you have a time frame for when, these exchanges can expect to be able to list these products if it does pass muster?
We've put out this request for comments. That's about, I think, a 30 to 45-day comment window. We'll take that input in. We're working together with Commerce. Expect some updates in the next couple months.
Great conversation with the chair of the CFTC, Michael Seelig, along with Bloomberg's Tyler Kendall, our Washington correspondent, doing great work at this inaugural meeting of the Innovation Advisory Committee at the Commission. That'll do it here for the early edition of Balance of Power, but we'll have much more on the late edition starting at 5 p.m. Eastern time as we check back in on where the bond markets end up as yields are once again climbing today. We're up 5 basis points on the 30-year to just shy of 424, retracing a lot of the gains made yesterday off the Treasury's bigger buyback announcement. Even the Treasury Secretary Scott Bessent saying they might buy back even more, not doing it for the market as it contends with a $40 trillion debt level and climbing here in the U.S. We'll have more on that later today. In the meantime, Bloomberg Business Week Daily is right ahead here on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, we are across Bloomberg platforms, radio, TV, YouTube, and Bloomberg Originals. Carol Massar along with Emily Graffeo. Of course, Tim is off this week. And so we're looking at a market, I got to say, we got stocks down just a little bit, down about 0.7% on the NASDAQ 100. We continue to be consumed, though, by a couple of things, including what we are seeing in terms of Bitcoin surpassing $70,000 for the first time in over 2 months. Is it?
It's good relative to how
what?
the last, couple months have been for Bitcoin. And it actually is impressive, Carol, that it's up on a day when the stock market is lower.
Yeah, I thought that was at one point supposed to be like a safe haven. So,
yeah. At one point it was a hedge.
And then it's a
against
risk
inflation.
asset.
Now it's a risk asset. Then it was a gauge for like speculative activity.
I feel
Just
like
let it have its day today.
All right, maybe we'll let it have its day. I should say it is also propelled by U.S. Treasury Secretary Scott Bessent's move to push U.S. bond yields lower. We also did have that meeting yesterday, too, with President Trump and those crypto industry leaders. Meantime, we're going to talk a little bit more, though, about the Treasury market. It is definitely front and center. The latest signaling from the U.S. Treasury market. We've got a great roundtable coming up. I can't wait for Emily and I to get to it. Plus, Emily, we've got to talk about Walmart.
Right.
Massive retailer, world's largest, I think, or very close to it, and what that says about consumers.
And speaking of the consumer, we're also going to talk about the housing market. It's all kind of tied together with Amy Rubenstein, CEO of Clear Investment Group, on opportunistic real estate plays.
Yeah, I do wonder if higher rates or the rate environment in any way creates more distressed assets and gives them some opportunities. Also, the owner of the New York Stock Exchange says it's looking at Polymarket's new funding round. ICE CEO will be with us in an exclusive. And then there's GLP-1s. I feel like AI and GLP-1s are two big stories in society and also in the market that we've talked about for the last 3 years.
Huge forces, reshaping healthcare, reshaping Wall Street, and we're going to get into all of that.
And so many different sectors. So a lot coming your way over the next 60 minutes. Let's get to it, though, with a check on the trading session. Matt Piper is in for Charlie Pellet. Matt, take it away.
Hey, Carol and Lemley, thanks so much. Live from the Bloomberg Interactive Studios, I'm Matt Piper. 2 hours left of trading, and we are still seeing a bit of a drop on Wall Street for your Thursday. We do check the markets for you all day long here at Bloomberg. Let's take a look. The Dow is down more than 1%, or 570 points. The S&P is down 47 points. The NASDAQ is down about 250 right now. The Bloomberg Dollar Spot Index is at 1193. The 2-year yield is up 2 basis points. The 10-year yield is up 5. So is the 30-year yield. We don't always talk about that, but that one is the primary focus of the accelerated buyback that we've been talking about with Treasury Secretary Scott Bessent. Gold right now is up at 4,520. The dollar is little changed, but Bitcoin is trading above 70,000 for the first time since June. Bitcoin right now is up $72,660. A rise in oil prices following President Trump's latest threats to Iran. Brent is at $93 a barrel. WTI is just shy of $88. And as Carol said, we are looking at Walmart today. Its quarterly sales fell short of expectations. The company's pharmacy business was hindered by federal negotiations that led to lower drug prices, and shoppers spent less per trip during the quarter. Walmart shares right now are down about 10.5%. We're also looking at Alibaba. Alibaba's profit diving 75% after AI spending hit $10 billion. The company reported a 9% jump in revenue, but net income did tumble. Alibaba shares right now are not doing actually too bad. They're right now up about 0.4%. And global luxury brands are facing a deepening sales slump in China, with sales at the 25 biggest luxury labels dropping more than 10% in July. Brands like Louis Vuitton and Dior recording double-digit sales drops, while Hermes swung from gains to declines. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper, and that is a Bloomberg Business Flash.
From Hermes to Walmart, we do it all, that's for sure, when it comes. Matt, thanks so much. Hey, Treasuries, U.S. Treasuries falling a day after the Trump administration's surprise decision to increase buybacks of longer-dated bonds, showing the move did little to counter angst about the surging U.S. government debt that pushed some yields to a 19-year high. Meantime, I love this story on the Bloomberg. We talked about it on our call. Market participants are warning that a lack of predictability when it comes to the U.S. Treasury's debt management strategy could ultimately portend higher borrowing costs. There's a lot going on. The U.S. Treasury Secretary Scott Bessent addressed some of this and the Treasury's actions yesterday earlier from the White House.
Anything that happens within a 24-hour period is noise. And, I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market.
All right, that, of course, was U.S. Treasury Secretary Scott Bessent earlier from the White House. Let's get to it with two of the smartest folks around here at Bloomberg when it comes to U.S. rates, and maybe just all around, to be fair. Our roundtable, Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey, joining us from our Princeton News Bureau. Also with us right here in studio is Bloomberg's news rates reporter, Michael McKenzie. Ira, I want to start with you. You've got some notes out. You've been writing U.S. long bonds yields. Malaise could persist for many reasons. Treasury buyback surprise signals more duration support ahead. Here it is, another day, and we're talking about yields. Where do we go from here? Or do we not really know?
Yeah, so I think we're going to just see more volatility. We don't know what Scott Bessent and the Treasury Department's going to do in terms of, look, I don't even call it liquidity support anymore, because if they're going to do significantly more than what they've already, kind of said, another $2 billion, Scott Bessent today did say that maybe they're going to do even more than that. So if they start doing another, $16 billion or $20 billion of buybacks in the long end, you have to start calling that either, Operation Twist or something more akin to that. And, ultimately, if the goal is for them to get longer term interest rates down, they have to do something much bigger than what they've done, because there's still a lot of debt out there. And treasuries now are competing with other debt around the world that now has real yields, which they didn't, 10 years ago when everyone had negative interest rates except for us.
How about cut the debt, bring down inflation? I don't know, a couple different tests. Michael, come on in. You two have been writing a lot about this and what we've been seeing in global rates. What are you hearing? There's a team out, our team also writing out a story on the Bloomberg. Market participants warn that a lack of predictability in the U.S. Treasury's debt management strategy could lead to higher borrowing costs. What are you hearing from the folks that you talk to?
I guess the short takeaway is this is just a drop in the ocean. You've got a 32 billion sized treasury market. Yeah. You've got a debt to GDP closing in on 100%. You've got budget deficit running at plus 6%. You've got an economy nominally growing above 5%, so it's running hot. It's interesting to listen to Bessent. He actually mentioned fiscal consolidation. There is nothing happening on fiscal consolidation front in Washington. Right. It's not going to happen, period. And this is why the bond market is saying, well, we're going to demand a higher premium to lend money to the U.S. government. And as Ira just said, they're competing with the hyperscalers who are coming today, who will come from time to time with 25 billion drive-by issuance in the long end, which is causing all kinds of concern amongst portfolio managers looking at this suddenly arriving. But real yields, or the inflation-adjusted yields, we had a very strong reception to today's 30-year Treasury tip or inflation bond sale, because it came at around close to 3%, which historically is a great number. But the problem is, all Bessent's really done is taken off one of these kind of hedge fund roles from the past and said, let me just try and knock those shorts out of the market. And that's what he said on TV today. But the problem is the fundamentals tell you that yield should be high, they will stay high, and you're not going to get fiscal consolidation. And by the way, the Federal Reserve still can't get back to its inflation target, and it's been missing it for 5 years. And you're going to hear from Kevin Walsh next Friday at Jackson Hole, who supposedly, doesn't want to tell the market what they want to do and doesn't want to define the framework for what they will do in terms of policy in the future. Right. So put it all together, and you get back to the refunding announcement that's coming out. Next one will be in November. What's T-Bag going to say to Scott Bessent? I mean, are we now going to rip up the playbook for decades where issuance has been predictable and reliable? It's a bit of a mess.
It's another piece of uncertainty in a market that's already uncertain, especially with Fed Chair Kevin Walsh not really giving a heck of a lot of guidance, Emily.
So, Mike, you talk to a lot of people on the buy side, a lot of people that have to deploy billions into U.S. Treasury bonds. Yes. What are they saying right now? Do they not want to buy this debt? Do they like the higher yields?
One of the issues you have with the 30-year is that it's a very long duration instrument, which is typically insurers, pensions play in that space. And if you look at most bond managers, most of them are happy owning the belly. It's kind of interesting because Besson today said, oh, these hyperscalers should be issuing bonds in the belly of the curve rather than putting this pressure on the long end. So the long end has been trading, disconnected from the rest of the market. And I think one of the reasons why Besson came out, again, that everyone's questioning why yesterday, why announce this buyback increase, and today saying we could even go bigger. I think they just don't want to see that 30-year disconnect even further, say, from the 10-year yield. Now, there's been a lot of people in the Treasury market who've been saying, well, I'll underweight the back end, or I'll actually put on a steepener trade. And I guess the reaction yesterday, we saw the 30-year drop by 9-10 basis points. That was really people being cleaned out. And Besson today said, I could take out the shorts. That's just a short-term thing. Mm-hmm. The longer-term story is that the long end is going to trade adrift. And if more hyperscalers keep coming in, and here's the big thing. I was talking to a portfolio manager yesterday. He said, Elon Musk and Jeff Bezos, they don't care about where they're issuing hedge bonds. If they need to do $25 billion, they're just going to do it.
Yeah,
and
that's a great point.
You've got all these factors that are really hurting the long end.
Hey, Ira, just to wrap up, saved a minute for you. I mean, yesterday you said folks are not selling treasuries, but they're not buying either. But, I do wonder, too, what Michael says about the fundamentals underlying why rates have been trending higher. I mean, that doesn't look like it's going to go away anytime soon.
Look, I agree, and when you look at the 10s, 30s yield curve, right, at 60, 70 basis points, that's actually historically not particularly high, right? You go back before the global financial crisis. I think we have to start thinking about the world in kind of the post-inflation era of 2022 in a much longer time horizon, right? Don't just look at the last 15 or 20 years. You really have to look back over the last 40, 50 years in order to get a better picture of, look, where are we in, where should these yields be fundamentally? But then to Mike's point and something we've been talking about, we're at this point in the supply curve where sell-offs are going to be bigger and rallies are going to be shallower just because of the quantum of debt that's currently outstanding. Scott Besson can't be the game master for where the 30-year is going to go.
Great stuff, and certainly top of mind for everybody here at Bloomberg and certainly on the Bloomberg terminal. Guys, thank you so much. Really appreciate it. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist out there in Princeton. Michael McKenzie, thank you. Bloomberg News Rates Reporter. Both of them read their research and their work on the Bloomberg and at Bloomberg.com. All right, we got to shift on over, Emily, to Walmart. That stock has been down as much as 10% in today's session. We're talking about dropping the most in more than 4 years, that intraday low. Walmart's quarterly sales falling short of expectations. It's a rare miss that's likely to stoke concern about the leading big box retailer decelerating alongside a slow-growing U.S. economy. That caught my attention. Let's see what Poonam Goyal has to say. She is Bloomberg Intelligence Senior Analyst for E-commerce and Retail. Poonam, good to have you here. You and your team, you watch a bunch of retail names. You do as well, Amazon included on the retail side. Walmart, though, is watched by everyone. And, walk us through the quarter and what's worrying investors.
Yeah, I think it's really the U.S. same-store sales miss. So when you look at that number and you look at why they missed, I think the miss is largely due to the pharmacy deflation issue. And that issue isn't a one-time issue. It's not going away just this quarter. Last quarter, it was a 100 basis point impact to the comp sales. This quarter, it was 125 basis point headwind. So clearly increasing. And the worry is for the next 2 quarters, you'll continue to see that headwind, and if trends continue, it could be even more pronounced. So that's what's causing, I think, investor concern. And the other thing is when you look at the comp, right, the comp that Walmart has, the US comp, if you strip out e-commerce, the comp is negative. So what does that mean for the stores business? I don't think negative is so negative because online is supported by the stores. Walmart's online business wouldn't be growing at a 20% plus clip for the last so many quarters that I can remember if they didn't have the store base. So I think they do go hand in hand in terms of the way they operate.
Okay, but what comes next? I mean, how do they navigate this miss?
So the miss is going to be reflected even in the upcoming quarters, which is why you're seeing investors react the way they are. What they can do is push the pedal on price. If you think about where the consumer sits today and just the desire to stretch that dollar further, Walmart's in a good place to do that. They've got tariff refunds and they can put them back in price, which is the intent. So as they press that pedal harder and drive value to their consumers, they should be able to draw in more spend. And that's really what we're looking for. We're looking to see that traction increase as they continue to bring value into the funnel.
So I know you don't say buy this or sell this stock, but when the stock is down 10% intraday, does it feel like, based on your analysis and looking at the fundamentals here of Walmart, Poonam, that it's an overreaction potentially?
Well, I think it's a temporary overreaction in that it's not driven by the underlying fundamental health of the business, right? So the pharmacy deflation isn't something that's related to execution or a miss from Walmart, or that consumers aren't buying pharmacy there. So that's not the issue. So the underlying health of Walmart, I think, remains very much intact. That said, it's an issue that's not going away either in the back half of the year. So you do have to be mindful of that. And in terms of, where Walmart trades, outside of the buy, hold, sell, when you look at the Walmart multiple, it's clearly at a premium to where it's traded in the past. And part of that premium is deserved because of its increasing online penetration and growth that it's had. And I don't expect that to slow. So when I think of the Walmart business, I think e-commerce, advertising are going to be two big pillars of it that are going to drive exponential growth for the coming years.
We have to ask you about what the earnings results say about the consumer. I mean, you watch Walmart, but you have a really good read on a lot of other retail names out there. What is the takeaway on the state of the consumer from these results?
I think the consumer is stretched. I mean, especially when you look at the low value, the low end consumer, they are trying to maximize every dollar that they have. And that continues as we move into the most important selling season of the year, which is holiday and back to school. So I do think they're making choices. I think they're making trade-offs. I think they're looking at private label. And I don't see that going away, especially in the current environment that we're in, where gas prices are high. But remember, we're going into heating season. Right, in October. So heats are going to start to turn on, electric and utility bills will go higher. So the consumer will only get more and more strapped if we see the continued impact from higher gasoline prices and oil prices.
I always find it interesting, Poonam, when I see the headline from Walmart, they see continued growth from their wealthier consumers. Is that becoming, this came from the CEO, is that increasingly becoming a bigger part of Walmart in terms of driving, or is it still small?
So I think you have to think about, where is that wealthier consumer coming into Walmart from? My impression is that it's not in the stores, it's in the online channel. So it's the Walmart Plus part of the business that is growing at materially higher rates than its store business. So when you think of the mix and where the growth is coming from, I think it naturally makes sense that it would be a more affluent consumer, because that's who's shopping online and paying for that Walmart Plus membership.
All I got to say is, with Walmart shares down, the trading volume, this was a little bit earlier, but it was like 600% of the 20-day average. So we're seeing a lot of activity, certainly in this one. Interesting perspective. Poonam, so appreciate it. And of course, such an important retailer. Yeah, thank you. We really appreciate it. Poonam Goyal, she's Bloomberg Intelligence Senior Analyst for E-commerce and Retail. Yeah?
Yeah, I mean, you gotta think about how the consumer, even if the more luxury consumer is moving down to Walmart, what does that say about the state of the economy?
Like looking, how to find the best opportunities and discounts. You're absolutely right. Hey, stick around, folks. We continue right here on Bloomberg.
It's 2:21 on Wall Street, live from the Bloomberg Interactive Brokers studio. I'm Matt Piper. A rise in oil prices is sending worries about inflation. A drop for Walmart following its latest profit report is helping drag stocks lower. We do check the markets for you all day long here at Bloomberg. Let's get to the big board. The Dow right now is down 605 points. The NASDAQ is down 276. Both of those are down more than 1% at this hour. The S&P is down 52. The Bloomberg Dollar Spot Index sits at 1193. The 2-year yield up 2 basis points. The 10-year is up 5 basis points. So is the 30-year yield, also up 5 basis points. Iran has dismissed President Trump's threats of economic pain and isolation, with its foreign minister saying it will only increase hostility after Trump threatened crushing economic measures against Iran. That has oil rising today. Brent crude, $93 a barrel. WTI, just shy of $88 a barrel. Stocks we are watching: Moderna, mRNA on the Bloomberg terminal. Shares are pulling back following yesterday's 177% rally. That was the biggest in the S&P in the last 25 years. That happened following highly successful phase 3 trial results for its experimental mRNA-based personalized cancer vaccine. Today, though, a different story. Moderna shares are down 40 right now. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash.
All right, Matt, thank you so much. Carol Masser along with Emily Grafeo here on Bloomberg Business Week Daily. Emily in for Tim, who is out this week. Just a few recent housing headlines, right? We had U.S. mortgage rates, Emily, falling for the second straight week to 6.65%. We watched that. We've seen Lowe's cutting its outlook as a soft housing market curbs demand. There's a few others.
U.S. pending home sales sliding to the weakest since the start of the year. And new home applications are below the seasonal trend as pricing stays soft. There's like a lot of dynamics going on with like pricing, affordability,
absolutely,
supply.
It all ties together.
And higher long-term rates and what that means for, where mortgage rates are going.
Exactly. So here to talk about housing, she's got a great, unique perspective. Amy Rubenstein is back with us. She's CEO of the Chicago-based Clear Investment Group. They target real estate investments in the distressed, mid-sized, multifamily sector, mostly in secondary and tertiary markets nationwide. And it's great to have her back here in studio. How are you?
Thank you. It's so good to be back.
It is great to have you back. I said before we got started, I'm eager to hear what you have to say about the macro, because there seem to be snippets where we're wondering.
There's a lot of confusing data, right?
Yes. Yeah. What's your read?
So demand for apartments or for housing has been very, very strong over the last few years. But that's been really masked by the oversupply that we saw over those years. And so that kept rents fairly flat. And while now we started to see something really shift in Q1, Q2 of 2026. And what happened is construction that was at a very high rate at the peak of 2022 was about 60% down over the last year. And so what's happening now is there's less supply coming online. And so that demand is now finally being unveiled. Mm-hmm. So in just Q1 and Q2, we had absorption that was about double of what new supply was. And so what's really interesting about this is the pricing of multifamily hasn't really adjusted yet. It's still really reflecting that 2024 pessimism, when we're starting to see fundamentals that are very strong and indicating that rents will start to rise and that cap rate compression will start to happen.
So from an investor's perspective, you guys are more upbeat about the outlook, except for those who are renting or that becomes a problem.
Right. So
affordability issues.
Apartment renting is far more affordable than buying a house right now. Mm-hmm. Interest rates are still relatively high. And what's crazy is how high construction costs are. They're 40% above where they were pre-pandemic.
Why is that?
Inflation.
It's just inflation.
It is.
Yeah.
And tariffs.
Yeah. All of that is playing into it.
Okay, so you focus on workforce housing.
Correct.
Tell us a little bit about what is that? Who's getting squeezed in that market specifically?
Yeah. So, the tenant base that we're working with, they're not a rent-burdened tenant base right now. So our tenants are making more than 3 times income on the rents that they pay. But what is happening is the supply of what's coming online, even suppressed, is almost no new supply coming in for affordable housing. Mm-hmm. So it does indicate that rents should start to rise. And that is hard for population that could be struggling financially.
It's so interesting. And what I do like about your perspective is coming from the investor perspective, right? In terms of, no, I mean, right? Like that is a big part of our world. But there is a balance of when things get much more, expensive, it squeezes out perhaps a consumer from being able to spend more money. I am curious though, then I guess it's cyclical. And so when prices start to go up, so if you expect prices to go up, good for investors later in the year, will you start to see then another bunch of more supply come on? Would you anticipate? Or is it tariffs and costs are kind of keeping everything in check right now?
We already know what the supply is going to look like through the end of 2026 and through all of 2027 based off of construction starts. It's about 18 to 24 months from when you start construction to delivering that supply online.
Right.
We already know how suppressed it was over the last year. So we are going to have that high demand that's outpacing supply at least for the next year and a half.
Okay, what about bottlenecks to more construction? Like sometimes you look at this environment and you think to yourself, let's just build more, right?
Right.
Is that possible?
Well, this is a problem right now is because costs are so high. So we're buying our properties far below the cost of replacement and we're selling them below the cost of replacement. And so how does new construction compete with that? So it is tough, but there will be a point when supply is going to have to come back.
I have to pull in a question. We've been reaching out to viewers and listeners to kind of bring them into the conversation. And I know this isn't exactly your world, but I want to ask you, Brendan from Maryland has a question. He says it's so hard to buy a house right now, which you confirmed earlier, and we know all too well, but renovations are up. Do you think it's possible that homeowners are undergirding this economy as they're functionally employers to so many small businesses? So carpenters, electricians, plumbers, and so on. After all, one person's spending is another person's income, right? So is this phenomenon shielding us against recession? What could be the flaws in this line of thinking? Now, I know you're from a different perspective, but do you have thoughts on that as you look at the real estate market overall?
As far as people staying put and remodeling?
If you're remodeling and staying put, right, you're certainly employing people. And so does that kind of make it look like there's more strength in the economy than there really is?
Well, we do have a bit of a shortage right now of construction workers in general.
Yeah, you've talked with us about this.
That was a little bit of deportations and some immigration issues. And so, but there is absolutely room to bring in people into that field, and that could boost jobs, sure.
Amy, when you look at geographies, where are you finding the best opportunistic situations?
We love the Midwest. We're all over Ohio, Columbus, Cincinnati, Cleveland. But we're quite opportunistic, so we'll look all over the place. We look for strong, stable metros.
Okay, so speaking of metros, you recently bought a distressed 300-unit property in Washington, D.C.
Yes.
What was attractive about that investment to you?
Yeah, that was a lender-owned deal. It was owned by Fannie Mae, and it was sold at auction, and we bought that deal at around $40,000 a unit in a market that trades closer to $120,000, $140,000 a unit. So it was an incredible buy. And I think, again, those buys are out there right now. There are great distressed things to get a hold of.
So in your business, I'm assuming then, with things like tariffs that make it more expensive, what is top of mind in terms of the risks then out there? For like what you guys are doing. You do have some visibility in terms of the build and then how that comes into the market and pricing, but I'm just curious.
Yeah, I mean, look, we don't know exactly what's going to happen with interest rates right now, right?
Yeah.
I think everyone's quite certain they're not going down anytime soon.
Yeah.
So there's always some sort of economic risk in that. We underwrite for higher interest rates.
How much higher?
So we have been underwriting.
I'm curious.
We have been underwriting flat over the past couple of years because everyone was expecting drops, right?
Yeah.
So now we have to start pricing in. I would price in right now 50 bips, not knowing what's going to happen. But this is really about being very, very discerning as an investor, making sure that you're really underwriting conservative levels because we don't know exactly what's going to happen.
What's a deal that you pass on in this environment?
I think that we're really lucky in an environment like this not to buy something that's overly physically distressed.
Yeah.
That we have the opportunity right now to take advantage of deals that maybe have outsized capital structure, and so they need some right sizing, but no, not fundamentally flawed.
You know, I want to go back to something you had said a little bit earlier, you know, that you're finding opportunities in the Midwest specifically. Tell us a little bit more about that. Like, what is driving that? I guess because we're in New York here.
Yeah.
You know, we forget about the Midwest sometimes.
Well, as did builders for a while. So, you know, you saw a lot of new construction in the Sun Belt and in certain markets that really started to build. And what happened was we weren't building as much in some of these other Midwestern places. And so that is what created some rent growth in those areas because of that demand with the lack of supply. And
People are moving out. Is that what you're seeing?
Well,
moving
right
out
after
of
the
metropolitan
pandemic, we had a lot of people moving south, right?
Yeah.
And moving out of metropolitan areas. And then now we're seeing that start to not necessarily fill in, but the demand is way outsized for the supply.
Since you play into workforce housing, I got to ask you in terms of the AI build, how is that? Is that impacting you guys? Are you thinking about kind of building or not building or acquiring or doing properties around that?
So it is definitely helpful where there are, you know, new data centers being built or new, you know, chip manufacturing plants or commercial growth related to AI. Anywhere around there, they're going to need employment, and so therefore they're going to need housing. So those are interesting things to look for.
Interesting, but you're not necessarily acting on it?
We're not necessarily buying dependent on that. We like to not be overly speculative, so we like to buy on fundamentals that exist
that's interesting,
today.
because you think that's speculative?
Well, it's how long does it take to get up and running, and it's what I mean. Generally speaking, if the project has already started, absolutely, sure, then you know what's going on. But when you're trying to guess where something's going to be built,
and I mean, how long do the people have to live near the data center that are building the data center? Like, is that like a
I think
sticky
that's a
kind
big thing we need to think about.
well, that's also true. That's a really good point, and that is also one of the things driving up the cost of construction too. Now that you bring that
building
up.
out data centers,
exactly, it's taking up the construction workers, right?
So, like, true, right? It's all connected. Favorite market right now, just before we wrap up. Do you have a favorite?
I'm going to stick with Ohio today, but there's a lot. We love DC. You know, we love. We're looking a lot in Indiana, so all over the place.
Well, Tim's calling because he's in Ohio, so he would certainly appreciate that. His wife is from Ohio. Good stuff. Thanks for finding time.
Thanks for
dropping by. Amy Rubenstein, CEO of the Chicago-based Clear Investment Group, joining us here in our studio on a day when we've got markets. Yields are definitely popping up today. 4.69 right now on that 10-year yield. Flip it on over though to equities, and we're down.
Yeah, we are down. The S&P 500 down about 0.7%, and the tech stocks also kind of taking it on the chin here. The NASDAQ 100 down 1%. Small caps also getting crushed. The only risk asset in the green I see is Bitcoin.
I knew you were going to go there. Coinbase is the number one gainer in the S&P in the S&P 500 right now, and I think Strategy was the number one in the NASDAQ 100. So yeah, some outperformance there. Hey, when we come back, how GLP-1s are reshaping so much in America. That's next.
It's 2:40 on Wall Street, live from the Bloomberg Interactive Broker Studio. I'm Matt Piper. Stocks still down at this hour with just over 1 hour left of trading. We do check the markets for you all day long here at Bloomberg. The Dow right now is down 634 points. The S&P is down by 57. The NASDAQ is down 290 points. Both the Dow and NASDAQ both down about 1.1%. The Bloomberg Dollar Spot Index is at 1193. Bitcoin is trading above 70,000 for the first time since June. Right now, it's up about 5% at $72,500. A rise in oil prices erasing some of the relief created yesterday from the Treasury Department. Brent is at just about $94 a barrel. WTI is at $87 a barrel. American consumers have not given up, but they're feeling the pressure. Walmart, which posted its weakest sales growth in more than 6 years today, primarily due to its pharmacy business, says consumer spending remains at consistent levels, even as customers make trade-offs to prioritize value. Target and Home Depot also reported sales gains this week. Let's see how shares are doing right now. Walmart is down 11 points. Target is just about mixed, just up 0.4%. Home Depot is down about 11 at this hour. A Boston area prep school is planning to borrow almost $35 million to upgrade its classroom and athletics facilities. That school, founded in 1866 to prepare boys to attend Harvard, called the Noble and Greenough School, taught the likes of President John F. Kennedy. Renovations will actually cost $70 million. That other half will come from philanthropic gifts, at least they're hoping. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash.
Good stuff, Matt. Thank you so much. Matt Piper, he is in for Charlie Pellet on this Thursday. Hey, Wells Fargo today out publishing its first GLP-1 report.
There's so much money invested in these GLP-1s, so the banks have to get involved somehow.
Well, they do, right? And what's interesting is I feel like the last 3 years it's been AI and GLP-1s, and there's been certainly ups and downs, and the narrative has changed. Specifically, this report, it is their first of its kind from Wells Fargo. It's about how GLP-1s are reshaping America's health, spending habits, and healthcare system, Emily.
I thought this was a very interesting perspective because you hear a lot about how these weight loss drugs are impacting like what people are eating and like snack companies.
Clothes, if they're losing weight.
Exactly. But this is specifically on the healthcare system. So let's get into it. We're joined now by Robin Wenzel, head of Wells Fargo Industry Insights, with us from Minneapolis. Robin, great to see you. Thanks for joining us. Tell us about this report and why now? Why look into this trend right now?
Thanks so much for having me. It's great to be here. You know, one of the reasons why is we have a large healthcare practice, a dedicated team that specializes in it. And we like to make sure we stay ahead of a lot of the topics and conversations that impact those businesses. So for us, looking at GLP-1s, we've all certainly seen a lot of conversation around how it impacts consumer purchasing and grocery store sales. But we really wanted to dig in and understand the implications for the healthcare industry. And many of the things that we found were quite surprising to us.
Like what?
You know, I'll start with bariatric surgeries. If we look at the rate of bariatric surgeries between 2022 and 2024, we saw them decline by over 30%. And that was at a time where we saw GLP usage rise by about 120%. So bariatric surgery has really been a go-to for managing late-stage obesity and helping to bring that weight down. And when we look at the impact of GLP-1s, really a game changer in terms of results and being able to help people get that weight off in a very effective manner. So being able to use that pharmaceutical off-ramp to avoid surgery is certainly a nice outcome for many people. Conversely, though, on the other side, we do see people that were not able to get the bariatric surgery, but the GLP-1s are allowing them to get to a healthier weight that allows that surgery to be possible.
So great for people, right? But, you know, when I think about healthcare, great for people and great and probably extending their lives in so many different ways. But I do think about the impact, too, on like healthcare systems and hospital systems, right? If they're doing less surgeries.
Absolutely. And I think what we have to look at is understand that this is a long-term solution to obesity. So it can take time for these drugs to take effect, to have impact. So certainly a lot of the care that these patients receive will be ongoing. It's going to be a slow off-ramp for them. But it's also nice to be able to have some other solutions and open the doors for others who have been battling obesity and some of the complications with it. I think for hospitals, it's an opportunity to really change the game and maybe the profit centers for helping these patients. So it can become more about outpatient services, medication management, management of side effects, and really you're on these weight loss drugs for life. So the ongoing help and support to patients.
How are the drugs reshaping what pharmaceutical companies choose to pursue and do research on?
You know, that's a great question, and it's an interesting one. We can see that the late-stage pipeline of pharmaceutical R&D is heavily weighted towards GLP-1s, and it's not necessarily just for obesity. We are seeing other opportunities coming out of these drugs and potential opportunities. One is the treatment of substance abuse, specifically alcohol abuse, and so we're seeing some research going into that. We've certainly heard about maybe some positive results around Parkinson's disease and dementia. So I think expanding and understanding these drugs and how they can help with other disorders is really a focus for some of these manufacturers.
Okay, I feel like, Robin, I'm the Debbie Downer here because I'm just going to go there. No, I've kidded with our reporter, Madison Muller, who has covered this space extensively and so smartly, but it does feel like this is the drug that can cure so much that ails us. Having said that, it's also a reminder that having extra weight or being obese is a problem for your health. It's a reality. And I don't want to get into how that can get, people uncomfortable about criticizing that. But it's just a fact of life, right, in terms of your health. But the other thing, what I'm thinking about is how does the emphasis and stress on GLP-1s maybe crowd out R&D spending on other drugs that also need to be discovered?
So they're taking up a bigger share of the late-stage R&D pipeline. That doesn't necessarily mean that they're taking up dollars. So we can see that GLP drugs have outpaced oncology, as a percentage of R&D spend. But that doesn't mean that those dollars towards oncology have diminished. In fact, they haven't. So I think what we're seeing is that we have a very widespread problem, specifically here in the U.S., with 40% of U.S. adults classified as obese. It's a medical diagnosis. And so treatment for this population, as you said, it's all aspects of their health. So there's a cardiovascular element to this too. So it's really not just a weight loss drug, it's a cardiometabolic drug. And so it can be a game changer towards the health and prevention for many, many people, impacting several that can benefit from this drug and enjoy a much healthier life.
I've seen it directly, like impact people, and just they are so much healthier, and it's just their outlook and situation is so much better.
Yeah, I mean, Robin, this is pivoting a little bit, but I do want to ask, what are the investment implications from this report? What do investors need to know?
I think we're looking at a situation where it's heavily weighted towards these drugs. And so any sort of disruption that could happen, supply constraints, those would ripple through and they would have an impact maybe broader than most people would expect. I do think there's a lot of research still to be done. And so the fact that there's money and capital going into it is a good thing. The other good thing is we are seeing the results. And so it is very promising in many areas. I'm encouraged by the investment, but I would just caution that it could have some larger impact should any hiccups happen along the way.
One of the things I wanted to ask you, like orthopedics or something like that, where losing weight or being slimmer can be better on your joints. It's not so much stress and so on and so forth. So maybe there's less demand for surgeries or so on. But at the same time, if GLP-1s, which is a good thing, is enabling folks to live longer and being a drug that's so productive in helping a lot of different things that certainly age an individual, that might orthopedics benefit because we're just around longer and we're going to all need kind of an overhaul.
Yeah, I think it's an excellent point, and I don't think the data has settled on that yet. So, on one hand, one of the side effects of long-term obesity is that wear and tear on the joints. It's the knee replacement, the hip replacements. If we're able to prevent the weight and keep the weight off, that could, in theory, reduce the need for those extra interventions. However, as you point out, you become healthier, you lose weight, you can become more active. We can see a whole new slew of runners out there,
right?
And people embracing, exercise. So it's a mixed bag. And I'll go back to the other opportunity that weight loss presents. Again, people who wouldn't otherwise qualify for the surgery, now it opens the doors for them as well by allowing them to lose weight and get a little healthier.
Yeah, no, I love this. I love this deep dive. Thank you so much. Really, really appreciate it. Robin Wenzel joining